Hi guys, welcome to the CA Inter Income Tax January 26 exams related revision marathon. Wait, do not skip this introduction. Don't scroll forward. Watch this introduction must and should. I will tell you what best you can get out of this marathon. What are all resources that you need to refer along with this marathon. The same resources are available on the YouTube itself. Problem solving is there on the YouTube itself. So that whatever instructions I'm going to give you, if you exactly follow these instructions, I'm telling you, you can get exemption in tax paper. And coming to the income tax part, you can easily attempt 45 to 50 marks of the paper for sure. Minimum 45 to 50 marks of the paper you can easily attempt with 100% confidence. I'm telling you, you can attempt 45 to 50 marks. And also in GST, Mohammed sir will give GST marathon, and that also you watch and come out in the Jan 26 exam with 60 plus marks in tax paper. Now, the first thing, this is a 3/4 strategy related portion marathon. Right now you are seeing, right, almost 12 hours is the video duration. This is a 3/4 strategy portion related marathon, where if you just cover these topics thoroughly, perfectly, commendably, okay, you can easily attempt 45 to 50 marks of the paper. Now, most important instruction. By the way, before I speak about everything else, sir, what is the material that I'm going to use in this marathon? First of all, I'm using a mixed. First I'll be scribbling and then explaining you. And also I will be using my GOAT notes, which is applicable, which is my 2025 edition, which is nothing but applicable for Jan 26 exams as well. No changes at all. Whatever material is there here, as it is applicable. So through this material, you know what the surprising part, this material is just 200 pages. This material is just 200 pages. Okay, now like where you can download this material, and apart from this material, what other things that I need to watch, okay, I will be telling you here. Now, by the way, remember, this is a 3/4 strategy portion. In this entire 12 hours, income tax 3/4 strategy related topics are uploaded. Sir, what is the 3/4 strategy? Just type on YouTube Ram Harsha 3/4 strategy. You will find plenty of videos. Watch the latest video in that. You will understand what exactly 3/4 strategy is all about. Okay, now all the chapters are covered except capital gains and TDS in this particular video. Don't worry, capital gains, TDS, TCS topic is marathon is already uploaded on the YouTube. We will upload once again that. Okay, that's a part 2 marathon. Let us name this as part 1 marathon. All the chapters that are there in 3/4 strategy except capital gains, except TDS, rest all other chapters which constitute the syllabus as per 3/4 strategy is covered in this marathon. And what you need to do, first watch this 12-hour video. Right now this 12-hour video is there, right? First watch this, then solve problems where, don't worry, for CMA students, no, for CMA students writing December 25 exams, we uploaded various problem solving videos, and trust me guys, amazing problems CMA study material has. Amazing problems. Like, there is a playlist here on the YouTube. There is a playlist. Just go to my YouTube channel. Okay, come to the playlist. You will find income tax. You see here, you will find income tax Jan 26 revision CA Inter. Inside this, you see, house property, salaries, resident status, basic concepts, even other chapters problems also will be added in this. Full problem solving, guys. House property 2 hours problem solving, salaries 4 hours problem solving, residential half an hour problem solving, basic concepts half an hour, like that. For other chapters, PGBP, everything also problem solving videos will come, and these problems will give you tremendous clarity on the application of income tax provisions. Now some students, sir, will you add CA study material problems also? Sorry, I'm not adding it. Only for CMA study material related problems I'm adding it, which will be useful for CA students as well. Come on, this is income tax paper. Problem solving is same, right? It's all about application of provision, correct? And so first, so what I'm covering, I told, watch this 12 hours video. Then what you need to do, solve CMA related study material problem solving videos. And after all this is completed, then finally watch capital gains full chapter video. In our exam oriented course, we have covered capital gains chapter somewhere in 9 hours. Within this 9 hours, if you watch this capital gains 9 hours video, Pakka on capital gains, if it is an 8 marks question, 8 out of 8. If it is 6 marks question, 6 out of 6. That is the kind of score that you can get just by watching this full chapter capital gains video. Okay, which is nothing but 1/4 portion. Sir, what about TDS TCS advanced tax? Don't worry, capital gains revision and TDS TCS revision video will once again be uploaded as part 2. This is a part 1 income tax revision. Now, sir, by the way, what about the PDF? This is the PDF that I'm using it. Okay, just 200 pages GOAT notes. I think many students are now aware of what is this GOAT notes is all about. Just open rest of a CMA website. Okay, open books, open CA Inter. You can see, you can come down here, only Jan 26 GOAT notes is there, right? Just 299 rupees, you will get the delivery. Sir, you want PDF? Don't worry, just come to free resources. Okay, go to P3 income tax, you see here, P3 income tax Jan 26 exams. That particular PDF you can download and start using it. That's it, guys. So I spoke about the book, I spoke about the coverage of marathon, I spoke about 3/4 strategy, I spoke about what problem videos that you need to watch, everything clearly. Why late? Continue watching this video, come out and most importantly, like the video and comment below what new points that you're learning. And I'm telling you guys, it's an amazing experience that you get while watching this marathon. Many doubts that you have in income tax will be locked, in the sense will be cleared through this particular revision class itself. Trust me, you're going to learn income tax in the best way possible. Okay, that's it. All the very best. Even GST Mohammed Sir Marathon is also on the way. Don't worry, it will be there. Okay, all the very best. Continue watching basic concepts, residential, salaries, house property, PGBP. Then after I uploaded other sources, then setup and carry forward clubbing provision, then deductions. That's it, I think. Deductions, AMT total income. By the way, one surprise. At the end of this video, last 40 minutes approx, you see, it's an approach, total income solving approach video. That's a total income solving approach video. That you watch it, you will get amazing experience. That's it. Okay, all the very best. So let's begin the income tax marathon or income tax revision. And the first topic that we are going to discuss is basic concepts. But before this, directly first to watch intro video, whatever I mentioned in this video, intro video. So after that, you please continue watching the revision of each and every chapter. Now, so first one, basic concepts. Okay, so what are the topics that are covered in basic concepts? Briefly, they discuss about the concept of what is previous year assessment year. Then they spoke about another concept called cases where incomes chargeable under previous year itself. I'll tell you, I'll revise it. And what is the tax on undisclosed incomes? Then we are also going to discuss in this revision what are the tax rates applicable under optional tax regime, default tax regime, and what are normal income tax rates, special income tax rates. Then we are also discussing surcharge rates. We are discussing marginal relief concept and rebate. And finally, we will conclude this chapter with agriculture income discussion and aggregation of agriculture income for tax computation topic. These are the brief topics that we are going to cover in the marathon. But remember, in the basic concepts, apart from this, there are various other topics also, like definitions were there. What do you mean by SSE? What is assessment year? Like that, some definitions and all were also given. Okay, Finance Act means what, all that. So whatever exam point of view mainly relevant, I am covering. Even other points which I am not covering in this revision, but which are there in our income tax book, they are also equally important. Don't think that they are not important. Everything is important. Okay, but mainly in a revision class, whatever is possible from my end, I am going to cover this now. So basic concepts without any delay. First one, what do you mean by previous year and assessment year? Remember, you people are writing January 26 exam. CA Inter students, you are all writing January 26 exam. If it is CMA students, they are writing December 25 exam. The upcoming exam is Jan 26 or December 25. For you, the Finance Act applicable is Finance Act 2024 number 2. This is the Finance Act applicable. Then next May 26 attempt or June 26 onwards, there is a next Finance Act 2025 is applicable to them. By the way, there is another income tax law has been passed. Every one of you know. Income Tax Act 2025. Income Tax Act 2025 is applicable for May 27, June 27 onwards. CA students May 27 attempt, CMA students June 27 onwards applicable. Right now we are discussing Income Tax Act 1961 amended with Finance Act 2024 number 2. This is the attempt, this is the Finance Act applicable for Jan 26 exams and December 25. Most important thing that you must know. Now, for you, if you see the question paper, problems will be given, right? problems will be given and they'll be asking you compute total income or compute income under PGBP, compute income under salary, so and so, so and so. For which year they will ask? They will ask you by default for previous year 24-25. Nothing but assessment year 25-26. So for Jan 26 exams, December 25 exams of CMA, the previous year applicable is 24-25, assessment year applicable is 25-26. This is the first clarification that you must know. For previous year 24-25, Finance Act number 2 is applicable. So this is what technically Finance Act means. So I mean previous year assessment year. Now you might have seen, some introduction, like what is a Finance Act? What is a Finance Act? Part 1, Finance Act is having 4 parts, correct? Part 1 deals with the current assessment year. Right now I told you what 24-25, assessment year 24-25. Whereas part 2 talks about current previous year 24-25. Again, this is also talks about current financial year, nothing but 24-25. Now, naturally, current year part 3 will become next year Finance Act part 1. Remember, current year part 3 of the Finance Act generally becomes next year part 1 of the Finance Act. This is about Finance Act. So Finance Act will have 4. The 4th part is dealing with rules related to agriculture income. Finance Act will have 4 parts. An MCQ might come. That's the reason I'm covering this. MCQ. Part 1 deals with current assessment year. What is the tax rate applicable? Current assessment year means for you, current assessment year means 24-25 assessment year. Current previous year means 24-25 previous year. Again, 24-25 previous year corresponding assessment year is 25-26. So current previous year or current financial year, when they say Finance Act is applicable for upcoming financial year, current financial year means Finance Act is applicable for which year? 24-25. Current assessment year means what? Regarding last previous year. That's what the meaning. Okay, this is the first thing. Next, so we understood what is the previous year, what is the assessment year. Logic we understood. Now what is the relevance of previous year assessment year? General logic in income tax, which you might have already learned, is income is earned in previous year. On that, assessment of tax will be done in the assessment year. And in the assessment year, assessment of tax will be done and return will be filed in the assessment year. This is what you might have heard, correct? But there are some cases where incomes are chargeable under previous year itself. There are some cases where incomes are chargeable under previous year itself. What are the cases where incomes are chargeable under previous year itself? You can find it here itself. Non-resident shipping business, and persons who established, who incorporated business and closing in the current year itself. Like that, there are some cases which are available. You see here, I think in the same book it will be covered. So just a minute. So there are some cases where incomes are taxable in the same previous year. Incomes are taxable in the same previous year. What are they? Non-resident shipping business. So for non-resident shipping companies, income is taxed immediately to ensure compliance before ship leaves. Okay, see, there are just 2 concepts that I'm covering. Immediately we'll go to tax rates computation, where practical part we will focus on. Next up, now here for non-residents, 7.5% of freight charges for delivery in India is treated as directly income. So ships will collect freight charges, right? That is a turnover. On that, 7.5% is treated as income. Another individuals leaving India. When an individual plans to leave India without intention to return, the income is earned in the same previous year. Yes or no? And AOPs, BOIs, bodies incorporated for special events. Suppose if you incorporate an association or body of individual for special event purpose, then for them income is taxed in the same year in which dissolution happens. Or if at all assessing officer finds that a person may transfer property to avoid taxes, then income from the beginning till the date until which assessing officer thinks that whatever income is there, he will tax in the same year. Discontinued business. When business discontinued operations within the relevant year, the income up to date of closure will be assessed in the same previous year. They don't wait up to assessment year. In the same year, they may ask you to file income tax return. In reality, this is not that practical, but very important for MCQs and theory question probability. In both CA as well as CMA, in both the cases, theory question probability can be expected in a worst chance. Then we have undisclosed source of incomes. Then we have something called undisclosed source of income. Now, previous concept completed. Yes or no? So previous year concept is over. Cases where incomes are chargeable in the same year over. Now tax on undisclosed incomes. What is tax on undisclosed incomes? Undisclosed sources of income. What do you mean by that? Sometimes in books of accounts a credit will appear. Okay, credit, a sum is credited, some amount received is credited. If you don't offer what is the source for this explanation clearly, okay, then that will be treated as income of that year. That will be treated as income of the year. I mean income of that previous year where it was credited, when it was credited. Okay, that's it. So you may credit that in the name of loan or borrowing. You may credit in the name of share capital. The person from whom you received it should explain what is the source. Able to understand. If the sum is credited as a loan, the explanation must be provided by the person in whose name credit is recorded, and it must be satisfactory. Means the lender should give explanation. Suppose if at all the credit is in the name of share capital, for closely held companies this point is more important. For credited amounts, a share application money, share capital, share premium, in whose name it was credited, the explanation must be given by that person. Are you clear? This section does not apply to venture capital funds and companies registered with SEBI. So this is unexplained cash credit. Then we have something called unexplained investments. What is unexplained investments? Suppose in your books you have shown there is a lot of investments. You need to explain details for the source of the investment. So now if SSE makes investments which are not recorded in the books and fails to provide explanation, there are so many investments which are discovered but they were not shown in the books, then the value of those investments may be taxed as deemed income of that financially whenever they were discovered. Or you have investments and assets but you disclosed also in the books but not fully disclosed. Same answer. If at all assessing officer discovers extra investment, extra assets, bullion, gold and all, if you do not give proper explanation, it will be treated as that year income. Next, expenditure. Suppose SSE spent a lot of expenditure, and if what is the source of income for the expenditure if the assessing officer could not show, then whenever you spend that money, that year it is treated as unexplained expenditure, that year is treated as income. These are all black money. This is nothing but we call it as black money. Next, borrowing or repayment on hundi. Hundi means nothing but by cash. Hundi is nothing but called as cash. Okay, amounts borrowed on hundi or amounts due or repaid without account pay check are deemed to be income in which they were borrowed or repaid. If whenever you are borrowing or repaying loans in hundi, means in cash, whenever you borrow, evidence is there, that year it is treated as income. That's it. Over. One of the main segment is over. Main basic concepts, first segment is over. Now the next segment, tax rates. This is the very biggest segment. This is the biggest segment. Okay, now what are the tax rates applicable? Remember, you might have already seen there is something called default tax regime, yes or no, and the other regime is called as optional tax regime. Default tax regime is also called as concessional tax regime. This is also called as concessional tax regime. Why it is called as concessional? Very simple. In default tax regime, the tax rates are lesser. The tax liability that comes by using those tax rates, the liability of tax will be lesser than optional tax regime. Yes or no? That is the reason we call it as concessional tax regime. Okay. Now in exam, the first thing that you should identify when you're doing problem or when you're solving a tax or MCQ is the question asked under default tax regime or optional tax regime. This is the first thing you should identify. Now, so how do you know? I mean, suppose in the question they didn't mention anything. They just gave information and they're asking you compute income, compute tax. You assume by default it is a default tax regime. Default, by default, that regime only applicable. Default tax regime if nothing is mentioned. Or sometimes they specifically mention this word. What words? SSE not exercised. SSE not exercised. Option of shifting out of default tax regime under section 115 BAC. This big sentence they will use. Okay, what they will use? SSE not exercised, option of shifting out of DTR. Did SSE shifted out of DTR? No, not exercised, which means here the SSE is declining income under DTR. Able to understand? Suppose here if the word is not removed, as it is this entire sentence, if you say SSE exercised option of shifting out of DTR, that means optional tax regime. So instead of directly telling SSE not opted 115 BSc, SSE opted 115 BSc, they may use this words also. SSE not exercised the option of shifting out of default tax regime, not exercised the option of shifting out means DTR. See, because by default DTR applicable, you have to exercise shift out. When you exercise shift out, optional tax. If you do not exercise shift out, default tax. So that's why the sentence was drafted like that. By default tax regime applicable. Now, what are the tax rates? What are the tax rates applicable? First, I will discuss optional tax regime rates. Okay, then we will go and discuss default tax regime rates. Now, predominantly at CA Inter and CMA Inter level, most of the questions will be based on individuals taxation. Okay, we have different types of SSEs, persons, yes or no, individual, company, partnership, LLP. There are so many. For us, what is important, individual and partnership form. Partnership form taxation we will focus in PGBP. In PGBP we will focus partnership form taxation. Now, under optional tax regime, let us now discuss individuals related tax rate. What are the tax rates for individuals? Now, by the way, under optional tax regime, individuals are categorized into two parts: resident individual, non-resident individual. Correct? Now, what is the tax rate for non-resident individual? First 2,50,000, correct? First 2,50,000, 0. Then 2,50,000 to 5 lakh, 5%. Then 5 lakh to 10 lakh, 20%. Then amount exceeding 10 lakh, 30%. This is the tax rate. By the way, we call this system as slab system. We call this system as slab system. We will compute the answer. We will take one problem and then do it. Then for resident individuals under optional tax regime, they are divided into three categories. Okay, very senior citizen or super senior citizen. There are two terms which are used interchangeably: very senior citizen, super senior citizen. What are they? Age more than or equal to 80. Even 80 years of age, 8 years is it, they are super senior citizen. Or more than 80 is it, super senior citizen. Or senior citizen. Okay, then more than or equal to 60. Then normal citizen, we can also call them as other individuals, normal citizens. Now, for them also same slab rates will apply almost, but with small modification. For normal citizen, basic exemption is 2.5 lakh. For senior citizen, basic exemption is 3 lakhs. For super senior citizen, the basic exemption is how much ma? 5 lakh. Now, what is the tax rate? For normal citizens, up to 2.5, 0. Then 2.5 lakh to 5 lakh, 5%. Then 5 lakh to, yes, then 5 lakh to 10 lakhs, how much it is? 20%. Beyond 10 lakh, 30%. Now, what about senior citizen? First 3 lakhs, 0. 3 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. Beyond 10 lakh it is 30%. Whereas for super senior citizen, up to first 5 lakh directly 0. 5 to 10 lakh 20. Beyond 10 lakh 30. Correct? These are the normal tax rates for individual. Remember again, tax rates are two types. Tax rates are what? Two types. Tax rates itself is two types. What are the tax rate? Normal rates. What is it called as? Normal rates and special rates of tax. Now, what is the difference between normal rate and special rate? Special rates of tax are income specific tax rate. What are they called as? Income specific tax rate. Normal rates are SSE specific tax rate. What is it called as? SSE specific tax rate. What is SSE specific? Right now I told, right? Up to 2.5 lakh 0, 2.5 lakh to 5 lakh 5%, 5 to 10 20%, above 10 30%. This is based on SSE type. The tax rates, income slabs, all that are based on SSE types. For example, you might have seen companies tax rate is 30%. Partnership firms, LLPs, the tax rate is 30%. Yes or no? Cooperative societies up to 10,000, one tax rate 10,000 to 20,000, more than 20,000. Yes or no? Slab system again. So here, based on the SSE type, if the tax rate is given, those rates are called as normal rates. Now, for every type of SSE, sometimes some special incomes are possible. For special incomes, it depends upon, it doesn't matter which SSE, individual or company or partnership firm or LLP, doesn't matter which SSE. If you have this income, that income is taxable at so and so specific rate. For example, long-term capital gain. Okay, long-term capital gain on 112A assets. For example, what is long-term capital gain on 112A assets? You will understand later in capital gains revision. Okay, 112A assets. Tax rate before 23rd July 2024. Before 23rd July 2024, the tax rate is 10% in excess of 1.25 lakh. The tax rate is 10% in excess of 1.25 lakh. Suppose if the capital gain is on or after 23rd July 2024, then tax rate is 12.5% in excess of 1.25 lakh. Able to understand? Now here there is a confusion among students, sir. 1.25. Old before amendment it is 1 lakh. No. After amendment only 1.25 lakh. No. This 1.25 lakh is basic exemption in long term capital gain, and this 1.25 lakh is full year long term capital gain. Remember this. Sometimes in exam, no, they will give you two long term capital gains. One long term capital gain before 23rd July, another long term capital gain after 23rd July. For example, no, 20th July, SSC got a long term capital gain of 1.1 lakh. And some 28th July, SSC got a long term capital gain of 1.5 lakh. Yes or no? Remember, full year put together, exemption is how much? 1.25 lakh. By the way, this is not exemption from income. It is not exempted income. It is exempted from tax only. At the time of tax computation, it's a slab limit. It's like a slab, basic exemption within the long-term capital gain. Now you can take a beneficial treatment because they said long-term capital gain is taxable beyond 1.25 lakh. Yes or no? Beyond 1.25 lakh in a year. The extra capital gain, if it is before 23rd July, the extra capital gain is taxable at 10% only. If it is after 23rd July, the extra capital gain is taxable at 12.5%. Now I will take a beneficial treatment. I will set off this against here. So balance 25% is taxable at 12.5%. Whereas this entire 1.1 lakh I will pay tax at 10%. Like some students have a doubt, sir, should I adjust in FIFO order or any order? Any order you can adjust. I can use this 1.25 set off for after 23rd July gain, because no, after 23rd July, on or after 23rd July, 12.5% tax rate applicable. If at all that 1.25 benefit I take for on or after 23rd July, I will pay 12.5% on a lower capital gain. Whereas before 23rd July, tax rate is lower, 10% only. So there I will not take this exemption. Are you clear? Remember, this entire 1.25 lakh is for full year all capital gains put together under 112A. It is not separately for this capital gain 1.25 lakhs in limit separately, for 23rd July on or after separate limit. No, it is not a separate limit. 1.25 is full year limit. Are you clear? Whether you got a capital gain before 23rd July or whether you got a capital gain on or after 23rd July, doesn't matter. In the entire capital gain 112A, 1.25 lakh is exempted. Okay, that too, this is not exemption from total income computation. This is exemption at the time of tax computation. Clear? This is 112A rate. Are you clear? Now you see, if you have a 112A capital gain, either the tax rate is 10% or the tax rate is 12.5% for previous year 24-25, depending upon the date of 112A capital gain. Correct? Now there is another capital gain 112, simple long term capital gain. Okay, if it is before 23rd July, the capital gains tax rate is 20%, where you can claim indexation facility. Sir, what is indexation? All that you will get a revision. That will be revised in capital gains topic. Suppose if the capital gain is on or after 23rd July, straight away tax rate is 12.5% without indexation. 12.5 without indexation. But you know, here there is one small exception. Okay, you know, income is to be computed here. For example, suppose if the SSC is an individual and HUF, or suppose if the SSC is individual and HUF, they brought a house property, land, building, or both. Okay, long back before 23rd July, they bought some property long back, but they sold on or after 23rd July. Okay, they sold on or after 23rd July. First, no, it's a long-term capital gain. When you are computing long-term capital gain, no, full value of consideration, sale value minus normal cost of acquisition only you claim. You will get long-term capital gain. You will get some answer. Correct? But you see here, you don't give indexation first. But when you are computing tax on this, you have two options. Option 1, option 2. What is option 1? You compute tax with indexation facility. First gain, compute long-term capital gain with indexation facility. On this gain, 20% tax rate you apply. Suppose you got tax liability of 1 lakh. And already option 2, without indexation, you compute long-term capital gain. You already computed without indexation only. When you are computing total income, you computed always without indexation. Now on that 12.5% tax you compute. Suppose if this comes 1.2 lakh, here whichever is lower, that tax you will pay. This is applicable for which assessees? Individuals and HUFs. That too on which capital asset? If the capital asset is acquired before 23rd July 2024, but it was transferred on or after 23rd July, then only this logic applicable. Are you clear? This is regarding capital gains, okay? And more about this in-depth discussion I already did in capital gain time stop. Below capital gain time stop will be there. You just watch there, okay? That's it. Now you see again. This is another income. 112 income, we call it as 112 income. Means what? 112A is what? You know 112A is listed equity shares, units of equity oriented mutual funds, okay? Then listed equity shares and listed securities, in fact listed securities, equity oriented mutual funds, units of business trust. For these three types of assets, 112A logic apply. Yes or no? Remaining all other long term capital gains, 112 section will apply. Correct? Suppose, sir, I am selling 112A asset only. I am transferring 112A asset only. But that is not long term, sir. It is a short term capital asset. Then what is the tax rate? 111A, what is the tax rate? Very simple. Before 23rd July, what is the tax rate? 15%. What is the tax rate? 15%. On or after 23rd July, the tax rate is 20%. 20%. Now here you see, until now whatever I showed, 112A, 112, 111A, here income is taxable at so and so rate. This is called special rates of tax. What is this called as? Special rates of tax. Whether the long-term capital gain by an individual, it may be by company, it may be by partnership firm, that doesn't matter. These incomes are taxable at that rate only for them. Are you clear? Yes or no? Now we have another capital gain. 115B. 115BB, nothing but winnings from lottery, card games, online games. All these are straight away taxable at flat 30%. They are all straight away taxable at what rate? Flat 30%. Further, I missed one point at the beginning. What is that? Undisclosed incomes. Undisclosed incomes. If at all they are taxable in current year, they are straight away taxable at what rate? 60%. They are straight away taxable at what rate? 60%. Are you clear until now? So undisclosed incomes are taxable at 60. That too, undisclosed incomes discovered, no, you should always separate it from total income. That's a black money taxation. That's a separate taxation. On that, basic tax rate is 60% plus 25% surcharge on 60. Okay, then you will get 60 plus 25%. You will get 75. Are you clear? 60 plus 25%. Yeah, 25 don't add. Okay, 25%. Are you getting it? So 25 surcharge is added on tax. Surcharge is to be added on tax. Okay, it is not 60 plus 25, 85. No. Okay, this is 25%. Then you get 75 plus 4% is equal to 78%. This is percent. On 75, 4%. 3 it will be. Okay, so total 78%. Undisclosed incomes, cash credit, unexplained investments, unexplained bullion, unexplained expenditure, loan repaid on borrowed on hundi, all these are taxable at what rate? 78% net rate. Directly in exam they may ask you. Even in the recent September 25 CA inter exam, this was asked in MCQ. Are you clear? That's it. These are special rates of incomes. Now again go back. Let's go back to normal rates of income discussion. Okay, normal rates means what? Just now we covered one. Normal citizens up to 2.5 lakh, no tax. 2.5 to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. 10 lakh and above, 30%. For a senior citizen, instead of 2.5 lakh, 3 lakh limit will apply. For super senior citizen, up to 5 lakh, no tax. 5 to 10, 20. Beyond 10, 30. Now this kind of classification, normal, senior, super senior, we do only for individuals, and that to residents. For a non-resident, or there is only one slab system. Whether non-resident age is 60 plus above, 80 plus above, doesn't matter. He is only exempted up to first 2.5 lakh. He is not exempted for remaining. Are you clear? Now, when you are computing tax, okay, in exam now they will give you total income information. Tax computation problem, they will give you total income information. Now this total income you should always split. Okay, how many of them are special incomes? How many of them are normal incomes? By the way, total income means what? Total income means what? Total income means gross total income minus deductions under section chapter 6A. Yes or no? Or deductions under 10AA. Then you will get total income. Okay. Now what is 10AA deduction? Deductions under chapter 6A you will understand in deductions chapter. Okay. Below. Next. So you will get total income. Now this total income split into two parts. Normal income, special income. First to know how much is long-term capital gain 112A. Allocate. For example, that amount is coming to, let us assume 2 lakhs. Okay. Then how much is long-term capital gain and 112, just 112. Then allocate here. How much is the allocation? For example, 3 lakhs. Let us assume there is a 3 lakhs. Then 115BB. For example, this is lottery income. This is, let us assume 1 lakh. Okay. This is 1 lakh. Then balancing figure. For example, here total income is 15 lakh. The total income is how much? 15 lakh. Now out of 15, 2 plus 3, 5 plus 6, 6 lakhs gone. Balancing figure is 9 lakh. Are you clear? Only this 9 lakhs is taxable at slab rates. Yes or no? Whereas these are taxable at their respective flat rate. For the convenience purpose, 112A capital gain, we assume that it is on or after 23rd July. We assume that it is on or after 23rd July. So which means the tax rate is 12.5% above 1.25 lakh. Remember. Whereas this is flat 12.5%. Whereas 115BB flat 30%. Now tell me, what is the tax rate? 2 lakhs minus 1 lakh 25 is equal to 75,000. 2 lakhs minus 1 lakh 25. Yes or no? Into 12.5%. 9,375. Yes or no? Then this is 3 lakh into 12.5% is equal to 37,500. Then this is 30,000. Now this is slab rates. Let us assume SSE age. For slab rates, whenever you are computing slab rate, you need to know whether the SSE is a non-resident or resident. Let us assume in this problem SSE is a resident. That too, let us assume SSE is a senior citizen. Okay. Now out of this 9 lakh, first 3 lakhs 0 tax. Then 3 to 5 lakh is equal to 2 lakhs. Correct? Which is taxable at 5% is equal to 10,000. Then above 5 to 10. But 10 we don't have. It is only up to 9. Therefore 4 lakhs is there. In 5 to 10 slab there is only how much income? 4 lakhs. 20% is equal to 80,000. Now how much is the total tax? 90,000 is the tax on slab rates, and this one 37,500, 9,375 plus 30,000 is equal to how much it is? 76,875. Now total put together 90,000 plus 76,875. 1 minute pa. 76,875 plus 90,000. 1,66,875. Now what is this 1,66,000? I will call it as basic tax. See, remember, whenever you're doing tax computation, whether it is in a rough working or in the answer sheet descriptive, always follow one tax computation format which I'm going to tell you now. So first you should compute basic tax like this. Okay. Then immediately what you should add, for the basic tax, you should add surcharge. In the given case, surcharge is not applicable because total income is just 15 lakh. So therefore surcharge is 0. Then what you will get is subtotal, which is again 1,66,875 minus marginal relief or rebate under 87A. Marginal relief or rebate under 87A. In this question nothing is applicable. Again subtotal 1,66,875 plus 4% education cess. So 4% cess if you add 1,73,550. This is called as gross tax liability. From this you should reduce TDS information given, advance tax information given. If you reduce TDS and advance tax from this, then what you will get is called as tax payable. Are you clear? Please be clear with the terms. Tax payable means after TDS, after advance tax. Gross tax liability means before TDS, before advance tax. Are you clear? This format, if you always follow in exam, you will not forget surcharge, you will not forget MR, marginal relief and rebate. Now let us understand what is surcharge, what is marginal relief, rebate. Right now you understood how to compute basic tax, yes or no? Now let us understand how to calculate surcharge, all that. Clear? Now let's go to the book again. So look at this. There is a format which we gave: basic tax. First to compute basic tax, then add surcharge at applicable rates. Then what you get is actually a subtotal. Then you reduce marginal relief. Then what you again get is subtotal. Then add health and education cess. Then what you get is gross total or gross tax liability. Clear? Now don't worry, everything is given in this book clearly. Okay, in the first chapter everything is systematically given. So even, you know, whatever I told, normal tax rates, all that. Here there is one important point, like, now sir, how to calculate whether an SSE is 60 years age or 80 years age, like what exactly? For example, SSE, you know, SSE just now got entered 60 years. Okay, like, should we take when he entered 60 years, should we take when he completes 60 years? What exactly? Tell me, 60 years means what? He completed 60 birthdays. First birthday will celebrate on the day we born, or first year completed. So if at all SSA completed 60th birthday, which means he completed 60 years of age. Now by 31st March of the relevant previous year. By the way, tell me, in our question, in our exams, what is the relevant previous year? Previous year 24-25. So by 31st March 2025, on or before they if, for example, if at all 1st April 2025, 1st April 2025 means next year first day. Suppose if at all on this day they are celebrating 60th birthday, means 60 years over by 31st March. 60th birthday they are celebrating means they are entering into 61. First birthday when you celebrate, do you enter into age 1 or age 2? Age 2 you enter. When you celebrate first birthday, you enter age 2. Same way, 60th birthday celebration means you are entering into 61, which means by 31st March 2025, 60th birthday, 60 years age is completed. For example, if the SSE 60th birthday falls on 1st April, he is 60 years. He is a senior citizen. If the 80th birthday falls on or before 1st April 2025, then for 24-25, he is a super senior citizen. For example, if 60th birthday comes before 31st March itself, he is a senior citizen. If 80th birthday comes on or before 31st March, he is a senior citizen. Even if it falls on 1st April alone, he is also senior or super senior. Correct? That's it. So this is how age has to be calculated. Are you clear? Now let's look at surcharge. Surcharge is nothing but it's a tax on tax. Surcharge is nothing but what? It's a tax on tax. You might have heard this word. Income tax is a progressive taxation. As income increases, tax also increases. Not only in same proportion, the tax will increase in additional proportion. Why? Because surcharge is levied. Okay, now you look at your surcharge. I have given rate of surcharge under default tax regime, rate of surcharge under optional tax regime you have given. Now there are 5 categories of surcharge rate. There are how many categories of surcharge rate? 5. 1, 2, 3, 4, 5. Now these 5 categories are broadly divided into 2 subcategories. These 5 categories are broadly divided into 2 subcategories. What are they? First one, look at the total income you computed. Total income. Remember, total income means only taxable income. Total income is only taxable income. Do not consider agriculture income, because agriculture income is exempted. Look carefully. One important observation. When you are computing basic tax, no, agriculture income will be considered. There is a concept called aggregation concept. Okay, which I will discuss little while later. Aggregation concept, like how to compute basic tax if agriculture income is there. What we will do is, first we compute basic tax including agriculture income. Then step 2, we compute again basic tax on agriculture income plus basic exemption. Then step 3, step 1 minus step 2 is equal to overall tax on normal total income, where agriculture income is once added and then again deleted. Able to understand? Aggregation concept we will discuss later. That's how you compute basic tax first. So at the time of computation of basic tax, you will consider agriculture aggregation concept. If agriculture income is given in the question, that too agriculture income, which agriculture? In India, agriculture income. See, agriculture income outside India is by default taxable. Agriculture income outside India fully taxable. Business income or other sources. Agriculture in India is not taxable, exempted, but for aggregation purpose, tax computation purpose, you will consider and then eliminate. So basic tax computation time, agriculture income will be considered. Then now you need to add surcharge. Now here, when you're adding surcharge, they are saying total income word. Which total income? Including agriculture income, excluding? Excluding. Total income means, remember, by default under income tax, total income means taxable income only. That too, not gross total income. After deductions, after 10AA exemption deduction, then whatever you get is called as total income. Correct? Now, if total income is total income including, if total income including dividend and capital gains, 111A, 112, 112A exceeding, remember, dividend is also covered here. Dividend is taxable at normal rates. Be careful. Whereas capital gains is also given, which are taxable at special rate. And remember, lottery point they didn't consider. But total income including everything, that's what they mean. Including everything. Why I said here including point, I will tell you later. So total income, simple. First take total income. Is it more than 50 lakhs? Is it exceeding 50 lakhs? Yes. Is it more than 1 crore also? No. It is not more than 1 crore. It is up to 1 crore. Then surcharge rate under default tax regime, optional tax regime, both the cases surcharge is 10%. Suppose if total income is more than 1 crore, but not up to 2 crore, total income, dividend, capital gain, doesn't all, total income, that's it. It's just total income. Up to 2 crore, then 15% surcharge rate. Suppose if total income is crossing 2 crore, total income is crossing 2 crore, then do one thing. Split the total income. How should I split? The moment you see in exam, the moment you see total income, 3 crores is given in exam. Total income is 3 crore. Then do one thing, split this. Dividend income, 112 income, 112A income, 111A, 115BB lottery. No, lottery is not to be excluded. Lottery income don't exclude. Okay. Now the law wanted to say on these incomes, the maximum surcharge rate is 15%. On these incomes related tax, dividend income related tax, 112 related tax, 112A related tax, 111A related tax, we do not want to levy surcharge more than 15. That is the reason. Okay. So whereas on remaining incomes, balancing figure, on this you already computed some tax, basic tax is already computed, on that, since total income is crossed 2 crore, 25% surcharge. What is the surcharge rate? 25%. Whereas on dividend income 112, 112A, 111A, maximum surcharge is always 15. Even remember 115B related tax also, what is the rate of surcharge? 25%. Are you clear? Yes or no? Look at, that's why what they say, total income excluding dividend, excluding capital gains. Okay, if at all total income excluding them is crossing 2 crore, excluding that also it is crossing 2 crore, but not more than 5 crore, then rate of surcharge is how much? In both the regimes, 25. Suppose total income excluding dividend itself is crossing 5 crore, then what is the surcharge rate? 25 under default tax, whereas under optional tax 37. In other words, under default tax regime, maximum surcharge rate is 25 in default tax regime. Whereas in optional tax regime, surcharge rate will go up to 37%. Sir, now you might get it out. Sir, total income excluding them 25, 37, right? What about on them? On them also surcharge is applicable, no? On the maximum surcharge rate is 15%. On the maximum surcharge rate is what? 15%. Are you clear? Now, for example, another example. Okay, my total income, some 2.2 crore it came. Okay. Condition, my total income is 2.2 crore. Is it first category? No. Is it second category? More than 1 crore up to 2 crore total income? No, it is 2.2. Third category. Okay, in this 2.2, 40 lakhs dividend, 40 lakhs capital gains, 80 lakhs if I remove. Total income excluding dividend, excluding capital gains is 1.4 crore only. Is 1.4 crore. Third category also not apply. Fourth category also not apply. 1, 2, 3, 4 categories don't apply. Then you are coming under fifth category. Fifth category is what? Final residuary category. Suppose if your total income including dividend capital gains is exceeding 2 crore but not coming under any of these above 4 criteria, then directly surcharge rate is 15 on the entire tax on the total income. Are you clear? That's it. So here, what is the observation? The rate of surcharge shall not exceed 15% in respect of tax computed on dividend capital gains. Yes or no? So on this dividend and capital gains, maximum surcharge rate is what? Either 10 or 15. Either 10%, if at all total income is above 50 and within 1 crore, 10% surcharge rate on all incomes. If total income is crossing 1 crore or up to 2 crore, the maximum tax rate is what? 15%. Then further, all other incomes, remaining incomes like lottery income, any other casual income, and the salaries, every other income, they are taxable surcharge rate of 10 or 15 or 25 or 37, depending upon the 1, 2, 3, 4 scenario, whichever is applicable. Clear? That's it. Now let us calculate surcharge problem. Let us do one problem on surcharge. For example, I think here itself in institute book there are some problems. Okay, I think it's okay, fine, I will directly do it. Okay, now for example, SSC total income is 1 crore 1 lakh. SSC total income is 1 crore 1 lakh. I am computing optional tax regime. SSC total income is how much? 1 crore 1 lakh. Okay, I am computing optional tax regime. Let us assume there are no special incomes right now. We will do one problem with special income, one without special income. Are you clear? Okay, 1 crore 1 lakh, no special income. And this is optional tax regime. SSC is a normal citizen, resident normal citizen. Now, this is first compute basic tax. What is it? Compute basic tax, which is at slab rates, correct? Which is at slab rates. So 1 crore 1 lakh, yes or no? Minus 10 lakhs into 30%. Up to 10 lakh, 1 lakh 12,500. I hope you are able to understand my calculation. Up to 10 lakhs, 1 lakh 12,500 in the normal optional tax regime tax. Beyond 10 lakhs, whatever amount is a 30% flat rate. So basic tax is coming 28 lakh 42,500 plus surcharge. Now case number 1, total income, including dividend, including capital gain, including lottery, whatever, total income more than 50 but not exceeding 1 crore. No, it is not category 1. Category 2, total income is exceeding 1 crore but not exceeding 2. Yes, here total income is coming under category 2. Category 2 means surcharge rate is what? 15%. How much it is? 28 lakh 42,500 is equal to how much it is? 28 42,500 into 15% is equal to 4 lakh 26,375. So subtotal, how much is that? 28 lakh 42,500 minus 4 lakh 26,375 is equal to 24 lakh, sorry, yeah, 28 lakh 42,500 plus 426,375 is equal to 32 lakh 68,875. Now minus marginal relief is applicable here. Check marginal, whether marginal relief is there or not, we should check. Now tell me, 1 crore 1 lakh, just because of this 1 lakh only, tell me, just because of this 1 lakh only, this surcharge is levied. 1 lakh income I got, you levied extra 4.26 lakh surcharge. Not only 4.26, within this 30,000 rupees tax is also there already. On this extra 1 lakh, 30,000 basic tax is there. And 4 lakh 26 surcharge also you levied. With literally 30,000 tax you are collecting on 1 lakh, and because of this 1 lakh, 4 lakh 26,375, you are indirectly asking 5 lakh, sorry, 4 lakh 56,375 rupees. You are asking me just for 1 lakh income. You are asking me 3 lakh 56,375 extra just because of 1 lakh. What SSC will argue? I will do one thing. That 1 lakh income I don't want. That 1 lakh itself I will pay you as a tax. Don't even take it as income. I will pay 1 lakh equal amount to 1 lakh tax. Give me 3 lakh 56,000 relief. Give me 3 lakh 56,000 relief. 3 lakh 56,375 relief. Able to understand how would we calculate it? Now in exam you cannot show like this now. There is a format for relief. So what is a format for relief? I have given here, in your book, printed book, here it is more the 2 more than 1, that word is there. I told you to rectify. I gave a video called rectification of errors. Okay, so here you need to mention 1 more than 2. It's not 2 more than 1. Okay, then relief is equal to 1 minus 2. Very simple. First, step 1, how to calculate relief? We are coming under second category. Step 1, compute tax on total income with 15% surcharge. Just now we computed. Compute tax on total income with 15% surcharge. How much it is? 32 lakh 68,875. Hello. 32 lakh 56,000. 32 lakh 68,875. 68,875. Now I will compute tax on 1 crore. How to compute tax on 1 crore? 90 lakhs into 30%. Okay, plus actually here relief computation we did wrong. Like this you should not do. Like this you should not do, because no, here up to 50 lakhs surcharge is applicable at 10%. Yeah, up to 50 lakhs surcharge is applicable at 10%. That point. See, if at all first slab is 50, directly I can compare. But right now we are in the second slab of surcharge. Here we are computing surcharge for what reason? Array, if at all I have income up to 1 crore, I am liable only for 10% surcharge. I am liable only for 10% surcharge. But because now income crossed extra 1 lakh, now they are asking me to pay 15% surcharge. Correct? Okay, look at the logic here. Look at the logic. Now, tax on 1 crore. For example, no, if at all my income is only 1 crore, if at all my income is only 1 crore, what would be the tax? Array, my basic tax would be 1 crore, 90 lakhs into 30% plus 1,12,500. Yes or no? 28 lakh 12,500 basic tax plus surcharge would be just 10% only, na? Hello? Surcharge is just 20%. 28 lakh 12,500 plus 10% is equal to how much it is? 30 lakh 93,750. So subtotal is 30 lakh 93,750. Now if you see, now if it is 1.01 crore, now both put together they are asking 32 lakh 68,875 they are asking. Now again that logic I am telling. Actually before that I forgot this point, so I am just telling once again. Okay, now look at, if at all 1.01 crore surcharge is levied at 15. Just because of that extra 1 lakh, rate of surcharge increased by 5%. 5% extra surcharge added now. Yes or no? Now look at 32 lakh 68. Now how much extra tax they are asking? 32 68 875 minus 30 93 750 is equal to 1 lakh 75,125. Array, the income difference is just 1 lakh here. Okay, income difference 1 lakh. Okay, on that 1 lakh extra 30,000 tax I am ready to pay. Yes or no? But still you are asking how much extra? 1 lakh 45 125. Too much, no? Yes or no? For extra 1 lakh income you are asking already 30,000 rupees extra tax I am ready to pay. And you are also asking extra surcharge because of that. Okay, so that's how we need to calculate. Okay, that's how we need to. Now for that there is a format given. What is the format given? We'll do one thing. If at all my tax on 1 crore, how much is my tax on 1 crore? 28 lakh 12,500 plus 10% surcharge. On 1 crore, what is tax? 28 lakh 12,500 plus 10% surcharge. How much amount we got? 30 lakh 93,750. 30 lakh 93,750 plus I will pay 1 lakh extra income. No, that income itself I will pay you tax. Don't ask me again tax and surcharge 15%. Don't ask me. I will pay 1 lakh itself. On 1 crore, see, my income is 1.01, 1 crore 1 lakh. That 1 lakh I'll pay tax first. That 1 lakh I'll pay you as a tax. On 1 crore, I will collect a tax as per first category. Yes or no? First category is what? 1 crore. On 1 crore, tax you calculate basic tax plus 10% surcharge is equal to how much? 31 lakh 93,750. Correct? So this is the amount. Even that extra 1 lakh if I sacrifice, my total amount of tax that I pay will become 31 lakh 93, whereas you are asking me 32 lakh 68 875. Correct? Minus how much is this? Minus 31 93 750 is equal to 75,000 125. This is the relief. Now look at the logic here. Is 1 more than 2? Yes, step 1 is more than step 2. Step 2 is what? Extra 1 lakh I have. Because of that you are asking this much tax, which is not fair. I will do one thing. 1 crore I will pay tax as per normal rates, special rates plus surcharge. Okay, 10% plus extra 1 lakh I will sacrifice. So total amount is what? 3193. So I am ready to pay full extra 1 lakh income itself also has a tax. This much I am ready to pay. On the above, it is only 3268 you are asking, whereas I am ready to pay this much. So balance 75,000 I am asking relief. How much is the relief? 75,125. Correct? 75,125. Now what is subtotal again? So 32, 68, 875 minus 75, 125 is equal to 31,93,750. Correct? Plus cess at 4%. This is the gross tax liability. 31,93,750 plus 4% is equal to 33,21,500. That's it. This is how we calculate. Okay. Now remember 50 lakhs example also I will tell you. Suppose SSC total income is 51 lakh. Now here the first logic I told, no, by default that logic I can apply. 51 lakh. First I will compute basic tax. I will compute basic tax. So 41 lakh into 30% and 1,12,500 is equal to, look at 41 lakhs. 41 lakh into 30%, 1,12,500 is equal to how much it is? 13 lakh 42,500. Correct? Plus surcharge. First category, total income is more than 50 lakh but not exceeding 1 crore. Therefore 10% applicable. 1,34,250. Correct? Subtotal. So now tell me. So 1,1342,500 plus 10% is equal to 14,76,750. Correct? Now here my logic. See, if at all I have only 50 lakh income. If at all I have only 50 lakh income. Okay. 50 lakh means what? 13 lakh 12,500 basic tax. Correct? Plus if I have only 50 lakh, surcharge is 0. My again tax liability will be 13 lakh 12,500. Now you see you are asking me to pay extra. How much it is? 14 lakh 76 250. 14 lakh 76 750 minus 13 lakh 12,500. How much extra they are asking me to pay? 1 lakh 64 250. How much extra income first of all I made? 1 lakh. I'll do one thing. This 1 lakh I will add it. And balance 64,250. Don't ask me. Logically correct. This logic is what at first I told. Because but here there is a change of surcharge slab. We did a small mistake there. So again I rectified it immediately. Clear? This is how you should apply the logic. Okay. Now so step 1. Surcharge formula. Step 1. Compute tax on total income. Compute tax on total income including applicable surcharge rate. Correct? Then step 2. Compute tax on 50 lakh plus total income minus 50 lakh. So this much I'm ready to pay plus extra 1 lakh also I'm ready to pay. How much I'm ready to pay? So 14 lakh 12,500 I'll be paying you. Okay. On 50 lakhs I'll pay tax plus surcharge 10%. That extra 1 lakh you take. I don't want. Because of that 1 lakh I have to pay 1.64 lakh tax. So I'll pay that 1 lakh to you, 14 lakh 12. You are asking me 14 lakh 76. I'm ready to pay 14 lakh 12. So balance 64,250 is the relief. Likewise, if at all total income crossed 2 crore but not exceeding 5 crore. Here, if the total income is just 2 crore plus little amount, because of the 2 crore logic, what is happening is surcharge rate is increasing to 25% from 15. It is increasing to 25 from 15. Because of the change in rate, because of the because of this 1 or 2 lakhs extra income, you are liable to pay surcharge so much. Are you clear? So there you will have a relief. Are you able to understand? Okay. Now when you are computing surcharge, tax amount and all, you take only normal income tax. Special income tax you don't have to take when you are computing relief for third step and fourth step. Third category and fourth category of surcharge. Third category is what? Total income excluding dividend, excluding capital gains. If the total income is crossing 2 crore but not exceeding 5 crore, okay, then 25%. If the total income is crossing 5 crore also, then it is 37% optional tax regime, but default tax regime maximum surcharge is 25. This is how you should calculate surcharge and marginal relief. Are you clear? That's it. Next. Now I'm clear with, now you are clear with surcharge and marginal relief. Okay. Now let me compute. Let us compute surcharge calculation. Surcharge calculation if total income includes all this dividend, everything. Okay. Let us assume my total income is 2 crore 50. Let us assume my total income is 2 crore 90 lakhs. Okay. Let us assume my total income is 2 crore 90 lakh. Okay. 2 crore 90. Now when I see the breakup, no, it has dividend income of 20 lakh. Dividend income is 20. 112A income is 20 lakh. Okay. Then 112 long term capital gain, remaining long term, or else let us assume 111A short term capital gain is approximately 30 lakh. How much is the short term capital gain? 30 lakh. Okay, see, I will make this problem complicated so you will understand in exam. Okay, then 115BB lottery, let us assume 10 lakh. Let us assume it is 10 lakh. Okay, now 115BB, let us assume it is 10 lakh. Now what is the balancing figure? 2 crore 10 lakh. Now you see, now if you observe, total income excluding capital gains, no. Total income excluding capital gains and dividend income is 2 crore 20 lakh. Be careful, because 115BB we should not exclude. Are you getting it? Then why I kept separately? Because it is taxable at special rate. That's the reason I kept it here. Able to understand? Now total income, sometimes in exam, no, you might get this 1 crore, 2 crore 5 lakh, or 1 crore 99 lakhs you might get here. For example, immediately some students, what they do, you know, excluding all this less than 2 crore. Therefore, fifth category is applicable. Like that they may conclude. So total income excluding capital gains and dividend only you should exclude, not 115BB. Now put together how much it is? 2.2 crore. Coming under third category. Since it is coming under third category, surcharge rate applicable on this and this is 25%. Whereas on this related tax it is applicable at, it is applicable at what rate? 15%. Now again, here there is a twist. Dividend is taxable at normal rates, remember. Whereas this balance figure is also taxable at normal rates. Okay, now when I'm computing normal rates of tax on these put together, what is the normal income? 2 crore 30 lakh. Total normal income is how much? 2 crore 30 lakh. Correct? Now on this normal income, apply slab rates. Okay, see carefully how I'm computing tax on dividend, because remember, dividend income is liable for surcharge 15. This is liable for surcharge 15. This is liable for surcharge 15, whereas this is liable for surcharge 25. On this tax also liable for surcharge 25. Correct? But dividend income is taxable at normal rates. This is also taxable at what rate? Normal rates. Okay, now look at, so 2 crore 30 lakh. So 2 crore 20 lakhs into 30%, let's 1,12,500. So total basic tax is how much? Oh no, 67 lakhs 12,500. How much is the basic tax? 67 lakh 12,500. Now in this 67 lakh 12,500, how much is belongs to dividend? How much belongs to other incomes? Because no, dividend related basic tax is liable only for 15%. Other income related basic tax is liable for surcharges 25. So step 1 we computed. First step we computed basic tax. Okay, now again, by the way, let us compute tax on this also. 112A 20 lakhs, right? Minus 1,25,000 multiplied by 12.5%. Let us assume it is on or after 23rd July. Let us assume the basic tax is on or after 23rd July. How much is the basic tax on the 2,34,375? Agreed? Now 30 lakh 111A capital gain. This is before 23rd July, I am assuming. This is before 23rd July. By the way, these rates are surcharge rates, not tax rates. Tax rates are, this 112A tax rate is what rate? What is the rate? 12.5%. 12.5%. Or else let us assume this is on or after 23rd July, 20%. This is tax rate is what? 30%. So now look at, so 30 lakh into 20%, 6 lakh. Correct? Then this is 3 lakh. Yes or no? This is 3 lakh. Now look at, now this is 3 lakh. Now apply surcharge. Very clear, 15% per surcharge. This is also 15% per surcharge. This is 25% per surcharge. Yes or no? This is 25% surcharge. So with the surcharge, how much is the tax? 2,34,375 plus 15% is equal to, with the surcharge, how much? 2,69,531. Then 6 lakhs into 15%, 6,90,000. Yes or no? 3,75,000. Correct? 3 lakh plus 25%, 3,75,000. Surcharge correctly calculated. Now on dividend also surcharge is 15%. But the problem is dividend is taxable at normal rate, slab rate. Remaining 2,10,000 also taxable at normal rate, slab rate. Total 2 crore 30 lakh. is taxable at slab rates. On the slab rates tax is how much? 67,12,500. Now tell me, in this, other than dividend income related tax is there? Hello? In the 67,12,000, 2 crore 10 lakhs related tax is there? Hey, what pa? In this 67 lakhs, 2 crore 10 lakhs related tax there or not? Amma, 20 lakhs dividend income tax rate is there or not? Tell me, dividend income on that whatever tax is taxable at what surcharge? 15. Whereas this income related tax is liable for 25. How much is dividend related basic tax? Remaining basic tax how much? How do I know? That's why we have to allocate it. You know, we need to apportion it. Dividend income related tax how much? Remaining tax how much? Remaining tax is liable for what surcharge rate? 25. Whereas dividend related tax is liable for what surcharge rate? 15. Now how will I calculate? You know, very simple. This 67,12,500 into 20 by 230. Can I? What is 20 by 230, sir? Where this number came from, sir? 20 lakh dividend. Okay, 20 lakh is what? Dividend. Yes or no? 20 lakh dividend. 67,12,500 is on normal income of 2 crore 30 tax. 20 lakh dividend related tax how much? Simple costing arithmetics. Okay, now whereas remaining amount how do I calculate? 210 divided by 230 is equal to, how much is that? 67,12,500 into 20 divided by 230 is equal to 5,83,695. Now balancing figure how much? Okay, 67,12,500 minus 5,83,695 is equal to 61,28,805. Why are we splitting like this, sir? Both are normal tax. So no, why are we splitting? Because here surcharge rate is 15, here surcharge rate is 25. For that reason we are splitting. Are you clear? Now 61,28,805 plus 25% is equal to 76,61,006 rupee. Yes or no? 5,83,695 plus 15% is equal to 6,71,249. Yes or no? Now everywhere we computed basic tax plus surcharge, correct? We computed basic tax plus surcharge everywhere, correct? Whatever I ticked, these amounts you add, then you get basic tax plus surcharge balance, subtotal you get, correct? Subtotal you will get. Now tell me, 76,61 lakh 61,006 rupee plus 6,71,249 plus 2,69,531 plus 6,90 plus 3,75 is equal to 96,66,786 minus marginal relief or rebate not applicable in this question. 96,66,786 plus 4% education cess, you will get gross tax liability. Many students have this doubt, like when dividend income is there, how to compute normal tax and how to compute surcharge separately. This is how you should split up and then do. For example, dividend itself is not there, then entire normal rates is taxable. Happily you can go 25, 37 as the case may be. Do you understand? This is the worst possibility. Okay, if at all paper they want to make it tough, this is how they can make it tough. Understood? That's it. So now we understood surcharge concept. We understood if dividend income is there and which is taxable at normal rates, and other normal incomes are also taxable at normal rates, but they are taxable at a higher surcharge rate, whereas dividend taxable at lower surcharge rate. How much is the basic tax component for dividend? How much is the basic tax components for normal income? How to identify that? We understood or not? Proportionate. That's it. This is how you should do proportionate calculation. Are you clear? All of you? Now next, there is one more concept. There is one more concept called unutilized basic exemption limit. There is another concept called unutilized basic exemption limit. This is available only for resident individuals. This is available only for whom? Resident individuals. Clear? Only for a resident it will come. Now what is this unutilized basic exemption limit? Very simple. For example, SSC is a super senior citizen. SSC is who? Super senior citizen. Okay. Now SSC has 1 lakh interest income. How much interest income is there? 1 lakh. Okay. Next, SSE has 112A capital gain 1.5 lakh. 1 lakh 50,000 112A capital gain is there. Then SSE has 112 capital gain. 112 capital gain which is taxable at 20%, that too, because no capital gain he got on 23rd July before. He got this capital gain before 23rd July. This is 1 lakh is there. Okay. SSE has 111A. SSE has 111A income which is again 1 lakh. Which is again 1 lakh. How much you know? This 111A gain is also taxable at 15%. Why 15? Before 23rd July he got. When the capital gain of short-term capital gain he got? Before 23rd July. Okay. Then he has lottery income. How much you know? 50,000 which is taxable at 30%. Now you know we have slab limits, right? Slab limits are there for only normal incomes first. Okay. This SSE is a senior citizen. Slab limit applicable is 5 lakh. After set off, still 4 lakhs worth of his basic exemption limit is unutilized. See, he can avail exemption up to how much? 5 lakhs income. But only 1 lakh is there for him normal income. 4 lakhs is unavailed. Unavailed basic exemption. What the law says, you know? Unavailed basic exemption limit can be set off against 112A gain. This can be set off against 112 gain. This can also be set off against 111A gain. But you cannot set off against 115BB. You cannot. But you can set off against 112A, 112, 111A. You can set off against these three. No problem at all. Okay. Now look at. Now, sir, I have 4 lakhs, sir. So first 112A, 1 lakh 50, I will set off. Don't set off like this directly. Never do that. You can set off, I agree. But when you are setting off, no, set off against that income where high tax is there. First set off with income which is high rate taxable. This is taxable at 12.5% only, pa. This is taxable at just 15 only, pa. Whereas this 4 lakhs you can set off against this particular, you know, 112 income which is taxable at what rate? 20. Therefore, how much is the balance income? 1 lakh I will set off. Correct? So 4 lakhs I will set off with that 1 lakh. So 1 lakh I will set off. Balance 112, 0. Still I have 3 lakhs income. Then I will go with next high rate income. Next high rate income. Next high rate income is what? 15. Okay. So this 1 lakh also I will set off. Okay. Then balance 0. Are you clear? Then you have how much? 2 lakhs. 2 lakhs. Here I will set off with 1 lakh 50,000. Then balance is 0. For example, no. Let us assume here it is only 30,000 left. Let us assume 30,000 only left. Okay, when I am coming to set off here, unavailed exemption limit just 30,000 left. Now I will do 30,000 set off. Now balance income is how much? 1 lakh 20 into what is the rate? 12.5%. Wrong answer. This 1.2 lakh up to first 1.25 lakh is exempted, right? Yes or no? Now 112A capital gain is there. In that 1.25 lakh exemption is there. Unavailed basic exemption is there. First, which should I set off? Unavailed limit you should set off first. Then balance LTCG 112A in excess of 1.25 lakh only taxable at 12.5%. Be careful. That's it. Okay. When you are computing like this with 112A, be careful always. That's it. Now, if you see tax computation, basic tax computation we understood. Surcharge we understood. Marginal relief we understood. Or rebate. Now we need to understand what? Rebate under section 87A. This we need to understand. Okay. We'll just take 5 minutes gap and then continue. Clear? Now let's continue the discussion of rebate provision. By the way, remember, till now I have not yet started default tax revision main provision. Okay, because default tax regime provisions were discussed in each head of income respectively. Okay, so it is not something that we discuss in basic concept at a stretch and then leave it rest of the places. It is to be discussed at heads of income wise, set off and carry forward, deductions chapter, everywhere it has an impact. AMT chapter it has an impact, everywhere it has an impact. Okay, 10-year deduction. So default tax regime concept is something that we need to discuss at every chapter. And even right now when we are discussing surcharge concept, default tax related effect to be covered. Yes or no? Now 87A. Here also default tax related provision effect will come. Now, what is 87A rebate? Under optional tax regime, rebate is available if total income is not exceeding 5 lakh. Remember, under optional tax regime, rebate is available if total income is not exceeding 5 lakhs. That too, maximum rebate how much? 12,500. Whereas under default tax regime, rebate is available if the total income is not exceeding 7 lakh. Maximum rebate is 25,000 rupees. And remember, in both the cases, 112A tax is not eligible for rebate. 112A tax is not eligible for rebate. You know, in May 26 exams, this is January attempt, right? May 26 onwards, Finance Act 25 onwards, special incomes itself is not eligible for rebate. There is a clear amendment which is given now, okay? But anyhow, it's not applicable for Jan exams, don't worry. I'm talking about May 26 exams, okay? That's why I kept clearly this marathon name, Jan 26 or December 25 CMA or CA. That's it, CA Jan 26. This is not applicable for May attempt. Fine, now. So, now this is the maximum rebate. Okay, now again, you see, total income means what? It is including normal income, it is including special income, it is including lottery incomes, all that. Every income is eligible for rebate. Able to understand? Only 112A income is not eligible for rebate. Clear, all of you? Now let us do one small problem. Okay, let us assume I have a total income of 4,90,000 rupees. You know, and this 4,90,000 rupees, if you see the breakup, 90,000 rupees is lottery. 90,000 rupees is lottery. Then we have some, let us assume 1,50,000 rupees 112A income. How much it is? 1,50,000 112A income. Balancing figure, if you see, 4,90,000, 2,50,000. What is the balance income? 2,50,000 balance income. Are you clear? Now let us compute tax on this. This 2,50,000 is taxable at slab rates. Remember, I am computing under optional tax regime. Therefore, 2.5 lakh is the basic exemption. So balance tax is what? 0. Now here, 25,000 only taxable at 12.5%. Able to understand? See, by the way, here the long-term capital gain 112A, I assumed that it is arising on or after 23rd July. That is why 12.5. If at all it is before 23rd July, then it is 10%. Okay. Now, how much is the tax? 3,125. Now, this is taxable at 30% is equal to 27,000. What is the total basic tax? I mean, okay, up to this. Okay, let us be like this. Okay. Now if you see, total income is not exceeding 5 lakh. Condition number 1 satisfied. Rebate can be how much? Up to 12,500 maximum. Now you see, here I didn't claim rebate. Here I cannot claim rebate. Whereas here I can claim 12,500. Now what is the balance tax? 27,000 minus 12,500 plus 3,125 is equal to 17,625 plus 4%. This is the gross tax liability. Understood? 112A tax is not eligible for rebate means here I will not claim rebate. Sometimes no. For example, another example I'll tell you. For example, here lottery tax is only 10,000. Okay. Now rebate can be 10,000. Maximum rebate is how much? 10. Sir, 12.5 can be there. No. What about 2.5? Lapsed. We can't use it. On this we cannot use it at all. That's it. Able to understand. Now let us understand another question. Default tax regime. Let us understand on default tax regime. For example, I have 6,90,000 total income. I have how much income? 6,90,000 total income. Now within this, lottery income is again 90,000. What is the lottery income? 90,000. Now 112A income is, let us assume 1 lakh. 112A income is how much? 1 lakh. Then 111A short-term capital gain income is, let us assume again that is 1 lakh. So total 4,90,000. Balancing figure how much, you know? Sorry, 2,90,000. Balancing figure is 4 lakh. And SSC is a senior citizen. SSC is what? Senior citizen. Under default tax regime, senior citizen, normal citizen, that and all irrelevant. This is taxable at slab rates under default tax. So up to 3 lakh 0, 327 5%, but only 1 lakh is the extra amount. 1 lakh into 5%, 5,000 is the tax. Correct? Now under 112A, what is the tax rate? Let us assume this 112A is before 23rd July, 10% tax rate, but up to 1.25 lakh there is no tax. Therefore tax amount is 0. Whereas triple 1A STCG. Now here date you should see, date of capital gain we assume that before 23rd July. Before 23rd July means 15% is equal to 15,000. Now here it is 30% is equal to 27,000. Now what is the total tax? 47,000 is the basic tax. Maximum rebate is how much? 25,000. Yes or no? Suppose no. Here if at all 112A, if at all any tax is there, this should never be set off with rebate. Okay. Now balance tax is how much? 22,000. 4% you add, gross tax liability will come. Are you clear? Now there is another calculation for rebate. For example, I have 7,05,000 total income. I have 7,05,000 total income. Able to understand? 7,05,000. Now tell me, if at all I have 7 lakh income, I will get 25,000 rupees rebate, right? But because of this 5,000, what is happening? Department is not giving me refund. Sorry, not giving me rebate, extra 5. That's why here marginal relief kind of calculation is applied. Okay, first on 705, what is the tax? Okay, I mean, what is, like you can see here. You can see here. First total income minus 7 lakh. In our example, how much it is? 5,000. What is the tax on total income on 7,05,000? On 7,05,000, apply slab rate. Let us assume here all incomes are normal income, slab income. 3 to up to 3 0. 3 to 4, 4 lakhs into 5%, which is 20,000. Now 5,000 multiplied by 10% is equal to 500. Total how much? 20,500. Remember. So step 2 is what? 20,500. 20,500 minus 5,000 is equal to how much is the rebate? 15,500 is the rebate. Now look at. So what is the basic tax? By the way, for us we are getting 20,500 minus 15,500. So balance tax is 5,000 plus 4%, 5,400. That's it. Indirectly what you know? Indirectly what you know? See, if you declare your income 705, pay 20,500 tax, no rebate. You want rebate? Do one thing. That 5,000 you sacrifice to me. Okay, you pay 5,000 as tax. I will just levy 4% such as 5,400. Done. You don't have to pay everything. Indirectly, marginal relief logic only. So, if at all total income is just in addition to 7 lakhs marginally, how to calculate rebate? First, on total income compute tax 20,500 we got. Plus surcharge not applicable 0. I mean, so again 20,500 minus rebate. Working note 1. 7 lakhs minus 7 lakh 5,000 minus 7 lakh 5,000. You know, income tax on total income step 1 already we computed 20,500. B minus A. Is B more than A? Yes. Array, extra income I got is very less than extra tax I have to pay because of that 5,000. So 15,500 unnecessarily I'm paying. If at all I have to, if I have to save about this 5,000 taxes or no, so I will pay 5,000 itself indirectly. So 15,500 I will ask refund. So indirectly rebate. Indirectly, how much is the balance tax I have to pay? That 5,000, extra 5,000 you sacrifice. Up to 7 lakhs anyhow no tax. That's it. Able to understand? You know, earlier up to 7 lakhs maximum tax liability is 20,000 only. Up to 7 lakhs max tax liability comes how much? Generally at slab rates 20 only. But rebate is given 25,000. Okay, getting the point. There is a slight inconsistency like this because originally when rebate is introduced, up to 6 lakhs only it is there. 3 to 6 lakhs, 5%. Able to understand? So on that logic, this point and all were given. But anyhow, that logic and all you don't have to worry in exam. This is the provision. Clear? With this, rebate discussion is also over. Entire rebate discussion is over. Confident. Now coming to default tax regime, I already told you default tax regime, the tax rates are up to 3 lakh 0, 3 to 7 5%, 7 to 10 10%, 10 to 12 15%, 12 to 15 20%, beyond 15 30%. There is no 25% slab. Now this slab system is also, this slab rates were there, right? In the Finance Act 25 they changed it. 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 above. Like that they changed in the May attempt onwards, May 26 onwards. Now it is for you 0 to 3, 3 to 7, 7 to 10, 10 to 12, 12 to 15, 15 above. Able to understand? That's it. So I'm not going into default tax regime provisions in depth. Clear? Now next directly let us now discuss agriculture income. Let us now discuss agriculture income. So now you see, I'll directly explain it from the book, which is very easy for you to understand. Okay, agriculture income. Yeah, agriculture income. You see in the book very clearly I gave, there are 3 incomes which are treated as agriculture income. 3 incomes you see, totally 3 incomes are treated as agriculture. First one, rental income or revenue received from agricultural land. I am not directly participating, I'm agricultural land, I'm leasing it, I'm getting rent income, provided the land is used for agriculture purpose. If at all the land given by me is for movie shooting purpose, no, that is not agriculture income, that is normal income only we will consider. Now first condition, another condition, land must be situated in India. Land must be situated in India. Are you clear? Now you are getting rent, right? Or you are getting revenue. It may be monetary or it may be agriculture produce itself we are giving. He is whatever agriculture, whatever produce he produced, it is only given by him. So still it is agriculture income. Remember, the rent I am getting is from land which is used for agriculture purpose. Able to understand? Second one, another form of agriculture income is I myself directly involved in activities, agriculture activities. I am growing, produce. I am only doing basic operations or I am also doing subsequent operations or both. Either basic operations are performed by me, subsequent operations. Okay, so cultivation I am doing. Able to understand? So that is agriculture. Now there are so many farmers who do dairy farming. Dairy means what? They rear animals, yes or no, and milk and all they'll be selling. That is not from the land, therefore that is not treated as agriculture income. Dairy, poultry, rearing of livestock, butter, cheese making, they are not considered as agriculture. So in order to be called as agriculture, you must do cultivation. Basic operations must be there or subsequent, whether you do or with your employees you will do, that doesn't matter. Are you getting it? However, there is something called nursery. Nursery means what? Where they sell plants, how they grow, they will not grow them directly in the land. They keep pots, in the pots they will grow. That is deemed to be agriculture income. Even though it is not done on the land, it is still deemed to be agriculture income. That is the main point. Are you clear? Not only that, if somebody else is helping us, like for example, all vegetables and all, they need to cut from trees and all, they need to clean it, they need to grade it to sell it in the market. So this process is incidental to agriculture. Now we pay him some charges for doing all this. Okay, these people, they won't do direct cultivation, they just come and do all this spray services, all that. For them, whatever income that we pay, that is also agriculture income. Next, whatever agriculture produce I made, I'm selling it in the market, I'm getting money, that is also agriculture income. Are you clear? Next, now sometimes what happens is agriculture income I get it. Okay, fine, this process related point I'll come back. Let me discuss about third type of income from farm building. For example, in agriculture land I have a small warehouse also, or house itself. I have a house which is in the agriculture land itself, on the agriculture land. Now for the house, I'm renting it to somebody. From the building also I'm getting rent. That's treated as farm building, and that is also treated as agriculture income. Now there are conditions. The land must be subject to local tax. If at all the land is situated in specified area, urban area. If at all land is situated not in specified area, or the land is situated in an area where population is less than 10,000, then even though there is no local tax, land tax revenue on that, no problem, still that building is eligible for exemption. Are you clear? That is regarding income from farmland. Now that building, when it is treated as agricultural income, when that building is used for the purpose of for the purpose of residence of the cultivator, where it is used for storing agriculture produce, or cultivator is residing in that, then only that is called as farm building. And the land on which the building is standing, if it is situated in urban area, tax must be paid on that, local taxes assessed to land revenue. If it is situated in other than specified area or in an area where population is less than 10,000, no problem. Able to understand? Clear? So farm building, when it is agriculture income, if it is used only for agriculture purpose, it is treated as agriculture income. That's it. Now sometimes what happens is, you will grow and manufacture product. Okay, for example, you are manufacturing sugar cane. Like this in CA Inter in September, in May 25 or Jan 25, mulberry leaf some problem is given. Okay, and in book also, CA Inter book, sugarcane problem is there. Okay, so what happens is, sometimes the farmer produces, for example, sugarcane. Okay, now sugarcane he produced, the cultivation cost is, let us assume 5 lakhs. The cultivation cost is, let us assume 5 lakh, 5 tons of sugarcane he produced, let us assume. Okay, now out of this 5 tons, by the way, those CA students who are watching classes, this particular revision, I am already solving CMA inter study material problems. There are so many problems we are solving, more than 100 problems we are solving, which you can also use, no problem. It will be like a practice. After watching this marathon, you can watch those problems also. CMA into December 25, ICMA study material problems fully we are solving and putting on the YouTube. So I'm just telling. Now 5 tons, you know what, this is the cultivation cost. You know what he did? 4 tons he sold in the open market. He sold in the open market for 10 lakh rupee. 4 tons, how much he sold for? 10 lakh rupee. Now tell me, per ton market value is how much? 2 lakh 50 indirectly, correct? Can I say like that from this point? Yes. Now 10 lakhs rupees I sold, 4 tons only I sold. By the way, 4 tons cost of production is what? 4 lakh rupee, correct? Yes or no? Now 10 lakh rupee worth of agriculture produce I sold, where I produced them using 4 lakhs cost. This is called agriculture income. What is agriculture income? 6 lakh, okay, from sale of produce. But 1 ton, no, I used it for further processing and manufactured sugar. Okay, 1 ton I use it for further processing, manufacturing sugar. You know, for 1 ton I incurred 1 lakh rupee further processing cost, and now I manufactured sugar. Okay, now you know what is sugar is sold. Sugar, no, ultimately I sold it for 10 lakh rupee. That 1 ton sugar I sold for how much price? 10 lakh rupee. Now what is the profit from sugar in PGBP? Because sugar is not an agricultural produce. So business profit is equal to sale value how much? 10 lakh minus sugar production cost how much? 1 lakh. And remember one more thing, I have used sugar cane as raw material here. If at all I didn't use this, another 2.5 lakh amount I would have got in market value. That entire 2.5 lakh would have been agriculture income, correct? Now the 2.5 lakh I will treat it as cost of raw material. What is cost of raw material? Sir, actually 1 ton sugar cane 1 lakh only, no, here. Proportionate conversion cost, cultivation cost is 1 lakh only, no. When I'm computing business income, accounting standard principle, if you are captively consuming your own material, market value will be taken as sale value in agriculture. Okay, market value is taken as purchase cost. Now what is the sugar related profit? Sugar related profit, 10 minus 1, 9, 9 minus 2.5, 6 lakh 50,000. This is business profit. And this 2.5 lakh worth of agriculture income, you should recognize an agriculture activity also. 2 lakh 50,000 you didn't sell, but you are using it for your own production. Minus 1 lakh is the cost of cultivation for that. Net agriculture income is 1 lakh 50 related to captive consumption. This is agriculture income. Now total agriculture income 7.5 lakh. Remember. Now how to compute tax on this? Let us go proceed. Aggregation concept I'm telling you. Now if you see, business profit is how much? 6 lakh 50. Agriculture income is how much? 7 lakh 50. Total income how much? 6 lakh 50 only. SSC total income is 650 only. Yes or no? Agriculture income is exempted. 10 subsection 1 agriculture income is exempted. Now while computing tax, aggregation concept will apply. Aggregation concept will apply. If at all SSC has a total income and agriculture income which is exempt from tax, then basic tax has to be computed in the following 3 steps. Step number 1. Generally, basic tax means what? 6 lakh 50 into slab rates. If it is default tax regime rates apply. If it is optional tax regime, optional tax. I will assume that it is optional tax regime. So normal citizen, okay, 1 lakh 50 into 20%, and up to that 12,500 is equal to 12,000. 1 lakh 50 into 20 and 12,500 is equal to, generally if at all aggregation concept do not apply, what is the basic tax? 42,500. But now I need to apply aggregation concept because SSC has non-agriculture income and agriculture income. So I will apply aggregation concept. Step number 1, tax on, first basic tax on agriculture income plus total income is equal to 7 lakh 50 plus 6 lakh 50, 14 lakh. On this you apply slab rate. 4 lakhs into 30%, 1 lakh 12,500 is equal to 2 lakh 32,500. Correct? 2 lakh 32,500. Now step 2, basic tax on agriculture income plus basic exemption limit. Agriculture income is what? 7 lakh 50,000. SSC basic exemption limit 2.5 is equal to 10 lakhs. On 10 lakhs tax how much? 1 lakh 12,500. Now what is the basic tax? Step 1 minus step 2. 2 lakh 32,500 minus 1 lakh 2,500 is equal to 1 lakh 20,000 is the basic tax. You see, actually if I directly compute basic tax is 42.5, but if I apply through aggregation concept and compute basic tax 120, which basic tax I should take? 120. Basic tax is equal to 1,20,000. Now immediately you might get a doubt, sir, agriculture income is exempt, but see, because of, see, department logic is what? Agriculture income adding. You see what department logic, what you know, agriculture income adding and you compute a tax. Again I'm adding and you're reducing also, no? So agriculture income knocked off, no? What am I collecting tax from you indirectly? They will argue this. But we know how much extra we are paying. If I directly compute 40 to 500 only, but if I compute like this 1,20,000, indirectly on agriculture income paying extra tax, yes or no? For the department reply is what, you know, I will give exemption on agriculture income absolutely, if at all that is the only income you have. You are having non-agriculture income, agriculture income. For you that logic is not applicable. Constitution says on agriculture you cannot levy tax. Entry number 82, tax on income other than agriculture. Constitutionally I am complying. I know the intention of the constitution is those who are earning whole income from agriculture activities only, for them I will give benefit always. Those who are having other incomes, I will not benefit absolutely. Okay, relatively indirectly I will collect tax like this. This is the department logic. This is aggregation concept. Are you clear? Now basic tax. Now calculate surcharge. Now on this you apply surcharge. For surcharge applicability, total income 50 lakhs or more, 1 crore or more, you will see, right? Which total income? Only taxable income you should see. Only taxable income you should see. That's it. This is aggregation concept. Are you clear? So we understood now what constitutes agriculture income. We also understood the aggregation concept. So now we will understand rule number 7A, 7B, rule number 8. Okay. Rule number 7, rule number 7A, 7B. No. Rule number 7A, 7B, 8. Okay. 7A. Now look at. Now here there are some activities which are called as composite activities. Which are composite. For example, no, sale of rubber plants products derived from rubber plants grown by seller. You see, you're only growing it. You're not just manufacturing. You're growing it. You're growing and then selling it. Then out of the total sale proceeds minus cultivation cost minus other cost, you get net income, right? That net income, 35% is taxable as business income, 65% is treated as agriculture income. 7B, suppose you are growing coffee and curing it and then selling it directly. You are not roasting, you are not grounding, you are not doing any further process, only curing. Just 25% is business, 75% is agriculture. Suppose you are doing more commercial activity, business income is 40 and agriculture income 60. Suppose if you are growing and manufacturing tea, 60 agriculture, 40 business income. Suppose you are only manufacturing tea by producing agriculture, tea leaves you are procuring and manufacturing tea, entire profit is business profit. Able to understand? Yes or no? This is composite income. Now for example, no, SSC is growing and manufacturing tea. They gave 10 lakhs income. 4 lakhs is what? Agriculture income. 4 lakhs is business income. Agriculture income is what? 6 lakhs. Now they will ask you, compute tax liability. What many students will do, you know, 6 lakhs exempted, on 4 lakhs they'll compute tax and proceed. Non-agriculture, agriculture, both are there, which means aggregation concept apply. Basic tax you should compute by using aggregation concept. Be careful. Okay, even in this method also it is applicable. Even that method also it is applicable. Clear? That's it. Agriculture income discussion is over. Major discussion is over. That's it. With this basic concepts, I think all the points we have covered. Tax rates we covered individual, surcharge rates we covered individual, default tax rates we covered, and unutilized basic exemption limit we covered, special rates of tax we covered, agriculture income we covered, rebate we covered. What else we covered? We covered previous year assessment year means what? We covered what are the incomes that are taxable in the same previous year we covered. Then we also covered undisclosed sources of income. Major 78% it is taxable. Major basic tax provisions we covered except some theoretical portion. Easy. Then company's tax rate how much, partnership firm tax rate how much, that is not relevant for you. Okay, not that important, don't worry. If you have time only read that, but this is primarily important. That's it. Now I think you'll be able to compute surcharge, margin relief, rebate, everything, tax computation, everything. That's it. Okay, with this basic tax is over, then we'll begin residential status. Now one important alert. So CA inter students and CMA inter students, whoever is watching this marathon. Now after discussing basic tax, you know, there is a CMA inter problem solving videos are there. Problem solving marathon is there. All the chapters of CMA inter study material problems we solved. CA students also can watch those problems to get understand of application of these provisions. Okay, that's it. And also CA inter students, what I will tell you is, I have uploaded May 25 RTPs, MTPs. I have uploaded September 25 MTP, RTP videos. Now Jan 26 also MTPs, RTPs are going to come. Literally, you know, 3 attempts, 2 MTPs. See, means 6 papers and 3 RTPs, total 9 papers. Okay, and if possible, I will also do last May 25th, September 25th paper also 2. Total 11 papers approximately. Solving will be done on the YouTube. Okay, I already uploaded. I will just merge and then upload. Pending recordings, if it all that also I'll do and then upload. You watch that for practice purpose. First, you need to first finish marathon, understand the application of provision, then go and watch those videos, which will be sufficient. Clear? I think all the points we covered. We didn't ignore any point. That's it. Yes, now let's discuss the revision of residential status. Okay. Now, by the way, in the residential status, we are going to discuss about section 5 to section 9. Basically, there is a section called section number 9. We never discussed this. Okay. So, and nobody knows what is section 8. Actually, section 8 is nothing but dividend section. Section 8 talks about dividend. What this section says, you know, under section 2, subsection 22, any dividend declared. 222, A, B, C, D, E, 5 clauses we have. There is some that you will understand in other sources. Okay. So, whatever dividend declared is taxable in the year in which it is declared. And it has another subsection. 8 itself has another subsection which also says that interim dividend is taxable in the year in which it is made available. So technically this section is something that is not dealing with residential status, whereas remaining 4 sections are dealing with residential status. Section number 1, by the way, income tax law section number 1, what is the title of this act? 2 talks about definitions, 3 talks about previous year definition, 4 is charging section. Okay, whereas now 5 talks about scope of total income, 6 actually talks about residential status of various SSCs, residential status of various SSCs, 7 talks about what do you mean by deemed to be received, what do you mean by deemed to be received in India. Okay, and section 9 talks about what do you mean by deemed to accrue or arise in India, deemed to accrue or arise in India. So these are the sections that we have in our syllabus. Okay, now let us discuss one by one. Before I actually discuss about residential status of any SSC, first let us discuss why this residential status is important. Okay, now so section 5, what is the section 5 talks about? Scope of total income. In any country, you see, income is taxable. In any country you take, there are 2 principles based upon which income is taxed. One is source principle, another one is called as receipt principle. Okay, what source principle says? What source principle says? If income accrued or deemed to accrue in India, if income is accrued or deemed to accrued in India, it is taxable for everybody. Able to understand? It is taxable. Now, you know, actually, before I even discuss this, basically a person from income tax point of view is categorized into 2 categories. A person is divided into 2 categories. One we call them as resident, and another one is called as non-resident. Again, these residents are again broadly classified into 2 more subtypes. Okay, this subtypes is applicable for individual and HUF. Okay, this subtype is not applicable for other SSCs. Generally, for all SSCs, the SSCs are either resident or non-resident. That's it. A company can be either resident or non-resident. A partnership firm can be resident or non-resident. Society, a resident or non-resident. Able to understand? Whereas individuals and HUF, there are 2 more possibilities: resident and ordinarily resident, resident not ordinarily resident. Okay, resident and ordinarily resident, resident not ordinarily resident. And third category in case of individual is non-resident. Now, what do you mean by resident and ordinarily resident? What do you mean by resident not ordinarily resident? And what do you mean by non-resident? You know, in a simplest way, I'll tell you, resident and ordinary resident means what? Resident means current year is resident. Whatever the year we are checking is a resident. Even in the past also is resident. In the past also is resident. We will call him as he is resident and also ordinarily resident. Resident but not ordinary resident. What do you mean by that? He is resident in current year but not resident in previous years. Non-resident, he is not a resident at all in current year. Now, when a person becomes ordinary resident, when a person becomes not ordinary resident, and when a person becomes a non-resident, we will discuss a little while later under section 6. Now, why we need to discuss this kind of classification? Remember, Now, which means ultimately there are three categories: resident, ordinary resident, resident but not ordinary resident, and non-resident. Why we need to discuss these three kinds of classification? Why bifurcation is required? And by the way, remember, this middle category is applicable only for individual and HUF. Middle category is applicable only for individual and HUF, whereas first category is applicable for all SSEs. Last category is applicable for all SSEs. Correct? All SSEs means what again? Individual, HUF and others also. Last category, others, individual and HUF and others also. Whereas middle category is applicable only for individuals and HUF. Now, what is the under income tax law? What is the taxation principle? Which incomes are taxable for them? See, a person may be getting income from India, or a person can be getting income outside India. Able to understand? Now again, residential status is something different from citizenship. You may not be Indian citizen, but you are settled in India and earning income in India. Possibility? Yes or no? Or you may be an Indian citizen but settled outside India. For example, Priyanka Chopra, Indian citizen and settled outside India. Able to understand? Or there can be some actors who are there who are actually born and brought up outside and were settled in India. For example, Deepika Padukone, she is actually a foreign country citizen but settled in India. Able to understand? Fine. Anyhow, so citizenship is by birth. Citizenship comes of any country by birth in that country. Residential status is every year varying. Your residential status can be varying every year. Okay, so in India, under income tax law, you may be resident in 1 year, you may be a non-resident in another year. So we don't know. Able to understand? Whereas citizenship is always constant. Generally, citizenship is always constant. You can get citizenship by birth in a country. In some countries, you can also become a citizen of that country by some specific procedure also. Okay, fine. Now. So which means a person can have incomes across India as well as outside India. Now, which incomes are liable to pay tax? Which incomes are liable for income tax in India? This is the question. Now, first one, receipt principle. What is this? First one, receipt principle. What do you mean by receipt principle? Income received or deemed to be received in India. Okay, received in India. Or else I will just write like this: income received in India. Whenever I say received, it includes deemed to be received in India. If at all it is received in India, whether you are a resident Indian, whether you are a non-resident, Indian citizen, foreign citizen, I don't look at all that. You are receiving that income in India. In all the cases, it is taxable. Are you clear? Suppose no, received is not in India. Suppose you didn't receive the income in India. Then I will see where is the source of income. Then I will see what? Where is the source of income? What do you mean by source of income? Where income is accrued or deemed to accrue. Where the income is accrued or deemed to accrue. If accrual is in India, then also in all the cases it is taxable. In all the cases it is taxable. Suppose no. Indirectly, from these 2 points, you can conclude one thing. If receipt is not in India and if source is not in India, it is not taxable. That's what we can conclude based on these 2 principles. But there is a third principle and fourth principle also there. Okay, what is this? Suppose no, income received outside India, and source is also outside India. Receipt is outside, source is outside. See, remember, source means accrual. Source means accrual or deemed to be accrue. Accrue or deemed to be accrue. Both called as source. Source is outside. Receipt is also outside. Now, what about that? First, I will see. Suppose both are outside. Then I will see one question. Okay. Is it from business or profession controlled? Is it business or profession controlled or set up from India? I will see this. If business or profession is controlled or set up from India, I will see. Second principle, other sources. Second principle is any other source. Other sources means any other source. Are you clear? Now, first I will talk about any other source. Okay, any other source. Now, one more thing I wanted to highlight. For resident and ordinary resident, global income is taxable in India. Remember, for resident and ordinary resident, what is taxable? Global. Therefore, whether source is outside or inside or doesn't matter, any other source doesn't matter, global income is taxable. Yes or no? Now, for a non-resident, no. I'm talking about the third column. For a non-resident, no. Income is taxable only in two cases. Receipt must be in India or source must be in India. If both are outside, not at all taxable. So, not taxable, not taxable. I will put it in red color. What is it? Non-taxable, non-taxable. Even for RNOR. Even for RNOR. An income is taxable only if receipt in India, taxable. Or source is in India, taxable. If both are outside, not taxable. If both are outside, not taxable. The answer is what? Not taxable. Now, both of outside also, not taxable. Wrong. Okay. Suppose here alone one small exception is there, taxable. Okay. Now, if at all, business or profession is outside, business is outside, profession is also outside only. Okay. You received also outside only, but that business you are controlling from India, that profession you are set up from India. For example, you are a CN office, you opened a CA office in India. You opened another branch office outside India. That's a profession set up outside India from India. That's a profession set up outside from India. Outside India from India. That has a professional identity from India. That's called profession set up from India. Okay. Or if a decision related to business outside India is taken in India, then that's a business, even though business is outside, even though receipt is outside, that's a business controlled from India. In case of business or profession controlled from India, for all types of residents, it is taxable. For non-resident, it is not taxable. Remember, for non-resident, simple rule. Source is in India, taxable. Receipt in India, taxable. Both are outside, not at all taxable. Sir, it's a business controlled from India, profession set up in India, doesn't matter, not taxable. Clear? Any other source, same logic. Not at all taxable. So, from this entire table, I can derive one thing. For a resident and ordinary resident, for a resident and ordinarily resident, global income is taxable. For resident but not ordinary resident and non-resident, for a resident but not ordinary and non-resident, incomes are taxable when source is in India. Incomes are taxable only when receipt is in India. Correct? When source is in India taxable, receipt in India taxable. If both are outside, not at all taxable. However, one small exception. For RNOR, if at all business is outside or profession is outside, receipt is also outside. But if it is from control from India or if it is set up from India, again it is taxable. That's it. The same thing is what we have even given in our book. The same thing is what we have given in our book also. What is it? 30. Yes, you can see here. There is a page number 30 in our book. Come back to the page number 30. You see here. Okay. Now here I have given conclusion, summary. Entire summary I have given. What is the summary? For an ROR, global income is taxable. Whereas for RNOR and NR, generally taxable only if either source or receipt is in India. Further, for RNOR, even if source and receipt are outside, but it is from business controlled from or set up from India, is taxable. Business controlled from or profession set up from. You can write the word profession there. Able to understand. So this is the table which I discussed right now. Clear? Now on this there is a problem. Okay, you can do a problems which are there in our question bank also. Just apply this blind logic. Sometimes in exam, no, they will give you in exam. For example, they'll give you an exam. Broad observations I'm telling you. Okay, foreign company dividend declared. Foreign company dividend accrual is outside. But if at all 50% of the dividend is directly received in India, 50% of the dividend is received in India, then 50% only taxable for RNOR and NR. Okay, whereas for ROR 100% taxable. Correct? Because for ROR, source doesn't matter, receipt doesn't matter, global income is taxable by default. I'm talking about by default. See, again here, sir, how come global income is taxable? In other country also, that income can be taxed in other country also. He has to pay double time tax. There are double taxation avoidance agreements that are there. You will understand it in CMA final. You will understand it in CA final. Okay, in CA final, you have double taxation related topics. Basic rules I'm talking here. Okay, next. Another one. Dividend from Indian company. You know what? 50% only received in India. How much it is? 50% only received in India. But you see, receipt may be 50% in India, but source is India. For everybody, 100% taxable. For everybody, 100% taxable. For everybody, 100%. So in exam, they'll give you, this is 10,000. Okay, how much you will write? For ROR, how much you will write here? 10,000 you will write. For RNOR, 5,000. For NR, 5,000. Indian company, 20,000. Okay, In all the cases 20K, 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 correct? Third kind of adjustment. There is a business. Okay, some business is there which is outside India or profession outside India. Received is also outside only. Received is also outside only, but it is controlled from India. Profession is set up from India or business is controlled from India, and this amount they gave, let us assume 1 lakh. They gave 1 lakh. Remember, entire source outside, receipt is also outside, but it is only controlled from India. For non-resident, it is zero taxable. For R and OR, entire 1 lakh taxable. For resident also ROR, entire 1 lakh is taxable. Are you clear? Suppose in the problem, out of 1 lakh, 20,000 is only received in India. 20,000 received. Then for non-resident also, the answer will be 20. That's it. Broadly, these adjustments only will be there. Okay, they will give you source. They will give you how much is received also. If source is in India, how much received in India doesn't matter. If source is outside India, how much is received in India does matter. Important. If both are outside, check whether it is from business or profession, controlled or set up from India. If that is the case, R and OR 100% taxable. Otherwise, for non-resident, it is not taxable. Easy. With this, section 5 is completed. Okay. Now this is the very reason why I have to know how much income, what income is taxable. If I have to know this, I must know scope of total income, section 5 concept. Only if I know section 5 concept, then there is a point in learning section number 6. Now let us understand section number 6. Residential status of various SSCs. Residential status of various SSCs. Now you see in that, the first one is residential status of individuals. The first one is what? Residential status of individual. But before I discuss individuals, before I discuss residential status of individual, first let me discuss about other SSCs. Now, what is the residential status of company? What is residential status of a company? How to decide whether a company is a resident or not? Check out, is it Indian company? Is it Indian company? Yes sir, Indian company sir. It's registered in Companies Act sir. Then that's an Indian company. Always a resident. Indian company is always resident. Sir, it's not Indian company sir. Some other company sir. It's not Indian company. It is not registered in the Companies Act sir. It's a foreign company sir. What about this? Is it a resident or not? A foreign company can become a resident if poem in India. If poem in India, then it's a resident. If poem is outside India, then it's a non-resident. That's it. If poem is in India, it's a resident. If poem is outside India, it's a non-resident. Sir, what is poem, sir? Place of effective management. POEM. Place of effective management. If place of effective management is in India, then it's a then it's a resident. If place of effective management is outside India, then it's a non-resident. This poem principle has to be seen for which company? Only for other than Indian companies. For Indian company, poem and all I don't bother. Even though it's an Indian company, all board meetings are happening outside India. Doesn't matter. It's an Indian company registered under Companies Act. Always it's a resident. That's it. This is residential status for companies. Then what is the residential status of LLP, partnership firm, society, AOP, BOI, local authority? In all these cases, what is the residential status? Very simple. Very simple. One criteria. There is a criteria called control and management. There is a criteria called control and management for all SSCs. Remember, I am not yet talking about LLP. I am not yet talking about individual. Whereas I just now spoke about a company. And just now spoke about LLP, firm, society, local authority, every other else. Just that individual is kept pending, HUF is kept pending. Rest all other I discussed. Correct? Now look at control and management. Where is it? If it is partly or wholly means even part of control and management is in India, full of control and management in India, then it's a resident. It's a resident. Sir, control and management is fully outside India. Fully outside India. Then the firm, LLP, society, local authority, they become by default non-resident. Simple. Sir, AOP, BOI, sir. Sir, this is an SSC. There is an SSC, sir. Not individual, not HUF, sir. Not a company also. How to decide residential status? Control and management where? Partly in India at least. Fully in India, lucky. Partly in India, resident. 100% outside India, then only it's a non-resident. 100% of control and management outside it, then it's a non-resident. That's it. Now let us discuss about residential status of individual. This is most important. Okay, residential status of individual. Residential status of individual. Okay, individual. Residential status of individual. And remember, I told you for individuals and HUF, residential status can be three types: ROR, RNOR, NR. Okay, now you know, an individual, basically how the structure I will tell you. Okay, for an individual and HUF, no, first we should decide are they resident or non-resident by default. First we should decide are they resident or non-resident. Okay, this we call it as basic residential status. First I call it as what? Basic residential status. Suppose if they're non-resident, no more confusion, non-resident, over. Suppose an individual or HUF became a resident. Suppose an individual or HUF became a resident, then I should decide are they ordinary resident, not ordinary resident. Are they ordinary resident, not ordinary resident? First I should decide whether an individual HUF or resident or not. Okay, in the test, no, in the testing process, no, either they become a resident or they become a non-resident. If they become a non-resident, no more questions, they're non-residents. If they become a resident in our first testing method, if they become a resident, then I should go for further testing. Then I will decide whether they are ordinarily resident or not ordinarily resident. Why should I decide like between these two, sir? Because for ordinary resident, global income is taxable. For not ordinary resident, received in India, accrued in India only taxable. Or business or profession controlled from India only taxable. Correct? Business or profession controlled from India, only that is taxable. Hello? Clear everyone? Just a minute. Yeah. Perfect, right? Now let us understand how to decide this basic residential status for individuals only. HUF I'm not touching right now. How to decide basic residential status for individuals? Look at carefully. For individuals, how to decide basic residential status? There are three categories. Through which an individual can become a resident. There are three categories: category 1, category 2, category 3. There are three categories through which an individual can become a resident. What are these three categories? First category, they spoke about basic conditions. Second category, I will name it as, I am naming this. Okay, this is not the name given in the act. Okay, I am naming it. I will call them as special resident. 120 day plus 15 lakh logic. Just a keyword. Okay, 120 day plus 15 lakh logic. 120 day plus 15 lakh logic. There is another logic I want to tell you. Okay, Indian citizen or Indian origin visiting India. Indian citizen or Indian origin visiting India. So second category, I call him as what? Special resident. He's a resident only, but I'm just calling it a special resident. That's it. Because you may become a resident. Through category 1. You may become a resident through category 2. You may also become a resident through category 3. If you are becoming resident through category 1, you are simply called as a resident. If you are becoming resident through category 2, you are also called as resident only. Category 3 also you are resident only. In all these three cases, any one case applicable to you, you are a resident only. Okay. Now category 3, I call them as deemed resident. I call them as what? Deemed resident. There is a section called 6(1)(a). There is a section called section 6 subsection 1(a). Okay. Now let us discuss one by one. Okay. Now if you see here how the testing logic will apply. First I will apply category 1. If at all category 1 basic condition satisfied, I will not check category 2, category 3. Category 1 failed, sir. Category 1 failed, sir. You cannot say non-resident. You cannot straight away say non-resident. Check category 2. Category 2 also failed, sir. Then check category 3. Are you clear? Category 3 also failed, sir. 1 failed, 2 failed, 3 failed. Then he is a non-resident. Sir, 1 only failed, sir. 2 satisfied, sir. No need to check category 3. So 1 failed, 2 failed. Then check category 3. All the 3 failed. non-resident. I hope you understood category 1, 2, 3. So in category 1, 2, 3, any one scenario only will be applicable. Okay, if a person become resident because of any of these three category, we will classify him as a resident. Then we should go for additional conditions checking. Then we should go for additional conditions checking. But here there is a twist. If a person becomes resident through category 1, if a person becomes resident through category 1, then only additional conditions logic I will apply. Then only I will apply additional conditions logic and I will check RORA, RNORA. Are you clear? So if a person satisfy basic conditions, category 1 he became a resident, then only I will go for additional conditions ROR, RNOR logic. Suppose a person failed basic conditions. A person failed basic conditions. He may satisfy category 2. He may satisfy category 3. Any of it or both of it doesn't matter. Okay. He will always, if at all a person becomes resident through category 2. If a person becomes resident through category 3, he is always RNOR. He is always RNOR. Straight away conclusion. Now, when should I check additional conditions? When should I check additional conditions? Only when basic conditions route. Only if a person become resident through basic conditions route. If a person become resident through the basic conditions route, then I will go for additional conditions checking to know he is an ordinary resident or not. Able to understand? Now, like sir, what are basic conditions? What is special resident? What is deemed resident? And once again I will sum up at last. Okay. Now, basic conditions. What basic condition? I will call them as B1 and B2. There are two basic conditions. I will call them as B1 or B2, and between these two conditions, any one only enough. Any one condition is enough. First I am talking about category 1. First I am talking about category 1 residential status. Okay. In that, two conditions are given. If any of these conditions satisfied by individual, an individual satisfy any of this condition, he is a resident. Now B1. What is B1? He is in India, sir. He is in India for 182 days. 182 days or more. He is in India for 182 days or more. When, sir? In relevant previous year. In relevant previous year. What is relevant previous year? Relevant previous year nothing but in your exam they are asking for previous year 24-25, assessment year 25-26, then relevant year is 24-25. If they are asking you for 23-24 residential status determination, then relevant previous year is 23-24. Suppose if they are asking you for assessment year 25-26 residential status, then relevant previous year is 24-25. That's it the meaning. Now, since in our exam 24-25 only we check, in 24-25, is he in India? Is he in India for 182 days or more? 182 days or more. Check out. Yes, he is in India, sir. He is a resident. Sir, what do you mean by in India? What do you mean by in India? Very simple. The date on which he entered in India, that day is counted as part of 182. And one day he'll be leaving, some date he'll be leaving, that date is also counted. On that date, he may be there only 1 hour in India. For example, on 1st January, night 11 o'clock he landed in India. Still 1st January is treated as part of 182. Okay. He left India on 28th February. For example, 28th February he left, he took the flight. Morning 1 o'clock he took flight. 1 hour only is in India. Doesn't matter. That is counted as 1 day. Are you getting the point? That's it. So he is in India 182 days. Sir, how he should 182 days means what? Continuously? No necessity. He came India and left. 10 days total he stayed. Then again he came again after 10 days, another 20 days he stayed. 10 plus 20, 30. Like this, how many days he stayed in India? Totally you count. Like that, if at all 182 days or in India is there, if at all 182 days is coming, that's it. B1 satisfied. He is a resident. He is a resident. Suppose if B1 failed, sir, he is not in India 182. He is not in India for 182 days. Then you should check B2. Then you should check B2. Now what B2 sections, B2 condition says, is he there for 60 days or more? Is he there for 60 days or more in relevant previous year? Is he there in 60 days or more? Check out. 60 days. Easily he'll be there. Not only that, plus and 365 days or more. 365 days or more in past 4 years. In past 4 years. 365 days or more in past 4 years is there in India. then also he will become a resident. So, sir, he is there in India in the relevant year, 60 days or more, sir. Relevant year means what in our problem? 24, 25. Past 4 years means what? 23, 24, 22, 23, 21, 20, 20, 21. Correct? So 23, 24, 22, 23, 21, 22 and 20, 21. In these 4 years, how many days is there? Check out. Minimum 365 days is there. In the current year is there for 60 days. Then automatically B2 condition is satisfied. Then automatically B2 condition is satisfied. Are you clear? Now here there is a twist. Condition B2 we should not check. Condition B2 we should not check for 3 categories of SSC. Condition B2 we should not check for 3 categories of SSCs. What are they? What are the, I mean, okay, 3 categories of SSCs. For 3 types of SSCs, for 3 types of, in fact, I will say 3 categories of individuals, because we are talking about individuals, right? So 3 types of individuals, we will not apply B2. Indirectly, we will apply B1 to them. If B1 satisfied, he is a resident. If B1 not satisfied, category 1 will not apply. I will go to category 2 check. If category 2 also not satisfied, then I'll go for category 3 check. That's how the logic applies. Okay. Now, in category 1, 2 criteria they have given. B1 criteria, B2 criteria. If B1 satisfied, no need to check B2. B1 not satisfied, then check B2. Yes or no? B2 is what? 60 or more in the current year, relevant year. 365 or more in the last 4 years. Correct? Now, this B2 will not apply. B2 criteria will not apply to 3 categories of individuals. Actually, in the act, what they will say, here 60 is there, right? They say 182 days logic. They say 182 days in current year. Automatically B1 gets satisfied. Able to understand? Indirectly, 60 days logic plus 365 days logic will not apply to 3 types of individuals. Who are they? First one, an individual, an Indian citizen. First of all, Indian citizen leaving India. What is it? Leaving India. No. Only that you should not interpret. Leaving India for employment. For the purpose of employment is leaving India. Employment means what? Either for doing a job in some foreign company or for the purpose of business outside India. For some money making purpose, earning purpose is leaving India. Only for him B1, B2 will not apply. Only for him B2 condition will not apply. Are you clear? Suppose a woman or a man, she or he married somebody abroad and left India because of the marriage, not for earning purpose. This exception will not apply. This exception will not apply because the exception is applicable only for whom? Indian citizen leaving India for employment. Clear? Next, second, Indian citizen leaving India. What is it? Leaving India as a crew member. As a crew member on Indian ship. On Indian ship. Okay. As a crew member. I mean, the main theme is here. As a crew member. That's enough. As a crew member. If at all you are working as a crew member, for you also B2 condition we will not check. We will not check. Okay. 3. Actually, they call it as foreign bound ship. They actually call it as what? Foreign bound ship. Okay. There is something called eligible voyage concept and all. We'll discuss that later. Not that important. Okay. Not that complicated. Then condition 3. Indian citizen here or POI. You may call them as IO or POI. Person of Indian origin. Person of Indian origin, POIO. Person of Indian origin or simply IO, Indian origin. Indian citizen, Indian origin, they are not leaving, they are visiting. They are visiting India only as a visitor, not for permanent settlement. They are visiting India. What is meant by visiting India? They visit, they stay some days and they again go back. Okay. For these categories of people, also, these 3 types of individual, B2 we will not check. In other words, for these 3 individuals, we will check only B1. We will check only B1. 182 days or more in India, yes, resident, category 1. 182 days or more in the relevant year, they didn't satisfy, non-resident, wrong. You should not say non-resident directly. Yes or no? Because you need to check, if category 1 condition is not satisfied, you need to go for category 2, category 3. Are you clear? So basic conditions, there are two basic conditions, any one only is enough. Basic condition 1, 182 days or more in India, resident. 60 days or more in India and 365 days or more in India, then also is a resident. B2, 60 days or more logic. That logic we should not apply for three types of individual. Who are they? Indian citizen leaving India for employment, Indian citizen leaving India as a crew member in a foreign bound ship, or Indian citizen or a person of Indian origin who settled outside but visiting India. For these three categories, B2 we will not apply. Are you clear? 60 days logic will not apply. Which means these three people can become resident in category 1 only by satisfying condition B1 condition. If they were in India for 182 or more, then only they will be resident as per category 1. Suppose in exam question they gave some Indian citizen or Indian origin or something, they gave visiting or leaving or something, they gave 182 logic, they didn't satisfy. 60 days logic is applicable to them, but they didn't satisfy. Category 1 closed, not applicable. Now you cannot straight away say non-resident. Category 2 you should check. Now what is category 2? What is category 2? Special resident. What is category 2? Special resident. Now what do you mean by special resident? Suppose if category 1 failed, B1, B2 both are failed. Now I will check residential status through category 2. What is this category 2? You know, this category 2 is applicable for whom? You know, Indian citizen or Indian origin. Category 2 is applicable for whom? Indian citizen or Indian origin. Okay, they are visiting India. They are what? Visiting India. They are visiting India. How many days? You know, more than or equal to 120 days in relevant previous year. They are visiting in India for more than or equal to 120 days in India and more than or equal to 365 days in last 4 years. More than or equal to 365 days in last 4 years they are in India. Okay, last 4 years more than or equal to 365 days. Are you clear? Okay, in the last 4 years, 120 days or more in the current year, more than or equal to 4 years. Remember, actually a person who is Indian citizen visiting India, for him B2 will not apply, 60 days logic will not apply, but you can check 120 days logic. You can still check what logic? 120 days logic and 365 days or more in last 4 years. And there is one more condition, and most important condition in this. Okay, and income from Indian sources. What is it? Income from Indian sources. Actually what they say, you know, total income other than foreign source. They say what? Actually total income other than foreign source. Indirectly income from Indian source. Remember, they're asking source, not receipt. Where are you receiving doesn't matter. Where is the source only matter. Are you getting it? So actually let me use that word only for a better clarity. Total income other than foreign, total income total income other than foreign source. Look at once again, total income other than foreign source. Okay, total income other than foreign source exceeding, what is it? Exceeding 15 lakh. Exceeding 15 lakh in that relevant previous year, in that year only. In that year, if the total income is exceeding 15 lakh, that to which total income? Which income? Other than foreign source. Nothing but which source? Indian source. Array, you are having Indian source so much income. You are there 120 days in India in this year and 365 days or more in the last 4 years. I will treat you as a resident. I will treat you as a resident. Basically, 60 days logic 365 does not apply. But if you have a total income in India, Indian source income more than or equal to 15 lakh, Indian source income more than or equal to 15 lakh, and you are having 120 days in India, this year you stayed, I won't even check 182 logic. You are there for 120 days or more in India. That's it. You are a resident. By the way, I will have to check this 120 logic, 365 logic only after if I fail 182 days logic. Yes or no? If at all I satisfy 182 days logic, even I became a resident, should I come back? Should I come to this? I will not check this. I will come special residential status logic only when I fail category 1. Hello? Yes or no? That's it. So, an Indian citizen, Indian origin, visiting in India, first check 182 days logic. 182 days logic you check. He satisfied basic condition. Happily go with additional conditions. Sir, he didn't satisfy basic conditions at all, sir. B1, B2, nothing is satisfied, sir. Now come and check 120 days logic in the relevant year and 365 in the last 4 year. And third condition, total income other than foreign source is more than 15 lakh, exceeding 15 lakh. Are you clear? Now, sir, what do you mean by other than foreign source? Other than foreign source means what? Other than foreign source means what? Very simple, yaar. Foreign source means what? Accrual is outside. Accrual is outside in India. Remember, I'm only talking about source. I'm not talking about receipt. Accrual is outside India. Are you clear? Now, you know, we remember in section 5, scope of total income, we found one point. Business or profession controlled from India. Remember, set up from India. Basically, this business is outside India. Basically, this business is outside India, correct? Source is basically outside, right? But for the purpose of checking 15 lakhs purpose, for the purpose of checking 15 lakhs income, for the purpose of checking 15 lakhs only, I am not talking about taxability. By the way, here I am talking taxability or residential status. Residential status. For the purpose of checking this 15 lakh, this business is there, right? This business is outside, right? Profession is outside, right? Yes or no? But it is controlled from India, no? Since it is controlled from India or set up from India, no? This is treated as Indian source. This is treated as Indian source. Only for the purpose of checking 15 lakhs, remember. Not for the purpose of taxability. Hello? Only for the purpose of checking 15 lakhs threshold. Not for the purpose of checking taxability, remember. Taxability is different. Residential status determination is different. Are you clear? Now, so foreign source means what? Accrual is not in India. Accrual is outside India. That is foreign source. Technically, business or profession outside India, it's a foreign source. But since it is controlled from India, since it is set up from India, for the very limited purpose of 15 lakhs rupees checking, this is treated as Indian source. Checking purpose only Indian source. Taxability purpose, it is foreign source only. Okay? That's it. So, this is the condition. This is the logic. Now, in exam, they'll give you. In exam, they'll give you. For example, I have a problem, I guess so. Okay? Just 1 minute. Yes, once I will solve one question on this. Okay, I will solve one question. This is actually my upcoming new question bank for May 26 attempt purpose. But residential status, whether it is May 26 or Jan attempt, doesn't matter. Okay, December attempt or June 26 CMA, Jan 26 EA inter, May 26 EA inter, doesn't matter. Residential status chapter syllabus is same. Okay, one question I'm solving. Okay, now look at, there is a question here. What are they saying? Miss Sarika, she is an Indian citizen. She is in employment with an overseas company located in UAE. Okay, this one question, if you understand, category 1, category 2 application you understood. You don't have to solve any other question. Okay, she is settled in UAE, correct? She is not liable to tax in UAE. Ayyo, she is not liable to tax in UAE. Yeah. Okay, fine, no problem. Okay, I think let us not solve this question. Okay, we'll solve it, no problem. We'll solve it, no problem. She is not liable for tax in UAE. Okay, fine. During the year 25-26, she comes to India for how many days? 121 days. She was in India for 50 days, 100 days, 76 and 145 days in the last 4 years. How many? 145 plus 100 plus 76 plus 50. 371 days, correct? 371 days she is there in India for past 4 years, correct? Okay, respectively in 21, 22, 23, 24, 25. That's it. Okay, last 4 years. Because here we are doing from 25-26 angle. For your exam, you will be doing in 24-25 angle. That's it. That's the only difference. Okay. Next, her annual income for the current previous year. In this question, previous year is 25-26. What is it? Salary accrued or arise and how much? 15 lakh. Okay. Where it is accrued? UAE. What is this source? Foreign source. Hello. Okay. By the way, before that, first what we know? Determine residential status and total income of Sarika for this year. What would be your answer if income arising or received in UAE from business setup in India is 10 lakhs instead of 5 lakh? In continuation to the point, what will your answer if Sarika comes to India for 45 days instead of 145 days? Okay, fine, we'll see that. Okay, first we need to decide residential status and then we need to compute total income. Okay, now next, UAE foreign source. Hello, then income accrued arise in India. Array, they said in India, Indian source. Income deemed to accrue or arise in Indian source. Income arising and received in UAE. And a business is set up in India. Basically, this is a foreign source only. But for 15 lakhs checking purpose, for 15 lakh checking purpose. For that purpose alone, I will call it as Indian source. For checking alone, not total income computation purpose. Income purpose I will not. Taxability purpose I will not consider that as Indian source. Only for 15 lakhs limit checking purpose I will consider it as Indian source. LIC premium paid by check. Oh, this is a payment ma. This is a deduction ma. This is a deduction. Fine. Now first I will check. Category 1 I will check. Okay. Category 1 B1. 182 days or more in the current previous year. Correct? 182 days or more in the current previous year. 182. She stayed only for B1 failed. B2. 60 days or more. She stayed 365 or more. 371. She stayed B2 satisfied? No. We should not apply B2. Why? She is an Indian citizen, settled outside, now visiting India. She is only visiting India. She settled outside ma. She is not settled in India. Indian citizen visiting only. She is only visiting. That's it. Yes or no? She is settled outside. So she is in employment outside already. Means she is settled outside. Now she is visiting India. Third exception. Third exception for B2. B2 we will not apply. Okay. B1 not satisfied. B2 we should not check. Therefore, as per category 1, she is not a resident. See my words carefully. I am not saying as per category 1 she is a non-resident. No, I am not saying she is a non-resident. I am saying she is not a resident. There is a difference between not a resident and non-resident. Non-resident means answer. Not a resident means still I am continuing discussion. Are you clear? Oh, category 1 failed. Now I will check category 2. Now I will check what? Category 2. As per category 2. As per category 2. There are, what are the things we need to check? First one, is she Indian citizen or Indian origin? Yes, Indian citizen. Is she visiting in India? Yes, she is visiting India. Is she stayed in India for 120 days or more? Yes, she stayed for 121 days. Is she stayed for 365 or more? Yes, she stayed for 371 days. And how much is Indian source total income? How much is Indian source total income? Okay, let me compute Indian source total income. Let me compute Indian source total income. Very simple. Just now we thought this is foreign source. No. Yes or no? Income deemed to accrue. Yes, Indian source. Deemed to accrue in India. Indian source. Income from UAE. Business in UAE. Set up from India. We considered, we understood that it is also Indian source. Yes or no? For the purpose of checking 15 lakhs Indian source. Now total Indian source income is how much? 9 lakh. Minus 1 lakh deduction. Minus 1 lakh chapter 6 deduction. Then what you will get is 8 lakhs. Oh, total income in India. Total income other than foreign sources. Total income other than foreign source how much? 8 lakhs. Tell me, second category as per our discussion. Second category as per our discussion. Look at second category as per our discussion. What is second category as per our discussion? Indian citizen, Indian origin, visiting India. 120 days or more in the relevant year. 365 days or more in the last 4 years. And total income other than foreign sources exceeding 15 lakhs. Then only she'll be a resident. Then only she'll be a resident. Now here, if you observe here, her total income is just 8 lakhs. Which means 15 lakh logic she failed. She is there for 120 or more. She is there for 365 or more. 15 lakh logic she failed. Deemed resident is there na category 3. There also 15 lakh logic only is there. There also what logic is there? 15 lakh logic. If 15 lakh logic is failed, category 2 category 3 also failed. If 15 lakh logic is failed, category 2 failed, category 3 also failed. She is a non-resident. What is she? She is a non-resident. Just a minute. Did we do any total mistake? Arey, that's what I'm asking. No, what are you doing then? 9 7 Okay, you should have told no. You should have told no. Okay. 2 plus 7 plus 5. How much it is? 9 plus 5, 14. 14 minus 1, 13. Even it is less than 15. No, it's okay. Anyhow, 15 lakh logic failed. You should have told no when I did a computation mistake. Okay, fine. So 2 plus 7 plus 5 Indian sources I'm adding minus Indian related deduction. Total deduction, LIC deduction, ATC deduction. Total income is coming 13. Even then 15 lakh logic failed. Category 2 15 lakh logic failed. Category 3 also has a 15 lakh logic. In category 3, two conditions are there. In that, one of the most important conditions is 15 lakh logical. There also it is failed. Category 1 failed, 182 days logic. Category 2, 120 logic she satisfied, 365 logic she satisfied, 15 lakh logic she failed. You know, category 3, deemed resident logic there. Actually, as per deemed resident, no, she should not be taxed outside India. Here, she is staying in UAE, not liable for tax. And 15 lakh logic should be satisfied. But 15 lakh logic she failed. Therefore, she is a non-resident. Therefore, she is a non-resident. Therefore, she is a non-resident. She is a non-resident. Now, we need to compute her total income taxable. Remember, sir, we already computed, no? 13 lakhs is the answer. No. This total income is for checking purpose. Okay. Now, we need to compute. Now, she is a non-resident, remember. Now, at the beginning of the class, we understood, right? For a non-resident, what incomes are taxable? Source must be in India. Or receipt must be in India. Sir, both are outside, sir. It's from business or profession controlled or set up. Still not taxable. Other sources, still not taxable. Yes or no? For non-resident, she is a non-resident. What are taxable? Sir, salary accrued or erased in UAE. Foreign source, not taxable. India, erased in India, taxable. Deemed to accrue, taxable. Sir, income arising in UAE, but it is set up from India, not taxable. Sir, immediately, sir, here why we didn't consider, whereas here why we considered this? The logic is, for the purpose of checking 15 lakh, even though business, even though it is outside, but it is set up from India, right? It is included since business is controlled from India, even though such income is accrued and outside India. For the purpose of 15 lakh limit check, this is treated as Indian source. This is treated as Indian source. In fact, this is not treated as foreign source. This is not treated as foreign source. But for the purpose of taxability, original logic will apply. Indian source or foreign source. Original logic, section 5 logic will apply. That's it. Over. Category 2 over. Are you clear? Now, category 3. Now we will see category 3. Category 3. Suppose, category 1, she became a resident. I will not check category 2, category 3. Suppose category 1 failed. Just now we saw category 2 we checked. Sir, category 2 also failed, sir. Then immediately in the same problem, I checked category 3 also. Correct? I checked category 3. You see here, in this problem, I checked category 3 also. Next, I'm even keeping some exceptional question word. Exceptional means what, Okay, in the next item, this question bank, they'll have exceptional word. Exceptional means that question is something tricky. What is the tricky point here? Here 5 lakhs is there, here 5 lakhs is not there. Okay, all category 1, category 2, category 3, 3 categories we checked. Even then she is a non-resident here. Are you clear? That's how this problem worked out. Okay, next. Now look at. So this is the question. Now category 2 also she failed. Now category 3 we should check. By the way, if category 2 she is satisfied, category 2 when she can satisfy, when any SSC can satisfy, they must be individual, they must be Indian citizen or Indian origin, they are visiting India, and they are visiting for how many days in India? 120 days or more in current year, and 365 or more in last 4 years, and total income other than foreign source must exceed 15 lakh. Clear? Yes or no? That's it. Now category 3. Sir, category 2 also failed, sir. Now category 3 you check. Category 3 talks about deemed resident. Category 3 talks about deemed resident. When a person will become a deemed resident? Very simple. Category 3 says, first condition, he should not be taxable outside India. Outside he should not be taxable. He is not liable for outside India to any income tax. His income is not liable for tax outside India because of his country, domicile, whatever the reason. I don't bother. He need not pay income tax. He don't have to pay income tax at all outside India. He's exempted from tax. He's exempted from tax. That's it. Literally, he's not paying any income tax in any country. And what He's Indian citizen. What is he? He is Indian citizen. Sir, is he visiting or leaving? Doesn't matter. He's just an Indian citizen. He may not be visiting also. He may not be visiting India one day also. It doesn't matter. He's visiting or non-visiting how many days? Deemed resident. No days information is required. Days information doesn't. It's irrelevant for deemed resident topic. Deemed means what? You're not actually saying in India. We assume that you're India. Deemed means what? Assumed to be a resident. Resident, generally dictionary meaning resident means what? You're residing there. 120 days hormones, you're residing there, right? 365 hormones, you are residing there, right? 182 means also you are residing. So you are residing, right? deemed resident, he need not reside in India. He need not reside in India. Still we call him resident. Still we call him resident. That's why we are treating it as deemed resident. Sir, when did I reside in India? That's why I'm not saying you resident. I'm saying you deemed resident. Deemed means what? I assume resided in India. Why you will assume resided in India? Because you are an Indian citizen. You don't have any tax outside India, and you have total income other than foreign source. You have total income other than foreign source, which means Indian source is exceeding 15 lakh. If at all you have Indian source exceeding 15 lakh, you are a resident. You are deemed to be resident. Array, you have 15 lakh plus income in India. You don't visit India. I don't bother also. You don't have to pay tax anywhere outside, right? First condition, you should not pay tax outside. First condition, you should not pay tax outside. Second condition, you should be Indian citizen. Third condition, your Indian source income should exceed, total income should exceed 15 lakh. Then I will assume you are resident. Now in this question just now we solved, yes or no? What we solved, Indian source income is just 13 lakhs. Okay. And you see 182 days logic, he didn't satisfy category 1. In category 1, B2 will not apply to him because he is an Indian citizen settled abroad. So it is not applicable. He is just a visitor to India. Correct? He left employment. He left for the purpose of employment long back. So we will not apply B2. Then category 2 visa, 120 days logic, 365 logic, 15 lakhs logic visa, 15 lakhs logic he caught. He failed. So category 2 does not apply. Category 3, he is a resident Indian citizen. Yes. He is an Indian citizen. Yes. Yes or no? Second condition, he should not be liable to pay tax. Not liable for tax in UAE. Oh, satisfied. Third condition, his total income from Indian source should exceed 15 lakh, but it's only 13 lakh. Therefore, category 3 also failed. Therefore, he is a non-resident. Are you clear? Now, first part of the answer is over. Correct? He is a non-resident, and we computed total income. Computed total income, how much it is? Only 8 lakhs. Okay. Then next one. Second question. What would be your answer if income arising and received in UAE from business is there na set up? That is India is 10 lakhs. Oh, this number is not 5 ma, this is 10. So 10 means 13 becomes 18. Oh, exceeding 15 lakh. Exceeding 15 lakh. Directly as per category 2. Directly as per category 2. He will be a resident. He will be a resident. Now immediately the question comes, since he is a resident, is he ordinary resident or not ordinary resident? At the beginning itself I told, category 2, category 3 SSEs, category 2, category 3 individuals will always be RNOR. For RNOR, which incomes are taxable? RNOR, which incomes are taxable? The first discussion, residence status beginning I discussed, source in India taxable, receipt in India taxable, both outside. But from business control from India, profession control from India, again taxable. Yes or no? Which means this 10 lakhs becomes taxable in case you are an RNOR. Yes or no? So here how much is taxable in the second scenario? Second scenario, automatically taxable income. Total income would be 18 lakh. Total income would be 18. Total income for Indian source calculation purpose also 18 lakh only. Taxability also 18 lakh only here. Why? For RNOR, even though business outside, receipt outside, if it is controlled from India, we will treat it as Indian source for RNOR and tax it. That's it. Are you clear? Next, they are asking one more question. Third question, what are they asking? In continuation to the point, what would be your answer? If Sarika comes to India, only 45 days. Oh, 45 days. Second criteria failed. Second category failed. 120 only, second category. First logic 120. Indian origin or Indian citizen visiting India, 120 or more, 365 or more, 15 lakhs or more. Correct? Category 2 failed. But category 3 she caught again. Category 3, 18 lakhs she has Indian source income. Yes or no? And she is not liable for tax outside. Whether she is residing in India doesn't matter. She is a deemed resident. And deemed resident is RNOR. And if she is an RNOR, the answer of total income is as it is step number 2 answer. Question number 2 answer only. Question number 3 total income answer. That's it. Able to understand? So third one you see. So the answer would be same as computed in point number 2 above. That's it. With this individual residential status is almost over. Not yet over. Almost over. Now look at. So individual residential status if you see. So individual residential status. Now just now we saw category 1, category 2, category 3. If a person becomes category 1 is talking about basic conditions. Category 1 is talking about B1, B2. B2 has 3 exceptions. Correct? Category 2 talks about 120 logic, 365 logic, 15 lakh logic exceeding. Category 3 talks about, by the way, here Indian citizen or Indian origin, both are covered. Category 3, Indian citizen, Indian origin not covered here. Okay, plus not taxable, not liable to tax outside India, correct? Outside India, plus 15 lakh logic. Easy. What do you mean by 15 lakh logic? Indian source income logic, how much? Now, if a person becomes resident as per category 2, category 3, for example, see, by the way, how should I verify? Can I verify any order? First I will check 3, then I will check 2, then I will check 1, or first I will check 2, then 3, 1. Can I verify in any order? Never. First you should check in 1. If 1 does not satisfy, then I will go for 2. If 2 does not satisfy, then I will go for 3. Be careful. The order you should always be careful. Able to understand? Now 1 again, 1. B1 satisfied. 182 logic satisfied. He is a resident. No B1 sir. B2 he is satisfied sir. Then also is a resident. But B2 does not apply to 3 SSCs. Indian citizen leaving India for employment, or as a member of crew in foreign bound ship, or Indian citizen or Indian origin visiting India. For them also we will not apply. For them we will only check B1. Satisfied. Then I will go for additional conditions. Then I will go for additional conditions. Additional conditions are called as A1 and A2. Additional conditions are called as A1 and A2. Now what are they? Now category 1, category 2, category 3. Through this I determine residential status, right? I call them as basic resident at first. I will call them as basic resident at first. And further, if at all through category 2, category 3 you became a resident, like 1 completely failed, you became a resident through 2 and 3, you are by default R and OR. You don't have to go for additional conditions checking. You don't have to go for 6 subsection to additional conditions checking. Clear? Suppose you satisfied category 1 and became a resident. Through category 1 you became a resident, either B1 or B2 route. Through these 2 routes you became a resident. Then I will go for A1, A2 check. So A1, A2, when should I check? 182 logic you satisfied. That time I will check. 60 days logic, 365 days logic is applicable to you and you satisfied that. That time any of these 2 logics satisfied. Then only I will check A1, A2. What is A1? Very simple. Last 7 years you take data. Last 7 years. Last 7 years means relevant previous year or not. You should not take that. Before that 7 years. In that, how many days he stayed in all 7 years put together? How many days? Minimum 730 days. Minimum how many days? 730. He's a A1 satisfied. Not sufficient. A1 and A2 both should be satisfied. Both should be satisfied. A1 and A2 it is end. B1, B2 it is OR. Okay. A1 and A2. A2 is what? Sir, take last 10 years data. Last 10 years data you take. Any 2 years. Any 2 years. Any 2. For any 2 years out of last 10. Minimum 2 ma. Any means here what? Minimum 2 years out of last 10 years. He is just a resident. He is just a resident. Last 10 years he is a resident, I said, right? It may be category 1 resident, category 2 resident, category 3 resident, doesn't matter. In the last 10 years, for all the 10 years I will apply 3 categories. Year 10 I will take 3 categories I'll check. Year 9 I will take 3 categories I'll check. Year 8 I'll take 3 categories I'll check. Year 4, year 7, year 6, year 5, all 3 categories I'll check. Any one category they satisfied and became a resident. Okay, in any year. Like that for any 2 years you become a resident minimum. Enough. A2 satisfied. A1 when it is satisfied? 730 days or more in the last 7 years. A1 satisfied. 2 years out of 10 years in the last you became a resident. A2 satisfied. If both are satisfied and you satisfied B1 or B2, you satisfied B1 or B2 and you satisfied both A1 and A2, then you are a ROR. Are you clear? Tell me, A1 and A2 I will check when? Only when B1 or B2 is satisfied. B2, B1 means what? 182 days logic. B2 means what? 60 plus 365 day logic. By the way, if at all B2 condition is not applicable at all, 3 cases, then I will ignore them. Okay, then I will check only B1. If B1 failed, B2 not applicable, then I will go for category 2, category 3. If an individual becomes resident in category 2, category 3, he is by default R and OR. That's it. Over. Residential status major topic is over. Are you clear? Next. Now we'll discuss about HUF. Again, HUF also the same logic. First you should decide resident or non-resident. HUF no, first you should decide resident or non-resident. Because no, in HUF no, residents are again 2 types. ROR R and OR. Now first before I go for OR, NOR category, first I should know is it resident or not. Basically just like individual, 3 categories are there. First know resident or not. Okay, now for resident, no. For HUF I will say control and management. For becoming a basic resident, a HUF will become a basic resident when if control and management is partly or fully in India. Sir, if control and management are fully outside, HUF is, if control and management is fully outside, it's a non-resident. If control and management is fully in India or partly in India, it's a resident first. It's a resident first. Now, is the HUF ordinary resident or not ordinary resident? Then you remember A1, A2 we covered, no? Conditions A1, A2 we discussed, no? A1 and A2, both conditions you apply for Karta. You apply for Karta. Did Karta of HUF satisfy A1 and A2? Karta last 7 years, 730 days stayed. Last 10 years, 2 years Karta is resident. Check out. Yes sir, he is a resident for 2 out of last 10, 730 or more in the last 7 years. And control and management of the HUF is partly or fully in India. HUF become ROR. Sir, Karta failed with A1 sir. A2 satisfied sir. A1 failed sir. A1 and A2, any one condition failed, doesn't matter. HUF is just RNOR. Just RNOR. Are you clear? Easy or not? So now here one logic. Sometimes HUF can be ROR, but Karta is non-resident. That is also possible. Why? Now tell me, if HUF, can I say HUF residential status is equal to Karta residential status? No. Karta is a separate person from HUF. Karta is an individual. For Karta of the HUF, how should I set residential status? Category 1, category 2, category 3. A1 and A2 as usual I check. He's an individual there. First of all, I'll check as per that. For HUF, how should I check? Control and management. Then Karta's A1 and A2 satisfied. Then HUF will become ROR, RNOR. Are you clear? So for a particular previous year, HUF can become ROR. Still Karta can be NR. Possibility. Same way, for a particular year, Karta can be ROR. 100% control and management is outside India. That is also possible. HUF can be non-resident. So there is no link between HUF residential status and Karta residential status because both of them are 2 different SSEs. That's it. Entire residential status topic is over. Then we have something called section number 9 discussion. Okay, section number 9, what I will recommend is my previous version marathon is there. My previous version CA Inter income tax marathon is there. The same is applicable. My previous version September return marathon, that related video I will attach to this. In the YouTube I will attach to this. Okay, there I will discuss, that you follow. Clear? With this residential status is done. Okay, and watch this continuation where I spoke about section 9. If at all I missed to attach that in this video, just watch my previous marathon which I uploaded for September 25 exams of CA Inter. In that section 9 I discussed. That is sufficient. That's it. With this residential status chapter is over. So let's begin income from salaries revision for May 25 attempt related onwards. We are going to discuss completely from the amended book. So specifically no discussion for amendments is required. When I am discussing rent-free accommodation perquisite valuation here, I will discuss what amendment happened. And there is 115 BAC standard deduction related amendment. Those who are following default tax regime, for them standard deduction is 75,000. Those who are not following default tax regime, the standard deduction is 50,000. Means optional tax regime 50,000 standard deduction, default tax regime 75,000. This is the major amendment. RFA is one amendment. This is one more amendment. That's it. There is no other amendment in salary. First, let us revise the salaries in a particular order where I will avoid 99% of the confusion that you have. Remember, this is a revision class. This is not a regular class. Getting it? But I will give you 99%. Entire vagueness will be removed. Those who have done a preparation of salaries already, you watch this revision, you get complete clarity on the salary. Now, you see, what are the various types of salaries? First of all, salary chapter, what are the various incomes covered for us? Now, you know, we have something called 17 subsection 1. Salary means what? In this, the observation points are salary includes contribution to recognized provident fund. Salary includes interest on recognized provident fund. Salary includes allowances. Getting it? Salary includes perquisites. Salary includes profit in lieu of salary. Now, perquisite means what? Again, it is defined under 17 subsection 2. Perquisites includes two types of perquisites. One is monetary perquisites. Most of the students don't understand the salary overview. Lack of overview on the salary is what making them confusion on the salary. Perquisite, monetary perquisite. This is nothing but reimbursements. This is nothing but what? Reimbursements. Reimbursements are different. Allowances are different. Reimbursement is different. Allowance is different. The basic difference is very simple. Allowance is given to you. The money will be given. Medical allowance is given. Whether you will use it for medical purpose or not, we don't know. That's irrelevant for us. Whereas reimbursement, first you will go spend money and give me the bill. Company will reimburse, or direct payment by company, employer. The employer is directly paying the third party. Are you getting the point? Both are treated as monetary perquisites. They are not treated as allowances. Allowance means what? Cash is given to you. Whether you will spend it or not, I will not ask. Are you getting it? Reimbursement means what? I will reimburse based on the bill, or I will directly pay to the third party. That is reimbursement. Then perquisite can be another variety, that is non-monetary perquisite. What is a non-monetary perquisite? Best example, rent-free accommodation, motor car, use of movable assets. Like there are plenty of non-monetary benefits were there, which we will be discussing. So how to tax this non-monetary perquisites? There is a perquisite valuation rule called rule number 3. Accordingly, we need to value those perquisites. Okay, don't worry, we will discuss it from the book itself. Just I'm giving you overview. Then we have another section called 17 subsection 3, profit in lieu of salary. Nothing but compensation received by employee on termination, that and all taxable under profit in lieu of salary. But still, since the amount is received from employer, because of employer and employee relationship, that profit in lieu of salary, the amount that you are getting instead of salary, that is also taxable under salary, because you are having employer-employee relationship. Remember, any income that is taxable under salary only if the recipient and payer, they have employee-employer relationship, and the amount is received because of this relationship, then only that is covered under salary. Clear or not? Next, for example, no, employee has a own house. This house is rented to employer. This house is rented to employer. I am getting rental income from the company for the house which I rented. Though we are employer and employee, the transaction is not because of employment. The rent amount which I am getting, no, from the employer for the renting of house, that is still taxable under house property only. Are you getting the point? Then so look at what are the points that are there in the salaries. So first thing is employer-employee relationship is must. The next one is what? Charging section. What is the basis for salary? We all know salary is taxable on due basis or receipt basis, whichever is earlier. Due, suppose no, April month salary, suppose we are doing financial year 1st April 2024 to 31st March 2025. This is the year for which the problems will be coming for us. Okay, 1st April month salary is due to me on 1st May. May month salary is due to me on 1st June. March month salary is due to me on next year. In the 24-25 year, how many due dates will come? 12 due dates. In 24-25 year, how many due dates will come? 12. First due date will be 1st April 2024. But 1st April 2024, the amount I receive, no, that is last year March month. Still, since it is due on 1st April, the due date comes under 24-25 year. Even though it is last year March month salary, still it is taxable in the current year. Remember, under income from salary, the income is taxed on due basis or receipt basis, whichever is earlier. Suppose I am at the last month, March. I am in certain urgent need of funds. I requested my employer, dear employer, next year April and May, I have salary, right? I will receive, right? Can you pay me now itself? I asked. Before due date, I am asking. Company paid it. This is called as advance salary. Advance salary, you received it before it became due. Since you received before it became due, it is taxable. So salary is taxable on due basis, if at all not yet received, or if you already received before it become due, then receipt basis, whichever is earlier. That's how the charging section. Then sometimes you will also receive arrears of salary information in the exam. Suppose in the question, arrears of salary received point they gave, don't tax it. We assume that this amount is already taxed on due basis in the earlier years. We assume that this amount is already taxed on due basis in the earlier years. Suppose in the question in the exam they told arrears of salary bracket not taxed earlier, now it is taxable for you. Suppose if the question is silent, arrears of salary, no point is mentioned, earlier we assume that it is already taxed, now already once again you are receiving, it is not taxable. The point is very simple. If an income is already taxed on due basis, subsequently when you receive it, once again it is not taxable. Or if salary is already taxed on receipt basis, subsequently when it become due, actually it is once again not taxable. Clear or not? Yes or no? Advance against salary and loan, both are different from advance salary. Advance against salary, loan, these both are treated as loan taken from company. Getting it? On that, perquisite valuation is there. They are not liable for taxation. Clear or not? Next, what is a salary? Salary includes wages, pension, gratuity, fees, commission, perquisite, PLU, advance salary, leave salary, provident fund. And remember, salary is an inclusive definition. Allowances and all will come under salary definition. Now, what are various types of allowances? Also, one more point I want to tell you. Provident fund contribution, that is also salary. Contribution by government or contribution by private employer, some other employer, to the employee account in the pension scheme ATCCD. For the employee, first it should be taxed. Then employee, when he is computing total income under optional tax regime, getting it, he can claim deduction for employer contribution. Getting it? That anyhow, we will once again touch it in the chapter 6A deduction. Same way, if Agniveer, central government is contributing in the name of Agniveer employee to Agniveer Corpus Fund, for him it is a benefit, therefore it is treated as salary. So pension amount paid to pension fund, amount paid to provident fund, amount paid to Agniveer Corpus Fund by employer is taxed as salary. However, provident fund, no, it is exempted up to 12% of salary. Amount contributed to recognized provident fund is exempt up to 12% of salary. I will discuss under provident fund taxation little while later. Clear until now? Salary definition, basics. No much thing in this. There is no major thing in this to remember. Yes, let's continue the discussion of allowances. We'll continue the discussion of allowances. Okay. Now, no need to write. I'm just giving it for clarification purpose. Everything is clearly given in the book. No need to write at all. Okay. If at all you want to write, pause the video and then write. Later you just see and then write. Okay. Because I can't wait here in the class. Now, types of allowances. Broadly two types. Allowances, no, they're broadly two types. Allowances given for personal purpose. Allowances given for official purpose. Allowances given for personal. Allowances given for official. Those of you who are planning to write, please, while watching the video, pause the video and then write. That's it. Okay. Now, in face-to-face, you watch the video later on and then write. Okay. Now, so official purpose allowance, there are two types. Official allowances are again broadly classified into two types. Helper allowance, research allowance, uniform allowance. Official allowances are broadly classified into two types. Helper allowance, research allowance, uniform. All these are official purpose only. Helper, official purpose, helper. You research and training related purpose, I am getting allowance from the company so that I can do better research and then give better service to the company. Uniform purchase purpose, they are giving me allowance. Under default tax regime, fully taxable, no exemption at all. Under default tax regime, it is fully taxable. So if the question is about default tax regime and these allowances were there, fully taxable. Under optional tax regime, how much allowance you received, first to total it, minus how much you actually spent on uniform, reduce it. Uniform allowance 10,000 received, spent 5,000, only 5,000 is taxable. If it is default tax regime, how much you spent also doesn't matter, 10,000 is fully taxable. Whereas under optional tax regime, exempt spent amount, spent whatever amount you spent, that much is exempted. Rest only taxable. Simple. If any official allowance was given to you, you enjoyed some benefit out of it, that is fully taxable under optional tax regime. Whereas in default tax regime, how much allowance you got, fully taxable. That's it. Clear? Next, another allowance, conveyance allowance, daily allowance, travel allowance. Sir, what is conveyance allowance? In the city, I am working in a company. I need to go and contact so many customers and suppliers. I am a marketing manager in a company. No problem. Company is giving me money so that I can travel in auto, bus, whatever. Okay, cab or my bike, whatever purpose. Okay, whatever amount I am incurring for traveling within the city, that is called conveyance allowance. That's official purpose. They gave me every day 1,000 rupees, monthly 30,000 rupees. They gave me. I spent 20,000. I saved 10,000 for my own benefit. That amount you saved alone is taxable. In both the regime, exempt spent amount. Indirectly, how much amount you saved, no, which is given for official purpose. You saved, right? You are only enjoying it, right? Fully that amount, saved amount is taxable. Suppose you didn't keep with you, you gave it back to the company. What benefit you got? Nothing. Nothing is taxable. That is conveyance allowance. What is travel allowance and daily allowance? Remember, travel allowance is different. Transport allowance is different. There is another allowance called transport allowance, which we call it as personal purpose allowance. Transport allowance is personal. Travel allowance is official. What is a travel allowance? See, if I have to go for a work within the city, that's a conveyance allowance. If I have to go outstation will go, right? Sometimes out of another city will go for official purpose another city. Suppose you are a CA tomorrow. Okay, you're working as an employee in a company, internal auditor. So the company sent you to their factory, which is there in Gujarat. So you are traveling there. For traveling purpose, they gave you 50,000 rupees. Plus, you are going to stay in Gujarat, Ahmedabad, you are going to stay for 20 days. Per day, 5,000 rupees they are giving you. 20 days into 5,000 rupees, 1 lakh. Traveling 50,000. 1,50,000 allowance they gave you. What allowance? Daily allowance is 5,000 rupees. Why daily allowance 5,000? You may spend whatever purpose you want. Hoteling you want to, you have to stay in a hotel. All that you only have to take care. Daily will give you 5,000 rupees. You take care whatever you want. So 5,000 into 20 days, 1 lakh. Traveling purpose 50. 1,50,000 I gave you. You spent only 1 lakh. 50,000 you saved. That 50,000 is taxable. You spent 1 lakh for official purpose. Okay, extra 50,000 alone you saved. That is taxable. So conveyance allowance, daily allowance, travel allowance, these three allowances under both regimes exempt to the extent spent. Genuine right. Yes or no? Array, I'm going to some other place here. Company purpose here. I'm spending entire money. How come you tax me? It's unfair. Whereas uniform allowance and all, no. Research uniform allowance and all, no. These are some additional benefits which are given to employee. These are generally not given in any company. Only for some special employees we will give this. This is actual indirect benefit. So that's why under default tax regime they are making it fully taxable even without looking at your spending pattern. Whereas in other, another allowance is what? Optional tax regime, it is exempt to the extent spent. Official allowance is clear. Allowance is given for official purpose, only this. Apart from this, judges of High Court, Supreme Court will get something called sumptuary allowance. Okay. Anyhow, that Supreme Court, High Court judge related, we have a separate discussion. There we will discuss. Okay. Now it is not required. Generally not required. This clarity we have, 99.99% every problem we can solve. Then, apart from that, what allowance we have? Allowance given for personal purpose. There will be so many allowances. Medical allowance, my children education allowance. So many allowances will be there for personal purpose. In that, main noteworthy points are 2. Transport allowance. Sir, what is transport allowance? Conveyance is there, travel is there, what is transport? This is for transportation between my company and house. For commutation between office and house. Up and down. For that reason, company is paying me allowance. Fully taxable. Fully taxable. However, for disabled people, monthly up to 3,200 rupees exempted. How much is exempted? Monthly up to 3,200 rupees exempted under both the regimes. For disabled people only exemption is there. Sir, what about I'm not a disabled person? Disabled means what? Dumb, deaf, blind, okay, physically handicapped. Okay, so disabled people, we call them as. For disabled people, up to how much is exempted? 3,200 rupees is exempt up to 3,200. Transport allowance for disabled people is exempt under both the regimes. Up to 3,200. Whatever regime doesn't matter. Both the regimes it is exempted. HRA, house rent allowance. I am giving employee some monthly, some extra amount for rental purpose. Fully taxable under DTR. This is fully taxable under DTR. Indirectly exempt only under optional tax regime. That too, exemption amount to be calculated as per 10 subsection 13A. It is not fully exempt, partly only exempt. How much is exempt? 10 subsection 13A will tell us. That we will discuss. These are 2 important personal allowances. Apart from that, we have few more allowances. Which are covered under 10 subsection 14. There is a section called 10. Inside that we have clause 1, clause 2. So 10 subsection 14 clause number 1, that is talking about official allowances. 2 is talking about personal allowances. personal allowances. Remaining all other allowances we call them as 10 subsection 14 personal allowances. Remaining personal allowances under 10 subsection 14. That's what I'm talking about. Remaining personal allowances under 10 subsection 14, they are fully taxable under default tax regime, no exemption at all. Whereas under optional tax regime, some fixed amounts are exempted. Under optional tax regime, how much is exempted? Some fixed amount. Remain simple. How can you write this? Remaining allowances. Remaining allowances. What are remaining allowances? Remaining allowances which are covered under 10 subsection 14 clause number 2, which are personal purpose. What is the tax consequence? They are fully taxable under default tax regime. Now they are partly exempted. They are partly exempted under optional tax regime. That's it. Now what are the remaining allowances? If at all we understand, allowance discussion over. This is where the entire crux in salaries chapter, where people have confusion, is this only. Because of this and rent-free accommodation, because of these two main provisions only, and everybody do wrong calculation in salary. Okay, both I will decode easily. Clear all of you until now? Now look at this. Now, so how many allowances were there? You see, fully taxable allowances under both the regimes. What regime? These are all various allowances, no exemption at all. Entertainment allowance, DNS allowance, OT, medical allowance, city compensatory, interim allowance, servant allowance, project allowance, tiffin allowance, any other allowance, non-participating allowance, all that. Are you clear? You see here, servant allowance is different, helper allowance is different. Servant means personal reasons, helper means official reason. Be careful. Okay, servant allowance is fully taxable, whatever the regime, doesn't matter. Sir, I spent already 5,000 rupees. Sir, company gave 5,000. I spent 5,000 for servant. No, nothing. 5,000 is fully taxable. Servant is a personal allowance. Helper, business allowance, official allowance. Helper allowance under default tax regime, fully taxable. Under optional tax regime, how much you paid salary? Claim deduction. Are you clear? You understood the difference? Next. Transport allowance is also fully taxable. Transport allowance is fully taxable, other than blind, deaf, dumb, orthopedically handicapped employee. Except to them, remaining all other employees is fully taxable. Sir, what about blind, deaf, sir? Transport allowance to blind, deaf, dumb, orthopedically handicapped employee up to 3,200 per month is exempt under both the regimes. Under both the regimes. Yes or no? This is exempt under both the regimes. Both regimes. Understood or not? Same way, traveling allowance, daily allowance, conveyance allowance, these are all exempt under both the regimes. These four are exempted under both the regimes. See, you see, I gave D point alone, you see, red color. Okay, whereas remaining, you see, because these three are official allowances, whereas this is personal allowance. Yes or no? Just now I covered it. Official allowance, these three official allowances are whatever you spend exempt. Transport allowance also up to 3,200 exempt under both the regimes. Correct? Whereas some other special allowance is there. Under subsection clause 1, personal, the official allowance. Under clause 1, 10 subsection 14 clause 1 official allowances. 10 subsection 14 clause 2 personal allowances. 10 subsection 14 clause 1 official allowances are 6 types. Helper allowance, uniform allowance, research allowance, travel allowance, conveyance allowance, daily allowance. That's what I've given in this diagram. Okay, this entire official purpose is where it is covered. 10 subsection 14 clause number 1. Now inside that you see conveyance allowance, daily allowance, travel allowance, they are exempt under both the regimes to the extent spent. Transport allowance, which is a personal allowance, which is actually covered under 10 subsection 14 clause number 1, but that is exempt up to 3,200 per month under both the regimes. Are you clear? HRA is exempt under optional tax regime only, fully taxable in DTR. Remaining allowances fully taxable under DTR. Under optional tax regime, some exemptions were given. Don't worry, once we cover everything, once again I'll come back and then sum up everything. You will get fantastic clarity. Okay, now I think right towards you're clear. Yes or no? Differential treatment means what? You see, these are fully taxable under both. Differential means what? Some treatment in optional tax regime, a different treatment in default tax regime. House rent allowance fully taxable under DTR only. Under OTR, some exemption is there under section 1013A. Special allowances, discuss it later. Okay, exceptions. Traveling allowance, daily allowance, conveyance allowance, transport. These are always exempt under both the regimes to the extent spent. Whereas transport allowance is exempt up to 3,200 per month. Yes or no? So the exceptions which are given in A to D above, they are exempt partly under both the regimes. Partly means what? ABC exempt to the extent spent. D is exempt to 3,200. Indirectly, partly exempted. Yes or no? Next, fully exempt under both the regimes. There is only one allowance which is exempt under both the regimes. Allowance paid by government of India to an Indian citizen outside India, that is fully exempted. Allowances granted to Indian citizen by government for services rendered outside India, 10 clause 7, fully exempt. Then there are some allowances which are exempt under OTR only. What are they? Allowance to High Court judge, salary and allowance paid by United Nations organizations, sumptuary allowance given to Supreme Court or High Court judge. These are all allowances which are taxable only in default tax regime. They are fully taxable in DTR. Whereas in optional tax regime, these are fully exempt. Are you clear? All of you? Now further. HRA, how to tax it? We'll come back to it later. Before that, special allowances. Remember, special allowances to meet expenses on duties, to meet personal expenses. Expenses on duties means what? Clause number 1. Expenses for personal means what? Clause number 2. Understood? Clause number 2. Inside this clause number 2, not everything is important. Only few are important. Correct? Yes, now you see. So clause number 1. These are the allowances which are granted exclusively for official purpose. These allowances, no, under both the regimes, no. Under optional tax regime, no. Entire official allowance, whatever name it is, to the extent spent, it is exempted in optional tax regime. Whereas in default tax regime, helper allowance, research allowance, uniform allowance is fully taxable. Whereas traveling allowance, daily allowance, conveyance allowance is exempt in both the regimes. Are you clear? To the extent spent. Uniform allowance, research allowance, helper allowance, no, employees may or may not spend. That is the reason they fully tax it under DTR. Okay. Moreover, these are given only to premium employees, top level management. Why for top level management exemption? That's the reason they will fully tax it under default tax regime. Technically, entirely they should have given single rule, which would have been good. Okay. To the extent spent, you exempt it. If they did not spend, you tax it, which is actually good, no? Because both are official purposes only, no? Are you clear? So only 3 official purpose allowances are fully taxable under DTR: helper allowance, research and training allowance, uniform allowance. Remaining all other official allowances, remember, remaining all other official allowances, they are fully exempt to the extent spent. Okay, that's it. Clear? Easy? Now, there are some other allowances for personal purpose. One personal purpose allowance we already covered. Transport allowance given to blind, deaf, dumb employee, orthopedically handicapped employee. Yes or no? Disabled employee. That's why we call them as disabled or differently abled employees. Okay. So allowance is given to some personal purpose transport, whether it is optional tax regime or default tax regime, up to 3,200 per month is exempted. Okay. Now, apart from that, the company will also give some other allowance granted to meet personal purpose. Exemptions are given only under optional tax regime. Here exemptions are given, right? They are giving various type of elements and they are talking about exemption. Correct? These exemptions and all will be only in optional tax regime, but not in default tax regime. Be careful. Okay. Border area allowance, remote area, all this and all not required. I will tell you what is important. 4th one, important. Children education allowance, important. Hostel allowance, important. Okay. That's it. That's it. Only these 3 allowances only you have to read. Okay. Tribal area allowance also, remember. Tribal area also. Tribal area allowance. How much is tribal area allowance exempted? 200 rupees per month is exempted. Tribal area allowance is exempt up to 200 rupees per month. Okay. Just 1 minute. Yes. Shall we? Now, transport sector employees. Transportation allowance given to transport sector employee. Blind, deaf, dumb, that and all irrelevant. Okay. An employee working in transport sector, he is getting transport allowance. Same for moving from office to home. For that reason only. Okay. From workplace to home. How much is exempted? 70% of the amount received is exempt. Sir, company paid me 10,000, sir. 70%, 7,000 per month is exempt. Or maximum per month exemption cannot exceed 10,000 rupees. Maximum per month exemption cannot exceed 10,000 rupees. Sir, company paid me 10,000 rupees allowance, sir. How much is exempted? 70% of 10,000, 7,000 rupees, or maximum limit is what? 10,000, whichever is lower. Therefore, 7,000. So indirectly, how much is taxable? 3,000. 3,000. Some students know what they do, 10,000 per month. 10,000 exempt, no? They'll exempt full 10,000. They'll tax 0. Wrong. How much is exempt? 70% of amount received or maximum 10,000 per month, whichever is lower. Sir, I got 20,000 per month. 70%, 14,000 or 10, whichever is lower, 10. So 20 minus 10, balance 10 is taxable. By the way, this exemption is available only under optional tax regime. In default tax regime, this exemption is not available. Next, children education allowance. Employee education, no, for employee, he's having children. For their education purpose, we are giving education allowance. Okay, children education allowance. How much is exempt? 100 rupees per month per child, up to maximum of 2 children. I am giving employee monthly 5,000 rupees for their children education. The employee has 3 children, doesn't matter. Only for 2 children, per month 100, 12 months is equal to how much it is? 2,400. Totally how much is taxable? 5,000 per month into 12 months. 60,000 minus 2,400 is equal to 57,600 is taxable. Be clear. When you are calculating for 12 months, allowance received also shall be calculated for 12 months. Minus exemption is given per month, so you should calculate exemption for 12 months. What if employee worked only for 8 months in the company? Then 8 months only. He will get allowance only for 8 months. Are you clear? Next. Any allowance granted to an employee to meet hostel expenditure. Oh, hostel purpose also, children hostel purpose also company gave allowance. There 300 rupees per month per child, up to 2 children only permitted. If employee has multiple children, extra children also, we don't care. Exemption is only 300 per month per child, up to maximum of 2 children. Are you clear? That's it. Remaining allowances don't remember at all. Not required at all. Till date, they never tested in the past 20 years. They never tested remaining allowances. Getting it? Who will remember here? Field area allowance, high altitude allowance, this feet and all, who will remember here? Okay, they just there, that's it. They don't test. 99% if the person, he's a little having little brain, he will not test. If the paper setter is testing any of this, no, he has a special place reserved for him in hell. Okay, so don't worry. Now, transport allowance for disabled employee, both the regimes exempted, correct? Granted to an employee who is blind, deaf, dumb, orthopedically handicapped to cover expenses between residence and place of duty. Exempt up to 3,200 irrespective of tax regime. Allowances which are fully exempt under OTR. Allowances given to judges of High Court and Supreme Court. Allowances given from United Nations like salary and allowance received by employees of UNO. They are exempt from tax under United Nations Act. United Nations have branches across countries. So in India, an employee working in UNO office, he is getting salary from United Nations. Allowance from United Nations, fully exempt under optional tax regime. Pensions received from UNO, fully exempt under optional tax regime. Yes or no? These are exempt only under optional tax regime. The same way, High Court judges and Supreme Court judges receive something called sumptuary allowance. That is nothing but compensatory allowance type only. It's not different. Names are different. Sumptuary allowance. Okay, they are exempt. So High Court judges, they are fully exempt under optional tax regime. See, when these many exemptions are there in optional tax regime, why the hell anybody choose default tax regime? Yes or no? That's it. And allowances payable outside India, they are exempt irrespective of tax regime. They are exempted irrespective of tax regime. This is what I gave in the first table. Allowance topic over. You see how easy, except HRA, we covered rest of the allowance topic in a crisp and clear manner. Correct? In a crisp and clear manner we covered. So simply, now you come back and see this book, you will understand much more beautifully. Now, types of allowances. Official purpose. Official allowances are broadly categorized into helper research uniform, conveyance daily travel. Helper research uniform fully taxable under DTR, whereas exempt to the extent spent on OTR. Whereas conveyance allowance and all is exempt fully under DTR as well as OTR to the extent spent. Remaining allowances are called as personal. In the transport allowance has a separate identification. Transport allowance given to a disabled person is exempt up to 3,200 per month. Up to that only. Suppose you are getting 5,000, up to 3,200 exempted. You are getting 3,000 only. Full 3,000 is exempted under both the regimes. HRA we will discuss later. Remaining allowances all personal in nature are fully taxable under DTR. Whereas some allowances are exempted under OTR. Okay, fully taxable under DTR. What about optional tax regime? Some are exempted. Tribal area allowance 200 per month exempt. Transportation allowance given to transport sector employee under optional tax regime, 70% of the amount received or 10,000 rupees, whichever is lower, that much only per month exempted. Third one, children education allowance up to 2 children, 100 rupees per month per children exempted. Hostel up to 300 rupees per month per child, maximum of 2 children. That's it, over. Allowance discussion is over. Easy or not? Now this entire discussion is given at the end. What we have given, you see here. By the way, judges, Supreme Court judges, allowances received by judge, not salary. Remember, salary is taxable for judge. Allowance only they discussed. Allowance received by judges, Supreme Court. Sumptuary allowance received by Supreme Court, High Court judges. Salary and allowance received by United Nations organization. Pension received by United Nations organizations. Yes or no? Salary, pension, allowance, everything literally UNO fully exempt. Yes or no? Judges fully exempted allowances under optional tax regime, which are fully taxable in default tax regime. Now what is the last page, ma? 62, yes. You see how beautifully we have given it one place now. So what are the deductions you will not get under default tax regime? Which deductions you will not get at all? Indirectly, they are fully taxable. Helper allowance, research allowance, uniform, fully taxable. Allowances for judges, salaries and pension paid by UNO, fully taxable. Yes or no? HRA, fully taxable. Clear? Special allowances given for personal expenses, fully taxable, except transport allowance for differently abled people. Okay, differently abled people, except that allowances given for personal, fully taxable. You see, that's it. Now, what is the difference between optional tax regime, default tax regime? If you read this table, without reading that, you will still get the understanding. Are you clear, all of you? That's it. Then we have something called entertainment allowance, exemption and all. Entertainment allowance is fully taxable for everybody. We will discuss these points later. Okay, we will discuss these points later. Okay, confident until now? That's it with this allowance discussion. Again, coming back to the table, where is that box? Big table is there. What's the page number? 40. Yeah. Yes. Yes. Now you master the table now. Easy or not? That's it. So we are still left with HRA and some other provisions of salaries. Okay. We will finish after the lunch break. Clear? Confident? That's it. Now let's come to some discussions on pension. Pension is categorized into two types. One is uncommuted, which is actually called as monthly pension. Monthly pension. Remember, pension received on retirement only I am discussing. If pension is received before retirement, fully taxable, always taxable, except disability pension. Except disability pension received by armed force employee. Disability pension received by armed forces employee is fully exempt. But any other pension received during service, fully taxable. On retirement I am receiving, on or after retirement I am receiving, then the pension is divided into two categories. Are you receiving on a monthly basis? Yes, fully taxable. Sir, I am receiving lump sum, sir. Commuted pension I am getting. Commuted pension means what? Very simple. Suppose originally company offered you 10,000 rupees per month monthly pension, or 5,000 monthly pension, 5 lakhs lump sum cash. You chosen this option, not this option. Indirectly, monthly how much you sacrificed? 50% you sacrificed. Originally they offered how much? 10,000. But you asked the company how much? 5,000 you pay me monthly enough. Instead of 5,000 which you are sacrificing, no, which is nothing but in the monthly, how much percentage you are sacrificing? 50% you are sacrificing in the monthly pension. For 50% sacrifice of the monthly pension, you are receiving lump sum how much? 5 lakh. Tell me, full pension value is how much? Full value is how much? 50% is equal to 5 lakh. 100% is full value is equal to 10 lakh. That's it. So first compute full pension value. In exam they will give you commutation percentage. How much commuted pension you receive they will tell you. Sometimes they will tell you uncommuted pension before commutation amount they will give you. Uncommuted pension after commutation they will give you. Percentage you calculate. Lump sum amount they will give you. That lump sum amount is equal to this percentage. 100% is equal to how much you should calculate. Are you getting it? Clear or not? No, sir, commuted, sir, lump sum amount I received, sir. Government employee, fully exempted. Non-government employee, check whether they are receiving gratuity or not. Sir, non-government employee, sir, he is receiving gratuity also, sir. He is receiving gratuity. See, I am not talking about are they covered under gratuity act or not. I am not talking about act coverage. I am talking about are they received or not. Yes, sir, they are received, which means they are claiming exemption for gratuity also. Which means under commuted pension exemption is lower. How much is exempted? Commuted pension received, how much you calculate? Based upon this full pension value you calculate. What is full pension value? Commuted pension received how much? What is commuted percentage? Check it out. You will get full pension value. In our example, commuted pension received 5 lakh. 50%. Full pension value how much? 10 lakh. So how much are received here? 5 lakhs are received. Minus 1/3 of full value. 1/3 means what? For full value, 10 lakhs into 1/3 means what? 3.33. So how much is exempt? How much is taxable? 1.66 lakh is taxable. Next, sir, I am not receiving gratuity, sir. Then half of full pension value. Half of full pension value is equal to how much? 5 lakh. How much are received? 5 lakh. Minus how much is exempted? 5 lakh. Taxable is 0. You should always compute. First, commuted pension received how much? Put in the amount column. Less exemption. 1/3 of full pension value, not 1/3 of received. 1/3 of full value. Full value you should compute. Sometimes if you're lucky enough in the exam, they'll give you that full value also. Clear? That's it. Pension is over. And I told you, disability pension granted to disabled person of armed forces, they are always exempted. Getting it? Okay, persons who retired normally is not exempt. Persons who are received because of disability during the service also it is exempted. That's it. Correct? sometimes pension may be received by family members. If family members are receiving the pension, that is taxable under income from other sources. Okay, that's it. Anyhow, that's it. Pension point is majorly over. Now let's look at gratuity. Now let's look at what? Gratuity. Gratuity again. If you receive gratuity on service, means you didn't retire yet, fully taxable. Gratuity received before service is fully taxable. Just 1 minute. Yes, let's continue. Gratuity. Gratuity received before retirement is always taxable. It is treated at par with allowance. Remember, gratuity received before retirement, pension received before retirement, uncommuted pension received before retirement, they are all treated at par with allowance. When I say at par with allowance, you should consider that in RFA salary computation purpose. RFA salary computation. For example, in September 24 exams, leave encashment is received during service, before retirement. It is treated as allowance and it is considered in RFA salary computation purpose. Remember? Fine. Sir, I received gratuity on retirement, sir. Very simple. You are a government employee. You are a government employee, fully exempt. Non-government, you received during service, fully taxable. Government employee received on retirement or death, fully exempt. Remember, if it is received during the service, whether it is government or non-government, are fully taxable. Sir, if the gratuity is received by other employee, if the gratuity is received by other employee, check whether that employee is covered under the Payment of Gratuity Act or not. An employee drawing a salary so and so amount, some limit is there, only they are covered under Gratuity Act. Check whether the employee is covered under Gratuity Act or not. Yes sir, he is covered under Gratuity Act. Then calculate, first identify how much amount received. Sir, he received some 15 lakh rupees, sir. First identify how much amount he received. Okay. From that, exemption is as below. How much is exempted? Least of the following. Statutory limit under income tax is 20 lakh. Maximum exemption cannot exceed 20. Maximum amount cannot exceed even 15 lakhs, right? How much amount you received? 15. That cannot exceed, right? Gratuity limit under Gratuity Act. How much is the limit? 15 by 26 into completed years of service or part thereof in excess of 6 months. What does it mean? Suppose employee retired after 26 years 8 months, it is treated as 27. Sir, employee retired after 26 years 2 months, sir, then it is treated as 26. Sir, employee retired after 26 years 11 months 9 days, it is still treated as 27. Suppose if act is not applicable, there you see only completed years of service is used. They didn't use part thereof in excess of 6 months. So, sir, I am an employee, completed 26 years, sir, 11 months, sir, 20 days I worked, sir. Still it is treated as 26. If act is applicable, 27. If act is not applicable, completed years means 26. Are you clear? Now, how much is exempted? 15 by 26 into completed years or part thereof in excess of 6 months multiplied by last drawn salary. Last drawn salary means what? At the time of retirement, what is your salary? Salary means what? Salary means what? Here we have given. Salary means what? Where Gratuity Act is applicable, salary definition is different. If Gratuity Act is not applicable, salary definition is different. If Act is applicable, for that employee, 15 by 26 into completed years or part thereof in excess of 6 months into last on salary is there, right? Their salary means what? Basic plus any DA. Whether for retirement or not for retirement are irrelevant. In exam, if they mention the DA, they didn't mention anything. We assume that it is not for retirement. Specifically, they mentioned something is for retirement. Then only we will consider. Clear? So, 15 by 26 into, in our example, 27 years into last run salary, you will get some amount, compute it. So, this amount this amount whichever is lower, that amount will be reduced from this. Balance amount is taxable. This is to be added to gross salary computation. Easy or not? Yes, next. Sir, employee, he is not covered under the Gratuity Act, sir. Every criteria is same. Exemption provision is same. Least of the following only exempted. One criteria is different. It's not 15 by 26. Here it is 15 by 30. Actually, in the ICA book, 1 by 2 they will use. Half only they will use. But in order for you to get a clear-cut distinction, I told 15 by 30 multiplied by completed years multiplied by average salary. Not last drawn salary. Average salary means what? Average of last 10 months salary preceding month of retirement. Okay, now last 10 months average you should take. What you should take in averaging? You should take 3 components. You should take basic of last 10 months, total it. TA for retirement purpose in the last 10 months, total it. Commission percentage of total last 10 months proportionately how much it is calculated. Remember, fixed commission should not be considered. Only commission percentage of turnover should be considered. Total it. 10 months you total it, divided by 10 is equal to, you will get average salary. That's it. And remember, the lifetime exemption limit is restricted to 20 lakh. Suppose in the question they might give you gratuity received. Earlier employee got exemption for 5 lakhs. Now here statutory limit is there not 20. That should be adjusted by 5 lakh. Means 15 lakh only you should consider lifetime. Whether you are receiving from one employer or multiple employer, whether you are receiving in 1 year or multiple years, you are receiving on retirement. Exemption is maximum 20 lakhs throughout the lifetime of the SSC. Clear or not? All of you. Next, when I am discussing RFA, at that time I will discuss HRA. Okay, HRA I didn't discuss. I will discuss at the time of RFA. Next, leave encashment. Leave encashment again. Remember, leave encashment received during service is fully taxable. On retirement I am receiving, sir. That time government employee fully exempted. Yes or no? Sir, non-government employee. Then 4 criteria were given. 4 criteria were given. So 25 lakh. Leave salary actually received. Remember, gratuity it is 20. Leave encashment it is 25 lakh. 10 months into average salary, 1 criteria. 4th criteria, cash equivalent of unavailed leave to the credit at the time of retirement. Earned leave entitlement cannot exceed 30 days every year. This is the point where every student will do wrong. For this, best way to understand this 4th point is what? Let us convert this 4th point into a formula. What is the formula? Look in the problem, they will give you completed years of service. Take that. Part thereof in excess of 6 months. Don't consider. Only completed years you take. Multiplied by per annum how many leaves employee eligible. Look at per annum company policy. What is it? Check out. Or 30 days. Whichever is lower. Yes or no? This is one bracket. Correct? Minus leaves utilized how much? Leaves utilized by employee throughout that number of years in service. How much? Calculate. Divided by 30 multiplied by average salary. So first numerator you should compute. What we are computing in numerator? We are simply computing. We are simply computing unavailed leave. Unavailed leave means what? Unutilized leave. How to calculate unutilized leave? Total leave how much minus utilized leave how much is equal to unutilized. Total leave is how to calculate? Per annum total leave cannot exceed 30 days. Eligible leaves per annum should not exceed 30. That's what they're saying. Earned leave entitlement cannot exceed 30 days for every year of service. So per annum, how many maximum leaves? 30. Suppose company policy 45 days, but you can only take 30. Sir, I completed 20 years, sir. Company policy 45 days, sir. No, that is not considered. 30 only considered. So total leaves eligible how much? 600 days. Correct? Sir, in those 20 years, I already used 450 days leave, sir. Leaves utilized, actual information you take. In the question they will give you mostly. So unutilized leave is how much? 150. Now what is the 4th criteria? 150 by 30 into average salary. That's it. If you understand this point, leave encashment, you can never do mistake. This is how you should understand leave encashment. Are you clear? Suppose, sir, if the company policy itself is 20, sir, then 20 or 30, whichever is lower, 20. 20 into 20, 40. Already you took 450 leaves, sir. No leave encashment exemption, 0 exemption. Clear or not? Everybody got communicated clearly whatever we discussed in depth without any confusion? Yes. Yes. Next, now here also average salary used. Average salary means what? Last 10 months salary preceding the date of retirement. Here they used date of retirement. In gratuity, where gratuity act is not applicable, month of retirement they used. Now salary means what? Same, basic plus DA for retirement plus commission percentage of turnover. Now immediately you might get, sir, somewhere at gratuity, where gratuity act is applicable, basic salary means basic plus any DA. At this one, leave encashment, gratuity where act is not applicable, HRA, there are various other. There again salary is different. Different places, different salary definition is there. How to remember that? Very simple. At the end of this chapter, we gave one schedule. We gave one simple table. At the end of this chapter, we gave one table, key observations under salaries. Meaning of salary for various purpose. You see, for gratuity, where act is applicable, basic plus any DA. For RPF contribution, VRS, gratuity, leave encashment, which gratuity, by the way, act is not applicable, HRA. In all these cases, if the word salary comes, salary means what? Basic, DA for retirement plus commission percentage of turnover. Sir, suppose if it is a rent-free accommodation, what is salary? Basic plus DA for retirement plus any commission, any bonus, taxable portion of allowances, only allowances, not reimbursements. Perk visit should not be considered in this. In salary definition, for RFA purpose, perk visit should not be considered. Only salary, basic plus DA for retirement plus all types of allowances, only taxable portion shall be considered. Under default tax regime, taxable portions will be mainly whole. Under optional tax regime, taxable portion will be proportionate. Able to understand? All of you. That's it. That's it. With this, leave encashment is also over. Leave encashment is over. Clear? Just a minute. Then coming to provident fund. Provident fund is one of the toughest thing in the entire salaries topic. Very simple, I will tell you. Okay, contributions by central government to their employees is SPF. Employer contribution fully exempt. Employee contribution we are collecting and paying. What is the tax treatment for him? He will claim ATC deduction, chapter 6 here, that too under optional tax regime. Employers, interest will be given on the contribution, fully exempt for government employee. Later he withdrawn lump sum amount, fully exempted. Correct? Then recognized provident fund. Next one is RPF. This is for private sector, not government companies, private sector. For them, no. Employer contribution is taxable in the hands of employee in excess of 12% of salary. Up to 12% of salary exempted. Salary means what? Basic plus DA for retirement plus commission percentage of turnover. 12% of salary is exempted. Beyond 12% it is taxable. Beyond 12% of salary it is taxable. That too. Employee contribution also will be there, right? RPF, that he can claim it as deduction under ATC in optional tax regime. Sir, interest is paid by employer, sir. Up to 9.5% per annum. Interest rate up to 9.5% per annum is exempted. However, from 2021 onwards, if at all employee contribution in a year is more than 2.5 lakh, beyond 2.5 lakh, very simple. Look at this, employer contribution, employee contribution. Employer contribution is exempt up to how much? Principal 12% of salary. Employee contribution ATC deduction under optional tax regime. Now we are paying interest. Interest is exempted how much? 9.5% per annum. Extra interest is fully taxable. Employee contribution is also exempt up to how much? 9.5. But employee contribution we should split. How much is employee contribution? First identify, sir. Employee contribution is 5 lakhs, sir, per annum. This year came. Then on first 2.5 lakh. 9.5% is exempt. Beyond that is taxable. On the balance 2.5 lakh, in the 5 lakh, no, balance 2.5 lakh, entire interest is taxable. Entire interest is taxable. Suppose no RPF is there. Inside that, employer is not giving any contribution, but employee voluntarily contributing. Then the limit is treated as 5 lakhs. Are you clear? Everybody. So that's why what they will do for the purpose of RPF. Separate accounts will be maintained for taxable portion and non-taxable portion. So taxable portion means up to 2.5 lakh, sorry, beyond 2.5 lakh, any contribution is there from employee, that amount will be credited to taxable portion account. On that, whatever interest is credited, fully taxable. Non-taxable portion will be there. On that, interest credited up to 9.5% is exempt. Beyond that is not taxable. But from exam point of view, this is not that important. Clear? That's it. Provident fund is over. Now, suppose RPF is there. Employee is withdrawing from RPF. Employee is withdrawing. Did he withdraw after 5 years of service? 5 years of service means what? With the same employer 5 years? Huh? No. After joining job, till now how many years you completed? More than 5 years. Now you are withdrawing from RPF. Fully exempt. Sir, I am withdrawing before 5 years. Is there a valid purpose? Valid purpose means what? Ill health, contraction or discontinuation of the employer business, or any reason which is not in the control of my employee. Somehow I got the money without a valid, for a valid purpose, for a valid purpose, if I got the money, exempted. Not a valid purpose. Suppose there is no valid purpose, then see, is the amount you withdrawn? No. Have you transferred to another RPF account with another employer? No, sir. Then no, I didn't transfer. Taxable. Or you transfer to pension account? Yes, sir. Exempted. Suppose you didn't transfer. Taxable. Simple. Easy or not? That is withdrawal from RPF. If you withdraw after 5 years, no, it is always exempt. The question comes only before withdrawal. Withdrawal before 5 years. For this 192A TDS section is also there, which we will discuss in TDS revision. Clear? Next. Suppose no, if withdrawal from provident fund is taxable, how to tax it? Employer contribution, interest on employer contribution is taxable under salaries. Employee contribution, no tax treatment. Interest on employee contribution is taxable under other sources. That's it. Simple. Contribution to pension fund, that and all easy. Profit in lieu of salary, nothing is there in this. Retrenchment compensation, not that important from exam point of view. Then VRS. VRS is what? Exemption only. Exemption only. If employee has completed 10 years of service or 40 years of age. Remember, this requirement does not apply to PSU employees. Public sector companies will be there for their employees 40 years age, 10 years, that and logic is not applicable. If they receive VRS, no, least of the following is exempted. How much is exempted? Maximum 5 lakh, maximum actual amount, or 3 months salary multiplied by completed years of service. Yes or no? 3 months salary multiplied by completed years of service, how much? Or salary at the time of retirement, how much you take? Into remaining months of service. If at all this retirement does not happen, how many months of service is that? Check out. That amount you compute. 3 months into completed years into last drawn salary. How much amount you check out? In all these 4, lowest amount is exempted from the amount received. Clear? All of you. Now remember, exemption for VRS is available only one time during the lifetime. It is not multiple times, only one time. If you claim one time exemption, sir, I claimed only 2 lakhs exemption, sir, one time, but statutory 5 lakhs is there, that is irrelevant. Clear or not? Now what is salary here? Last drawn salary is there, all that. Basic DA for retirement plus commission percentage of turnover. For 5 purposes, the salary definition is same. HRA, RPF, gratuity where act is not applicable, leave encashment, VRS. For all these 5 purposes, salary definition is same. Correct or not? Easy or not? Next. Then perquisites. There are various types of perquisite in this. No, there's one complex taxable perquisite calculation is there, which we discussed in regular class. It is not required in revision purpose, not that important in exam point of view. Even this comes, it will come only for 4 to 5 marks weightage. Getting it? Which is very difficult to solve. We already seen it. Able to understand? Next. Exemption from superannuation fund. This is also not that required. Tax-free perquisites. These perquisite means what? It may be monetary or it may be non-monetary. Monetary means what? Reimbursement or your expenditure employer paid directly, obligation paid to on behalf of you. Or perquisite can be non-monetary. Facility. Facilities are taxable only for specified employees. Reimbursements, your amount I paid, employer paid, your amount liability. These and all is taxable for all employees. Whereas facility is taxable only for specified employee. Who is a specified employee? Specified employee is a person, we have given somewhere definition. Yeah, you see specified employee definition. Who is a director, or an employee who is having substantial interest in the entity, or employee who is drawing per annum more than 50,000 monetary benefits. Obviously, this definition is very outdated. Today, practical, if you see, everybody is a specified employee. In the problem that you're going to get, 99% everybody is a specified. Sometimes to test this, a 2 marks question might be given as a two descriptive questions they might give, 1 mark each. Like that, they will test this provision. Apart from that, there is no testing of this provision practically with the numbers. Clear? All of you. We are about to finish the salary chapter. Another hardly 10 minutes. Okay. Now look at this. There are some benefits which are fully exempt. What are they? Telephone facilities fully exempt. Transport facility provided by an employer to a transport sector employee is exempted. Remember, transport allowance is different, transport facility is different. Transport allowance given to transport sector employee, allowance, optional tax regime, 70% of the amount received or 10,000, whichever is lower. Transportation facility fully exempt. Yes or no? Whether it is default tax or optional tax, doesn't matter. Clear? Next, all perquisites, no, if any exemption is there, they are exempt under default tax regime. Also, optional default tax regime, no differential treatment here. Only per meal coupon alone, 50 rupees up to limit, that is not there in default tax regime exemption. Yes or no? Yes. Remember, all these points will come at later. We will discuss all these points. We'll discuss now. Exemption for LTC, leave travel concession. Very simple. Exemption is given only for travel expenses for the employee on a tour. Travel expenses for the employee on a tour. Only travel expenses. For example, company paid, employee tour related one, some 10 lakhs he paid, company paid. Tour must be within India. The travel must be within India. Exemption is available only for travel expenses of individual employee, spouse, 2 children, parents or brother or sister, family members. Correct? You see here, family members means what? Here we have given somewhere. Yeah, you see, the exemption is available only for whom? Employee and his family. Family means what? Spouse, children, dependent parents, dependent brother or sister. In entire perquisites, no, family members means brother and sister included, parents is included, provided they must be dependent. Children and spouse can be dependent on me, maybe independent also, doesn't matter. Dependent means income they don't have, they are depending on me for livelihood. Okay, not dependent means what? Non-dependent means they have their own incomes. That's what the meaning. Are you clear? Next, LTC. What is exempted? Only travel cost is exempted. That too for how many? Spouse, children, dependent parents, dependent brother or sister. Children for how many? 2. Yes or no? That's it. Limit for exemption. How much is exempted? 2 journeys it is exempted. In a block of 4 years. Employer has given you travel expense related tour for how many? 2 tours. 2 types of tours it is exempted in a block of 4 years. Right now 2022 to 2025 calendar year is running on. Getting it? So up to March 2025, for you problem will be given on 24-25 and they will give you information how many tours were already completed. Suppose this is 3rd tour, leave travel allowance is fully taxable. Suppose this is 2nd tour. Getting it? Travel cost reimbursement alone is exempted for self, spouse, children, 2 children, all that. 2 children means what? Who were born on or after 1998 only will be counted. If their children were born before 1998, they may not be counted. They will not be counted. Again, children born after 1998, twins, first time, they are considered as 2. First time single, second time twins, they are considered as 2 children only as a whole. Yes or no? That's it. Then how much is exempted? Economy fare in air travel. Rail fare, first class air condition. That's it. This is only exempted. Clear or not? Then, sir, company provided medical facility. Next perquisite is what? Medical facility. Medical facility, how much is taxable? How much is exempted? All medical facilities are taxable except following 4. Except following 4. Medical facilities given to whom? By the way, employee or family members. Family means what? Spouse, children, dependent parents, dependent brother or sister. What medical facilities are exempted? Only the following are exempted. How many were there? 1, 2, 3, 4. Only 4 medical facilities are exempt. Rest all other taxable. Medical reimbursements, everything is taxable. Following, what are they? Reimbursement. Remember, a medical treatment provided to their family in employer hospital. Straight away treatment in employer hospital fully exempt. Sir, employer hospital, it's not employer hospital, sir, but outside hospital, company bear the expenditure or company is reimbursing the expenditure. Then it is exempted only if the treatment is in government hospital or a local authority hospital, or if the treatment is for specified disease in any hospital approved by Commissioner of Income Tax, or it is for COVID-19 treatment, provided COVID-19 positive report is required, treatment related bills and all is required. Okay, 1. If at all company is reimbursing you the money or company paying directly to the hospital, the amount paid is exempted only if it is a government hospital or for specified diseases or for COVID, yes or no, or medical treatment abroad. Abroad medical treatment means what? For abroad, no. Employee or family member, somebody suffering from some problem, company is bearing the entire expenditure. That expenditure is exempted for medical treatment up to the limit permitted by RBI. Travel and stay also up to the limit permitted by RBI is exempted, provided travel and boarding expenses and traveling and boarding expenses are restricted to only the patient and 1 attendant. Yes or no? That too, traveling related reimbursement is there, right? Medical treatment outside in traveling reimbursement, that is exempted only if the gross total income does not exceed 2 lakh. Typically speaking, for all employees it is taxable. But sometimes in exam only medical facility they will give you where this point may be tested specifically on that. Clear or not? Yes or no? Now sometimes companies might take premiums, okay, for health insurance of the employee. Company might pay premium, okay, or they will reimburse you for the health insurance policy you purchased. That is fully exempted. Remember, if a company is giving you medical allowance, fully taxable. Medical allowance is fully taxable, no exemption at all. Medical reimbursement, These 4 types of reimbursements are exempted. Apart from this, company might take personal accident insurance where maturity amount will not be there, exempted. Suppose company is paying life insurance premium where maturity amount will be there. Life insurance premium company is paying on your name, fully taxable. If on the employee name, company is paying life insurance premium where maturity amount will be there, that is fully taxable. Personal accident insurance, only if the employee he will get, family members get, so it is fully exempted. You see, that's what, if an employer takes personal accident insurance and pays the premium, no benefit is provided, therefore insurance is exempted. However, if employee LIC policy, life insurance policy is taken on his name, which is not an accident insurance policy type, where some benefit he will get tomorrow if at all he is alive also, that is fully taxable. In one of the test your knowledge problem, it is there. Clear or not? Yes or no? Then perquisites which are taxable only for specified employees. Specified employee what? Facilities only taxable. Yes or no? Now let's cover RFA. Let's understand RFA discussion and HRA discussion both. HRA what? HRA, suppose I am receiving HRA received 10 subsection 13A. Only under optional tax regime it is exempted. How much is exempted? Actual amount, how much checkout? Okay. Rent paid minus 10% of salary checkout, 50% of salary in case of Delhi, Mumbai, Kolkata, Chennai, 40% of salary if the house is taken on rent in another city, other cities, correct? One condition, in that city he should not have a own house. He should not be claiming SOP benefit. Correct or not? That's it. So salary means what? Basic plus TA for retirement plus commission percentage of turnover. Easy or not? Now this is HRA. By the way, here salary is there, right? Suppose I am receiving HRA from April month to September month. For these 6 months HRA I am receiving. Salary should also be considered only for these 6 months. Sir, April month salary is paid in May, sir. May month salary is paid in June, sir. June month salary is paid in August, sir. Like that it is there, sir. What about that? That is irrelevant. When the salary is paid, salary of this month is paid in which month? That is irrelevant. April month salary, how much? That only you should take. September month salary, how much you should take? Only that only. Are you getting the point? In ICI book, test your knowledge question. First question is the important question. Very best question that you solve it. Clear? That's it. RFA is, HRA is over. Now RFA. Everybody, I'm telling you, 99% of the students, they do mistakes in RFA computation. For RFA computation, there is a simple decoding. First to know, furnished, unfurnished, leave all that. Leave all that. First calculate, look at the question. Identify what employee is getting. He is getting furniture, sir. He is getting house also, sir. Then look at who is the employer. Who is the boss? Government is the boss, sir. Government is giving the benefit. Now look at, is the property owned or rented by the government? Check it out. Is it a hotel or not a hotel? Check it out. Sir, it's not a hotel, sir. It's an accommodation given by government. Then straight away license fee determined will be value of the house given to you. Is the value of the house given to you. Okay. Compute. Answer K. Suppose value of the house, license fee, some 10,000 per month. 12 months the government gave you. You stayed 12 months. Then 12 months you should compute 1,20,000. Sir, I stayed only for 4 months, sir. Then 4 months only it should be computed. Able to understand? Then suppose, sir, government gave me a hotel, sir, accommodation. Then 24% of salary or actual rent for the hotel, whichever is lower, that much is the outer column. Fine. This is accommodation perquisite value. Sir, along with this, I was given furniture also, sir. I was given furniture appliance. If it is given, compute the value. If it is not given, 0. Sir, furniture is given, sir. Then look at whether the furniture is purchased by the government and then gave you. Purchased by employer and then gave you. Yes, sir, he purchased and then gave me, sir. Then 10% per annum of the original cost of the movable asset. Remember, laptop facility is always exempt. Remaining any other furniture is taxable at 10% per annum of the original cost. That is treated as perquisite value. Sir, company hired on rent, sir. Then they are giving me. Rental expenditure is the benefit given to you because you are getting a benefit. Now, total accommodation 1,20,000, furniture whatever value, you will get the gross perquisite. Remember, this is not taxable value. This is value of the perquisite I got. How much is taxable? First, you should solve like this in the exam. First, compute gross perquisite. Just now we computed. Minus amount recovered, reduce it. Then you will get what? Taxable amount. Are you getting it? Suppose if the employer is a private sector employer, not a government employer, but other than government, then more than 40, suppose employer owned, so or else we'll take here 3 categories were there: rented, hotel, owner. Rented, 10% of salary or actual rent, whichever is lower. 10% of salary or actual rent. Before amendment, no, it was 15% of salary up to 31st August 2023. But for 24-25 year exams purpose, this percentage is enough. No need to remember. ICA book itself does not talk about before amendment. Students are unnecessarily looking at old amendment and new amendment and confusing. Not required at all. Getting it? Suppose if it is hotel, same as government. So compute that value. Sir, employer owns, sir. Then look at the population in that city where you got the accommodation. More than 40 lakhs, 10% of salary. 15 to 40 lakhs, 7.5. Any other area, 5% of salary. By the way, salary means for which many, how many months? Accommodation is occupied by SSC for 3 months. Then for 3 months only salary you should take. Which 3 months? Jan, Feb, March, employee taken, sir, accommodation. Only those 3 months related salary only you should take. Salary means what? Basic plus DA for retirement plus every allowance only taxable portion. Correct? Under default tax regime, taxable portion generally will be full. Under optional tax regime, taxable portion can be some amount because exemptions were there. Yes or no? That's it. So now you compute like that. Suppose, sir, furniture is also given, sir. Furniture valuation rule is same. Government employee, non-government, no variation at all. Same valuation rule. Look at here, same. Then you will get total benefit value. What is the total benefit value? Minus, did employee recover? Did employee paid company any amount? Did company recover any amount? Recover. Then balance is taxable. Now here, there is most important point. Subsequent year valuation rule. What is this? Subsequent year. Sir, in 23-24, I got accommodation, sir. Perquisite valuation is done, sir. In 25-26, I'm continuing the same house, sir. Employer has given me, allowed me, I'm staying in the same house. Then there is a maximum limit on perquisite valuation. Generally, many interpret it as second year we should compute perquisite like this. Wrong. You should compute in second year also the same way. Second year also you should compute the same logic. But one checkpoint you should do. Checkpoint is what? Value of perquisite in the 23-24, how much checkout? Previous year, how much is the perquisite checkout? Index numbers they will give you. Cost inflation index numbers they will give you. Of the 24-25 amount, how much account? Number. First year you got perquisite, no? Or 23-24, whichever is later is there, right? That number you take. How much value you are getting? How much value? Sir, I am getting some 2 lakhs at this value. Sir, this perquisite value is 1.8 lakh only. As per the rule, it is 1.8. Since it is less than 2 lakhs, no need to apply that provision. 1.8 lakh only perquisite. Yes or no? Sir, as per 10% of salary, 7.5% of salary, hotel accommodation, all that, no? I saw it is coming somewhere around 2.5 lakhs, sir. In the second year. First year it is 2 lakhs only. In second year, how much it is coming? 2.5. Because in second year, my salary increased, sir. That's why RFA value also increased. But perquisite value shall not exceed indexed value. Perquisite value shall not exceed indexed. As per the indexed value, how much it cannot exceed 2? How much as per the main rule? 2.5. But since it is less than 2, I will restrict the valuation to 2 lakhs. This is a benefit. In subsequent years, remember first year your salary will be low. But subsequent year, as you grow further, your salary will be increased. Automatically, RFA valuation also will increase. No, same house I am saying, but you are increasing value of the house. It should not be done. It should be increased only to the extent of inflation. That is the logic. It shall not exceed. Getting it? So this is only a checkpoint. If at all the value you, by the way, this checkpoint is applicable only for non-government employer. Yes or no? So first compute 10% of salary, 7.5%, 5% of salary, or 10% or actual rent, whichever is lower. In case of rented, all that you compute. Remember only accommodation value. Furniture value should not be considered. Furniture value should not check here. Accommodation value you check. In the second year. First year, how much is accommodation value? Check out. Second year value increased. Then immediately you should apply this logic. If the second year value, first year value both are same, no need to. If second year value increased, then you should apply this logic. First year value multiplied by second year index number divided by first year index number. How much that value? Your perquisite cannot exceed that. Already computed value is less than this, no problem. Computed value will be the perquisite value. Correct? Once again, listen to this if at all you don't understand. Clearly told. Getting it? That's it. Now, first year means what? First year means what? In which year you got accommodation? Check out. Sir, I got in 9-10 years, sir. 23-24 year or 9-10 year, whichever is later. Nothing but if accommodation is given long ago, now you are staying. 23-24 accommodation value, how much you check out? Multiply by index number. Sir, accommodation itself I took first time in 24-25, sir. Then first year means 24-25. Clear? Now first year 24-25 means 25-26 onwards will be second year. Second year onwards you should apply this logic. Correct or not? Then finally, if accommodation is given to a judge of a high court or supreme court, they are fully exempted under optional tax regime. Under default tax regime, it is fully taxable. Then car. Can I proceed? Easy. Just another 5 minutes, it will be over. Almost 1 hour. We are finishing within 1 hour. You see, day before exam, many students will have a worry how to finish. Very simple. 1 hour and finishing salaries chapter. PGBP will be another 1 hour. Capital gains will be another 1 hour. 3 hours. Remaining all other chapters will be put together 4 hours. 8 hours. 7 to 8 hours. I'm revising entire book without leaving one point. I'm in fact explaining, not revising. I'm explaining. Yes or no? Next. Car perquisite. What is car benefit? Very simple. You see here in the book I have given you. If everything is employer, orange color. If employees, then purple color. Getting it? Car. Very simple. Company gave a car. They are only bearing expenses. Simple logic. They are only bearing expenses. Car is given for you for official, fully exempted. Fully personal. Then car comes under use of movable asset. 10% per annum of the original cost in case of it is a own car. If it is a rented car, rental expenses plus actual expenses for petrol, diesel, all that. Yes or no? That's it. They're official and personal. Then deemed perquisite value. What is deemed perquisite value? Office and personal. Company owned car, company is only bearing up to 1.6 cc. 1800 per month or part of a month is the deemed perquisite value. Remember, 1800 per month. Per month means calendar month. Sir, I received car on 16th July, sir. 15th August only I used. 15th August I returned to company. It is considered as 2 months. July you got, August you got. 2 months it is considered as. Able to understand? Not day to date, month to month. Getting it? Now, driver is also given 900 extra. Sir, more than 1.6 is the car engine capacity. 2400, 900 in case driver is provided. Sir, suppose no company is owning the car, sir. Employee is bearing expenses. Means only for car benefit should be taxed, right? Both official. 600, 900. That's the only difference. Sir, company, car owned by employee, sir. Employer is only bearing expenses, sir. You can see here. Expenses are met by whom? Employer, sir. Fully official, sir. Fully exempt. Fully personal. All whatever expenses incurred. Sir, both official and personal. Look at what is the actual expenses minus what is the deemed value for official purpose. Actual expenses, look at minus deemed value for official. Official purpose deemed value, how much we assume? 1800 per month or 2400 and 900 in case of driver. Suppose no, this deduction you felt the more than I spent more, then you need to prove records. You need to maintain records. That's it. For all official purpose, if you are saying you have to maintain records, that's it. Car is over. Easy or not? One more point is there in the car. Suppose if the employee was given 2 cars or more than 2 cars, for 1 car only you will do valuation like that. Remaining all other cars are treated as personal purpose. Same way, accommodation also we have 1 point. More than up to 90 days, more than. Suppose if an employee was given accommodation at another place because of transfer, up to 90 days, both accommodations will value. Any lowest value we will tax it. After 90 days, both will be taxed. That's it. Easy or not? Domestic servant, easy point, not a big deal. Whatever employer facility taxable for specified employee, reimbursement fully taxable for all employees. Gas, yes or no, pay, supplied from company own, then equal to, supplier from own resources, manufacturing cost. Employer is buying from somebody and giving, amount equal to amount paid by employer. Valuation of education facility, reimbursement is fully taxable for everybody. Facility, employer school or employer related school. Getting it? If cost of similar education is less than 1000 rupees per month, no perquisite at all. If cost of education in similar school is exceeding 1000, fully taxable. Correct? Remember, education allowance is fully taxable under default tax regime. Under optional tax regime, 100 rupees per month exemption is there. Correct? That's it. Next, other benefits, interest free or loan. Suppose no company is giving you loan. Company is giving you loan. Now, at a concessional rate of interest. The year you got loan, right? First date, 1st April, SBI rate is how much you get, rate of interest. For that similar kind of loan, SBI rate of interest how much? That rate minus employer is charging from you only 4%. SBI rate is 10%. Employer is charging only 4% for the loan. 6% is taxable. Suppose you are repaying principal every month. Then every month end outstanding amount you compute, maximum outstanding monthly balance. What is that outstanding balance at the end of each month? First compute it every month. At the end of the month, outstanding balance compute, multiplied by 1 by 12 multiplied by benefit interest. Benefit means what? SBI rate minus employer how much is charging interest. Like that 12 months you compute total values perquisite over. However, if the loan is not exceeding 20,000, no perquisite. If the loan is given for medical treatment of specified diseases, no perquisite. Yes or no? Next, food and beverages. Food, non-alcoholic beverages provided to employer fully, they are typically taxable. However, meals up to 50 per meal is exempted under optional tax regime. Default tax regime, it is fully taxable. However, if the food is served at remote work site, fully exempted. Yes or no? And employee was given any refreshments, tea, coffee and all in the office, that is fully exempted. Gift voucher. Gift is exempted if the value is below 5,000. In the institute book it is wrong. They use the word does not exceed 5, means equal to 5. That's wrong. As per the perquisite rule, you go income tax portal, income tax rule, rule number 3 you open, 3 sub rule 7 you open. Inside that you will find gift. Gift value below 5,000 is fully exempt. Beyond 5,000 is fully taxable. But in ICA book also, up to 5,000 they can claim exemption. Beyond 5,000 they are taxing. Accept ICA practice. Able to understand? But remember, this is about gift in kind. Suppose if the gift is in cash, fully taxable. It is treated as allowance and it should be considered for salary definition for RFA purpose. Yes or no? Then credit card, club and all, remove it. Movable asset. Suppose employee was given any asset for usage. Laptop, fully exempt. Any other asset, own asset, 10% per annum original cost for the number of months used by the employee. Rent, rent expenses per month paid by employer for the number of months used by employee. That's it, perquisite value. Yes or no? Suppose employee purchased asset of the company. Company own asset, employee purchased it. Company purchased it 10 lakhs. Employee bought it from the company at some 2 or 3 lakhs. Directly you cannot calculate 7 lakhs as benefit. No. Notional depreciation you should reduce. For computer and electronics, remember TV, bike, everything comes under other assets. Just because electronics word is used, don't think electronic means every electronic. Computer and electronic means what? Computer related items. Then deemed value of depreciation, notional depreciation is what? 50% for every completed year of usage. Yes or no? 50 WDV method. Car 20% WDV. Any other asset 10% SL. How to compute? Original cost to the employer how much? Less notional depreciation at rate specified for every year reduce. Then WDV value will get on the date of transfer to employee minus how much amount employee paid, check it out. Then balance is taxable. Easy or not? Next, other benefits, very simple. Telephone allowance is fully taxable. Telephone facility is fully exempted. Then coming to valuation of specified security, being equity share. Equity share, very simple. If the employee was given ESOP, equity share, other than equity share, whatever it is, doesn't matter. ESOP we have given, you exercise it. On the date of exercising, fair market value is there. That much is perquisite. But year of taxability will be different. Generally, whenever you exercise the option, that time you got allotment of shares, market value is taxable. But in case if eligible startup you are getting ESOP, then taxation is deferred. Taxation is deferred to when? After 48 months it will be taxed. For which year you got? Assessment year checkout. End of the assessment year checkout. After 48 months, that previous year will come, right? Exactly that year it is taxable. Are you clear? Suppose before 48 months you left the company. Then year in which you leave the company, taxable. Before this you sold the shares also, then sale year it is taxable, whichever is earlier. After 48 months from the end of the relevant assessment year or date of leaving the company or sale of those securities, whichever is earlier, in that year it is taxable, not in the year of exercising option. Remember, this kind of facilities there only for eligible startup employees. Normal employees, which year you exercised the option, that year it is taxable. How much is taxable? Market value of the share is taxable. Minus you would have paid some amount to the company that you will reduce anyhow. Yes or no? Then what are the deductions from salary? 3 deductions. Standard deduction under optional tax regime 50,000. Under default tax regime 75,000. Entertainment elements, deduction only for government employees. Remember, entertainment elements is fully taxable for everybody, but for government employee, under optional tax regime only, he will get a deduction 1/5 of basic salary, 5,000 actual amount, whichever is lower. Profession tax. If company is paying it, first it is taxed as salary minus under optional tax regime. Whatever amount is paid ultimately is allowed as deduction. Relief not that required from exam point of view. Observations completed. Predominant salary topic is completed in 1 hour 10 minutes. Yes or no? All of you confident? Yes. Intense preparation is required. Okay, it's all about intensity. Everybody will sit 12 hours. It's not how much time you sit, it's with what intensity you sit. That's important. Clear? I think I didn't miss any point. Almost every point I covered, right? That's it. Okay, yeah, take care. The next session will come, we will discuss house property. House road is nothing, 20 minutes or half an hour only. Okay, that's it. Yes, let's revise the income from house property, which is the second head of income. And the charging section is 22 directly. So what the charging section says, annual value of any property which is building or land attached to building, nothing but land and building. Okay, provided SS is the owner, then only the annual value is chargeable to tax. Remember, in house property, it's not the rent which is taxable mainly, it's the annual value. So whatever rent you are getting, we should not straight away tax it. What is taxable is annual value is taxable. Now, what is annual value? How to figure out annual value? All that. Now, first of all, before I go into that, okay, suppose, no, sir, I am holding some house as a stock in trade, sir. I'm a real estate person, sir. I'm also having house properties. Getting it? I'm owner. You see, in the house property charging section, they didn't mention anything specifically for business. And you see, one exception is there. So, however, certain properties are not taxed when if the SSC uses the property or part of it for their own business or profession, then that portion is excluded from chargeability. So if at all I am having a house property, nothing but building, if I'm using it for my own business or my own profession, then that part is not treated as house property. That part is treated as building in PGBP. You can claim depreciation on that. Repairs and maintenance, municipal taxes, everything you can claim under section 30. We already covered in PGBP revision that point. Yes or no? Which you will get it. Okay, next. Now, suppose, sir, I'm a real estate person. I'm having stock in trade all the buildings, sir. What is my position? Because I'm not using them for my business. I kept it to sell it, not using for my business. What about them? For 2 years, the annual value will be treated as nil for 2 years from the end of the year in which completion certificate is obtained, provided the property is not rented during the 2 years. A real estate person who is having buildings and flats as stock in trade for 2 years, we will not apply house property head of income, but after 2 years we will apply house property head of income. That's it. Getting it? So now, composite rent. Composite rent means what? Suppose, sir, I'm having a house, sir. I'm renting house along with furniture. Either the tenant can take both together or they can take only one. Like the letting is inseparable. Inseparable means what? Either he has to take both or he can't take it. Sir, my building along with furniture I'll rent. Building rent is 20,000. Furniture rent is 5,000. Total 25,000. Breakup is available. Don't think that 20 is taxable under house property, 5 is taxable under other sources. No, you should not tax like this straight away. See whether this can be rented separately. Means if the tenant don't want furniture, he want only house. Can he take like that? He can't. Such a kind of option is not there. Tenant has to take both compulsorily. If that is the kind, then we call it as composite renting. We call it as composite letting, and the rent is called as composite rent. Straight away it is taxable as PGBP income or other sources. Suppose if letting is separable. Separable means what? Tenant said, sir, I don't want this furniture, sir. I have my own furniture. Owner also agreed. Okay, furniture I will take back. I'll give only house. That contract is called a separable contract, divisible contract. If divisible contract is there, then only building, I mean that building rent alone, whatever you are getting, you tax it under house property. Here also furniture is taken on rent. That furniture will be taxed under other sources. Nature is what? You can take whichever you want. Only house you want, you can take. With the furniture also you want, you can take both. You don't want furniture, I will give you that option. If such a kind of flexibility is there for the tenant, then each component rent is taxable under respective head. Such flexibility is not there. Both components rents are straight away taxable under other sources or PGBP. That's it. Okay. Next. Now, how to calculate income from house property? By default, everyone has to follow this format. By default, everybody has to follow this format. In exam, you follow only this format. How to compute? In exam, you should put heading, computation of income from house property for the assessment year 25-26. Nothing but previous year 24-25. First, you should compute what? Gross annual value. What is gross annual value? We have discussed below. How to compute gross annual value I have given here. Getting it, gross annual value, outer column. How to compute, we will see later. From that, only one deduction. Gross annual value, only one deduction. Remember, house property charging section, annual value is taxable. That is what? Nothing but gross annual value. That is nothing but generally what? Gross annual value. From that, reduce municipal taxes paid. Here, paid means actually paid. Cash base is only allowed. Whatever municipal taxes and property taxes and water taxes and chivalrous taxes that you pay between 1st April to 31st March of that year, whatever you actually pay, that you claim it as deduction. Then what you will get is net annual value. Some amount you will get. Now, in house property, for house, buildings, you will incur so many expenses, repairs, maintenance, insurance, all that. No, you won't get any deduction. You will get only two deductions. Standard deduction, which is 30% of the NAV. On this, apply 30% value. That amount you will get. Then another deduction is interest on borrowed loan. How to calculate interest on borrowed loan? That I will explain it now. In house property, if you are able to understand gross annual value discussion, if you are able to understand interest on borrowed loan, these two computations, if you understood, I am telling you house property you mastered. Pakka 4 marks question. Pakka 4 marks question on house property minimum. If you understand these two elements, you can do house property any kind of problem. Now, before I start this, suppose if the house property is self-occupied by SSE, means I am not renting it at all. See, there is a concept called straight away NAV, you can take it as 0. There is a concept. Actually, we have a section called 23. Inside that, we have 23 subsection which talks about GAV computation. 23 subsection 2 which talks about NAV directly 0. Subsection 2 and subsection 3. Both of this collectively says what? NAV you can straight away take it as 0. When NAV can be straight away taken as 0, two conditions has to be satisfied. One, either the property is self-occupied or property should be vacant. 12 months is there. Okay? For 6 months it is self-occupied, 6 months it is vacant, or 9 months it is self-occupied, 3 months it is vacant. Either 12 months are vacant or 12 months self-occupied. Only one point. Should not be rented. Should not be rented even for 1 day. Should not be rented for even for 1 day. Should not be rented for even 1 day. You should not get any benefit there. You should not get any benefit from that property. You should stay or it should be unoccupied. If these two conditions are satisfied for that house, you can straight away start computing income from NAV. No need to compute GAV. Straight away you compute NAV is equal to 0. Now, this kind of facility is there for two such properties. This kind of facility is there for how many properties? Two properties which satisfy both these conditions. SSE can straight away start the problem with NAV is equal to 0 for a particular property. Two conditions. That should be either self-occupied or unoccupied, and you should not at all rent. Even for 1 day, you should not be rented. You should not get any benefit. You should not get any benefit. No, best example I'll give you. Suppose I'm working in a company. The company as part of employment, they told me they will give me housing facility, housing accommodation. I told company, sir, why do you take it on rent at somewhere else and give me? I have my own house in the same city. Take my house as rent. Put a rental agreement. Pay me monthly 20,000. Give me the same house as an accommodation. See, now SSE might say, I am only staying in this house, entire 12 months, my own house. But you are getting some benefit from this property. Since you are getting a benefit from this property, you cannot call it as SOP. Since you cannot call it as SOP, NAV is equal to 0 cannot be claimed. If NAV is equal to 0 cannot be claimed, you should compute GAV. If NAV is equal to 0, logic do not apply. You should compute what? GAV. Are you getting the point? Now, by the way, for how many properties SSE can claim NAV is equal to 0? Two properties. Both the properties must satisfy two conditions. One, it should be self-occupied or unoccupied and not rented at all throughout the year. Two, no benefit you should get from that. Then NAV is equal to 0 can be claimed for two kind of properties. Sir, SS is having 5 houses, sir. In 5 states and 5 metropolitan cities, he's having a 5 houses. He's a movie actor, okay, or he's a politician. He's having 5 houses, sir. All the 5 for his own purpose only he's staying, sir. He is not renting at all. Can he claim for all the 5 houses NAV is equal to 0? No, only for 2 houses out of 5. Any 2 houses you can claim NAV is equal to 0. Remaining 3 you must treat them as deemed let out property. You must treat them as deemed let out property, and for them you have to compute GAV. And we already know for a deemed let out property, gross annual value is expected rent only. Gross annual value is expected rent. Don't conclude anything by this time. How to calculate expected rent? 12 months, how many months you should calculate? Ownership period, all that we are going to discuss. Able to understand? So for GAV, for DLOP, GAV you should calculate straight away expected rent. In house property, ICA book, test your knowledge and some illustration. You have fantastic questions. Getting it? 3 houses information will be given. You know, you can't apply any shortcut also. Getting it? You have to consider 2 houses as SOP, 1 as DLOP, or the 2-3 options you need to compute and see which option is best for you. Remember, which option is best for you? Fine. I'll come back to it better. Let me discuss interest on housing loan, all that. Once I cover the entire head of income, how to do solving of house property provision also we will discuss. Remember, interest claiming deduction. In house property, interest deduction is there, right? That is subject to default tax regime or optional tax regime. Okay, that I will cover that point. Even in the PGBP, in salaries, everywhere we discuss default tax provisions at respective places. Here also we will discuss default tax provision at respective place. Are you clear until now? No. So now when we can claim NAV is equal to 0, we know. If those 2 conditions are not satisfied, you cannot claim NAV is equal to 0. That time what you should do? You should compute GAV. Now, how should we compute gross annual value? Very simple. Gross annual value is computed in 3 steps. First step, no, calculate expected rent. Remember, charging section says annual value is taxable, not how much you are charging. See, you are charging rent which is more than the value, then rent is taxable. You are charging rent less than the value, then value is taxable. So cleverly drafted the section. Getting it? First, calculate expected rent, value of the renter, value, how much the property can give you rent. Step 2, calculate actual rent received. Step 3, gross annual value. Step 1 or step 2, whichever is higher, straight away higher of step 1 or step 2, whichever is higher. However, there is one scenario where gross annual value we will take it as step 2 only, where gross annual value will be actual rent received, which is computed under step number 2 straight away. Okay, so gross annual value is computed in 3 steps, right? First you compute step 1, expected rent, then compute step 2, actual rent received. Don't worry, I'll explain detailedly. Step 3, by default generally what you can go for, step 1 or step 2, whichever is higher. But in some scenarios, gross annual value is equal to step 2 only. When? Rule. See, I am telling you how to solve the problem directly. More than logic in the revision, solving ability is what most important for you to learn. You know, suppose you calculated step 2 answer. Suppose you calculated step 2 answer. This is the step 2 answer. And you also calculated step 1 already. Suppose if step 2 answer is lesser than step 1. Step 2 answer is lower than step 1. And one more condition. Property remained vacant during the relevant year. In the relevant previous year, getting it, that property was empty for certain months. Then just do a cross verification. Just to do one small checkpoint. Already you calculated step 2 value rent received, right? Put that amount here. For that, vacancy period rent. Vacancy period means what? Some 2-3 months property was idle, no? If at all it is not idle. If at all it is not idle, for these 3 months, if at all rented, how much rent you will get? Add that. Now, how much would be the actual rent if at all there is no vacancy? Calculate. Suppose if you add back vacancy period rent, step 2 value is becoming greater than step 1. If you do not add vacancy period rent, step 2 value is less than step 1. If you add vacancy period, it is higher than step 1. If you do not consider vacancy period rent, it is lower than step 1, which means Because of vacancy, our actual step 2 answer is lower than step 1. If vacancy, step 2 is lesser than step 1, sir, I am not renting cheaply, I am renting super. I'm charging very good amount, but my rent amount received is lesser this year because of vacancy. If you are able to prove vacancy is the reason why your actual rent received is lesser than step 1 expected rent, then gross annual value will be actual rent received. Actual rent received means what? Step 2 value, whatever step 2 value is there, right? That itself is gross annual value. Got the clarity? Easy or not? You're able to recollect? Now, for this in ICA book, we have given in the question bank, in our question bank, we have given illustration also, just to go and solve it immediately after this. Whenever you're solving, if you're not getting the answer, once again get back. But wait, still it is there. Now, sir, how to calculate step 1? How to calculate step 2? Step 3 relatively we understood better. Once again I will cover step 3 once we cover step 1, step 2 understanding. Now, how to calculate step 1? Step 1 means what? Expected rent you should calculate. Expected rent. Tell me, if I am owner for 12 months in this year for a house, 12 months I can expect rent, no? Basically, suppose I purchased the house only on 1st October. Up to 31st March I am owner only for 6 months. Then how many months I can expect the rent? 6 months only. Able to understand? Sometimes in exam they'll give you a combination provision. SSE purchased a house at 1 crore whose stamp duty value is at so and so, and the expected rent information also they'll give you. Getting it? What are the tax implications? Stamp duty value information they gave, purchase price they gave, gift provision you apply, other sources, plus 1st October you purchased it, right? From 1st October to 31st March. Getting the point? 6 months if at all your owner, you should also apply GAV computation. Here house property income is computed in this year for how many months? 6 months. Sometimes the problem will be a combination of capital gains and house property. Like SSE is having house from long ago, but he sold the house on 30th September. He sold the house on 1st October or 30th September, he sold it. Now sale consideration is there. Stamp duty value information might be given. Full value of consideration, 50 you apply, compute capital gains. 2. House property income has to be computed for 6 months only. Such a combination also they can ask. Able to understand. Now, what is expected rent? Simple. Fair rent, municipal value, whichever is higher, but it should not exceed Rent Control Act limit, because it's legally you are prohibited. So expected rent cannot exceed standard rent. So simple equation, higher of fair rent or municipal value restricted to standard rent. Now expected rent generally will be computed for 12 months. However, if the property is purchased or constructed or sold during the year, then it is computed only for the period of existence and ownership in the relevant year. Getting it? Completion certificate is the criteria for number of months property is in existence, if at all this year only you constructed. Able to understand? Then what is fair rent? Fair rent is the rent similar property in the same locality would fetch. Getting it? Municipal value means the value as per the municipal records. That's it. Able to understand? Sometimes in problem they will give you municipal value for full year, standard rent for full year, fair rent for full year, but SS is owner only for 6 months for that house. Don't consider full values, you should consider proportionate values. Able to understand? Sometimes in problems, they will give you this house is partly for house personal purpose, partly for self-occupied, partly for renting. Then NAV is equal to 0 for that portion. NAV is equal to 0 for that portion of the house which is used for self-occupation. Remaining portion, only that portion related, a fair rent, municipal value, municipal taxes paid, loan amount, everything should be considered. Able to understand? Okay. Then now step number 2. First actual expected rent, everybody understood? Now step number 2, actual rent received. What is actual rent received? Actual rent receivable first you compute. What is actual rent receivable, sir? Tenant stayed for 10 months, sir. I should also receive rent for 10 months. So number of months rented into actual rent per month minus, sir, tenant stayed 10 months, sir, but paid only 9 months rent, sir. 1 month rent he didn't pay, he left. That amount is called as unrealized rent. Unrealized rent, no, here you should reduce. You can reduce unrealized rent from the receivable rent only if 4 conditions are satisfied as per rule number 4. What are they? Tenancy must be a genuine. Defaulting tenant should have vacated. He should not occupy other property of you, and you have taken steps to recover like legal proceedings, only then you can reduce the unrealized rent here. Once you reduce unrealized rent, what you will get is called as what? Actual rent received. Now step 1 we computed, step 2 we computed. Now see step 1. Step 2, suppose if the step 2 value is higher than step 1, straight away GAV is equal to step 1 or step 2, whichever is higher. Suppose if this step 2 value is less than step 1 value and property vacant for part of a year, property was vacant for part of a year, then add vacancy period rent for step 2. See now actual rent how much after adding vacancy period. Sir, it is more than step 1, sir. Oh, if vacancy period is considered, step 2 is more than step 1. If vacancy is not considered, actual step 2 value is less than step 1, which means your actual rent received is less than step 1 because of vacancy, and therefore gross annual value is equal to actual step 2. Able to understand? Easy or not? You see, you read this actual rent received, that one put it. Add vacancy period rent. Many students will have, sir, vacancy period rent we should add. No, we should add this before unrealized rent reduction, after reducing unrealized rent, after reducing unrealized rent. That's why you follow this format. I'm telling you, you will never do mistake in the house property. Easy or not? That's it. House property GAV computation we understood. Now there are some circumstances. Okay, fine. GAV computation understood, right? Let us discuss remaining also. Then at the last, we will discuss how problems has to be solved, how different ways of problems will come, how it has to be solved. Conceptually, let us understand. Okay, now, okay, sir, GAV understood, sir. What is the computation format? What is the computation, sir? First, you should compute GAV. We know how to compute. When we should not compute also, we know. When GAV should not be computed, straight away NAV is equal to 0 we will take if the house is self-occupied, unoccupied, not rented at all throughout the year, and no benefit you are getting, NAV is equal to 0. Like this, for how many properties you can claim? 2. By the way, house property means a portion of full property. Full property. Suppose I have an independent house. I have 4 portions in that. All the 4 portions I am only stake. It is treated as one property only. How do I identify how many properties SSC has? How many registration deeds are there? Check out. Suppose in a big apartment, I have a flat. I will have a separate registration for it. In an independent house, I have 4 houses inside that. 4 portions are there. For 4 portions put together, one property it is treated as, because one registration only there for the entire house. Generally, able to understand. Next, now how to calculate NAV? Reduce municipal taxes paid. Then what you will get? Net annual value. Municipal taxes paid allowed as deduction only if it is actually incurred by owner. Suppose if the tenant is bearing, no deduction for the owner. Suppose if the property is outside India and I'm an ROR, if you are computing income under income house from house property in India, even taxes paid in foreign country can be claimed as deduction. Able to understand? Now GAV computation is over. Now once NAV computation is also, NAV over, GAV computation both are over. Now once NAV is computed, you should calculate what is income from house property. If you have to calculate income from house property, you can reduce only 2 deductions. One, flat 30% of NAV. Flat 30% of NAV. Another one you can claim it as what? Interest on borrowed capital. One you can claim flat 30%. Another one interest on borrowed loan. NAV flat 30%. How much you are spending actually, that and all doesn't matter. Straight away flat 30% you can claim. Here I have given one important note point which was asked in September 24 exam, which is actually fundamental. If a part of a property is used for business or profession, this point I even covered in PGBP revision, yes or no, then the attributable expenses can be claimed as deduction under PGBP. Suppose municipal taxes paid, repairs and maintenance, insurance and all taken for the house, and the house is 50% used for residential, our residential own SOP, 50% is used for business, or 50% I'm renting it to somebody and 50% I'm using it for my own business. Whatever I'm using it for my own business, that portion, that percentage of the property is not covered under house property. That time municipal taxes, repairs and maintenance, insurance proportionate to that 50% of the property, you will claim deduction under PGBP. Whereas in house property, these expenses you will ignore. Municipal taxes you will consider. Repairs and maintenance, insurance you will ignore under house property. Straight away you will claim 30% of NAV. Able to understand? Next. Now another deduction is what? Interest on borrowed capital. Interest on borrowed capital. Generally for purchasing houses and constructing houses, we go for loan and we will be paying interest on that. That interest can be claimed as deduction. Now this interest deduction is subject to this interest under house property, the interest expenditure is classified into two types: pre-construction period pre-construction period interest, current year interest. Pre-construction period interest means interest expenditure during pre-construction period. Pre-construction period means what? Year of completion of construction will be there. The year in which construction gets complete, no, that year ignore. Preceding all years for which loan is outstanding, that entire period is called as what? Pre-construction period. Able to understand? Remember, if I am borrowing the loan and construction of the property or purchase of the property is completed in the same financial year I borrowed loan, same financial year purchase is over, construction is over, pre-construction period logic will not apply. Pre-construction period logic will not apply. What is pre-construction period? In problem they will give you date of construction or date of purchase before 31st March. Exactly before 31st March. Date of completion 29th March sir, 2025 sir. Before 31st March means 31st March 2024. Sir, problem 30th March 2025 is the construction completion date sir. Pre-construction period means before 31st March. Sir, 10th April 2024 construction completed sir. Before 31st March means 31st March 2024. Pre-construction period end date shall be computed like this, end date. Now, pre-construction period means what? End date we know. Beginning date is what? When you borrowed the loan. When you borrowed the loan. Sir, in the problem they gave, I borrowed the loan on 1st October 2022, sir. And here, 31st March 2024 is the end date in the pre-construction period, sir. Based on construction date, I computed, sir. For this period, calculate interest expenditure incurred how much? Total interest, how much you calculate here. That interest is called as what? Pre-construction period interest. That interest is called as what? Pre-construction period interest. Wait, then we understood now pre-construction period interest. Now what is current period interest? Current year interest, current relevant previous year interest, nothing but. What is current year interest? Sir, in the problem they said construction is completed on 30th March 2025, sir. Pre-construction period means what? Up to 31st March 2024. This is PCPA. Then what about 24-25 interest? That interest is called as current year. Once construction is completed, purchase is completed in a particular financial year, that year is called as current year. From that year, every year you will incur interest again. Every year whatever interest is there, right, in that respective years, that is called as current year interest. Remember, current year interest will be changing every year. Current year will change, whereas pre-construction period will be same. Yes or no? Current year might be 25-26, current year might be 26-27, current year might be 28-29, but pre-construction period is 31st March 2024 only. In our example, able to understand. Now, so suppose SSC borrowed a loan on 1st April 2022, okay, or 1st September 2022, best example, and for construction or purchase, but for some reasons finally the property construction is completed on 2025, 30th June 2025, the property construction is completed. Sorry, 2024 we will take, because in our exam mostly problems will be 24-25 based. Okay, 24. Now yeah, correct only, 2024. Now what is pre-construction? This is date of purchase or date of completion of construction. Before 31st March means what? 31st March 2024. So 1st September to 31st March 2024, approximately 7 plus 12, 19 months, approximately 19 months. In exam they will give you loan amount, they will give you rate of interest multiplied by 19 by 12 is equal to, this amount is called as what? Pre-construction period interest. Now remember, you not only spent interest here, loan is outstanding you computed only up to 23-24 in this problem. You loan is outstanding even in 24-25 also you will incur interest expenditure on loan, right? That is called as current year interest. Now total interest is how much? This is called total interest. This amount you can claim it as deduction. Wrong. PCPI straight away you can't claim. PCPI you have to claim in 5 installments. PCPI you have to claim in 5 installments. Okay sir, from which year I will claim, sir, deduction? Until now what we computed is interest expenditure is how much. Now when I will claim deduction, from which year I will claim deduction? Array, you will show this house Only in the year of purchase, right? To the income tax department, from when you will start showing this house? Only after construction is completed, only after purchase is completed. In this question, when the construction is completed 30th June means for the first time you will show to the income tax department for which financial year? 24-25. In this year I will show. For this year I will compute GAV, municipal taxes paid, NAV. Now in this example, GAV is computed only for 9 months. Because the property's construction is completed only on 30th June. Only from 1st July I can expect rent. 9 months. Now minus municipal taxes paid, then you will get net annual value, then minus 30% of NAV, interest on loan. Here you need to reduce. Now how much you will reduce? Already you computed PCPI and you computed current year interest. Now PCPI 1/5 amount you take, current year full amount you take, total amount you take. So that amount you can claim it as deduction. From which year? From the year of first year in which you are computing house property income for that house. From the year of completion of construction onwards, from that financial year onwards, you will claim PCPI interest, not fully at a time, 5 installments you will claim. Current year interest every year you will claim, both total it and then claim deduction. How much you can claim? Whatever amount you incur. Because GAV you computed. If GAV is computed, interest expenditure, no limit at all. If GAV is computed, interest expenditure, no limit at all. Sir, I am default tax regime or I am optional tax regime. It doesn't matter. When you computed GAV, if the property is a let out property or a deemed let out property, where GAV is computed, then interest expenditure, no limit at all. Now you see, interest expenditure logic is same everywhere. Suppose the property is SOP or UOP, sir. I claimed NAV is equal to 0, sir. That time also interest expenditure is there, right? PCPI multiplied by 1/5, current year interest, PCPI into 1/5 in current year. Both put together some amount came, sir. Okay, can I straight away reduce it here? No. In case of default tax regime, if at all NAV is equal to 0, suppose you are going to declare income under default tax regime. You are going to declare income under default tax regime. And this property is SOP or UOP where NAV is equal to 0, benefit is claimed. No deduction for interest, straight away 0. In case of default tax regime, for self-occupied and unoccupied property where NAV is equal to 0, benefit is claimed. NAV is equal to 0, benefit must be claimed. Then only no interest deduction, straight away income is 0. Are you getting it? Sir, I am going with optional tax regime. Now what is the situation? Very simple. Interest expenditure you calculated, right? PCPI into 1/5 plus current year. Total interest expenditure you calculated, right? To be claimed, it cannot exceed 2 lakh. It cannot exceed 2 lakh. Actually, original limit is 30,000 only. However, if you satisfy 3 conditions, 2 lakhs limit is applicable. If you satisfy 3 conditions, loan must be borrowed on or after 1999. Okay, loan must be borrowed for purchase or construction purpose, not repairs, not renovation, all that. And this purchase or construction is completed within 5 years from the date of borrower of loan. Actually, from the end of the financial year in which loan is borrowed, that and all is there. Within 5 years logic, you remember, 99.99% of the cases within 5 years only they will buy or they will construct the property. You able to understand? If these 3 conditions are satisfied, then for a self-occupied property, unoccupied property where NAV is equal to 0, benefit is claimed, interest expenditure can be claimed as deduction up to 2 lakh. Remember, interest expenditure means what? Full PCPI plus current year, 1/5 of PCPI plus current year. 1/5 of PCPI plus current year is equal to total interest. That cannot exceed 2 lakh. If these 3 conditions, sir, some condition is failed, sir, then maximum limit applicable is 30,000. By the way, this 2 lakhs limited, 30,000 limit are there, right? Is it applicable per property or per SSE? Per SSE. This is applicable per SSE. Sir, suppose I have 2 loans, sir. 2 houses are there, both are self-occupied, sir. NAV is equal to 0, sir. But one house, no, interest amount I borrowed for repair. Loan amount I borrowed for repair. Another house, 2 lakhs limit is applicable, sir. Which limit I should take? 2 lakh limit you take. If for the SSE, 30,000 limit is applicable for one property, 2 lakhs limit is applicable for another property. If both the limits are applicable, then higher limit you take, 2 lakhs limit. Able to understand? Easy or not? Okay, now look at this theory. Loan can be borrowed from any person. Interest is allowed on accrual basis. Remember, interest on late payment of interest is not deductible. Yes or no? The total interest is computed in 2 parts. Pre-construction period interest, current year interest. Pre-construction period interest means what? From the date of borrow till the end of the previous year preceding the year of completion of construction. Very simple. Date of completion of construction find out before 31st March. That is the any date. Original from date is what? Borrowable date. Easy. Yes or no? Suppose, sir, construction is completed on 30th March, sir. 30th March. I borrowed loan on 1st April 2024, sir. Construction is completed on 30 March 2025, sir. Before 31st March means 31st March 2024, sir. I borrowed loan on 1st April 2024. How can I go backward? That's why if date of borrowal and construction date and purchase date are in the same year, pre-construction period logic will not apply. Now, what about that year interest? That year interest is called as current year interest only. Able to understand? Now, so interest incurred during pre-construction period can be deductible for a period of 5 years. The deduction commences from which year? The deduction commences from the, one student asked me, sir, previous year. Previous year in income tax means that relevant financial year. The previous year, sir, it is claimed in year of construction onwards. No, you said previous year, last year, how can we claim? Array, previous year means not last year. Previous year in income tax means the year in which, previous year in which construction is completed. Suppose you are doing 24-25 previous year problem, then 24-25 is the previous year. Yes or no? Yes. Suppose if date of borrow and date of completion are in the same financial year, PCPI is nil. That's it. Current year. Interest expenditure incurred from year in which construction is completed. That interest is called as current year interest. The same can be fully claimed irrespective of the previous year. In respective previous year. Total interest is called PCPI plus current year. By the way, PCPI means what? Only 1/5. So here you take 1/5 of PCPI. Better for better. Okay. Now, how much reduction I will get? How much reduction I will get? Sir, how much reduction I will get in case of let out property? Let out and let out, no limit at all. Whatever total interest is, you can straight away claim. Sir, suppose mine is a self-occupied or unoccupied where NAV is equal to 0 benefit is claimed, sir. Then under default tax regime, no deduction will be given at all. No deduction at all. Under optional tax regime, and it's an SOP or UOP, NAV is equal to 0 benefit is claimed, sir. And in such a case, maximum reduction is 30,000. However, if the loan is borrowed for construction or acquisition and borrowable construction or acquisition is completed within 5 years and loan is borrowed on or after 1/4/1999, then the limit is maximum 2 lakhs. And remember, this limit is per SSE, not per property. If the SSE is having 2 limits applicable, then higher limit we should take. Able to understand? Able to recollect everything? Now. So to get interest deduction, some formalities and all were there. Set off and carry forward we will discuss later. In set off and carry forward chapter, I will discuss set off and carry forward of losses. That's it. Then again, interest on loan. There is another link in 80EE. Okay, like that there is a section. Okay, 80EE section is there. There I will once again cover, and then when I'm revising chapter 6 deductions, that time I will cover this point once again. Able to understand. Next. Sometimes we receive arrears of rent. Means I am not the owner of the house. It's long 3-4 years back I have a house. That time tenant used to stay. That time he defaulted me. Unrealized rent or some amount he has to pay. Finally this year he paid me. This year whatever amount you recovered is fully taxable. In the problem they might give you additional information. That time you didn't offer income tax. That time you already paid tax on that. That $10 irrelevant. This year have you got any arrears? Yes. Have you realized any amount in the name of unrealized rent? Yes. How much you received? That is fully taxable. Minus 30% flat deduction. That's it. Able to understand. Suppose, sir, there is a house, sir, co-owned. Means two people are there as owners. 2 or more than 2 people are there owners. Then forget about number of owners. Compute GAV. NAV is equal to 0 if the entire house is self-occupied by both of them. Yes or no? Suppose it is not self-occupied by both of them. Rented. First compute GAV for rented portion. For self-occupied portion, NAV is equal to 0. Claim municipal taxes deduction. Minus 30%. Minus interest. You will get the net result, right? That net result distribute in the share. Distribute to the each owner. Able to understand. Now when you are claiming interest deduction, how many owners are there? That much limit is applicable. Limits on interest we will see only in case of self-occupied and unoccupied property. Where NAV is equal to 0 is claimed. That too under optional tax regime only. Correct? Everybody? Now, when you're doing problems, how the problems will be given. For example, SSE will be having house property. What they will do, this house property for some 5 months he rented it. Tenant vacated. Remaining 7 months he is staying it. Entire 12 months it is occupied, either by you or by tenant. No vacancy at all. Okay, like this they will give you. Now see, NAV is equal to 0 can I claim? For 5 months can I calculate NAV separately? For 7 months can I calculate NAV separately for the same property? Never. NAV is equal to 0 can be claimed when entire 12 months you stayed or it is empty. No benefit is there. But here 5 months you rented. So NAV is equal to 0 cannot be claimed. You must compute GAV. For 12 months you are owner, right? Expected rent must be computed for 12 months. You remember this problem solving method, what I'm telling you, just apply that logic, you will get it. Getting it? So 12 months. Step 2, actual rent received. You rented for 5 months. So step 2 will be computed for 5 months. Step 3, sir, step 2 is lower than step 1, sir. But there is no vacancy. Straight away, whichever is higher, over. Are you getting it? Sir, I have a house property, sir. It has 2 portions, sir. One portion is self-occupied. Another portion is let out property, sir. For this portion, NAV is equal to 0. For this portion, you will compute GAV. Now, when you are computing GAV for one portion, whereas in the problem, fair rent, similar property rent, municipal value, standard rent, they are all given for annual. Sorry, they are all given for full house. You should take only LOP portion. Suppose it is half or 2/3, whatever, some proportionate they'll give you in the exam. Only that proportionate you should take. Minus municipal taxes paid, only proportionate you should take. Then you will get NAV minus 30% minus interest. Before you claim interest, no, here also interest you will get. Suppose if the SS is following optional tax regime, you will calculate interest. Suppose if the SS is following default tax regime, first calculate interest. How to calculate interest? PCPI, current year, total interest you calculate. Split into 50-50. In case SOP is 50%, LOP is 50%. Or split into 1/3, 2/3. Or 1/4 to 3/4. Whatever proportion they'll give. Split the interest into 2 parts. Now, here whatever interest is there, claim as it is. No problem at all. Here you will interest amount you allocate, right? Look at what regime. Default tax regime, 0. Optional tax regime, see how much you allocated. Maximum you cannot allocate more than 2 lakhs. If it is for repairs purpose, you cannot allocate more than 30,000. That's it. Over. House property head of income is over. Now, sir, suppose NAV is equal to 0 cannot be claimed, sir. It's an SOP, sir. UOP, sir. I didn't rent to anybody, sir. 1 rupee rent also not there. But I have more than 2 houses. Like this. Any 2 at your option. Take it as, SOP or UOP. Show NAV 0 minus interest. Everything you compute properly, depending upon the regime. Remaining houses, compute it as DLOP. 3 houses were given. House number 1, house number 2, house number 3. Getting it? Suppose house number 1, SOP. House number 2, SOP. This is called DLOP. Compute income from house property. Don't decide based on annual value. Income in each case you compute. Okay. Then second option. Okay. This is DLOP. Remaining to SOP. Compute income from house property. Another third option. Okay. This is SOP. One is DLOP. Like that you compute 3 options. Under optional tax regime, under default tax regime. Under optional tax regime, house 1, house 2 might be best option. Whereas in default tax regime, house 2, house 3 might be best option. So which 2 houses you can claim it as SOP? Under optional tax regime, decision might change. Under default tax regime, decision might change. Ultimately, all the 3 houses put together, how much is the net income you are getting from house property? Lowest in which option you are getting, that is best option in that regime. Are you clear? All of you, that's it. Income from house property is over. Confident? Yes. Let's revise profits and gains from business or profession. Okay. And for the May 25, September 25, and Jan 26, there is only one major amendment in PGBP. Actually, there is only one amendment. It's not even major, I can say. There is only one amendment in PGBP. That is section 40B, assessment of firms. Inside that, earlier no, remuneration to working partner. Earlier, remuneration to working partner is restricted to 1,50,000 or 90% of book profit up to 3 lakhs worth of book profit, whichever is higher, or on the balance book profit 60%. Now this limit is increased. This limit is doubled. 1,50,000 instead of that 3 lakh. Now up to 3 lakhs book profit is there, right? That is increased to 6 lakhs. Anyhow, when I am discussing that concept of 40B, there I will cover that point. Okay. Fine. Let's revise the entire PGBP revision with a crystal clear understanding with illustrations also. Certain illustrations. Illustrations means not the IC illustrations or like something. I will give customized illustrations here. If you understand that illustrations and the concept which I'm revising, that is enough, more than enough. You can solve any kind of problem in the exam. That's it. And we all know charging section is what? 28. You know, in PGBP, the most important thing is, 1 minute. So in the PGBP, the most important thing is having an idea on the structure. PGBP is structured into 4 parts. Okay, 28 and 41. These two sections are talking about what incomes are taxable under PGBP. 29, okay, let me not cover this, okay. 28 and 41 talks about incomes. Then we have sections from 30 to 38. 30 to 38. These are the sections which are talking about deductions. Then we have sections called 40 to 43B. These sections are talking about disallowances, they call it as. People generally call it as disallowances. You know what I call it as? Conditions for these deductions. What are they? Conditions for these deductions. Conditions for these deductions. Indirectly, if at all you do not comply with this condition, this deduction you will not get. That's why it is called as what? Disallowance. Then finally, we have some administrative provision called 44AA, 44AB, 44ADA, 44AE, 44AD, presumptive taxation, books of accounts, and audit. And you know what? There is a section called 29, which says that entire income under PGBP shall be computed. Entire income under PGBP shall be computed by taking reference from 28 to 43B. By using all these sections, you should compute PGBP. This is the structure of the PGBP. Getting it? In the PGBP, many students do wrong problems, like in the sense they do wrong answers. The only reason they do not understand how to apply the disallowance logic. And you know, 15 marks compulsory question will be there. That is generally based on PGBP. 99% of the cases, the question, 15 marks question will be based on this PGBP. So PGBP is such an important topic, and it is easy also. It's not complicated. It's very logical. Just if you understand this logic, if a P&L account is given, how to do the problem. If receipts and payment account is given, how to do the problem. If you understand that decoding, if you understand that logic, that's more than enough. Getting it? You know, now let me straight away proceed with that. Now, what is the charging section in PGBP 28? In charging section, nothing much is there. In charging section, there is only one important element according to me, that is conversion of inventory into stock in trade. What is it? Conversion of inventory into capital asset. Conversion of inventory into capital asset. This 9th clause you see, 9th point, conversion of inventory into capital. Remember, it's not vice versa. Conversion of capital asset into stock in trade comes under capital gains. Conversion of inventory into capital asset is PGBP. Yes or no? Now, so if at all inventory is converted into capital asset. Suppose I'm a jewelry shop owner. I have a jewelry which is actually inventory, but suddenly my wife likes one model. She wants to take it and use it for personal use. She took it. Now what happened? My inventory became my personal property right now. Capital asset. It is treated as sale. It is treated as sale. In PGBP, that conversion is treated as income. How much income you should show it under PGBP? Fair market value of inventory on the date of conversion. So that much you should show it as income. And this jewelry item you might have purchased at some price earlier. Fair market value minus purchase price is equal to business profit or business loss. That's it. Able to understand? Same way, sometimes our capital asset will be there. That is converted into PGBP. See, when you are converting this into capital asset, you are calling it as selling price, right? When that is converted, when capital asset is converted into PGBP, you are bringing into business. Means it should be recorded as purchase. It should be recorded as purchase. At what value? Same fair market value on the date of conversion. If capital asset is converted into PGBP, if capital asset is converted into PGBP, that item becomes inventory. What is the purchase price for the inventory? Market value on the date of conversion. In the capital gains chapter, the same market value is treated as full value of consideration for the purpose of computation of capital gains under 45 subsection 2. If you recollect, under capital gains 45 subsection 2, the capital asset transfer into stock in trade conversion is not taxable in the year of conversion, but it is taxable in the year ultimately when I sell the stock in trade in the business. Now in PGBP, what is the business profit on this converted capital asset into stock in trade? What is the business profit? Sale price plus or minus, sale price minus market value of the conversion. Market value on the date of conversion from capital asset to stock in trade. That is equal to again business profit or loss. Able to understand? Able to understand? That's it. So that is one important point in entire charging section. Rest of the points in charging section, no, whenever it is necessary in the revision, wherever it is necessary, I'll come back to it. Now, what is the method of accounting in PGBP? Remember, for other sources and business or profession, you should maintain accounting records. There is a section called 44AA, which we will discuss little while later. That section says if you satisfy certain parameters, getting it, you must maintain, simple, in that section, 4 categories of SSS has to maintain accounts. 44AA section says 4 categories of SSS has to maintain accounts. So what are the 4 categories of SSS? We will come back to that later. Getting it? Now, what is a method of accounting? Very simple. How are you maintaining books of accounts? Accrual. In PGBP also, computation shall be based on accrual. Suppose if you are maintaining books of accounts on cash, then in PGBP also, books of accounts shall be maintained on cash. Just 1 minute. Yes, sorry for the interruption. Yeah. So, if the books of accounts are maintained on accrual, PGBP income is also calculated on accrual. If the books of accounts are maintained on cash, PGBP income is also calculated on cash basis. That's it. Okay. Now, remember in PGBP, no, when we are discussing incomes and expenses, no, sometimes they will use the word paid, or sometimes they will use the word payable. Paid or payable shall be interpreted in context of method of accounting. Suppose if the word used is paid, don't think that it is actually paid. Okay. If it is accrual basis, in PGBP, income is taxable on accrual, expenses are also, deductions are also given on accrual, except 43B. Except 43B payments. In 43B, 7 types of payments are there, 7 or 8 types of payments are there. Those deductions you will get only if you actually pay. And remember, 43B section is applicable only for the SSC following mercantile basis of accounting. Okay, fine. I'll come back to it. So this is the PGBP related method of accounting. And in 145B, in 145B, if at all you are getting any subsidy, grant, any other from government for your business or profession, that is taxable only when you receive it, irrespective of your method of accounting. Your method of accounting, accrual or cash, doesn't matter. Government grant, when the government declared the grant, that time not taxable. Only when you receive it, taxable. Same way, if you are getting any interest on compensation or interest on enhanced compensation related to transfer of some capital asset, generally that interest amount is taxable under other sources. Getting the point? Straight away the interest is taxable under other sources. 145B is addressing 2 issues. One is interest on compensation. Interest on compensation is directly taxable under other sources. And if you recollect, we discussed in our class, flat 50% deduction is available. What is it? Flat 50% deduction is available. That's it. And suppose if the SS is having multiple businesses, if the SS is doing some cotton trading, some rice trading, some manufacturing, some iron and ore, getting it, and he is also having a software company, like that, some 5 to 6 kinds of businesses SS is doing. For each business, you should compute income separately. At the end of the computation of all the business incomes, combine it, you will get total income under PGBP. Getting it? That's it. Now, there is something called income computation disclosure standard, which is not relevant at CA Inter. ICDS standards are applicable for an SSE who is liable for, who is following mercantile basis. Who is following mercantile basis. Remember, individuals and HUFs who are having business but not liable for audit under 44AB, they are exempted from ICDS. MCQ, this is important. Getting it? They might test this under MCQ. That's it. This is introduction to the PGBP, which is more than sufficient. Directly, we have something called speculation related discussion. This entirely we will be covering in set off and carry forward revision. Okay. Now, what are the various deductions? First deduction is what I told you, right? Entire PGBP, incomes are covered under 28 and 41. What are all incomes taxable under PGBP? Very simple. If you are getting any amount related to business, it is taxable under PGBP. Able to understand? So, incomes, there is no need to learn specifically what incomes are taxable. Very simple. You are doing manufacturing, sale of goods. You are providing services, sale of services. You are providing any other additional warranty, all that. Whatever income you are getting from that and all is taxable under PGBP. Now, what expenses you can claim under PGBP? What expenses you will get? What deductions you will get? Deductions are covered under section 30 to 38. Actually, 37 only. 38 section says, if at all any deduction, if at all any expenditure you spent, that is used for both business and personal purpose, only business related portion you should claim. Personal related portion you should not claim. That is where it is said 38 section says. So 38 section is not a deduction section. 38 section is a clarification section. Now, 30 first deduction section. What is this first deduction section is saying? This deduction section is saying deduction for building expenses. Remember, building expenses, building related expenses. Now, what are the deductions? Suppose, sir, I am a tenant, sir. So what expenses will be there for building? Rent I will pay, sir. That is allowed. Sir, here the word used is paid. No, which means cash basis. Huh? No. Getting it? If at all SS is following accrual basis, paid means payable. Getting it? Remember, all the deductions under PGBP, you will claim deduction on accrual basis if at all you are declaring income under accrual. If your books of accounts are accrual, in PGBP, each and every expenditure, each and every deduction is only on accrual. Accrual means what? You incur, that is enough. However, there is a section called 43B where 7 types of payments are covered. These 7 types of payments you will get deduction only on cash basis. Rest all other expenses on accrual, and inside that 43B, rent is not covered. Therefore, rent, the word paid means what? Rent incurred. That's what the meaning. Able to understand? Suppose if the SS is following cash method of accounting, if the SS is following cash basis, then the rent must be paid by 31st March. Only then the expenditure will be given as deduction. Cash method of accounting means what? From 1st April to 31st March. See, for you, the problems will be based on 1st April 2024 to 31st March 2025. May exam, September exams, all that. Getting it? January 26 also. The financial year which will be tested in exam is 24-25. In that year, if you receive any money, that is taxable. In that year, if you pay money, that is deductible. That is cash method of accounting. Yes or no? Now, then another expenditure, repairs. Repairs expenditure is allowed as deduction. Remember, it must be borne by the tenant. Further, tenant might sometimes pay what? Property taxes. He might also pay what? Insurance. He might incur some other expenses. They can also be claimed as deduction. And remember, repairs. They said repairs, right? Which kind of repairs are allowed as deduction? Capital nature. Sorry, revenue nature is allowed. Repairs of capital nature, they are not deductible. Repairs of capital nature. Suppose, I am a tenant, sir. I have taken a building on rent, sir. I incurred some capital expenditure on some renovation, sir. What should I do? I cannot claim deduction. You can't claim. You should create a block to it. You should create a buildings block. Getting it? And then add that into the buildings block. Suppose if it is interior work. Suppose you took a building on lease. You took interior work. Interior is generally coming under furniture meaning. Getting it? You add it to the block of asset under section 32, you claim depreciation on that. So if repairs of capital nature is incurred, they are not deductible, they are added to block, and depreciation can be claimed by the SSE. Next, premises partly used for business and partly used for others. Very simple. Sir, the building which I am using for business, that is also used for other purpose, sir. What should I do with regard to this? Very simple. Claim proportionately. Getting it? Business purpose only you should claim expenditure. If at all some expenditure is being enjoyed in other purpose also, being enjoyed by personal purpose also, don't claim deduction for that. Yes or no? Sometimes in problem, they'll give you like, okay, let me cover this point also. Sir, SSE is the owner of the building. Rent alone will not be there. Rent expenditure alone will not be there. Rest all other expenses, repairs will be there. Municipal taxes he might be paying. Insurance expenditure is there. Everything else is there. But remember, property taxes, they are subject to 43B. Able to understand. Now, there is one more expenditure. With respect to building, you might have borrowed some loan also, right, from the bank. Interest on loan related to building, right? That interest on loan is covered under section 36. The interest on loan is covered under section 36. It is not covered under section 30. Able to understand? That is also building related loan only. Remember, any interest expenditure paid on or after the building is put to use. On or after the building is put to use. The interest expenditure related to that period on or after building is put to use is a revenue expenditure. You should not add it to the asset value. You can claim deduction under section 36. And remember, interest to banks and financial institutions is subject to 43B. Interest to banks, interest on loans borrowed from banks and FIs is subject to 43B. 43B means what? That expenditure you will not get deduction just on accrual. You should have actually paid by due date for filing IT return under 139 subsection 1. Yes or no? That's it. Now in problem they'll give you sometimes. For example, in September 24 they have given one problem like SSE has house property. In the house property, 50% is used for business, 50% is used for 50% used for residential purpose, personal purpose. Municipal taxes, repairs expenditure, they all give you. In house property, repairs, insurance, all that you ignore. In house property, for the 50% portion, you directly claim 30% of the NAV, correct? Whereas in PGBP, you should consider that repairs, you should consider the insurance, actual expenditure, how much proportion, whatever is used for business, that much actual only you should consider. Whereas in house property, we ignore actuals, we straight away claim standard deduction. Remember this point. Getting it? Same way, municipal taxes paid. 50% is for house property. 50% is for business. In house property, you will get deduction only if it is paid in the 31st March before. Whereas in PGBP, municipal taxes paid on or before due date for filing IT return under 139 subsection 143B, up to that you can click. Able to understand. That's it. Next, coming to next one is what? Machinery, plant, furniture. Very simple. Any repairs and maintenance incurred on this. Any repairs and maintenance expenditure incurred on this plant and machinery furniture, you can claim deduction. Sir, I leased this plant and machinery, sir. What about the lease amount? What about the rent amount? You can claim deduction under section 37. You can claim deduction under section 37. Because section 31 is silent on rental amount of plant and machinery, all that. Suppose for my business purpose, I took plant and machinery on rent. What should I do? You can claim deduction under section 37. Able to understand. Next. So repairs and maintenance, assets must be used for business. Usage includes passive usage. Passive usage means what? Sir, I purchased machinery, sir. I just kept it idle. It's installed. Just to switch on, it will start working. It is ready to switch on and start working. Is it ready to use? That's enough. You need not actually use it. Getting it? That's it. Remember, repairs, that too. Which kind of repairs are allowed as deduction? Only current repairs, only revenue repairs. Capital nature are not deductible. They are added to block. Then, now for insurance and for plant and machinery furniture and all, no, you will be incurring some insurance expenditure also. Deduction is allowed for insurance premium paid. Deduction is allowed for insurance premium. Incurred is enough. Getting it? That's it. Then this point is not required. Okay, majorly it is done. 31 is over. 2 deductions we completed. Now the next major deduction in PGBP is 32, depreciation. Major deduction is what? Depreciation. Remember, depreciation is mandatory to reduce from the block of asset. Compulsorily you should reduce. Where, you should claim compulsorily depreciation. You should also reduce the depreciation in the block. Under PGBP, very important, most important, depreciation is the most confusing point where 90% of the students do wrong answers when they are computing depreciation. Very simple. In PGBP, depreciation is calculated based on block of asset approach. Depreciation is calculated based on block of asset approach. However, for power sector, who is engaged in generation or distribution of power, getting it? Any entity which is engaged in power generation or power generation and distribution, whatever they have in the first year of business. For them, in the first year of business, they can either choose SLM, asset wise, or they can use WDV method, block of asset approach. This option is given to them only in the first year. Only in the first year. First time they are claiming depreciation under income tax. They can claim on SLM basis if they want. Once they choose this, forever that power sector has to go with SLM method only. For that, depreciation is given under, depreciation rates are given separately. For power sector SLM basis, depreciation rates are given separately. There is something called appendix 1, appendix 1A, depreciation rates. Okay, so one appendix is applicable for block of asset approach, another appendix is applicable for SLM method. That's it. Now suppose the power sector decided, no sir, we don't want SLM, sir, we will go with the block of asset approach. Then if they choose block of asset approach in the first year, the same they should follow forever lifetime of the electricity company. Able to understand? Now remember, electricity companies, there is something called additional depreciation. Remember, there is something called in PGBP additional depreciation. Additional depreciation is eligible for whom? Manufacturing entities, power sector. Power sector additional depreciation they will get only when they follow block of asset approach. If they follow SLM, they don't get additional depreciation benefit. Yes or no? That's it. Now, sir, what do you mean by block of asset? Very simple. In income, block of asset means 1 or more assets, 2 or more assets falling under same category and carrying same rate of depreciation, same percentage of depreciation, same category. In income tax, thumb rule, the categories are only 4: intangibles, buildings, furniture, plant and machinery. Any asset you buy, suppose I bought a computer, suppose I bought books, suppose I bought air conditioner, I bought a mobile phone, I bought a car. All these items are not intangibles, they are not buildings, they are not furniture. So books comes under plant and machinery, computer comes under plant and machinery, motor car comes under plant and machinery. So they are all plant and machinery. And see what is the rate applicable. See what is the rate applicable. For that, don't remember all the rates. I will tell you what rates to be remembered. Most important rates. This entirely is PGBP only. You see, for example, what is the rate of depreciation for intangibles? Straight away 25% block. Rate of depreciation is what? Straight away 25. Buildings. Suppose if the building is used for residential purpose like staff quarters, residential premises, 5% is the rate. Suppose if the building is not used for residential, factory, official purpose, office purpose, 10%. Suppose if the building is a wooden structure, then 40% is the rate of depreciation. Suppose it is a furniture, then rate of depreciation is 10%. Remember, furniture, all furniture should come under one block. Buildings, 5% buildings, all that should come under one block. 10% building should come under another block. 40% building should come under another block. So within buildings you have 3 blocks. Then coming to plant and machinery, in plant and machinery, entire totally 5 blocks only possible. Plant and machinery 30% block, plant and machinery 45%, plant and machinery 40, plant and machinery 20. Many students confuse here. They will think it is a computer block, books block. No, it's a plant and machinery 40% block. What are all the assets eligible for 40% depreciation? Assets eligible, no? Renewable energy devices 40%. Computers, including computer software, even computer printers. Printers are also eligible for 40%. Books, whether annual or professional, doesn't matter. You are purchasing books, which is 40%. Pollution control equipment, aeroplanes and engines, life-saving medical equipment, they all come under 40% block. You should call them as only plant and machinery. Getting it? So if they, in the problem they'll give you SSC purchased so and so, computer, books, aeroplanes, all that. You should include them in one block. Like how to compute depreciation block wise, we'll come back to it later. Just 2 minutes, we'll come back to it. Then remember, if energy devices, if at all they are installed before April 2014, then it is 50%. 99% they won't test it. Getting it? Then cars, motor cars. What is the depreciation rate for cars? Motor cars, generally what is the rate of depreciation? 15%. Suppose if the car is purchased between 23rd August, if the car is purchased between 23rd August to 31st March 2020, which is actually generally not required. Mostly they won't give this point, 30%. Generally, if the car is used for taxi purpose, hiring purpose, renting purpose, depreciation is 30. Sir, I bought a car not for renting, sir. I bought a car for my director's purpose, sir. My office, business purpose, sir. Then rate of depreciation is 15%. Suppose in this list, no, mobiles is not covered, air conditioner not covered. They all come under what category? Any other plant and machinery. They all come under what? 15% block. You able to understand? That's it. Now, so this is block. So block of asset. Now, what are they saying here? Block of asset. So what do you mean by block of asset? Asset falling under same category, carrying same rate. You should divide them into block, a single block. Now, how to compute depreciation on the block of asset? This is the question. This condition I will tell you, then I will open depreciation format. You in income tax under section 32, when you should calculate depreciation? 31st March of the relevant previous year. The year begins on 1st April 2024. Year ends on 31st March 2025. You should calculate depreciation on 31st March. You should calculate on 31st March. On 31st March, you will calculate depreciation if 2 conditions are satisfied. One, block exists. One condition is what? Block exists. Another condition is what? WDV exists. What is it? WDV exists. Written down value also exists. Block must exist. Inside the block, WDV must also exist as on 31st March. Sir, what do you mean by WDV? Many students thinks that WDV means after reducing depreciation, closing. No. Closing WDV after reducing depreciation is different. WDV of the block is different. WDV of the block means what? I will show you right now. This is the format. Suppose you see this is a depreciation computation format. You should follow. See, I have given you how you should present in the exam also. I have given you how you should calculate normal depreciation, how you should calculate additional depreciation. If you follow this format, you 99.99%, no, 100 out of 100%, you will get the right answer only. You will get the right answer only. You follow this format. Now, what is the WDV of the block? First to know, opening WDV you take of the block on 1st April. Sometimes when you are solving the problem, they will tell you WDV as on 31st March. Many students, what they do, they take it as opening. No, wrong. WDV as on 31st March. If at all the problem says WDV as on 31st March, simply, they did not mention before depreciation, after depreciation, they did not mention. By default, it means before depreciation. By default, it means before depreciation. WDV as on 31st March 2024, they said. It's nothing but 31st March WDV of 2024 before calculating depreciation for 23-24. Suppose in problem they said very clearly WDV as on 31st March after allowing depreciation. Then that is opening WDV for this year. Remember this point. Suppose in the question they said WDV. In our ICA illustrations, these problems were there. Same namings were used. You go and check. WDV as on 31st March means it's not after reducing depreciation, it is before reducing. If the question clearly says after reducing depreciation, then only you take it as after reducing. Suppose no, in the question they gave WDV as on 31st March simply. Now they are asking you to find out current year depreciation how much. What many students do, they will take it as opening and they start calculating depreciation. Wrong. First give last year depreciation reduction. Then you will get closing WDV after depreciation of last year. That you take it as opening WDV. Then in the current year, how you should calculate depreciation in the current year. First identify what is the opening block value. What is the opening block value? Identify. For that you should add 4 items. You should add 4 items. Many things only 3 items, but there are 4 items to be added. 1. Assets. You should add what? Actual cost of. You should add what? Actual cost of assets acquired during the previous year. Actual cost of assets acquired. Immediately some students say, is there assets acquired and installed also? No. Acquired enough. If you acquire, you add it in the block. See, for claiming depreciation, installation condition is required. For adding in the block, installation condition is not required. Many don't know this. For claiming depreciation, only installation condition is required. For adding in the block, installation condition not required. Now you see here. How you should assets put to use for less than, more than or equal to 180 days. How much? Assets put to use for more than or equal to 180 days. The cutoff date is 4th October of the previous year, relevant year. Suppose right now your problem will be based on 24-25. If the asset is purchased and used, if the asset is purchased and installed before 4th October, straight away it is used for more than or equal to 180 days. Straight away is used for more than or equal to 180. If the asset is installed, see, I'm not using the word purchase. If the asset is installed on or after 4th October 2024, number of days from 4th October to 31st March is 179, which means the asset is used for less than 180 days. So in the problem they'll give you additions. Look at the date of installation. Sometimes in questions they don't give you date of installation, they only give you date of purchase. If date of installation is not specifically given, we assume that on the purchase date itself asset is also installed. Able to understand? Yes, sir. So assets purchased and installation date, you see, accordingly you categorize the assets into more than 180 or less than 180 you categorize. Apart from that, you should also add 2 more. Sir, I also acquired some assets, sir, but not at all installed, sir. Not at all installed as on 31st March. It is not ready for use. No passive usage also. That amount you separately add. Suppose if the SSE has incurred any capital repairs. If the SSE has incurred any capital repairs, we just discussed under 30 and 31 section, that also you add. Then opening value, add actual cost of assets acquired and capital repairs incurred during the year, added. Then what you will get, value of the block, which we call it as gross value of the block, opening plus additions. Remember, here I am going to discuss capital gains point also, section 50. Getting it? Now less from this, what you should raise? See, first you are calculating closing WDV of the block before depreciation. Remember, in exam they don't use the word before and all, they simply use the word WDV of the block as on 31st March 2025, 31st March 2024. If they simply mention WDV as on 31st March, you should consider that as before depreciation. Unless they specifically tell you, you should not consider it as after depreciation. Yes or no? That's it, WDV. So how do I get WDV of the block? Remember, 2 conditions are there. WDV shall exist, block shall exist. This condition I'm discussing now. WDV means what? This value must be there. This value must exist. This value must be positive. Only then I can claim depreciation. Only then I can claim depreciation. This value must be positive. Asset also must be there in the block. Means block should be there. Block is there, value is there. Then I will calculate depreciation. If value is turning negative, if the value is turning negative, for example, why? Like, you understood gross block, right? From that, what you should reduce, what you should reduce, block is there, right? Inside that, some part of a block. Please, you see the word I used is part of a block, not full block. If at all full block is transferred. Transfer means sale, demolition, destruction, compulsory acquisition, any reason. My depreciable assets, no. Government compulsorily acquired, or they were destroyed, I received insurance compensation, or I sold them, I received sale consideration. Simply speaking, with respect to assets belonging to this block, right? In this block some assets are there, right? Have you received any money regarding them? Yes. That money received, reduce it. That money received, reduce it. That too, you will reduce here. You will follow this format, whatever I'm telling, only if it is a part of a block transfer. Suppose, very simple. Look at this question. Already in the capital gains also I told this point. Getting it in the capital gains revision also I am covering this point. Very simple. Sir, opening WDV they gave sir in exam, which is 10 lakhs sir. Additions during the year sir, which is 8 lakhs sir. Getting it? Now in this year no, part of a block only sold sir. Part of a block only sold. Okay sir, part of a block is sold for some 9 lakhs sir. Now tell me, is depreciation applicable? Yes. Opening plus additions is equal to 18 lakhs minus money received on part of a block 9. Balance is 9. So value is there as on 31st March. WDV is there. Block is also there. I will straight away go and calculate depreciation. Suppose sir, I sold this part of a block for not 9 sir, but 19 lakhs. Part only I sold, but 19 lakhs money I got. Sir, opening plus additions is 18 sir. If I reduce 19 minus negative is coming sir, WDV block value can never be negative. It can only be 0. Then what about that extra one? You will straight away tax it as short term capital gain. You will straight away tax it as short term capital gain. If part of a block is sold, either short term capital gain you will get or depreciation you will get. Sir, suppose no sir, opening is 10 lakhs sir. Additions during the year 8 lakhs sir, but you know what, full block is sold sir, full block is acquired compulsorily, full block is destroyed sir. I got insurance compensation 9 lakhs sir. I got insurance compensation 9 lakhs sir. Now what is the tax treatment? Very simple. Full block is sold. As on 31st March 2 conditions shall be satisfied. Block must exist, value must be there, WDV value must be there, yes or no? Written on value must be there. Now written on value 10 plus 8 minus 9, WDV value is there, but the block is not there. But the block is not there. When the block is not there, straight away section 50 you should apply. Straight away section 50. When section 50 is applicable, opening plus WDV 18, this much value of the block I sold for 9 lakhs. Short term capital loss. If amount received is less than gross block value, short term capital loss. If the amount received is more than gross block value, then the amount is called as short term capital gain under section 50 in case of full block. Part of a block. If amount received on part of a block is more than the gross block value, straight away the extra amount is capital gain. If the amount received on part of a block is less than gross block value, then WDV value is there. You can still claim depreciation. Able to understand. So here, so for money received on part of a block, reduce this. Here there is something point regarding slump sale is there. This is not that required. It's okay, no problem. Okay, so this I think I already covered in slump sale revision also. In capital gain slump sale revision I already covered. Getting it? So reduce it. Then what you will get? Closing WDV of the block. Now you should calculate. By the way, this is before depreciation. Now on this value you should calculate depreciation. On this value you should calculate depreciation. For example, I will give dummy numbers. Suppose I purchased for 10 lakhs sir. Assets I purchased which are used for more than 180, 5 lakhs I purchased. I purchased for what price? 5 lakh. Assets I purchased sir, but installed and used for less than 180, 6 lakhs sir. And I also purchased assets sir, which I have not yet installed sir, 8 lakhs sir. And you know what? Some part of a block is sold sir. Some machineries relating to this block no, I sold. By the way, this is a 15% block sir. For our computation purpose, let us assume this is a 15% block sir. You know what? I sold approximately almost, this is a gross block value is how much it is? 18 plus 11, 29, correct? Almost 29 is the gross block value. You know what? I sold approximately 14 lakhs worth of block sir. 14 lakhs worth of block. You know, this is case number 1. 14 lakhs worth of block I sold sir. Part only I sold. What is the balance block value? 15 lakh. Now calculate depreciation. In exam you should follow the same steps. Working note 1. What is working note 1? WDV of the block before depreciation how much? Just now we computed how much it is? 15 lakhs. How much it is? 15 lakh. Now look at the answers here. Look at the point. First, allocate the value to assets bought but not used. How much in our example assets bought but not used? Assets bought 8 lakhs is there. Okay, out of this 15 lakh, no, 8 lakh I will allocate here. How much it is? 8 lakh. Then still how much is there? 7 lakh. Then second you should allocate the value to assets used for less than 180 days. How much is the value of the asset less than 180? Oh, 6 lakhs is there. Okay, 6 lakhs I will allocate. This is how you should do allocation. Then balancing figure 1 lakh. Now what is the rate of depreciation? Here no, nil depreciation, because asset you purchased only but not installed. In the year in which you purchase the asset and not installed, normal depreciation you can't claim, but second year onwards you can claim depreciation on this, because second year onwards it will belong to opening value. You can't find out this kind of breakup in the second year. That is why they say normal depreciation is not allowed in the year of purchase if the asset is not installed. Suppose if the asset is not installed in the year of purchase, normal depreciation is not allowed only in the first year. Second year onwards can I claim? Yes. Why you can claim in second year onwards? You don't claim separately. It is forming part of opening value. That's why you can claim. It is forming part of, in the second year it will come under balancing figure if at all there. Able to understand? Now 0. Now in current year 6 lakhs is there, right? 6 lakh. Now what are they saying? Apply half rate on this value. Half rate means what? 6 lakhs into 15% into half only. How much is it? 45,000 is a depreciation. Then 1 lakh is there. Apply full rate into 15%. 1 lakh 50,000. Sorry, 15,000. What is it? 15,000. So total normal depreciation is how much? 60,000. Able to understand? Total normal depreciation is 60. Now if the SSE is engaged in manufacturing, he is also eligible to claim additional depreciation. In that case, working note 2 will be there. Part number 2, depreciation is computed. See, this is working note 1. In this working note 1, part 1 computation is normal. We understood right now normal. Now, okay, now we will understand part 2. Don't worry, I will take one more illustration here itself. Part 2, additional depreciation. How to calculate? You know, additional depreciation. For example, in the problems they gave some machineries and all. You know, machinery purchased during the year but not installed. Additional depreciation is 0. Sir, second year also it is not installed. Same 0. Third year it is installed, sir. That year you will get additional depreciation. Additional depreciation you will get in the year of installation. Sir, I installed, sir, in this year. Machinery I installed, sir, but used it for more than or equal to 180 days, sir. Then look at actual cost. Remember, for computing additional depreciation, WDV value is irrelevant. What is important? Actual cost multiplied by 20%. You will get some amount. Suppose if the machinery is used for less than 180 days, you will get 10%. Balance 10% you can claim in the next year. When you are solving the problem, see whether in the before year, any additional depreciation is there, balance 10% is there or not, check out in the before year. Getting it? Machinery A brought last year, balance additional depreciation to be claimed how much? Actual into 10%, that value. Remember, if at all any balance additional depreciation is there, coming which is belonging to the last year, getting it? Balance additional depreciation, can you claim in the current year if at all you are following default tax regime? No. If at all the SS is following default tax regime, getting it? You cannot claim additional depreciation. Remember that point. Okay, that's it. You calculate additional. Now what is the total depreciation? Part 1 plus part 2. This value you should include here. Then you will get what? Closing WDV as on 31st March after depreciation. Are you getting it? Suppose, sir, in this question, for example, this is not 14 lakhs, sir. For example, this is 20 lakhs, sir, sale value. How the answer will change? Very simple. If it is 20 lakh, WDV before depreciation is how much? 9 lakh. So here how much value is there? How much value is there here? Just a minute. So how much value is there? 9 lakh, correct? So how much value is there here? 9 lakh. Now anyhow, first I should allocate for what? Assets bought but not used. How much is the asset bought? 8 lakhs. 8 lakhs into 0% depreciation 0. Then yes, second allocate, balance only 1 lakh is there. Here we have how much value? 6, but I have only value how much here? 1 only there. So 1 only I will allocate. Able to understand? So 1 lakh multiplied by 15% into 1 by 2 is equal to so and so amount. Balancing figure 0. Entire 9 lakhs is allocated, 8 here, 1 here. That's how allocation should be done. Able to understand? That's it. This is how you should calculate depreciation. Easy. All of you. Now additional depreciation. Who will get additional depreciation? SSE not following default tax regime. First point. 2. SSE not following default tax regime. Second condition. SSE must engage in manufacturing or generation of power or generation and distribution of power. Power sector is eligible provided only when they follow block of asset approach. How much is the rate of additional depreciation? 20% of actual cost you will get as a deduction. Further, Additional depreciation is eligible only for new plant and machinery. Remember, we have given here itself. Additional depreciation is eligible only for new machinery or plant acquired and installed in the factory. Getting the point? If it is installed in office premises or residential premises, no additional depreciation. You will not get additional depreciation on any type of vehicle, roads, ships, aircraft, transport vehicles, nothing. You will not get additional depreciation. If at all, you are claiming 100% deduction on it. If at all you purchase any asset for scientific research, you cannot claim additional. Forget about it. You can't even claim normal depreciation. If you purchase any asset for scientific research, that will not come under block. If you purchase any asset for specified business, capital expenditure, that will not come under block. Yes or no? And second hand machinery, getting it, you will not get additional depreciation. What is additional depreciation? 20% of the actual cost. If the asset is put to use for less than 180 days, you will get only 10%. Balance 10% will be claimed in the subsequent year. Easy or not? 32 is over. 32 is over. So entire matter is given here. Getting it? Remember, here I not only covered depreciation computation, I also covered section 50 capital gains computation also I covered. Yes or no? Now there are few points. You will not get depreciation on land and goodwill at all. Getting it? Okay, depreciation is allowed on spare parts and components also if at all they qualify for capital expenditure criteria. Plant and machinery definition includes ships, books, vehicles, scientific apparatus, surgical equipment. I told right. And tea bushes, livestock, building, furniture, they are all not plant and machinery. Remember, tea bushes and livestock, they are not at all eligible for depreciation. Getting it? Then that's it. You know, remaining points are not that important. This is enough. This understanding is enough from exam point of view. Clear? Yes. Next. Now coming to power sector. Power sector, they are eligible to claim, deduction. They are eligible to claim terminal depreciation and balancing charge. Power sector, if at all following WDV method. For them, no, depreciation will be calculated on what basis? For them, depreciation is calculated on what basis? Depreciation is calculated on SLM. Even for power sector also, we will calculate depreciation only on 31st March. If the asset is still existing, then only we will calculate depreciation on 31st March. Suppose as on 31st March, asset is sold. Opening date, asset is there. 31st March, asset is sold. See, I am using the word asset, not block. Power sector, SLM basis. Asset is there. Opening value 10 lakhs, sir. 31st March, it is sold, sir. At what price? 5 lakhs. 5 lakhs is loss, no? Don't call it as loss. Call it as terminal depreciation. Sir, 10 lakhs is the opening value, sir. Asset is sold for 15 lakhs, sir. Original cost is 20 lakhs, sir. Original cost is 20. Okay, 10 lakhs worth of asset you sold for 15. No, 5 lakhs profit is right. You call it as balancing charge. 41 subsection 2. Balancing charge. It is treated as income under PGBP. Sir, same opening value 10 lakhs, sir. I sold for 25 lakhs, sir. You know, original cost is 20 only, sir. Which means you have a profit of 15 lakh. Profit up to original cost 10 lakh is taxable as balancing charge under 41 subsection 2 PGBP. Extra 5 lakhs is there, right? You profit over and above original cost. That 5 lakhs is treated as short-term capital gain under section 50A. You will straight away treat it as what? Short-term capital gain under section 50A. Clear? Hey, what happened? Yes or no? That's it. Next. With this, depreciation computation is completed. Next, we will straight away proceed with the actual cost. What do you mean by actual cost? Remember, in depreciation block, no, you should add actual cost of additions. No, in the recent January exam, this was asked for 3 or 4 marks question. Getting it? What is the actual cost? Sir, I purchased, some asset is there, sir. I purchased it for scientific research, sir, first. But after using there, no, I directly brought into my normal business, sir. Means I added into my normal block, sir. At what value you should add? Actual cost minus deduction allowed. Generally, it is nil. Getting it? Then, sir, my inventory, no, sir, I am converting into capital assets, sir. My inventory is there, right? Nothing but, sir, actually, I have a furniture shop, sir. I have a furniture, which is actually inventory, sir. This furniture, no, I converted into my office appliance, office furniture, which means I am converting from inventory to fixed asset. Now, how much value you should add in the furniture block? Market value on the date of conversion. Remember, if this point is given in the question, no, you should add in the block, as well as you should also show it under sale. You should show it as sale value, 10 lakhs market value. The 10 lakhs will be added in the block also. Remember, what is the tax consequence? MCQ might come, or they might ask you a 2 or 3 marks question. SSE has furniture, or SSE has some machinery which is inventory for him. He converted into so and so depreciable asset. Now, what is the tax treatment? You should treat it as sale plus you should also add it in the block. What value? Market value on the date of conversion into capital asset. Remember, capital asset means what? In case of business, depreciable asset is also a capital asset. Yes. Sir, I got the asset as a gift or inheritance. I got the asset under gift or inheritance, sir. How much? How much is the cost to previous owner? Check it out. Minus notional depreciation, reduce it. Plus installation expenses you might have incurred now when you purchased after installation, that and all you should add it. No, cost to previous owner. Previous owner purchased 10 lakhs, sir. He gifted me now. Getting it? Now 10 lakhs, don't take it as cost. Don't add directly 10 lakhs in the block. When he purchased, how many 31st Marches were there? You see, how many 31st March were there? He purchased, I got it, no? Between how many 31st March is there? You see, for each 31st March, on WDV basis, reduce notional depreciation. Whatever the rate applicable to that asset. If it is computer, 40%. If it is other plant and machinery, car and all, 15%. So, for every 31st March on WDV basis, that rate you apply, you will get WDV value. That value you should add in the block of your assets. Able to understand? Easy. Next, then suppose SSE transferred asset used for business. I am using for my business one asset. I sold. Again I repurchased. Very simple. What is the price on reacquisition? How much price you paid at the time of reacquisition? Check that. You have actual cost, no? You purchased, no? Minus depreciation till the date of sale. You sold now, right? Yes or no? Later you acquired it. Up to the sale date, how much is the depreciation? Check out. Original cost minus depreciation up to the sale date, check out. WDV value, check out. WDV value on the date of sale. Simple. WDV value on the date of sale. Getting it? Check out. Compare with the cost at which you acquired, whichever is lower. That is treated as actual cost of addition to the block. Able to understand? Next, we already discussed this enough in the in-depth in the class. Again, logics and all I can't discuss in the revision class. Okay. Then, sir, second hand asset is there, sir, given on lease. Okay, hire or otherwise to previous owner. Previous owner himself I gave. What is it? I purchased an asset from him. Actually, my friend is owning an asset. I purchased it from him. Again, I gave him lease. I purchased it from him. I gave him back as lease. Some tax related fraud they are doing. Now, what is the block? WDV to the previous owner will be treated as the block value. Getting it? What price you paid for purchasing from him? Don't add. Because no, you purchased and give it as a lease to him only, which means there is some tax manipulation. So don't record that purchase price. WDV to him in his books of accounts, how much? The same value will be treated as purchase price for you. Simple. Able to understand. Next, sir, I have a building, sir. I brought into business. My personal asset I brought into business, sir. If it is building, original cost how much? Identify. Minus notional depreciation for every 31st March from the date of purchase of building till the date I am bringing into business. Suppose I purchased the building in 2019 April. 2019 June I purchased the building. I am bringing into business on 20th June 2024 in the problem. 2020 31st March, 2021 31st March, 2022 31st March, 2023 31st March, 4 31st March is there before I bring into business. For 4 31st March, reduce notional depreciation. Now, moreover, if it is a personal building, no, you might have used it for residential purpose. Then 5% depreciation. Suppose if you at all that building earlier you are renting it for commercial purposes and all, then reduce 10% notional depreciation. You able to understand? Then you add it as a block. Suppose in the last January exam this question was asked. Suppose, sir, other personal asset brought into business, sir. I have a personal car, sir. Now I am bringing into my business, sir. What price? Directly actual cost. You see, don't reduce notional depreciation. Symbolically, how I gave minus notional and I wrote stroke off, because you should not reduce notional. Directly actual cost. You able to understand? Then, sir, I borrowed loan, sir, relating to asset purchase, sir. Interest expenditure is there, right? Up to date of put to use, that should be capitalized. From the date of put to use, interest amount will be the rate on the loan outstanding. Claim it as deduction under section 36. Remember, then, sir, when I'm purchasing the asset, no, GST amount and all is there, sir. I'm a registered person under GST law, sir. Input tax credit is available, sir. To the extent of input tax credit, don't add it in the block. Over. Yes or no? Sir, grant I got, sir. Central government or state government or somebody else, sir. Actual asset price is 10 lakhs, sir. But I incurred only 2 lakhs, sir. 8 lakhs somebody else incurred. Then you should add in the block only 2 lakhs. Able to understand? Then this specified business point and all is not that important for us at CA inter level. It's not required. But in regular class, we discuss this very in-depth logically. Yes or no? How this point will come, all that. But briefly, once again, I'll cover this point. Once I'm covering 35 AD. Able to understand? All of you, that's it. Rest of the points are not required. Carry forward and set off of depreciation, nothing but unabsorbed depreciation loss. All that we will straight away discuss in set off and carry forward revision. Now it is not required. We will discuss in set off and carry forward revision. Yes or no? That's it. Depreciation is completely done. Able to understand. Then section 35. Section 35. Deductions for scientific research expenditure. Deduction for scientific research expenditure. Remember, under section 35, you will get two types of deduction. You know, deduction where you are directly incurring the expenditure. Deduction for SSC where he is directly incurring the expenditure. Deduction where you are giving as a donation to other entities. Deduction towards donations, contributions to others. You know, if you are giving deductions or donation, if you are giving contributions or donations to Scientific Research Association approved, Indian Company for Scientific Research approved, Social Research approved, National Laboratory University, IIT and all approved. If you are giving donations to these four categories of persons, you will get 100% deduction only under optional tax regime. You will not get deduction under default tax regime. However, sir, scientific research expenditure, I am only directly spending, sir. Many students confuse. If you are directly spending, you will get deduction. Many students interpret section 35 is not eligible for default tax regime. Wrong. 35 subsection 1, 4, 1A eligible. 35 subsection 1, clause 2, clause 2A, clause 3, 2AA. This is only not eligible under default tax regime. Directly expenditure is incurred by the SSC. You can claim. You know what you can claim? You know, revenue expenditure anyhow you can claim. Not a big deal. Capital expenditure also you can claim. What you can claim? Capital expenditure also you can claim. You see here. Capital, just a minute. Capital expenditure also you can claim on scientific research. Whatever research expenditure you allowed, no, you spent, no, fully you can claim deduction, except land cost. What you will not get deduction? You will not get deduction for land. Getting it? Sir, no deduction for cost of land. However, building cost is also deductible. Now remember, if at all any asset you purchase it for scientific research, it is not eligible for depreciation. No block of asset. It should not be added in the block. When this asset will be added in the block from scientific research, I directly took into normal business purpose. Then I will add in the block. At what value will add in the block? Explanation 1 to 43 subsection 1. Actual cost. Actual cost minus deduction claimed under 35. Deduction claimed is equal to full 100%. So nil. At nil price you will add. Able to understand. Now, so capital expenditure. Sometimes I will incur expenditure on scientific research before starting the business. Before starting the business, I might incur. What about the previous? Before starting the business, if I spend some money, that year business is not there, no. So I spent money, but I didn't claim deduction anywhere. In the year in which you started business, no. Whatever last 3 years, remember last 3 years revenue expenditure, last 3 years capital expenditure, whatever is there, claim it as deduction in the first year in which you started the business. When you are claiming deduction for revenue expenditure, for past 3 years before commencement, only salary and material cost is allowed as deduction. Once you started the business, again you are incurring scientific research. No type of expenditure, no limit on type. Any expenditure you incur, scientific research allowed. Revenue, capital, both are allowed. Able to understand. All of you. Now, sir, scientific research purpose I purchased asset, no, I removed it now. Removed it means what? Either you might have sold it to somebody or you might have transferred it to your normal business. Suppose, sir, I sold directly to somebody, sir. I purchased an asset for scientific research purpose, sir. I sold it to somebody directly, sir. Without using it for some other purpose, I sold it directly, sir. How much amount you got? How much amount you got? First check out. Sale proceeds, how much you got? Or how much deduction you claimed under 35, you see. Sir, I purchased scientific research asset for 10 lakhs, sir. Earlier I claimed deduction 10 lakhs, sir. Now I sold it directly, sir. Directly I sold. Remember the word is directly. Directly sold means what? I didn't take into normal business. Directly from my research and development department itself, I sold it, sir. How much you got? 5 lakhs you got, sir. Whichever is lower. How much is taxable? 5 lakh. Where it is taxable? 41 subsection 3. It is treated as a deemed profit. Oh, sir, I didn't sell it, sir. I transferred it into block. I used it for normal purpose, sir, directly. Then in the block, I will add it at 0. That asset I sold from the block, sir, at 5 lakhs. No tax treatment on that here. You will reduce that 5 lakhs from the block value, because once an asset is forming part of the block, it will lose the identification of scientific research asset. Once you transfer scientific research asset into block, it will lose the identification of scientific research. It is now part of the block. When asset is sold in the part of the block treatment you will apply. 30 to 50, all that logics will apply. Yes or no. That's it. So that is what I have given. Suppose if the asset is brought into normal business, the same will be added to the block at nil, which is explanation 1 to 43.1. Indirectly, there is no retaxation. Yes or no? That's it. With this, 35 is also over. Then we have 35 AD. 35 AD. You know 35 AD talks about what? Capital expenditure for specified business. Sir, I am doing specified business, sir. What about revenue expenditure? Revenue expenditure, anyhow you can claim 30, 31, 32, 36, 37. Revenue expenditure you can claim as usual. 35 AD is specifically drafted for which deduction? Capital expenditure deduction. Suppose, sir, I am following default tax regime, sir. I will not get 35 AD deduction. Yes or no? If the SS is following default tax regime, will he get 35 AD deduction? No. 35 AD deduction he will not get means which deduction he will not get? Revenue expenditure, capital expenditure? Capital expenditure. Yes or no? Because 35 AD talks only about capital. Sir, if 35 AD section is not there, sir, what is the consequence? Every capital expenditure, it is eligible only for depreciation. Revenue expenditure as usual, 30, 31, 35, 36, 37 as usual. 35 AD specifically talking about what? Capital expenditure. Now, if at all you are starting any of these 14 businesses, if at all you are starting any of these 14 businesses, I am not repeating this list, okay, you take care of it later. If at all SSC is doing any of these 14 specified businesses, in these businesses, he is incurring some capital expenditure other than land, other than goodwill, other than financial instruments. You are incurring some capital expenditure. Don't claim depreciation. Claim 100% deduction for capital expenditure. That is what 35 AD benefit is. Getting it? To encourage investments. So if at all I have to encourage investment means I should give deductions investment linked. This section is also called as what? Investment linked deduction. This investment linked deduction, capital expenditure related deduction section is not applicable when the SS is following which regime? Default tax regime. Yes or no? Until now, DTR, additional depreciation you can't claim. 35 AD, contributions, donations, 35 you can't claim. Contributions and donations. 35 AD, capital expenditure you can't claim. Sir, what about revenue expenditure for specific business? That you can claim. That's a normal business expenditure. Yes or no? Next, what is the amount of deduction? 100% deduction on capital expenditure incurred. Sir, not only current year, sir. Before I started this business itself, I started constructing hotel. Getting it? Past 3-4 years, I'm constructing hotel, sir. What about that? That expenditure incurred before commencing the business. No, that time you incurred expenditure. You didn't claim deduction anywhere. By the way, which expenditure I'm talking about? By the way, capital only. Under 35 AD, we are only discussing about capital. Revenue expenditure, no problem at all. You can claim under respective sections. Yes or no? Now, before commencement of specified business, I incurred some expenditures. So what about that? You can claim deduction in the first year in which you started the business, provided only one condition. Whatever expenditure you incurred, no, please capitalize it in your books of accounts as on the beginning, 1st April or beginning date of the business. Capitalize it. Then you claim deduction in the current year while filing IT return. You able to understand. Now, again, when you're incurring any capital expenditure, no, if at all you're making any payment exceeding 10,000 in other than cash, crosser check, bearer draft, you will not get deduction for that capital expenditure. Same point is there in depreciation also. In depreciation, 43 subsection, what is actual cost? Actual cost is purchase price. However, if the amount paid is more than 10,000 by other than cash, nothing but, if the amount paid is by other than prescribed modes, other than prescribed mode means what? Cash, crosser check, bearer draft, then you will not get any depreciation on that. You will not add in the block. Actual cost is treated as nil. Same way here also in 35 AD, if at all you're incurring any capital expenditure in a day to a single person more than 10,000 by other than prescribed mode. What is other than prescribed mode? Cash, bearer check, crosser check, bearer draft. Then it will no deduction for that capital expenditure at all. Yes or no? Now, conditions. Conditions, it should not be splitting. It is not, the business should be started as completely afresh. It should not be like a demerger from existing business. And in that business, no, you should not use second-hand machinery. Up to 20% only second-hand machinery can be used. Able to understand? You will get deduction. Second-hand machinery, new machinery, everything you will get deduction. But second-hand machinery should be only maximum 20% of the total machinery installed in the business. What is not a second-hand machinery? If it is not used in India and no depreciation is claimed in India by anybody on that asset till date, getting it? Then it is treated as a new machinery. Yes or no? It is imported into India for the first time, and on that mission, no, nobody claimed depreciation till date. Then only it is treated as what? New machinery. Otherwise, that machinery is treated as second hand. Second hand can be there up to how much? 20%. Then, there are some conditions. Most important conditions in 35 AD. Very simple. Now, you are incurring capital expenditure. You can claim 100% deduction, right? There is one condition. That asset, no, whatever you are claiming deduction, that asset must be used for that asset must be used only for specified business for 8 years. Only for specified business for 8 years, you must use it. Sir, I'm not using it, sir. Within 8 years, no, I transferred it to my some other business, sir. See, I'm not talking about sale. I am not talking about transfer. I'm talking about usage condition. 8 years you must use it for the same specified business. Sir, I'm not using it for 8 years, sir. Some 4th or 5th year, no, I transferred that machinery to my normal business, sir. What is the consequence? Very simple. Earlier given deduction. What is it? Earlier given deduction. Deduction claimed earlier how much? Minus the asset purchased. That year 100% you claim deduction. No? After that, how many 31st March came? You see. For number of 31st March, you claim notional depreciation. The balance is treated as income under 35 AD subsection 7B. The balance is treated as what? Income under 35 AD subsection 7B. This is treated as income. This income is there, right? This is income under PGBP 28. Sorry, 35 AD 7B, not 28. 35 AD 7B, it is treated as income. Now this income, what is treated? What is taxed as income, right? This amount. The same amount will be added in the block also. Because now we are moving the asset from specified business to block. This is what there in the explanation 13. In the 43.1. This income, what is deemed as income? By the way, we are treating it as income. Why? We are selling it. No. We are using it from specified business to other purpose within 8 years. Sir, I am using it for other purpose after 8 years, sir. In the block, 0. Value added in the block is 0. Retaxability under 35 AD subsection 7B, 0. Within 8 years, I am using it for some other purpose. Actual cost, deduction claimed how much? Minus notional depreciation for every 31st March. Reduce it and you calculate. Total notional depreciation you calculate. So WDV value you will get. That amount is treated as income under 35 AD subsection 7B. Able to understand. Now the same value will be added in the block also in the normal business. Able to understand. Sir, it's not about usage, sir. I sold it, sir. When you are selling, suppose I purchased an asset for specific business. 100% reduction claimed. Now I sold it, sir. Whether you are selling within 8 years, after 8 years, that 8 years logic is not applicable for sale. The amount you got, whatever amount you got is straight away taxable under charging section PGBP. That's it. Suppose, sir, asset I bought for specified business, sir. Within 8 years, I used it for some other purpose. Then income will be taxed. How much income? Deduction allowed earlier minus notional depreciation, that is treated as income under 3587B, and the same value will be added to the block. After adding in the block, I sold, sir. What should I do? Reduce it from the block, because once an asset is forming part of block, and any subsequent transfer of that particular block, only block of asset treatment will be applicable. That's it. Able to understand. Everybody? Yes. Next. Amortization of preliminary expenditure, 35D. 35D is not a big deal. Okay, you can handle on your own. Okay, like very simple. Total preliminary expenditure, find out. Find out total preliminary expenditure. How much is allowed? Sir, I am a company, sir. I am a company, sir. Mine is a company, sir. 5% of COP, cost of the project, 5% of capital employed, whichever is higher. Suppose, sir, I spent 10 lakhs money, sir, but cost of the project is only 100 lakhs. Capital employed is 105 lakhs. 5% of it and 5% of it is equal to whichever is higher, means some 5.2 lakh is coming, sir. For example, you spend 10 lakhs. Deduction is only for 5.2 lakh. Maximum preliminary expenditure under 35D cannot exceed 5% of COP, 5% of capital employed, whichever is higher. By the way, you can't claim deduction at a time, that amount also. 5 lakhs also you can't claim at a time. You have to claim in 5 installments. Able to understand what are all preliminary expenditure. I have given meaning here. You can look at it. Okay. Now, for claiming preliminary expenditure, one most important condition is within 1 month before the due date for filing IT return. By 30th September, nothing but accountant report, chartered accountant report has to be submitted. Even for 35 AD, capital expenditure reduction, you should give chartered accountant report. Able to understand. You're able to recollect everything? Productive? Yes. Next. 35 DDA. Sir, SSC, he is incurring VRS expenditure, sir. Voluntary return. Whatever amount paid under VRS, you can claim deduction in 5 installments. in 5 installments. That's it. Other deductions. Sir, I took insurance policy for inventory, sir. You can claim deduction. Sir, I took insurance policy for my employee health benefits, sir. Employee health insurance. You can claim deduction only if it is paid in other than cash. Yes or no? Sir, I took insurance on plant and machinery, sir. What about that? It is not covered in 36. It is not covered in 31 also. It is allowed under 37. Because 37, no? 37 talks about one expenditure. It is related to business. Expenditure must be related to PGBP, business or profession. And it is exclusively used for that. And it must be revenue in nature. It is not a personal nature. Business expenditure, not a personal nature, revenue in nature, not covered in the above sections. You can claim it under 37. Suppose salary paid by company to the employee. Salary is not covered anywhere in the section. 37 you can claim. Electricity expenditure, 37 you can claim. Telephone expenditure, 37. Internet charges, 37. Repairs and maintenance, 37. Repairs and maintenance of plant and machinery furniture, 31. Repairs and maintenance of building, 30. So repairs and maintenance are covered under 30 and 31 only. So 37 will not apply. 37 will not apply. You able to understand? That's it. If any of you are feeling speed, my revision, reduce the speed, playback speed. That's it. Watch speed you can reduce in the YouTube. Okay, that's it. I think you're able to understand. I hope I'm not fast. Okay, that's it. Next. Suppose I paid bonus or commission to employees, sir. Yes, allowed as deduction subject to 43B. Bonus or commission is covered under 43B. Sir, interest on loan borrowed, sir. Used for business or profession. Getting it? Allowed as deduction subject to 43B. Which interest on loan? Banks and FIs and NBFCs. You borrowed loan from banks, FIs and NBFC for business purpose. Interest incurred. You can claim deduction only subject to 43B. Moreover, suppose if the loan is borrowed for purchasing asset, up to the date of put to use the asset, as per explanation 8 to 43 subsection 1, up to the date of put to use the asset, you should add it to the block. That's it. Then zero coupon bonds. Getting it? Zero coupon bonds means what? Zero coupon bonds, what you can claim? Discount amount you can claim deduction on pro rata basis. Discount amount you can claim deduction on pro rata basis. What is discount amount? Maturity amount, how much you have to pay. Now how much, at what price you issued the bond? Sir, maturity amount, no sir, approximately 12 lakhs I have to pay, sir. 12 lakhs I have to pay, sir. You know, right now I have issued the bond at 10 lakhs, sir. So 2 lakhs, sir. 2 lakhs is the per bond discount, sir. 2 lakhs per bond. How much is the discount? 2 lakhs. You know, this bond duration is 200 months. This bond duration is how many months? 200 months. Per month reduction is how much? 1000 rupees. In the current year, the bond is issued on 1st October 2024. Then for 6 months into 1000, 6000 you can claim deduction. Next year, 12 months, 12,000 you can claim deduction. That next year, 12,000. Again in the last year, no, of the bond, 6 months only is there in the financial year. 6 months into 1000. Simple, per month 1000. In this year, bond is in existence in this year. How many months? That many months into that much. Able to understand? So discount divided by number of months you should identify. So you will get a pro rata basis. Able to understand? Next. Then you remember contribution to welfare funds. Employer, no, he is contributing to RPF, superannuation fund. Employer is contributing to RPF and superannuation fund within prescribed limits. That amount is allowed as deduction. How much ever employer contributed, that much amount is allowed as deduction subject to 43B. Contribution towards national pension scheme, sir, is also allowed as deduction. How much maximum deduction here? Limit is there. 14% of salary. Salary means what? Basic plus DA for retirement benefits. Able to understand? Then, sir, employer, no, he is contributing to gratuity fund, sir. Approved gratuity fund, sir, is contributing subject to 43B. Sir, 5A. What is this 5A? You know, I collected from employee contribution, sir. Not mine, employee. First treated as income. First treated as income under 2 subsection 24. You paid to the respective statutory authority within due date under that law, claim it as deduction under 35. 36 subsection 1 clause 5A. Getting it? So, deduction is allowed under this section if employee contribution is remitted to respective fund within the due dates prescribed under the respective law. Remember, employee contribution collected by employer shall be first treated as income. 43B will not apply on this because this is not your contribution, this is employee contribution. Again in 43B, I gave a comparison table for this. Again in 43B, I gave a comparison table for this. Bad debts. Very simple. You sold goods on credit. You showed it as income on the you showed income in the PGBP on accrual basis. You pay tax also. Subsequent year, no, amount is not recoverable. You wrote off in the books. Or the amount became irrecoverable. Either you wrote off or it became irrecoverable, as the case may be. That amount you showed as income in the PGBP, right? You can claim it as deduction in the subsequent year. Able to understand? Sometimes no, sir, I claim a deduction, sir. I claim a deduction, sir. 10 lakhs I claim a deduction in PGBP, sir. But the assessing officer no opened my case. He allowed only 5 lakhs deduction, sir. 5 lakhs only he allowed deduction, sir. How much he disallowed? 5 lakh. Getting it? Which means, sir, my bad debt is 10 lakh. I sold goods for 10 lakhs. My bad debt is 10 lakhs. Many faculties, I am telling you, many books are having wrong provision on this. Many books are containing wrong way. Getting it? See, suppose bad debt amount is 10 lakhs. Bad debts claimed is 5 lakhs. What? That question itself is wrong. If bad debt is 10 lakh, you will also claim how much? 10 lakh. If assessing officer does not allow entire 10 lakh, that is what the provision is about. You know, there is a section in the bad debt 36 subsection 2. Inside that there is a clause number 3. This talks about assessing officer involvement. Even ICA book does not have this point. Getting it? This is the actual meaning. Suppose, sir, I sold goods on credit for 10 lakhs, sir. The customer is not paying. Not paying at all. That entire 10 lakhs I showed it as bad debt, sir. In my books I showed it as bad debt. In income tax also I claim it's at 10 lakhs. But you know what? Assessing officer did not allow. The assessing officer did not allow full 10 lakhs. He allowed only 5 lakhs, sir. Okay, 5 lakhs only I claim it, sir, ultimately. Actually, 10 lakhs is the sale value I showed. But 5 lakhs deduction I claim. Net amount still how much income I showed to the department? 5. Subsequently, I collected luckily 5 lakhs, sir. I already showed originally 10 minus 5. 5 only I showed. Finally, I collected 5 only. Nothing is taxable. Suppose I collected 7 lakhs, sir. Till now, original I showed 10. Second year, I claimed bad debts 10. But assessing officer only 5, right? So net amount to claim it is how much? Only 5. Now I recovered 7. 2 lakhs is treated as business income. Sir, I recovered 10, sir. 5 lakhs is treated as income. Suppose I recovered 11 lakhs, sir, including interest, sir. Then 6 lakhs. Sir, suppose you know what? Ultimately, I recovered only 4 lakhs, sir. Original I showed 10 lakhs income, sir. Entire 10 lakh is bad debt, sir. Second year I claimed 10 lakhs bad debt, sir. But the assessing officer permitted only 5 lakhs, sir. Indirectly, 10 minus 5, 5 lakhs income I showed, sir. But you know, ultimately I collected only 4 lakhs. Now the customer is insolvent. I don't even get 1 rupee extra. I showed 5 lakhs income in net effect already, sir. But I recovered only 4 lakhs now, sir. That 1 lakh which you showed extra income, no, is allowed as additional deduction. This illustration, if you understand bad debts, you understood it. You know, here indirectly what am I covering? You know, 41 subsection 4, recovery of bad debt also I'm covering. Recovery. So how much is taxable? Recovery of bad debt is taxable. Recovery of bad debt is taxable to the extent deduction allowed earlier. Deduction allowed earlier means what? Sir, bad debt claimed. Bad debt claimed how much? 10 lakhs, sir. Deduction allowed by AO is how much? 5 lakhs, sir. How much is not allowed, sir? 5 lakhs, sir. To this extent only, recovery is taxable. Able to understand? Yes or no? That's it. Then family planning expenditure, only company SSE can claim deduction. Only company SSE can claim deduction. This family planning expenditure is again broadly classified into 2 types: revenue, capital. Capital expenditure is also eligible for 100%. Revenue is also eligible for 100%. If you purchase any asset for family planning, that asset will not form part of the block of asset. Remember. Now, what is capital expenditure in family planning? You constructed some small hospital, you constructed some, you recruited some medical equipment, all that. A company, normal manufacturing company recruited some medical equipment and all. That is capital expenditure. Revenue expenditure means treatment cost. That's revenue expenditure. Revenue expenditure 100% you can claim. Capital expenditure also you can claim 100%. But capital expenditure is subject to unabsorbed depreciation rules and all. Scientific research capital expenditure is there, right? That is also subject to unabsorbed depreciation rules. Specified business 35 AD capital expenditure is there, right? That is also something subject to the unabsorbed depreciation rules. These are all similar to unabsorbed depreciation rules. What is unabsorbed depreciation rule? All that we will discuss in set off and carry forward chapter. Able to understand. Next. Suppose I'm doing stock market or commodity market. STT paid, CTT paid. Remember, if it is a capital gains chapter, STT paid is not deduction. No deduction at all in capital gains if it's a capital asset. But in PGBP, it is not like that. If it is a stock in trade for you, STT paid is allowed as deduction. Finally, sir, there are so many other expenses which I incur in business, sir, like salary, salary expenditure, office maintenance, telephone expenses, fiber net, like internet charges, so many, paper cost, printing and stationery, so many expenses I'll incur, sir. Fuel. Where I can claim deduction? You can claim deduction under section 37. Only one condition. It must be incurred after the business is set up. It must not be related to personal, or it should not be capital. Expenditure is exclusively for the business. It is not covered under 32, 37. Remember, in PGBP, no deduction for provisions and reserves. You will get deduction in PGBP for an expenditure only if it is a real expenditure. You create provision, you don't get deduction. You create reserve, you don't get deduction. Then further, CSR expenditure, company will spend CSR activity expenditure, right? That's your personal obligation. That is not related to business. You will not get any deduction. Further, there is a section called 35 subsection 2B. Sir, I am incurring an expenditure, sir, which is actually advertisement cost in a newspaper, sir. That newspaper, pamphlet, brochure, no, it is published by political party, sir. It is not treated as a business expenditure. It is treated as a donation. No deduction under PGBP. For companies under 80 GGB, the same amount is given as donation. The same amount can be claimed as deduction towards donation. You able to understand? That's it. All the deductions are over. All the deductions are over. Hardly 1 hour 15 minutes. We completed all the deductions. Getting it? Yes. 2 minutes gap will take and we'll immediately start disallowances. Confident until now? Disallowance until another 45 minutes to 1 hour. Over. Okay. Now let's begin disallowance sections. Let's continue disallowance sections revision. Okay. See, we have very many disallowances. For example, what are the sections that we have? We have section 40A subsection 1, 40A subsection 1A, and we have 40 subsection B, which is actually applicable for firms or LLPs. Then we have something called 40A subsection 2, 40A subsection 3, 40A subsection 3A, 40A subsection 5, 40A subsection 7, 40A subsection 9. Actually 5 we don't have, we only have 7 and 9. Just a minute. We only have 7 and 9. Okay, that's it. Then we have 43B. We have something called 43B. Now if you observe these sections, these two sections, getting it? 40A1, 40A1A, 43B. In these, the deduction of expenditure is linked with 139 subsection 1 due date predominantly. If at all you do not pay, suppose in 43B there is clause H, MSME, that is linked with the due date under MSMED Act. Okay, by the way. In these two sections, in these three sections, if an expenditure is disallowed, it is not permanently disallowed. In this year it is disallowed. Later when you once again comply with the section, you will get once again a deduction. Whatever is disallowed now, you will once again get a deduction later. So it is like a temporary disallowance. Whereas disallowance under 40B, disallowance under entire 40A series, this is a permanent disallowance. Permanent means what? For example, there is a section called 40A2. Any amount paid as expenditure to related person. If the unreasonable portion is there, that is fully disallowed. Will it be given as deduction later on again? No. 40A3, it is talking about revenue expenditure claimed to be deduction on, if at all, amount paid in other than prescribed mode. Other than prescribed mode means cash, all that, more than 10,000. So that one is 40A3. 40A3 is talking about treating as income, deeming as income. We'll come back to it. 40A7 is saying provision for gratuity, all that. You will not get deduction for provision. You will get deduction only if it is a funded gratuity, only if you really pay it. Or if the gratuity actually becomes payable in the current year. 40A9, this is talking about contribution to unrecognized funds. Suppose if the employer is contributing to unrecognized funds in the name of employee, no deduction at all. Actually, this deduction is over. This deduction is over. Simple. 40A7 is talking about provision for gratuity, no deduction. If you contribute to gratuity fund really the amount, subject to 43B, you will get a deduction. Gratuity becomes payable in the current year. You have to pay. Accrual basis you recognized, you will get deduction. Provision for gratuity which will be paid somewhere later, no deduction. 40A9, any contribution to unrecognized funds, no deduction at all. 40A2, payment to, what is this 40A2 is about? Payment to related persons, any revenue expenditure, obviously capital expenditure you can't claim deduction, that's the reason. Revenue expenditures which are covered under section 30 to 37, any payment made to related person, deduction will be allowed only for the reasonable portion. If the amount is unreasonable, no deduction at all. Who is a related person? Who is a related person? I have given a simplest way the definition. Who is a related person? You see, for individual, relative. Relative means what? Spouse, brother, sister, any ascendant or descendant. In January exam, amount is paid to aunt. Some point is given, which is not covered under relative definition in the Jan 25 exam. Now, will the section be applied or not is the question. Intention of the section you understand. To related person, yes or no? Maybe the examiner might consider two options. They may absolutely interpret this definition of relative and say, since it is not covered under relative, no disallowance. or they may apply the intention of the section. We don't know what the suggested answer looks like. Getting it? Fine. Suppose expenditure is paid to entity, sir, not to the individual, sir. Not to the individual, paid to entity, sir. You know, I am a business person, individual. I am paying expenditure to another individual who is my relative. Unreasonable portion disallowed. I am paying money to some enterprise, sir, in which myself or my relative has substantial interest. That is also covered under related person. For companies and HFs and firms, you know, very simple. Directors for companies, you know, and partners for the firms, members for HUF, members for AOP, and their relatives. They're all covered under related persons. So for a company, directors and relatives. For a firm, partners and the relatives. For AOP, members and the relatives. For HUF, members and the relatives. They're all related persons. Not only them. Entities in which these directors, partners and their relatives has substantial interest. They are also related persons. Very simple. 40A subsection 2. If you are paying to related person, yes sir. Unreasonable portion is there? Yes sir. Assessing officer can disallow. Able to understand. Over. 40A2 is over. Substantial interest means what? Minimum 20% voting power in case of companies. Other entities, minimum 20% profit sharing ratio. Then only we call it as what? Substantial interest. That is 40A2. Able to understand. Now, permanent disallowance I'm discussing first. Then final I'll come to temporary disallowances. 40A subsection 1. 40A subsection 1. A payment to non-resident, payment to non-resident without deduction of TDS, that and all I will discuss at last. Just now. Okay. Now, payments made in cash. Sir, there is an expenditure, sir, which is actually eligible to be claimed under 30 to 37. By the way, I will also talk about how the disallowance mechanism works, how to compute the problem when P&L account is given, how to compute the problem when receipts and payments account is given. I will give you one technique. If you follow the technique, I'm telling you, you will get fantastic clarity. Okay, fine. So 40A3. Sir, I'm incurring some expenditure, sir, revenue expenditure. I can claim it under 30 to 37, sir. But you know, that amount is paid exceeding 10,000 in a day to a person, in a single day to a single person. If at all you are paying any expenditure more than 10,000 by other than prescribed modes. Prescribed modes are what? Account pay check, account pay draft, electronic purpose. Getting it? Account pay check. Remember, crossed check is not covered, bearer check is not covered, bearer draft is not covered, cash is not covered. Suppose if at all you are paying any expenditure for more than 10,000 in a day to a single person by cash, by bearer check, by crossed check, or by bearer draft, more than 10,000 you paid, fully disallowed, no deduction at all. That expenditure is not considered under PGBP. If it is already debited to P&L account, to the net profit you will add back. Suppose if this information is not debited in P&L at all, it is not recorded in books of accounts, it is given as an additional information. Some expenditure is missed to be recorded in business. Some expenditures they forgot to record in the PGBP, but that expenditure is paid in cash more than 10,000. You don't claim deduction. It's already not recorded, and you don't get deduction. You ignore. Able to understand? Yes. Then you know there is another section called 40A3A. In the recent September 2024 exam, this fantastic adjustment was asked. Suppose no. We all know expenditure can be claimed as deduction on accrual basis, right? April to March, I incurred expenditure. I can claim. Only 43B items I must pay within 139 subsection 1 due date. Remaining expenses I can claim on accrual. By 31st March, whatever expenditure I incurred, no, I can claim on accrual. But you know, in the next year, no, April or May or June, some amount, some month, no, later on, that amount was paid by me in cash. That amount was paid by me in cash. Very simple. I incurred in previous year 24-25 some expenditure which is 20,000 on accrual basis I claim. But in 25-26 or some other year, whatever year, this entire 20,000 I paid in cash. What is the tax treatment? For 24-25, no problem. You claim deduction on accrual. No disallowance for that. Whereas in 25-26, 26-27, 28-28, whenever that amount is paid in cash, that year it is treated as income because you violated payment in other than prescribed modes. Getting it? So you violated that provision. So it is treated as income. So any expenditure which is allowed as deduction under accrual basis in the past year and the same is paid in the subsequent year in other than prescribed mode, then it will be treated as income. Now this amount is 10,000 limit, right? Suppose if you are making payment to a transporter, then the limit is increased to 35,000. In case is payment to transporter, the limit is increased to 35,000. That's it. Now this disallowance will not attract on repayment of loan. This disallowance will not attract on between transactions between principal and agent, because transactions between principal and agent, oh, there is no expenditure involved. Simple logic. Now if there are some exemptions from 40A3 applicability, suppose if you are making payment to cultivator or producer, getting it, not a trader in fish, getting it, Payment to cultivator or producer, no disallowance. You are making payment, for purchase of products, where they are not where they are manufacturing without aid of power. To them you made payment more than 10,000, no problem at all, in cash. Payments to government not covered. Payments of book adjustments not covered. Payment made on a bank holiday, exempted. Able to understand? That's it. Okay, 40A3 is over. That's enough. 40A3 section is over. 40A3 is over. 40A3A is also over. Now you see, I completed 40A2, 40A3, 40A3A, 40A7, 40A9. We are only left with what? 3 more sections: 40A1, 40A1A, 43B, and 40B. That's it. So hardly another half an hour. This particular deductions will be over. Can I proceed? Now there is a section called 43B. There is a section called 43B. What 43B section says? Certain expenses. You see, specific deductions. Some expenses, you will get deduction only on payment basis. Only on payment basis means cash method. No, not cash method of accounting. Payment basis by some due date is there. Of course, actually cash only. I can say cash only. This section is applicable only for the SSC following accrual basis of accounting. This section is applicable only for the SSC following accrual. See, SSC who is following accrual basis, for him, he can claim any expenditure on accrual. But these 7 payments, totally 7 payments, clause H and up to above 6 total 7 payments. These 7 payments, in some books they may write it as 8, in some books they may write it as 6 also. It depends upon, some points, they will merge into 1 point. That's it. That's why in my book I wrote it as 7 points, which is logically correct. Getting it? These 7 payments, you will not get deduction purely on accrual. If you incur is not sufficient, you must have actually paid to the other party. By when? This is the question. These 6 payments, April to March you incurred. By 139 subsection 1 due date. For the business, what is the due date for filing IT return checkout? 31st July. Normally for every SSC. 31st October in case of the SSC is subject to audit. Yes or no? Within this due date, you must have repaid this money. You must have paid this money. Not only accruing, but you should also pay. Then only you will get a deduction. Suppose in the question, in the exam, some amount is debited in P&L account. Some amount is debited in P&L account. That amount comes under these 6 items. In the additional information or somewhere they gave this point. These amount is paid before 139 subsection 1 due date. No problem. No adjustment is required. Suppose some amount is debited in P&L, 1 lakh. In the below additional information, they said only 50,000 rupees is paid on so and so date. Another 50,000 paid down after due date, they said. Then what you should do? For 24-25 year, that 50,000 which is paid after due date, for this year no deduction. Next year it is paid, no, that year you will get deduction. Able to understand? Very simple. These 6 payments, you will not get a deduction. You will not get deduction if you do not pay by IT due date. 31st March before you incurred, by 31st July due date for filing IT return, or 31st October as the case may be, you must have paid it. Suppose you didn't pay it, for 31st March P&L is there, right? Net profit, for that it will be added back. Disallowed. Not allowed as deduction. It is not allowed as deduction. Sir, later on again I paid, sir. When you paid, check out. That date comes under which year you check out. For that year you will compute PGBP income, right? You can claim specifically deduction for that. Able to understand? For example, sir, in 24-25, I incurred some expenditure, sir. I incurred bonus. I declared bonus to my employees, sir. What are the 6 expenses? I will cover the list now. Okay. I declared bonus to my employees, sir. Bonus. How much I declared, sir? 10 lakhs I declared, sir. I accrued. But 31st March in my books of accounts, 10 lakhs provision is also created. For me, the due date applicable is 31st October, sir. Mine is a company, sir. Audit is applicable, sir. 31st October is the due date, sir. Within this due date, is this 10 lakhs paid a checkout? Not paid, sir. Then for 24-25 PGBP income, you are computing, right? In assessment year 25-26, for previous year 24-25, you are computing PGBP income, right? This 10 lakhs, you will not get deduction. Suppose you already debited to P&L, right? From net profit, what you should do? Add back. Sir, suppose within 31st March, I paid 5 lakhs, sir. Another 5 lakhs I did not pay before 31st October. Before 31st October, I paid only 5 lakhs, sir. Remaining 5 lakhs is pending. Then 5 lakhs only disallowed. Sir, ultimately, sir, this actually 31st October 25 due date, sir. You know what? I paid it on 4th November 2026. Ultimately, the balance 5 lakhs, sir. 4th November 2026 comes under which year? 26-27. For this year, you will compute PGBP income rate previous year for this previous year. In this year, this 5 lakh you claim it as special deduction. That's it. That is 43B. And very simple. You incurred any expenditure which is covered under above 6 payments. Incurred on or before 31st March. You claimed in P&L account. You debited in P&L. You claimed in PGBP also. But on or before 31st, on or before the due date under 139 subsection 1, it is not paid actually to the other party. Then the amount which you debited in P&L, which you already claimed as reduction from net profit. Later I paid, sir, after due date. When paid, check out. Date you check out. That date comes under which April to March of which year you check out, which previous year. For that previous year, once again you will compute PGBP income, right? For that year you will claim deduction. That's it. Able to understand. Now this is for 6 payments. There is another type of payment which is 7th payment, which is payment. Suppose no, I incurred some expenditure, sir. I purchased goods. I purchased some service, sir, from micro and small enterprise. Medium enterprise is not covered, my dear. Only micro and small is covered. Getting it? I incurred some expenditure payable to micro and small. You must pay them within 15 days from the transaction date. You must pay them within 15 days from the transaction date. Suppose agreement is there, maximum 45 days credit period. Sir, as per agreement he gave 60 days, sir. That doesn't matter. Maximum allowed is 45 days. Suppose there is no written agreement and credit period terms and all not there, then 15 days is the maximum period. Suppose, very simple, sir, I purchased goods from MSME on 31st March 2025, sir. Means previous year 24-25 is the expenditure I incurred, sir. I incurred the 24-25 related expenditure, sir. Repairs and maintenance, sir, to MSME, sir. Okay, 25th March. Agreement is there. We have an agreement also. 45 days agreement is there. Plus 45 days means logic is what? Approximately 10th May 2025, sir, approximately. Sir, within 10th May 2025, you paid approximately 10 lakhs is the amount, sir. You paid within 10th May? Yes, sir, I paid, sir. Then no problem. For this 24-25, you can claim deduction. Sir, I paid on 11th May, sir. After the 45 days, what is the consequence? For 24-25, you will not get deduction. You will not get deduction. Again, you can claim deduction. Yes, sir. When you paid 11th May, you paid, no? 11th May 2025 comes under which year? 25-26 year. For this year, you will get deduction. Now, one more twist. Sir, I incurred this expenditure on 10th January 2024. Look at this example and that example. Compare both again later. Okay. Replay the video once again. Okay. 10th January 2024, I incurred, sir. How much incurred? 10 lakh. You know the due date, sir, it's actually 45 days, sir. Let us assume 45 days comes under 28 plus 21 approximately. Okay, you know, 24th, approximately 23rd February is coming, sir. 23rd February 2024 is coming, sir. 25 we will put, because for us problems are 24-25. Okay. What is the due date for MSME? February 23rd, 2025 is the due date. Within this due date, no, sir, I did not pay. I have not paid. 10 lakhs deduction on this date, you will not get deduction. But you know what, SSC, know this 10 lakhs, 30th March 2025 he paid, sir, fully. But remember, within 45 days he didn't pay. 43B subsection H attracted, it is disallowed. But same section, what it says, ultimately again it is allowed as deduction in the year of actual payment. I paid on 30th March, sir. This comes under 24-25, sir. Indirectly, the section says 24-25 originally is allowed. For the same year, again they are saying allowed. Indirectly, what is it? If at all actual payment date to MSME is on or before 31st March, no need to apply this section. Suppose if the actual payment is after 31st March, transaction is before 31st March, actual payment is after 31st March, then you should check, is it within 45 days, within 15 days, logic. If it is after 15 days and after 45 days paid, and the payment date is in the next financial year, and it is after 15 days from transaction days, after 45 days from transaction date, then for this year it is disallowed. For that year you will get a deduction. Yes or no? If at all you did not get this, repeat once again, you will understand. Able to understand. Okay, now I hope you got clarity. That's it. Now, so look at this. What are the 6 expenses? Taxes, cess, duty, interest, taxes, property taxes, interest on taxes. That's what. Penalty is not allowed. Remember, penalty is not allowed. They are violation. They are not allowed. Employer contribution to welfare fund, employer's contributions, we said already, subject to 43B. Gratuity fund, superannuation fund, everything. Payment of bonus commission to employees, leave encashment to employees, interest on loans and borrowings from banks, NBFCs, public financial institutions, state financial corporations, state industrial investment corporations, all that, excluding primary agricultural loans, primary agricultural banks. Getting it? So suppose if I borrow any loan from my friend and relative, that is not covered under 43B. I can claim deduction on accrual basis. Interest. Suppose I borrowed loan from bank, FIs, all that. I can claim deduction of interest amount only if it is paid before 139 subsection 1 due date. But so if the payment is made after the due date, then deduction will be allowed in the year of actual payment, in the previous year of actual payment. However, deductions where MSMED Act is involved, any expenditure payable beyond the time limit is disallowed. If it is not paid or credited to the MSME within 15 days or within 45 days, as the case may be, this is actually called as appointed day. This period is called as what? Appointed day. Getting a due date is called as appointed day in MSME. If you pay within appointed day, you will get for the respective year. If you do not pay within appointed day, then in which year you paid actually, for that year you will get. If the date of payment is also same year of transaction, you will get deduction for that year itself. Yes or no? Next, further, if the amount is paid subsequently after the credit period, then deduction will be allowed for the actual year of payment. In September 24 attempt 43B, 40A3, 40A3, one adjustment is given. What is that adjustment? You know what? SSC, very fantastic adjustment. SSC, 10 lakhs. 10 lakhs expenditure is there. Okay? 10 lakhs expenditure is incurred in financial year 24-25. That too, date of transaction is 20th March. What is the date of transaction? 20th March 2025. 20th March 2025. This amount is payable to MSME within 45 days. 45 days due date is what? 5th May. What is the due date? 5th May 2025. What happened? This 10 lakhs is entirely paid within 5th May. What is it? It is paid in within 5th May he paid. When he paid, 1st May he paid. For example, 1st May he paid. How much he paid? 10 lakhs he paid. Within 45 days, he paid. Allowed. But this 10 lakhs is paid in cash. This 10 lakhs is paid in cash he paid. Now under 43B, any expenditure paid in cash for more than 10,000 rupees is fully disallowed. But remember, this is incurred in 24-25 but paid in next year on cash. 40A3 subsection will not apply, but subsection 3A is applicable. As per that, for previous year 24-25, no treatment. Whereas in 25-26, this 10 lakhs is treated as income. In September exam this year, where every student added to P&L account, added to net profit. Entire answer is wrong. For that year, no treatment. Why? It is not a case of disallowance. It is a case of treating income in the respective year in which it is paid in cash. 48(3)(a) is applicable. Once again, watch this if you do not get it. Okay, that's it. I hope you got it. Already I explained in regular class also in depth on this point. We discussed almost more than 15 minutes time. Yes or no? That's it. Next. Now, sir, interest on loan, no, converted into principal, sir. Conversion is not treated as payment. Only if that amount is paid subsequently, it is given as deduction. Contribution to welfare funds. Employer 43B section apply. Employee 43B do not apply. Employer contribution disallowed if it is not paid within 139. Subsequently, if it is paid, you will get deduction. Whereas employee contribution, no, you must pay within respective due date under the law. If you do not pay, you collected and not paid within the respective statutory law, straight away treated as income. Even though later you remitted with interest and all, no deduction. It's a severe punishment. Then what is meaning of micro and small enterprises? Recent January 25 exam, they asked this question for 3 marks. What is a micro enterprise? Investment in plant and machinery shall not exceed 1 crore. Turnover shall not exceed 5 crore. Small 10 crore, 50 crore. That's it. Able to understand. That's it. With this 43B section is completed. Now let's understand 40A1, 40A1A. Finally, I will explain you 40 subsection B. Now let's understand 40 subsection A clause 1, 40 subsection A clause 1A. Okay. You see the book. I fantastically wrote in 1 page. In single page, this entire provision is given. You will get a clarity on this section like anything. Again, this is also something similar to 43B logic only. You see what is the heading I used? Disallowance. Disallowance. Just a minute, it's loading. It's okay, fine. Disallowance on account of non-compliance with TDS provision. Disallowance on account of non-compliance with TDS. Suppose you did not comply with TDS. Very simple. Every expenditure you are paying, right, it is liable for generally TDS. what you have to do as per TDS provisions, when you are making the payment, you should deduct amount, TDS. The TDS which you deducted, you should remit to the department in the name of the payee. You should remit. If you deduct in the current year and remit within 139 subsection 1 due date, no problem at all. Suppose you did not deduct in the current year, or you deducted but not remitted in 139 subsection 1 due date. Whatever expenditure is there, right? If the expenditure is paid to a non-resident, or if the expenditure is paid outside India, 100% of the expenditure, what is it? 100% of the payment is not allowed as deduction. When it is not allowed as deduction, when disallowance will apply? If you do not comply with the TDS provision. If you do not comply with the TDS provision. What do you mean by non-compliance with the TDS provision? You did not deduct the TDS in the respective year in which you incur the expenditure, or you deducted but not remitted within 139 subsection 1 due date. That is treated as non-compliance. When there is a non-compliance of TDS provision and the amount is paid to non-resident, or the amount is paid outside India, 100% of the amount is disallowed. Suppose if the amount is paid to resident payee, 30% is only disallowed. Now what expenditures are covered? For non-resident, interest, royalty, fees for technical services, any other sum, literally every amount is covered. For residents also, every amount paid is covered. Remember, TDS provision should be applied and you failed to comply, then only this section. Sir, TDS provision itself is not applicable, sir. TDS provision itself is not applicable. For example, there are sections called 194A, 194C, 194H, 194I, 194J, 194R. These 6 sections are there. These 6 sections, they are not applicable for individual and HUF. Whose previous year, whose preceding financial year turnover is less than or equal to 1 crore. Business less than or equal to 1 crore. Profession less than or equal to 50 lakhs. For them, these sections will not apply. Now, I am an individual, I am not covered under TDS provisions, and I am paying some amount without deducting TDS. It's not a non-compliance. TDS itself is not applicable to me. When TDS provision itself is not applicable to me and I paid full amount without deducting TDS, what mistake I did? Nothing. This section will not apply. When 40 subsection A clause 1, 40 subsection A clause 1A will apply to me, I am liable for TDS. When I am making payment, I should deduct TDS as per TDS provision, but I didn't deduct. But I did not deduct. Or I deducted but not remitted within due date. Then only I have not complied. Then only that is called as a non-compliance with the TDS provision. Only this section attracts only when there is a non-compliance with the TDS provision. Now what is the consequence? You will not get deduction. So for the relevant year in which expenditure is incurred, in that year you didn't deduct, or deducted but not remitted. You see, if TDS is deductible, means first TDS is applicable and you have not deducted in that year, or you deducted in that year but not remitted within 139 subsection 1 due date, then no deduction. For non-resident, 100%. For resident, 30%. However, this is temporary disallowance, I told you. Subsequently, you ultimately realized your mistake and remitted to the department, like TDS deducted in RPY but not remitted within the due date. Then disallowed for RPY. For the relevant year, it is disallowed. Ultimately allowed as expenditure in the actual year of remittance. Whatever you disallowed earlier, the same you can claim it as a special deduction in the subsequent year when you actually remit the TDS. 139 due date is irrelevant subsequently when you are remitting. Suppose TDS itself is not deducted, sir, earlier. That is why they disallowed. Ultimately allowed as expenditure. Ultimately allowed as expenditure in the year of actual deduction and remittance. Original year I didn't deduct, sir. Straight away disallowed. Later you deducted and remitted, sir. When you remitted, check that date. That date comes under which year? Check that. For that year PGBP income you are computing, specially claim that deduction. Whatever you disallowed earlier, you claim it as deduction. You able to understand? Sometimes we don't apply this entire section itself. When suppose I paid amount, sir. I am liable for TDS. I am liable for TDS and I paid amount, sir. I am liable for TDS. I paid amount to the person, sir. No TDS I deducted, sir. I didn't deduct, or I deducted, I did not remit, sir. Actually, if I do not deduct and if I deducted but not remitted within due date, disallowance will apply, no. But actually what happened, to whom I paid, no. That fellow filed IT return, sir. That fellow filed IT return. In that return, no, the amount which I paid is also included, sir. And he paid tax also, sir. And my CA is giving a certificate on that. It is treated as deduction. It is treated as deduction. In which year? It is treated as, it is assumed that TDS is deducted and TDS is remitted in the year in which payee furnishes return of income. Sir, in 24-25 expenditure, I paid, sir. 10 lakhs I paid, sir. TDS I deducted or not deducted and not remitted, whatever reason, non-compliant, sir. But my recipient, no, by 31st July, his due date is 31st July, sir. Okay, his due date is 31st July, or maybe he filed the return of income in some date, sir. He filed return of income on 31st July, yeah, 30th July, when he filed doesn't matter. When he filed, in this example, 31st July he filed, sir. He filed on 31st July 2025, he filed, sir. In this return, no, my amount is there, right? That is included. He paid tax also, sir. Now, the section says, I complied with the TDS provision on this date. The section says, I complied with the TDS provision on this date, which means I complied for which year? 25-26. Indirectly, the section says, I have not complied for 24-25. For 24-25, 100% or 30% is disallowed. In 25-26, again I compute PGBP income, right? For that year, that 30%, that 100% which is disallowed for 24-25 PGBP computation, no, that is once again allowed. That's it. 40A subsection 1, sorry, 40 subsection A clause 1, 40 subsection A clause 1A is completed. Easy or not? Now 40B, once that 40B is over, entire PGBP is over except 44 series. Getting it? Are you easy? Feeling easy or not? PGBP. Now 40B, remember, whenever you are doing problem, if at all the problem gives partnership firm, PGBP computation, you should always compute as per this format. Many students in 40B have a confusion on book profit. What is book profit? Everybody will do wrong this problem. Even in CA final, they do wrong. Many students. You follow the method which I am telling, you will never do wrong. Getting it? Fine. If at all you have to compute PGBP, if at all you have to compute for partnership firm income from business or profession. For partnership firm, no, they will get additional 2 deductions. Whatever we covered 30 to 37, right? Apart from that, you will get 2 more deductions. Interest on capital borrowed from partners, remuneration paid to working partner. These 2 the firm can claim as an extra deduction. Actually, as per partnership act, partnership firm and partners both are one and same. But under PGBP, they are treated as different. So if firm is paying any interest to partner, if the firm is paying remuneration to partner, it is allowed as deduction. Suppose if a sole proprietor firm is paying interest to sole proprietor, remuneration to sole proprietor, no deduction. It is payment to self. Yes or no? Now, sir, if firm problem is given, what I should do? How? First to know, look at the P&L account, apply 30 to 37 sections, apply 40 series everything, apply full, compute profit under PGBP before reducing interest amount, and remuneration amount paid to any partner. Doesn't matter. Sir, firm paid some amounts to partners, sir. Interest on capital, sir. Interest on loan, sir. Firm paid remuneration to working partner, non-working partner, all that, sir. Except these, reduce all other deductions. You see, after considering all deductions, depreciation, additional depreciation, capital expenditure, scientific research, disallowance under 40, 40, 43B, whatever we discuss now, disallowance you apply, deductions you reduce, compute income of the firm just before interest paid to partners, remuneration paid to any partner. Don't reduce payments to partners alone, don't reduce. Compute firm income before reducing interest to partner, remunerations to partners. Compute. This is income of the firm under PGBP before reducing interest to partner, before reducing remuneration to any partner. Deduction you will claim only for remuneration to working partner. First, I should compute profit before reducing any type of remuneration. Reduce. Computed. Now, first. Now, firm is paying interest on capital. Yes, sir. Partner gave a capital, sir, out of his own funds. Partner gave a loan, sir, out of his own funds. Interest on capital, interest on loan of the partner own funds. Maximum interest allowed is up to 12% per annum on the capital or loan amount, which is given out of personal funds of the partner. Personal means whether he out of his pocket, whether he borrowed loan and then gave, doesn't matter. Sir, actually in our firm, no, a company is a partner, sir. Company is the partner, sir. On behalf of company, director is attending the meeting, sir. We want some amount, sir. Director out of his personal pocket giving me loan, sir. Remember, Director is not partner. Company is the partner. Representative is giving loan in personal capacity. Representative partner is giving loan in personal capacity. Is it treated as loan taken from partner? No. When it is not a loan taken from partner, interest ceiling limit 12% will not apply. That's the logic. That's what we have given here table. Now very simple. So interest deduction up to 12% on capital, 12% of loan is allowed as deduction. Getting it? So that's it. How much is the maximum deduction? 12% of capital. Reduce that first. First compute income of the firm under PGBP. After reducing all deductions, all apply all disallowances, but don't reduce interest paid to partner. Don't reduce remuneration paid to partner. If at all in the P&L interest and remuneration is debited, some remuneration, working partner or non-working, or leave it, add back. First reduce what? Interest on capital, interest on loan. Then what you will get, the balance profit, that is called as book profit. If you know book profit computation, I'm telling you, you're mastered in this 40B. This is how you should compute book profit. Now book profit is computed. Now look at, did the firm pay remuneration to partners? Yes. Remuneration is paid to working partner, remuneration paid to non-working partner. Both are already added back. Consider only remuneration paid to working partner. How to calculate that deduction? First look at actual remuneration paid to only working partner. Actual amount look at. Now book profit you already computed, right? Book profit. Suppose this book profit is, remuneration paid to working partner is 10 lakhs. Total is 10 lakh. Actually 2 working partners are there. Both the partners we are paying 1 lakh each. Total remuneration paid is how much? 24 lakh we paid. And the book profit of the firm is 30 lakh. What is the book profit of the firm? 30 lakh. How much is eligible? This is the question. First 6 lakhs of book profit. First 6 lakhs at 90%, or this is amendment. Remember earlier, this limit is 3 lakh. This limit is 1.5 lakh. Up to January 25 exams, here 3 lakhs limit, here is 1 lakh, 1 lakh 50. But from May 25, September 25, Jan 26, these limits are applicable. So first 6 lakhs book profit at 90% or 3 lakh, whichever is higher, is equal to 5.4 lakh. Then balance book profit is 24 lakh. On balance book profit is 24. On that 60%, what is it? What is 60%? 24 lakh into 60%? 14 lakh? 40,000. Okay, both put together 19 lakh 80,000. How much is eligible remuneration? 19 lakh 80. 14 plus 5, 19 lakh 80,000. Array firm pay 24, but eligible is 1980. Deduction allowed is how much for the firm? 1980. Lower of A and B. This is how you should solve in the exam also. This should be your working note. Getting it? 19 lakh 80. Now firm income is there, right? Here you reduce what? 19 lakh 80. Then whatever balance is there, right? That is income of the firm. On this, the firm will apply set off and carry forward provision. Brought forward business loss and all. Now they will set off. Then if balance profit is there, that will be claimed as deduction. That will be, if at all unabsorbed depreciation is there, right? That also you should allow here itself. When you are computing income itself, unabsorbed depreciation you will allow. Sir, how to allow unabsorbed depreciation, all that we will discuss in setup and carry forward. On this, firm will pay 30% tax. Still after tax some amount is there. Firm will distribute to partners. That is share of profit. Share of profit received by partners from the partnership firm is exempted. 10 subsection 2A over. Able to understand? Now remember, here we have given some conditions. The above deductions will apply only if it is explicitly authorized by partnership deed. That too prospectively only, not retrospective. Further, with effect from 1st April 2025, TDS under 194(2) is attracting. This might be asked as an MCQ. Many students will ignore. This is also a new amendment, 194T, new amendment, new section is added in TDS provision. But in TDS chapter, this section is not there. Only here it is discussed. Suppose if the firm is paying any remuneration, any interest, remuneration, firm is paying to partner. If it is exceeding 20,000 in that year, directly TDS rate is 10%. TDS rate is what? 10% they need to deduct. TDS. That's it. Able to understand. Okay. Further. Now, sir, partners are getting some interest from the firm. Partners are getting some remuneration from the firm. What about that? That is taxable under PGBP. How much is taxable? How? No, they don't see firm paid. Whatever firm paid, did the firm get deduction? No. Firm got deduction only 12%. Remuneration to working partner. Same way, partner is receiving some amount, right? Whatever they receive is taxable for partner? No. How much deduction firm got? That much only in the hands of partner it is taxable. For firm, deduction is 19 lakh in our example. Partner received 24. Firm pay 24, but firm got deduction only 90 lakh 80. For partner also 90 lakh 80 only taxable. That's it. Entire 40 subsection B is also over. That's it. Okay. 44 AA, 44 AB, 44 AD, 44 ADA, 44 AE. Once these 5 sections are completed, PGBP is over. Literally, I covered everything. 1 hour 40 minutes, approximately 1 hour 50 minutes. Another 15-20 minutes, PGBP will be over. Able to understand? That's it. We'll continue after a break. Okay. That's it. So let's continue the discussion on the PGBP. Final, we are at the conclusion stage of the revision. Yeah, right? We completed all the sections like incomes. Basically, we discussed incomes. We need not discuss any, but already some elements of it we already covered. Then 30 to 38 covered. 40 series, conditions for dissolvences completed. Now we need to look at the other provisions, 41 and 44 series. 41 is very simple. Inside 41, balancing charge is over. Sale of assets directly from the scientific research over. Recovery of bad debt is also over. Then there is another one, expired business losses. This you need to cover as part of set off and carry forward. This revision you need to cover as part of set off and carry forward revision. Now this revision, what is this? Remission or cessation of trading liability. Very simple. We all know that we can claim deduction on accrual basis, right? Suppose I purchased goods from some some person, third party. I claim a deduction on accrual basis. Later on, the third party waived me. In the sense, I don't have to pay the amount. Ultimately, the amount which I claimed as deduction earlier towards purchase cost, now I don't have to pay it. Means it's not an expenditure for me. Now it is treated as income. So in the year of waiver, in the year of remission, in the year of cessation of liability, cessation means seizure of liability. Liability is cancelled. If your liability is cancelled, trading liability, the two. If a trading liability is cancelled, it is treated as what? Income. Getting it? Remission, waiver, cessation of trading liability. Getting it? So, if a deduction was claimed in earlier and later such liability is remitted or seized or recovered in cash, then the amount of benefit is taxable as income irrespective of whether business is an operation or not. It doesn't matter. Generally, PGBP income is applicable only when the business is run, only when the business or profession is active during the year. Here, the remission of liability is taxable irrespective of whether you are active or not. And here, even if the successor is receiving the remission, even then it is taxable. Actually, there is a bad debts provision. Bad debts is recovered. If bad debts is recovered by successor, the section is silent. Therefore, we don't tax it. Able to understand? Yes. Next. Now, foreign currency exchange 43A section. This is very simple section. If at all you borrowed, see, you acquired an asset. You acquired an asset from a foreign country. And for that, no, you have taken a loan. You have taken a loan. Getting it? Increase or decrease in liability due to change in foreign exchange at the time of settlement of liability or repayment of loan. Suppose you purchased an asset, later you need to settle the amount, or you purchased an asset by using a bank loan, foreign loan. Foreign country, you acquired an asset using foreign country loan. Getting it? Now, at every 31st March, your loan liability amount not only, your loan liability amount increases or decreases because of the foreign currency fluctuation. That foreign currency fluctuation, so no, it shall be added to the block or reduced from the block. Able to understand? That's it. Simple. There's no much complication in that. Then we have something called 43A, stamp duty value of immovable property. This point we will be covering anyhow as part of 50C. Capital gains revision is there. Inside that anyhow 50C it is covered. Getting it? There we will discuss. In capital gains, the same provision as it is there, but in the capital gains chapter, the immovable property is a capital asset for the assessee. Here it's a stock in trade. Very simple. You are selling immovable property at certain price, right? Sale price alone is not considered. We will also compare it with stamp duty value. Stamp duty value means what? Stamp duty value, date of registration will be there, date of agreement will be there. Date of registration we should take normally. However, if agreement is there, on or before date of agreement, if advance is paid by any other mode other than cash, if advance is received by the seller, getting it? If we receive, because in PGBP we are selling this land and building, we received advance, getting it by other than cash, then stamp duty value on the date of agreement will be applicable. Now, freeze the stamp duty value. Now, check that stamp duty value with the consideration you received on sale of building, which is a inventory, which is a stock in trade. This section is applicable for real estate people. Okay, so now stamp duty value, is it more than 110% of the actual consideration? I mean, is it more than 110% of the actual consideration? Yes, then stamp duty value will be the revenue under PGBP. Sir, it is not exceeding 110%, sir. Then whatever the price at which you sold immovable property, no, that itself is the revenue under PGBP. Remember, it's not profit, it's revenue, turnover. Able to understand? That's it. The provision is over. 43 CA is over. Then finally, we are left with 5 more sections: 44 AA, 44 AB, 44 AD, ADA, AE. Okay, 44 AA and 44 AB, these two are talking about accounts and audit, whereas 44 AD, ADA, AE, these three are talking about presumptive taxation. Okay, so you see this section 44 AA is one confusing section for many. I made it in a simplest way. Now 44 AA, what this section says: 5 categories of SSEs has to maintain books, or else better I'll come back to this later. First let me finish presumptive taxation, because in 44 AA, 44 AB, presumptive taxation link is also there. So first I will cover presumptive taxation, and then we'll then discuss this one. Okay, now what is presumptive taxation? See, we have something called presumptive taxation. Presumptive taxation. So we have totally 3 sections on this: 44 AD, 44 ADA, 44 AE. 44 AE is applicable for the SSE who is engaged in a business of plying, hiring, leasing of goods carriage vehicles. 44 AE is applicable for an SSE who is engaged in the business of plying, hiring, leasing of goods carriage. 44 ADA, this is applicable for the SSE who is carrying notified professions, correct? And this is applicable for any other business SSEs only. Any other business SSEs only. Getting it? Now, what is the presumptive taxation means? Presumptive taxation means, see, until now what we covered in PGBP, how to calculate PGBP income. Add all the revenues minus all the deductions, disallowances, all that. Whereas in presumptive taxation, forget about disallowances, deductions, all that. You know turnover, you know gross receipt, on that some percentage you declare it as profit directly. Some percentage you declare it as directly profit under PGBP. Like what is that? 44 ADA, this section says, if at all your turnover is less than or equal to 50 lakh. Suppose if 95% of receipts are other than cash, then the limit is 75 lakh. 95% or more than 95% of the receipts, payments condition is not there here. Whereas in tax audit section, both receipts and payments logic is there. So your cash receipts are not exceeding 5%, or your other than cash receipts are minimum 95 or more than 95. Then the turnover limit is what? 75 lakh. Otherwise, your turnover limit is what? 50 lakh. So up to this turnover, whatever is there, you straight away declare 50% of turnover. Actually, in case of profession, we don't call it as turnover, we call it as gross receipts. We call it as what? Gross receipts. Straight away declare 50%. What is this? This is directly profit and gain, directly income from business or profession, directly, that's income. No more depreciation, no more additional depreciation, no more scientific research expenditure, no more deduction. 32, 38, what are all deductions we covered, right? We assume that we claimed. We assume that we claim. Remember, this is income, not turnover. On turnover, we apply this percentage, the resulting number, that resulting whatever is there, right? This is straight away treated as what? Income. This is straight away treated as income from business or profession. Understood? Now, similarly, 44 AD is there, another section. This section talks about business SSEs. This section talks about business SSEs. However, 44 AD do not apply. 44 AD do not apply. 44 AD, you see, do not apply to person earning commission or brokerage income, persons involved in agency businesses, persons who are claiming benefit under 10 AA chapter 6A. Sir, what is 10 AA chapter 6A? We will discuss. By the way, not full chapter 6A, only heading C. Income based chapter 6A deductions. See, we are going to learn, we are going to revise in chapter 6A topic. Chapter 6A deductions are 2 types: investments and payments based deduction, income based deductions. Generally heading C will come, generally income based deductions will be there under heading C. Getting it? In our syllabus, heading C related 3 sections only there: 80 QQB, 80 RRB, 80 JJAA. Only these 3 sections are there in our syllabus. Getting it? Heading C related. See, if you see chapter 6 here, no, there are so many sections, but in our syllabus, heading C related, only these three were there. Able to understand? So if an SSC claiming heading C related, which are forming part of CA inter syllabus these three, and claiming 10AA, he cannot go for presumptive taxation. And of course, obviously, an SSC who is covered under 44A, separate section, plying, hiring, leasing of goods carriage vehicle, or a person who is covered in notified professions under ADA, they are also not covered under 44AD. Clear? Okay, now, so who is covered? Only residents are covered. Even in ADA also, 44ADA also, resident individual or resident firm only covered. HUF is not covered. Here, in 44ADA, who are covered? Individual and firm, other than LLP. Other than LLP. HUF is not covered here because HUF cannot engage in profession. Whereas in AD, business, individual, HUF or firm other than LLP. Same here also, other than LLP. Provided here also residents, here also residents. Presumptive taxation is available only for residents in India. Getting it? Now, so if at all you are a resident, getting it, and your turnover from business, what is the turnover? Shall not exceed 2 crore. In ADA professions, just now we covered, turnover shall not exceed 50 lakh. In ADA, if 95% of the receipts minimum are other than cash, then turnover limit is increased to 75 lakh. Here it is increased to 3 crore. The limit is 3 crore. If cash receipts are less than or equal to 5, means other than cash is more than or equal to 95. That's it. Now, presumptive income. How much is the presumptive income? How much we will straight away declare it as income? If at all turnover is in cash mode, 8% of the turnover. Suppose if the turnover is received in prescribed modes under 40A3. Prescribed modes means what? Other than cash, other than bearer draft, bearer check, crossed check. Okay, then on the turnover, 6% we can apply, provided. Generally turnover means what? You might have sold it on cash sale or credit sale. You must have recovered it within due date under 139(1). If at all you sold on credit any amount of sale, that amount must be recovered within 139 subsection 1 due date. If you recover in other than, if you recover in 40A3 specified modes, then 6% logic you can apply. If at all the turnover is not realized by due date, then the department assumes the turnover is received in cash. On that balance turnover 8%. Very simple. I sold goods on credit, sir. 1 crore is there, sir. As on due date for filing IT return, I have not yet recovered this 1 crore, sir. What should I do? Treat it as cash turnover, apply 8%. Sir, 1 crore I recovered, sir. See, bank statement, bank proof is there. On recovered portion, apply 6%. Simple logic. Okay. For this detailed logic, I already told in the regular class. Okay. Now, here in 44AD, some conditions are there. Once an SSC chooses 44AD, what is it? They must continue declaring profit for the next 5 years. Means for 1 year if you choose it, that year plus next 5 years, means total is 6 years attested you must declare. And if the SSC stops declaring in any of these 5 years, getting it, they lose the benefit of the section for the next 5 years after non-declaration. For example, if you declare this year, next 5 years, totally 6 years at a time you should declare continuously, consecutively. Suppose in 4th year I stopped. 4th year as well as that next 5 years, means 6 years you will not eligible totally for presumptive taxation. Able to understand? See, once you choose, next 5 years also eligible. Once you stop, for that year plus next 5 years also you are not eligible. Able to understand? For that I have given a clear-cut example here. Okay, that's it. So with assessment year numbers and all I clearly gave. That's it. 44AD section is over. Now there are some common conditions which are there for all the presumptive taxation sections. I'll come back to it later. 44AD. It is also applicable for only resident, only individual and partnership firm. Remember, HUF is not covered because HUF cannot carry on profession. HUF can carry on business, family business, but family cannot carry on doctor profession, right? For example, yes or no? That's it. So, gross receipts 50 lakh. However, the limit is 75 lakh if the cash receipts are less than or equal to 5%. How much is the presumptive income? Straight away 50% of the receipts. Straight away 50%. Now, finally, sir, I am an SSC who is engaged in business of plying, hiring, leasing of goods carriage vehicle. Either goods carriage vehicle I will rent, I will lease, or I myself run hiring, I myself ply. Getting it? I will take contract of goods shipping and I myself do plying. Getting it? So if the SSC is engaged in this, and most important conditions, and owning not more than 10 vehicles. Owning not more than 10 vehicles. 365 days you see. On any day, you should not have ownership for more than 10. 1st April, 2nd April, 3rd April, 4th April, 5th April, 6th up to 31st March, on any time also. At a time. Suppose morning I am owner for 10. Evening, afternoon I sold one vehicle. Evening again I purchased another vehicle. At a time you see, it's not there more than 10. That is again permitted. Able to understand? So that is not an issue. At a time, on any time, in the entire 365 days into 24 hours, on any 1 hour or any 1 minute you see, SSE shall not be owner for more than 10. How many vehicles you can be owner for? Goods carriage vehicles. Ownership I'm talking about. You may have taken on rent 100 vehicles. How many vehicles you have taken on rent doesn't matter. How many vehicles your owner? 10. It should not be more than 10. Then only 44 AE section is applicable. Okay, sir, I'm not more than 10 vehicles. I don't have more than 10 vehicles. You have two options. One, you might have renting it, no? You might have got rental income, all that right, lease income, flying income, all that right, minus all expenses under 30 to 37 claim. You will get profit. You declare that. Or presumptive income. How much presumptive income? It depends upon the type of vehicle. Sir, I am having heavy goods vehicles. I'm having heavy good vehicle. What is a heavy good vehicle? Heavy good vehicle is a vehicle where gross vehicle weight is exceeding 12 tons. Exceeding, remember, up to 12 tons, it is not a heavy good vehicle. Only if the gross capacity of the vehicle is crossing 12 tons, that only. See, generally, gross vehicle weight is different, unladen weight is different. In exam, they should give you only gross vehicle weight. Sometimes they don't give you gross vehicle, they'll give you unladen weight. Then you should take unladen weight. Gross vehicle weight means vehicle weight plus load permitted on the vehicle. Put together is called as gross vehicle weight. Unladen weight means what? Without a load, what is the weight of the vehicle? It depends upon the state to state. Some states, no, actually it is uniform now. Right now it is uniformed. Getting it? Every dealer has to mention only gross vehicle weight. Unladen weight, it should not be mentioned on the registration certificate. Getting it? On the registration certificate of the vehicle, you will find what is the gross vehicle weight. Very simple. If the gross vehicle weight is more than 12 tons, straight away, getting it? I mean, if the gross vehicle weight is more than 12 tons, then that vehicle is straight away called as what? Heavy good vehicle. Now for heavy good vehicle, how to calculate presumptive income? Suppose I have a 13 ton capacity vehicle, sir. Then 13 tons into 1000 rupees per month into per ton. How many? 13 tons. So 13 tons multiplied by 1000 rupees per month per ton. This is your presumptive income. This is your presumptive income. Remember, many students in 44 AE, they do wrong answers because suppose, in April I have 10 vehicles. Okay. We have a problem on this. May 2nd, I sold one vehicle. Again, May 6th, I purchased one vehicle. Okay. Then again, up to 31st March, no changes at all. Now, what many students will do, entire May month, only one vehicle is there. No, they will think it as 1 month. No. Getting it? For this vehicle, remember, presumptive income is there, right? 1000 per month per ton. Yes or no? Per vehicle. Per vehicle in case of heavy goods vehicle. In case of other goods vehicle, 7500 per month or part of a month. Here also per ton or part of a ton. I mean per month or part of a month, per ton per vehicle. Okay, per month or part of a month per vehicle. Able to understand? So you have a problem in the ICA book illustrations or test your knowledge. It's fantastic question. You please solve it. Getting it? So now you see, suppose April he is having 10 vehicles. May 2nd, he sold one vehicle. He sold one vehicle. May 6th, he purchased one. So May 2nd, he is having 9. May 6th, he is having 10. On any time you see, there is no more than 10. How you should calculate presumptive income? First, April month, 10 vehicles multiplied by, let us assume all are other goods vehicle. 7500 is equal to 75,000. May month, one vehicle we sold, right? Only for that vehicle you calculate. Only for that vehicle you calculate 7500, which is sold actually, but still income will be computed. In again May month, I purchased one more vehicle. 7500, again 7500. Now you see, in May month, I computed presumptive income only for the one vehicle sold and one vehicle purchased. What about remaining 9 vehicles, which are as it is there? For that also I should calculate 9 vehicles into 7500. How much it is? 67,500. Then June to March, how many months? 10 months. In all these 10 months, 10 vehicles are there. Per vehicle 7500 is equal to how much? 7,50,000. That's how you should calculate. Able to understand? Sir, in May month, no, it is like a double calculation. No? Yes, it has to be no problem at all. Getting it? Because here in May month, one vehicle you owned even for 2 days, right? That is enough. Even if you are owner for 2 days, it is considered for full month. Able to understand? That's it. This is how you should compute presumptive income. Are you confident? Yes. Next. So now, what are the common conditions for presumptive taxation? What are the common conditions? Very simple. All deductions under 30 to 38, they are deemed to have been claimed, allowed. No set off for depreciation, unabsorbed depreciation, nothing. You get presumptive income, right? On that income, no, you can apply losses, set off and carry forward provisions, you can apply. What is set off and carry forward? I'll discuss in set off and carry forward revision. Okay. Now, in case of 44AE alone, in case of 44AE, and remember one more point, 44AE is applicable to any SSE, whether resident or non-resident. So here there is no specification, either resident or non-resident. It is even applicable to LLP, even applicable to company. Anybody can do this, 44AE. Yes or no? Now, in case of 44AE, applying hiring business of lease goods carriage vehicle, for that section alone, interest and remuneration paid to partner is allowed as deduction additionally. After calculating presumptive income is there, right? 7,500, 1,000 per month. After calculating, you get the total amount, right? From that, you can still claim it as, you can still claim deduction for interest and remuneration. Nothing but in 44AE, suppose if it is a partnership firm, in 44AE, whatever income we are calculating, no presumptive income, 75,000, all that logic, that is stated as income of the firm before giving deduction for interest and remuneration. First you reduce interest, then you will get what? Book profit, then minus as usual 40B provision. Able to understand? Whereas in 44ADA, suppose if the SSE is a partnership firm, you computed 50% of the gross receipt, right? And you computed 8% or 6% in AD, right? That is straight away treated as income of the firm. Straight away that is treated as income of the firm after giving deductions for remuneration to partner, after giving deduction for interest. Whereas in 44AE, we will treat it as before giving deduction. And I told you in the regular class, this is a mistake happened in the law. This is actually a mistake. Getting it? This is not supposed to be. This mistake they have not rectified. They rectified this in 44AD and 44ADA, but in 44AE they missed to rectify. I told you this is a loophole in the law. Getting it? Next. Then that's it mainly. Okay. Now generally no need to maintain books. If at all you are declaring income under 44ADA, 44AD, 44A, everywhere you don't have to maintain books. However, see, audit also do not apply. Even if your gross receipts are more than 50 lakh, audit do not apply. However, under ADA and AE, if lower income is declared, nothing but very simple. Suppose I'm doing that business or notified profession. As per presumptive income, I'm getting so much, but I'm actually having a loss, or I'm actually having a very minor income. Real income is minor. If you want to declare a lower income, then books of accounts are mandatory. Audit is mandatory, provided income is more than basic exemption limit. That's it. And advance tax. Suppose an SSE claiming 44AD and ADA presumptive taxation, they don't have to pay 4 installments of advance tax. They just have to pay 1 installment, that to last installment, March. Whereas AE SSE, advance tax has to be paid in 4 installments, 15th June, 15th September, 15th December, 15th March. All 4 installments will equally as it is apply. Able to understand? What is advance tax? We will discuss in the TDS TCS advance tax revision. Easy. Everyone. Now, in 44AD, what is the point here? Suppose if the SSE stops declaring, then they lose benefit of 44AD on non-declaration. After non-declaration, what is the consequence if they are not declaring? 44AB section will apply. 44AB clause number E, tax audit clause number E. An SSE for whom 44AD subsection 4 is attracted should maintain books of accounts, should get them audited, provided their income is more than basic exemption limit. Yes or no? By the way, presumptive taxation is over. Now we will go back to 44AA, 44AB. First I will finish tax audit. You see, very simple. Simplest way presented. Tax audit is compulsory for 5 categories of SSS. Very simple. The following 5 categories of SSS, they require to get their books of accounts audited by a chartered accountant by specified date. What is a specified date? Remember, the word due date is different, specified date is different. Due date means, if I am under 139 subsection 1, if audit is applicable, the due date for filing IT return is 31st October. But audit report has to be given 1 month prior, means 30th September. That's it. Okay, that is what specified date. Now, who has to get their books of accounts audited? Sir, persons carrying on business, sir, not a profession. They should get their books of accounts audited if turnover exceeds 1 crore. However, the turnover limit is 10 crore if aggregate cash receipts are less than or equal to 5%. Aggregate cash payments are also less than or equal to 5. Means 95% of the receipts, 95% of the payments are carried in other than cash. In such a case, business SSE's turnover limit is 10 crore for getting audited. Same way, sir, suppose the SSE carrying on profession, sir. That which profession? Notified profession. Getting it? And gross receipts are exceeding, any profession. But ADA, presumptive taxation is applicable only for notified profession. Suppose the SSE carrying on profession, sir, then tax audit is compulsory if gross receipts are exceeding 50 lakh. Yes or no? But remember, in ADA, presumptive taxation limit is also 50 lakh. Up to 50 lakh turnover only you can declare presumptive. The moment you cross 50 lakh, it is not applicable. However, if 95% of the receipts are in other than cash, 75 lakhs limit is applicable. If at all you are declaring under presumptive taxation because your turnover is less than 75, audit do not apply. Able to understand? Next. And SSE who is declaring income lower than presumptive, just now I told. Suppose, sir, I am engaged in 44 AE, sir, flying, hiring, goods carriage vehicle. I'm actually having loss. But how in under income tax, presumptive income is 10 lakhs, 12 lakhs, it is coming. Actually, I'm having 1 lakh only profit. Suppose you want to show real income, not that income, which is lesser. Then maintain books, get them audited. Same way, sir, 44 area, I am in a notified profession, sir. Income tax department is asking me to show 50% flat profit. My turnover, for example, 50 lakhs turnover, sir. Flat 50 means 25 lakhs, they're asking me to show profit. But really have 10 lakhs only profit. You want to show 10 lakhs, sir? No problem, show it. But get them audited. Sir, for me, 44 AD subsection 4 is applicable. What is subsection 4? Sir, I'm engaged in business, sir. I declared in presumptive basis one time, sir. Actually, next 5 years, I need to go for presumptive, sir. But I breached. I break that logic. Then in that year, you should maintain books of accounts and get them audited. And in the next 5 years, you are not eligible for presumptive taxation section at all. By the way, audit is required if income is exceeding basic exemption limit. That's it. 44 AB is also over. Easy or not? Now, what is the penalty for failure to get audit? If at all audit is applicable, 0.5% of the turnover or 1 lakh 50, whichever is lower, which means maximum penalty is 1 lakh 50. That's it. Next, suppose if at all SSE is declaring income under 44 AD, 6%, 8%, or ADA, getting it, whatever that 50%, all that, then audit under AB do not apply. Not only that, AE also. Even if the SSE is declaring income under 44 AE, then audit is not applicable. Actually, this is what earlier also we have the same provision. But now department explicitly told this. Department now explicitly told this. Able to understand? All of you? Next, now maintenance of books of accounts. This is where many students will have confusion in entire 44 series. Maintenance, 4 categories have to compulsorily maintain books of accounts. What are they? Sir, I am carrying on notified profession, sir. I should maintain books of accounts. I am carrying on business or profession, sir, but not notified profession, sir. I should also maintain books of accounts. When should I maintain books of accounts? Sir, notified profession has to maintain books of accounts. See note number 1, if these conditions are satisfied. Sir, I am not a notified, sir. I am carrying on some business or profession. I am covered in second point, sir. Then these limits you should apply. Or third category, sir, I am declaring income lower than presumptive income, sir, 44 AE. Then also I should maintain books of accounts. Sir, for me, 44 AD subsection 4 is applicable. Then also I should maintain books of accounts. Able to understand? Now, sir, note number 1, notified profession. I am. When should I maintain books of accounts? 2 circumstances. Now, suppose in all the 3 last years, my receipts are exceeding 1 lakh 50. In all the last 3 years, my receipts are exceeding 1 lakh 50. Every year 1 lakh 50 crossed my receipts. Then I must maintain books of accounts as per rule number 6F. Notified profession has to maintain books of accounts as per rule number 6F. Rule number 6F books will apply if in the last 3 years your gross receipts are exceeding 1 lakh 50. Yes or no? Or, sir, I newly started the profession, sir, notified profession, sir. Then my turnover is likely to exceed 1 lakh 50. Likely to exceed 1 lakh 50. Now, sir, what do you mean by rule number 6F books, sir? Cash book, journals, ledgers, copies of bills. Xerox copies is enough. If at all bill value is just exceeding 25. Original bills are required if the bill value is exceeding 50. Moreover, voucher has to be maintained for all the bills less than or equal to 50. Next, doctors, daily case and inventory register has to be additionally maintained. Suppose, sir, I am not covered under this category, but I am notified profession. I am a notified professional, but I am not coming under this A category. Then I will come under other. At that time, rule number 6F do not apply. Rule number 6F books does not apply. But you should maintain reasonable records so that assessing officer can compute your total income. Easy. Finally, suppose, sir, I am not coming under notified profession. I am carrying on some business or other professions, sir, not notified profession. Then the SS is divided into two types. Are you individual or HUF or others? Suppose if you are another partnership firm, AOP, BOI, company, all that, they must maintain books of accounts if income is more than 1,20,000 or turnover is more than 10 lakh in any of the 3 years. Last 3 years you take any 1 year, if this criteria, these two criteria, any one criteria satisfied, you must maintain books. Or sir, you are newly started business, sir, likely to exceed. That's enough in the current year. Sir, I am an individual and HUF, sir. Then I have a higher amount. Income is 2,50,000, turnover criteria 25 lakhs. Current year likely to exceed 2,50,000 income, turnover is likely to exceed 25 lakh. Then only I should maintain books of accounts. Able to understand. Easy. That numbers are easy. Now, sir, what is the penalty if I fail you to maintain books of accounts? 25,000 rupees penalty, 271A. Now, who is a notified profession? Because you see here, what is a notified profession? Here I have given a star mark. Who is a notified profession? Every person carrying on legal, medical, engineering, architecture, accountancy, technical consultants, interior designer, all that. Further, notified by the CBDT. The CBDT notified, authorized representative, film artist, company secretary, IT professionals are as notified professionals. Able to understand. All of you. Now, sir, how much period I should maintain books of accounts? 6 years you must retain from the end of the relevant assessment year. You should retain for 6 assessment years from the end of the relevant assessment year, where you should maintain. If single place only is there your business, then principal place, that place itself. If multiple places are there, at respect to place itself, you can maintain books. Easy. Entire income tax revision is over. Confident or not? Yes. Yes. Now let's begin income from other sources revision. Income from other sources revision. In other sources, only one provision dealing with default tax regime is allowances received by MPs and MLS is generally exempt under 10 subsection 17, but in default tax regime that is not exempt. So in other sources, typically many provisions are not affected by default tax regime. Capital gains literally zero. Default tax regime has no impact on capital gains. Correct? No. Income from other sources. Now see. So in what are the incomes that are specifically taxable under other sources? Very simple. If it is not covered under earlier head of incomes, that is straight away covered under other sources. Now the most important income is what? Dividend. So if at all you are getting a dividend, whether a company is getting, which is involved in investment activities, dividend trading activities, doesn't matter. Whether a normal individual is getting this, doesn't matter. Dividend income is always taxable under other sources. And dividend includes deemed dividend. Deemed dividend is defined under 2 subsection 22. In that, first and foremost amendment is clause number F is added. Okay, this is for the first time applicable for May 25 exams. This point is something I already told in capital gains, 46A buyback. Remember in buyback we discussed one point. If a company is buying back the shares, domestic company buying back its shares on or after 1st October 2024, any amount the company gave on buyback, that amount received by the shareholder is straight away taxed as income from other sources as deemed dividend. Sir, what about the shares purchased by him in the company? That is treated as cost of acquisition in capital gains. Full value of consideration is taken as zero. It will be a capital loss which will be set off against only capital gains and carry forward to other years. And on that, there is a problem given in this book. You can easily understand. Refer capital gains revision and then see this problem. You will understand capital gains revision and other sources, both you cover. Now, so any sum paid, any sum paid by domestic company for purchase of its own shares on or after 1st October 2024, whatever the amount you are receiving is straight away treated as deemed dividend. It's straight away treated as whatever amount you are receiving is straight away treated as deemed dividend. Getting it? Now, dividend includes deemed dividend. So what are they? Suppose company is giving any amount, company is distributing any asset to shareholders. How much is treated as deemed dividend? To the extent of accumulated profits. TEOAP means what? To the extent of accumulated profits. Whatever accumulated profits are there, up to that it is straight away treated as dividend. Now, sometimes company instead of giving cash or asset, they will issue shares. For example, they are giving debentures, they are giving deposit certificate free of cost to shareholders. Preference, equity, doesn't matter. Market value of the security is treated as dividend. Up to how much? Accumulated profits of the company. Sir, preference shares, bonus shares we are giving, sir. That is also treated as dividend. But equity shareholders, if at all a company is giving bonus, it is not treated as dividend. To equity shareholders, there is simple logic. Even if the company is giving bonus, there is no accumulation of liability for the company if equity shares are given. But if preference shares are given, company liability increases. Preference shares can get tomorrow for sure that extra amount. Yes or no? That's it. Liquidation. On liquidation, here please add the word any distribution on liquidation. Here please strike off here the cash received. What is it? Cash received. Now company when the company is liquidating, on liquidation they might distribute anything. Anything means what? Assets or cash, anything they may distribute. If asset is distributed, market value please consider. If cash is distributed, cash received you consider. Total market value plus cash received, total it up to accumulated profits of the company, tax it as deemed dividend. Tax it as deemed dividend. For example, here there is a link with section 46 to subsection 22 clause number C. In capital gains revision I kept this pending. Getting it? Sir, I have purchased shares of the company by paying 10 crore rupees, sir. Now the company distributed me 20 crores, sir, on liquidation. On liquidation, company distributed me how much? 20 crores, sir. I got some assets, I got some cash, I got total value 20 I got, sir. Company profits are approximately 8 crore were there. Accumulated profits are how much? Approximately 8 crore were there. Now out of 20 up to 8 crore, I will straight away tax it as dividend. What about the remaining amount? 12 crore. This is treated as consideration under capital gains. In capital gains 40, they will tell you amount received, market value of the asset received minus 2 subsection 20C deemed dividend 8. The amount is difference is treated as consideration minus cost of acquisition how much? 10 crores, sir. So balance 2 crore is capital gain. Now here most important point, when the liquidation is announced, that is most important. Liquidation date is treated as transfer date. If the transfer date is before 23rd July, then indexation is available. If the liquidation date is on or after 23rd July, then indexation is not available. Remember that. Easy. So next, sir, company is reducing its capital, sir, and because of reduction they are distributing, sir, either cash or kind of whatever, everywhere cash kind, everything is covered. Getting it? So it is treated as dividend to the extent of accumulated profits before the reduction. Suppose, sir, I'm a shareholder in a closely held company. Closely held company is a company in which public is not substantially interested. Suppose in a company, if public has a substantial interest, then that's a widely held company. Deemed dividend provision will be applicable here for closely held company. Yes or no? Sir, there is a closely held company, sir. Instead of receiving it as dividend, cash or distribution, I am taking it as a loan. Even loan taken by you is treated as dividend. Up to how much? Up to accumulated profits, provided the shareholder must be a key shareholder. Key shareholder means what? Holding 10% or more voting power. Holding 10% or more voting power. Remember, preference share is not considered as voting power. So if a preference shareholder is getting loan from the company, deemed dividend section will not be applied. If equity shareholder is getting a loan from the company, deemed dividend can be applied only if the equity shareholder is having 10% or more voting power. And remember, if at all the loan is given by a company whose business itself is giving loans, this provision will not apply. Able to understand? This provision will not apply. Further, if amount or loan or advance is given to shareholder for purchasing raw material from him tomorrow, later date, it's a trade advance. Trade advance is not covered under deemed dividend provisions. Able to understand? By the way, here reduction on capital, C and D, reduction on capital and liquidation, distributions are there, right? If at all any amount is distributed to preference shareholders who are not having any participative rights, that is not treated as dividend. Some clarifications you see. Shares distributed to, any distribution under C, liquidation or reduction on capital to any shareholder not entitled to participate in surplus, that is not treated as dividend. Buyback before 30th September, not treated as dividend. Trade advances, not treated as dividend. Shares distributed by resulting company, getting it? That is not treated as dividend. What is accumulated profits? All profits of the company up to the date of distribution by liquidation or reduction or whatever reason, up to the date of giving the loan or advance or whatever. Able to understand? Next. Now remember, once you are getting dividend, to get this dividend, you might have incurred some expenditure, right? Whatever expenses you incurred, you can claim deduction. But maximum expenses that you can claim deduction in case of dividend income cannot exceed 20% of the dividend income. 99.99% of the cases, students will forget this provision. If dividend is there, expenditure is there, dividend 10 lakhs, sir, expenditure 3 lakhs incurred, sir, they will claim deduction straight away. 20% checkpoint you should apply whenever you are claiming deduction towards expenses for earning dividend income, getting it, whatever expenditure it is, doesn't matter. Maximum deduction cannot exceed 20% of the income. Further, you will not at all get deduction for any expenditure if at all dividend is in the form of buyback of shares. 222 clause F. Able to understand. Next. And remember, in 2 subsection 22 clause F, one more important observation is there. Here, accumulated profit logic is not there. 2 subsection 22 clause number F, accumulated profit is not there. Whatever amount you got in buyback, fully taxed as dividend. Able to understand. Next. Then there are many other incomes which are taxable under other sources. Casual incomes, winnings. Winnings, no, not a big complicated thing. So from winnings, no, you cannot claim any expenditure. No chapter 6A, basic exemption limit and all you can't. But remember, 87-year rebate can be claimed. 87-year rebate can be claimed even on winnings related tax component. Okay. Then, sir, I received compensation, sir, on compulsory acquisition. That compensation is already taxable under capital gains, sir. 45 subsection 5. As per that, we will compute. Now, that compensation is received late by me. For that, government is paying interest, sir. That interest amount is taxable in the year in which it is received only on cash basis. Now, how much deduction available? I spent so much, sir. That at all doesn't matter. Flat 50%. Sir, I didn't spend single rupee also. Doesn't matter. Flat 50%. Then, sir, I forfeited at once. In capital gains also we discussed. If forfeiture is on or before before 1st April 2024, reduce it from cost of acquisition and actual transfer of the capital asset later on. If forfeiture is on or after 1st April 2014, straight away tax it in other sources in the year in which it is forfeited. Then there are some incomes which are taxable only under IFOS or PGBP. If it is not taxable, and I mean if PGBP is not applicable, this is not a big deal. Okay, I'm not discussing it here now. Sir, banks, they will invest in securities either because of SLR or non-SLR. What about that interest? That interest is always taxed under PGBP. Getting it? Next up, we have gift taxation, life insurance policy. I'll come back to it little while later. Okay. Next, amount received under life insurance and gift. In other sources, these are the 2 provisions which are major, bit complicated. Rest of the provisions are very easy. Residual income. Okay, salary received by MPs, MLS, straight away taxable under IFOS. Allowances received by them, exempted. By the way, remember, allowances received by them is exempted only under optional tax regime. It is not exempt under default tax regime. Sir, apart from this, sometimes we also receive family pension. Family members of the deceased individual might get pension from the husband's employer. Now, this pension is called as what? Family pension. How much is family pension is fully taxable in other sources in the hands of the legal heir, but they can claim deduction for that. Okay, 1/3 of the pension amount or 15,000 rupees, whichever is lower. In case if you are going for optional tax regime, or suppose I'm declaring income under default tax regime, then 1/3 of the pension amount or 25,000 rupees, whichever is lower. So default tax regime link is one more is there here. Getting totally 2 links in other sources, default tax. One is MPs, MLS allowances. Another one is 25,000 family pension. Yes or no? However, family pension received under the following circumstances fully exempted. Received by armed forces family members. Received by an awardee of Paramveer Chakra, Veer Chakra, all that. Commuted pension received from LIC. That is also fully exempted. Easy or not? Now, sir, for getting other sources income, I am incurring so many expenses, sir. Can I claim deductions of whatever expenses I incurred? Yes, you can claim. For family pension, deduction is already specified. For interest on compensation, deduction is already specified. For dividend income, deduction is already specified. Sir, remaining incomes I have, sir. Lottery income, you can't claim any deduction. Sir, remaining incomes I have, sir. Whatever reasonable expenses you incur, repairs, maintenance, everything, that and all you can claim. Only few conditions. It should not be personal. It should not be, if TDS is not deducted, 100% or 30% disallowance as usual will apply. Payments to related person, unreasonable amount, you will not get deduction. Payments in cash exceeding 10,000 or exceeding 35,000 to a transporter other than prescribed modes, deduction is not allowed. No deduction for winnings income. Easy or not? That's it. Then there are some exemptions under other sources incomes. Sir, I am getting post office savings interest, sir. Don't use the word bank here. Savings bank interest, we use the word generally, but it's not a bank. Post office savings interest income I'm getting, sir. How much is exempted? 3,500 rupees is exempted. Suppose post office interest is 20. Suppose I'm getting 25,000. 3,500 is exempt. 21,500 is only taxable under IFOS. That too under optional tax regime. In chapter 6A, 80 TTA up to 10,000 I can claim further deduction. Able to understand? That's it. So remaining all are easy. Interest on NRE account, not NRO. NRE account interest amount is fully exempted. If at all, because of disaster, government is giving you compensation, local authority giving you compensation, state government is giving you compensation, that is fully exempted. And scholarships received, fully exempted. Yeah, awards and rewards received in public interest like Bharat Ratna, Bharat Ratna, Padma Bhushan, Padma Vibhushan, Padma Shri, all these gallantry awards, people fully exempted. Able to understand. Now we are only left with two provisions. One is gift provision, another one life insurance policy provision. First, let me discuss gift provision, which is easy. Gift provision first we will cover. So see, gift also sometimes many students are doing mistakes only because structure they don't understand. Now you are getting a gift. First, straight away don't compare with 50,000 limit, all that. First decide from where, from whom you are getting the gift. Source. Gifts are two types: taxable source gift, exempted source gift. What are they? Exempted source gift. First decide source. Taxable source is exempted. If it is exempted source, straight away ignore it. Straight away ignore it. What are exempted sources? Received from relative is exempted. Suppose gift is received by a trust from an individual for the benefit of the relative of that individual, then trust is receiving gift, no, that is fully exempted. Gift received on the occasion of marriage, not marriage anniversary, not birthday, not Sashti Purti and all. Okay. Next, any property or amount received on will or inheritance, that is fully exempted. In contemplation of death of the payer, it is fully exempted. Gift received from local authority, gift received from fund, foundation, universities, gift received from trust or institution registered under income tax, charitable trust, we call it as fully exempted. Gift which is, if for the transfer or when he gifted you, it is not taxable for him under capital gains. For you, it is exempted. Able to understand? And gift received for COVID-19 treatment, now it is not that relevant. This provision is not that relevant, so I'm not covering it. Okay. Next, who is a relative? Relative means, you see, okay, 7 categories of people are called as relative. For me, my spouse is relative. Spouse, brother or sister is relative. Spouse, ascendants and descendants are also relative. Like spouse, ascendant means what? Parents, grandparents, great grandparents, children, grandchildren, great grandchildren. Descendant means yes or no. Now this is about my spouse and their relatives. They are also relative to me, my spouse side. Now from my side, my brother or sister is relative. Okay. And brother or sister of my parents, mother's brother or sister, father's brother or sister, they are also relative to me. Any linear ascendant and descendant, my parents, my grandparents, great grandparents, my children, grandchildren, great grandchildren, and spouses of all these people are also relatives to me. Able to understand? Now here one point, remember, gift relative definition will be applied from recipient perspective. You received from relative, that's it. Now for example, no, my nephew is there, my sister's daughter or my brother's son or daughter is there. I received from them the gift. They were not covered anywhere in the list. They are not covered anywhere in the list. For me, it is taxable. I gave a gift to them. I gave a gift to nephew. From my nephew point of view, I am a relative because I am his parents' brother or sister. Therefore, for her it is exempted. For my niece or nephew, it is exempted. Able to understand? So, gift definition shall be applied from recipient perspective, not from the giver's perspective. Able to understand? That's it. By the way, in this provision, gift is received by anybody, not necessary. This section 56 subsection 2 clause 10 is applicable for anybody. Are you getting it? Now, suppose if the gift is from exempted sources, in the problem they'll give you list of gifts. Exempted sources, keep it aside, ignore it. Remaining gifts are there, right? They are all taxable sources. Remaining gifts, no, categorize into 5 categories. Remaining gifts, divide them into 5 categories. How much is the money gift? From taxable source only, by the way. Keep all money gifts aside. Sir, I got movable property as gift, sir. Movable property means what? Car, TV, all that? No, only 8 type of movable properties are considered. 8 type of movable properties are considered. Shares and securities, jewelry, archaeological collection, drawing, painting, sculpture, any other work of art and bullion. Only 8 kind of assets are considered. Getting it? Now, have you received any of these 8 kind of assets? Yes, sir, I received, sir. Okay. Have you received them without consideration? Sir, I received some without, sir. Some inadequate, sir. So, split them. Inadequate cases, keep them separate. Without consideration cases, keep them separate. So, without consideration separate, inadequate consideration separate. Sir, I also got a gift of immovable property, sir. Without consideration, keep it separate. Inadequate consideration, keep it separate. Divide the gifts into 5 categories. Yes, sir, I divided, sir. Now, money. Total it. Total money received from taxable sources. Total it. Is it exceeding 50,000? Yes, fully taxable. If money is taxable, movable property is also taxable. No, there is no link. Now, sir, movable property, sir. I received some 3 gold rings, sir. Okay, without consideration, sir. All the 3 gold rings put together, what is the market value? Check out. 3 put together, aggregate, cash, aggregate, movable property, aggregate. Sir, exceeding 50,000, sir. Then entire market value is treated as taxable value. Sir, I purchased some gold ornaments, sir. Market value 10 lakhs, sir. But I paid only 7 lakhs, sir. 3 lakhs is inadequate portion. Okay, so aggregate value minus consideration paid is equal to how much in this example? 3 lakhs. Is it more than 5 lakh 50,000? Yes. Then that entire 3 lakhs gift portion is fully taxable. Remember, taxable amount is always gift portion only. In order to tax it, 50,000 limit we check. Able to understand? All of you? Sir, I received a ring, sir. Market value 40,000 without consideration. I purchased a gold chain, sir. Market value 1 lakh. I paid 60,000, sir. Here 40,000 benefit is there. Here 40 is there, sir. Can I totally then tax it? No. This is without consideration. You should tax it separately with 50,000 limit. Inadequate consideration has a separate limit. Sir, I am getting immovable property, sir. Immovable property gifting will be gift provision we apply each property wise, whereas movable property aggregate we apply. For immovable property wise we apply. Immovable property means what? Land, building, or land and building. Okay, sir, I got immovable property without consideration, sir. Look at the stamp duty value. Stamp duty value means which date, sir? Without consideration means registration date. If consideration is there for getting immovable property, then look at the agreement stamp duty value, look at the registration date, see whether advance is there on the agreement, see whether advance is paid by other than cash. In such a case, STB on agreement date will apply. If it is without consideration, straight away registration date, because consideration itself is not there. So now if STV of that property is exceeding 50,000, which is received as fully free of cost, yes, then entire STV is taxable value. Sir, I purchased removable property, sir, at less than stamp duty value. Then gift provision I can apply. Only one condition should be satisfied. Stamp duty value must be more than 110% of the consideration you paid. Sir, stamp duty value paid is more than 110%. Yes. Now calculate free portion. Is it more than 50,000? Yes. That free portion is taxable. That's why how they expressed it. Sir, I purchased removable property, sir. Some portion gift is there, sir. Pakka STB 1 crore, sir. I purchased it at 92 lakhs. 8 lakhs gift is there. Don't straight away compare it with 50 and then tax it. Now 8 lakhs, you purchased it at 92, right? Into 10%, how much? 9.2. Array, 10% variation not an issue in the property purchases. We will not tax it. If the variation is more than 10%, then the gift provision can be applied. Now when you apply the gift provision, free portion is how much? Is it more than 50? Yes. Then entire that free portion is fully taxable. Yes or no? You understood this point? So indirectly how the section is expressing this: I purchased a house, sir. I purchased removable property, sir, at a price less than stamp duty value. And the difference amount is more than 10%, sir. And the difference amount is moreover more than 50,000, sir. Then gift provision can be applied. Now what is the free portion? STV minus actual is equal to free portion, fully taxable. Re-listen once again slowly, you will understand the logic. Here many students confuse if this adjustment comes in the question. Able to understand? Remember, gift provision attracts only if the asset received is a capital asset for the recipient. That's it. Entire gift provision is over. Now we are only left with one more provision, that is life insurance policy. Maturity amount. Just 1 minute. Yes. Now suppose immovable property is there. For example, gift immovable property. Okay, simple example I'll tell you. Okay, suppose stamp duty value applicable, that may be agreement value or registration, whatever it is, depending upon the scenario, that is 1 crore, sir. Whereas actual consideration is 90 lakhs only I paid, sir. Now free portion is how much? 10 lakh. Many students compare it with 50,000, they will fully tax it. No, you should not straight away do that. If free portion 10 lakhs, right? Is it more than 10% of actual consideration? Yes, sir. Condition satisfied. Then is the free portion more than 50,000 also? Yes, sir. Is it more than 10% also? Yes, sir. Then entire 10 lakhs is taxable. Okay. Suppose, sir, I purchased it for 93 lakhs, sir. Free portion is how much? 7 lakhs, sir. Is it more than 10% of actual consideration? No. Free portion, though 7 lakhs is there, since it is less than 10% of actual consideration, nothing is taxable. Able to understand? Next, amount received under life insurance policy. Amount received under insurance policy. You know, see, insurance policy, if you're getting any amount, no, it is again divided into two types: taxable maturity amounts, non-taxable maturity, exempted maturity amounts. Exemption is covered under 10 subsection 10D. Now, exemption is covered under 1010D, whereas 1010D do not cover exemptions for the following. Key man insurance policy maturity amount is always taxable. Okay, and if at all we have taken insurance policy on one fellow who is dependent on us, he is a disabled person. Okay, for safety only we received insurance, but he died at first, and I received maturity amount. For me, it is fully taxable. That is 80DD subsection 3, which we will once again cover in chapter 6A deductions. Getting it? Now, sir, I have an insurance policy, sir. I have insurance policy, which I purchased it on before 2003, sir. 1st April 2003, before I purchased it, sir. Now in 24-25, I'm receiving maturity amount. Insurance policies maturities will be 40 years, 50 years duration. So this question will be there probably. I purchased insurance before 1/4/2003, sir. Suppose, no, if the SS is receiving on death, suppose if the family members are receiving on death of the person, that is always exempt, irrespective of amount. That is always exempt. That's why term insurance policies, no, they are always exempt, because term insurance maturity amount is received only by legal heirs. In term insurance, maturity will not be there. Only legal heirs will get it. Remember, we are talking about the life insurance policies other than ULIP policies. ULIP policy taxation is not there in CA Inter. Now, coming to, sir, life insurance policy maturity amount I am getting, sir. Maturity amount means what? Either sum assured you will get plus bonus also you will get. Whatever it is, both put together we call it as maturity amount. Remember, here they never said, here, you know, 1010 you see, sum received under life insurance policy, they say, though the section heading we use maturity, surrender value is also covered here. Suppose you purchased insurance policy, after 5 years you surrendered it and you are getting money. That is also covered under 10 subsection 10D scope. That is also covered under this discussion. And in ICA book it is clause number 13. Actually in ICA book it is given as clause number 12. So in ICA book it is printing mistake. Fine. Now, sir, I received some amount, sir, under insurance policy. What is the tax statement? Tax statement is dependent upon when you purchased the policy. Sir, I purchased policy before 1/4/2003, sir. Now you are getting some money, fully exempt, always. Always exempt. Sir, I purchased insurance policy between 1st April 2003 to 31st March 2012. 1st April 2003 to 31st March 2012. If this is the period in which I purchased this, it is exempt only if the premium does not exceed 20% of the sum assured. So you have taken the policy between that period, right? Every year how much premium you are paying, check out. Is it less than or equal to 20% of sum assured? Yes. Then maturity amount or surrender value, whatever you are receiving now, fully exempt. Sir, I received a policy on or after 2013. I received a policy on or after 2013. 10% of sum assured. Or else let us look at, sir, I purchased a policy on or after 2012. On or after 2012. Exemption is applicable only if the annual premium does not exceed 10%. Every year premium paid is not exceeding 10%. Yeah, straight away exempted. Suppose now disabled persons, no, from 1st April 2013, the percentage limit is increased to 50. Now, most confusing part of the section is for policies issued on or after 1st April 2023. For policies issued on or after 1st April 2023, the exemption is subject to two conditions. The exemption is subject to two conditions. Very simple. First condition, 10% criteria you apply. Disabled person, 15% criteria you apply. First condition. Second condition, if at all SSE has taken only one policy on or after, if at all SSE has taken on or after 1st April 2023, only one policy he purchased. That policy premium for any year does not exceed 5 lakh, and the annual premium also does not exceed 10% or 15% as the case may be. Premium does not exceed 10%, amount does not exceed 5 lakh in any year, then that related maturity amount or surrender value is fully exempt. This is very simple. You know, until 2023, before any insurance purchase, any insurance policy purchased, even though very good amount, good policies, commercial policies, high premium policies, income tax department is giving exemption irrespective of amount. But now high premium policies they want to tax it. That's why they kept a limit of 5 lakhs premium limit. They kept a 5 lakhs premium limit. What is this 5 lakhs premium limit? Suppose I purchased a policy on or after 2023, 1st April. Annual premium shall not exceed 10%. That is one condition. 2. Amount of premium shall not exceed 5 lakh. Only if these two conditions are satisfied, maturity amount is exempted. Now, since if it is single policy 5 lakhs premium, SSC is what they started doing. So SSC what they might do, they will take multiple policies. Now, if at all SSC has taken multiple policies, it's okay, you take multiple also. For all the policies put together, how much premium you are paying? Is it exceeding 5 lakh? Yes. Yes or no? In any 1 year it is exceeding, that's enough. Then exemption is available only for those policies whose aggregate premium does not exceed 5 lakh. Okay, at the option of the SSC. Which insurance you want, which policy you want to claim exemption is your choice. But at your option, aggregate premium shall not exceed 5 lakh. Be able to understand. Now, we have given ICA problems. ICA, in study material, IFOS problems were there. But anyhow, I have already uploaded previously when I made this particular amendments video in the previous, my old video is directly solved from ICA book. Getting it? So that video link I will show you on the YouTube. You just watch it if at all you have a doubt on this. Very neatly, very clearly explain this entire provision. Be able to understand. Next, by the way, 5 lakhs premium you are considering, right? That should be considered excluding GST. You should not include GST and then see. In exams, they will confuse you, including GST. Exclude GST component and see. Is it less than 5 lakhs? Yes. Then exemption is there. Multiple policies put together, premium is more than 5 lakhs. 6 lakhs you are paying. Up to 5 lakhs worth of premium related policies amount maturity only exempted. That's it. Easy or not? Entire life insurance policy is also over. Now, sir, I got amount. No, it is not exempt, sir. If it is not exempt, what is the tax treatment? It is taxable. How much you will tax it? How much I will tax it, sir? How much amount received? First identify. How much amount received? First identify. Minus, sir, whatever premiums I pay, no, that also I'm getting back in this. The premium when I pay, no, I did not get any deduction, sir, in income tax also. I did not get any deduction. I got 1 crore money, sir, now. I paid in the past 20 years, 25 lakhs premium, sir. I got 5 lakhs only deduction. 20 lakhs I did not get deduction at all in the past 20 years. 1 crore minus 20 lakh, the deduction which you did not get for the premium paid, reduce it. Then 80 lakhs only tax. Over. With this, entire income from other sources is also over within half an hour. Okay. If you do once again resolve the problems which we did in test your knowledge, past exam questions in our regular class, whatever, once again you just go and resolve it. I am telling you, you use this revision and once again solve it, you will master on the income tax. Clear? That's it. Heads of income is completely over. Basic concepts over, residential status over, heads of incomes over. Literally up to now whatever we covered is having a weightage of 40 marks approximately. Minimum what? 40 marks out of 60. 60 is with choice. Okay, minimum I'm telling you, minimum 40 marks weightage we covered. Getting it? Now we still have chapter 6 deductions, return of income, TDS, TCS, alternate minimum tax. Okay, these provisions, advanced tax, if these provisions are also revised, entire income tax revision will be over. Clear? That's it. Now let's revise clubbing of income. Okay, remember clubbing is you will not get a direct question sometimes. You will get it as part of a total income question or as part of some other question. Sometimes clubbing and set off and carry forward together they will ask 6 marks question. That's the weightage. I always tell you, it's not the problem how many you solve, it's the clarity in the provision. So everywhere now when I'm discussing, I will give a simple example so that you will understand clubbing provision easy. Clubbing provision, actually if you look at the income tax original study material, income of other assessees included in the total income of the individual. This is what? Income of other assessees included in the total income of the individual. This is the chapter heading. Nothing but others are getting income, but that is tax in your hand. That is why it is called as what? Clubbing. Able to understand? Now, what are the sections that we have in clubbing? We have the following sections in clubbing. Okay. Look at this at the end of the chapter. I'm giving a diagram. So 60 club, what are the sections we have in clubbing? So we have totally 3 sections. We have totally 3 categories: 60, 61 to 63, then 64. In 64 we have various categories. 64 subsection 1, 64 subsection 1A. 1A is dealing with minor income, clubbing of minor income, minor children income. 1, it has again 5 subsections. Subsection 2, remuneration to spouse. Okay, then subsection 4, subsection 6. Okay, remuneration 7 only. I think it is 7 only. Subsection 4, subsection 7, gift to spouse, directly or indirectly. Then we have 6 and 8. This is gift to daughter-in-law. These are the provisions. Then we have another section called 64 subsection 2, conversion of self-acquired property into HUF property. That's it. These are the sections that we have in our syllabus in clubbing. Now, what are they? What is that section 60 is talking about? Very simple. Transfer of income without transfer of asset. What is it 60 is talking about? Transfer of income without transfer of asset. You know, that income is taxable in the hands of the transferor. Straight away the income is taxable in the hands of the transferor. Very simple. I have shares in a company. I am eligible to receive dividend from the company. I told company, dear company, I have a security guard to his daughter who is studying in so and so. She need money. The dividend amount don't pay me. Directly pay the dividend amount to the daughter of my security guard or my son. Okay, I mean, pay the dividend amount to my brother's son. Pay the dividend amount to my sister's daughter. Pay the dividend amount to my grandfather. Simple. I told the company, don't pay me dividend, pay the dividend to them. But who are the owner for the shares? I am the owner. What am I actually transferring? Am I transferring shares? No, I am only transferring income to them. That income is treated as application. That is treated as application of money. That income is taxable still in your hands only. You can't escape tax on that. That income is taxable in your hands only. So if I have an asset, on the asset I am getting some income. That income alone I am diverting to somebody. Still I am only treated as owner of the income, and that income is taxable in my hands only. That's it. That is section 60. Next, revocable transfer. Now if I only transfer income, department is taxing in my hands only. I got an idea. I will do one thing. I have a building, I have a land, I have some shares in a company. I transfer those properties to my friend, my brother's children, or to my wife only, or to my mother or father. Somebody I transferred property. But you know, in that property transfer deed, no, I mentioned one condition. Whenever I want, I can take back that. Whenever I want, I can take back that. Getting it? This is called revocation power. What is this called as? Revocation power. This is called revocable transfer. Revocable means what? You transferred, but you can take it back. No, that is called revocable transfer. If at all you are transferring any asset with a condition of revocation of the asset or revocation of income, any of it, even part of it only you have a right to revoke, still the transfer is treated as revocable transfer. And even though the asset is in their name, even though income is they are only receiving, but power on that asset is ultimately with you, because you can revoke it back again. Income is taxable in the hands of the transferor only. Income is taxable in whose hands? Transferor only. Income arising on revocable transfer of asset. Income arising on revocable transfer of asset is taxable in the hands of transferor. Are you clear? Now, there is a section called 62. What that section says? If transfer is made by a trust that is irrevocable during beneficiary lifetime, or a transfer is not revocable during transferee lifetime. Very simple. I transferred. In the deed, there is a clause. I cannot get back the asset during their lifetime. In the transfer deed, clause is there. Condition is there. What condition? I can't get back the asset during lifetime. Their lifetime, I don't have any right on that asset. Then the asset is theirs. Income they are getting. Income is taxable in their hands only. It is not taxable in my hands, because the transfer which I made is not treated as revocable transfer, because I cannot revoke during the lifetime of the beneficiary. However, beneficiary died after 5 years. 6th year I am getting back my asset and my income. 6th year onwards again it is taxable in my hands, because beneficiary is no more. Now I got back my asset. From now it is taxable in my hands only. Clear? Able to understand? That's it. So that is regarding revocable transfer. 61, 62, 63. Easy or not? Then 64. Now, when you're discussing, no, here in 64, many students will have a doubt. Now, 64 subsection 1, 1A. First, you should compute as per 1. After computing as per 1 only, you should compute 1A. Because section order is that only. Because, no, minor income is taxed in whose hands? In the parent's hands, whose total income is higher. Subsection 2, if you see, remuneration in an entity where the spouse has substantial interest. There also one point is there, if both husband and wife are having substantial interest, then in whose hands clubbing will apply? First exclude this income. Calculate husband income separately, wife income separately. Whose income is higher? Add in their income. Yes or no? After adding this income, then minor income will be added. Are you getting it? That time I will check again, father income higher, mother income higher. Accordingly 1A. Indirectly, in a same year, spouse income is subject to clubbing under clause 2. Minor income is also subject to clubbing in the 1A. Ignore those both. Compute father income, mother income separately without including spouse income, without including minor income, without including these two. Calculate father, mother, husband, wife income. Whose income is higher? In their income, spouse remuneration, tax it. Minor income also, tax it. Yes or no? Easy or not? Here's a confusion. Very rare this confusion comes. Clear or not? Yes or no, everybody? Yeah. Now what is remuneration to spouse? Very simple. You know, remuneration to spouse in the individual's entity. There is a company. There is a partnership firm. There is an LLB. In that entity, I have substantial interest. I have substantial interest. Substantial interest means what? Minimum 20% profit sharing ratio. If it is a company, I have 20% voting power minimum. Then it means I have substantial interest. In that company, you know, my wife is working. She is getting salary. Per annum, she is getting 12 lakhs. Monthly, she is getting 1 lakh salary. Monthly 1 lakh, right? What is the total salary? 12 lakhs. Minus standard deduction 50,000 or 75,000 depending upon optional scam, depending upon tax regime 50, 75, reduce it. Balance income is what? 11 lakh 50, 11 lakh 25, as the case may be. That income is taxable in the hands of the husband. Because husband has ownership in the company. Because husband has ownership. Suppose no, wife is there. She is only having ownership in the company. She is only working in the company. Income is taxable for her only. But husband is having ownership, but wife is drawing money. Or wife is having ownership in the company, husband is drawing salary. Department assumes because your husband or wife is having ownership in the company, you are getting this money. Otherwise, you don't have that much talent and all. So this is completely a tax planning. We will tax that money in the hands of the spouse who has ownership in the company. You clear? So if one spouse is having substantial interest in one organization, in the same organization, other spouse is working, then other spouse, whatever remuneration she is getting, salary, whatever she is getting, first compute income from salary, tax it in the hands of the other spouse who has a substantial interest. But this clubbing do not apply. This clubbing will not apply. If the spouse is getting remuneration because of her qualification, because of her experience, skill and all, then clubbing will not apply. Are you clear? All of you. Now a question arises. Sir, if both husband and wife are having substantial, both of them are getting in remuneration from the entity, both of them are not having any talent, skill and all. Purely tax manipulation purpose. They are getting some salary income. First compute husband income from salary, wife income from salary, compute as usual. First compute salary income, all that compute. Net income. Now, keep these two incomes aside. First, husband, wife, whatever income they are getting from the company, keep that aside. Other incomes, total it for them. Whose income is higher, check out. In their hands, club both the incomes. Now, once in a particular year, in the hands of one spouse, if the income is added, forever in the next year also, in the hands of same spouse, income will be added. Income will be taxed. Yes or no? Getting it? So, that's what all the points I've given. Once income is included in the hands of one spouse, the same will be applied in the subsequent year unless assessing officer deems it necessary to change. Are you clear? That's it. Then, income arising to spouse on asset transferred. Here I transferred an asset. Income is arising to spouse on asset transferred. It is not remuneration to spouse. Remuneration to spouse provision is over. Now what happened? I gifted one asset to my wife, or wife gifted to husband, whatever. Now on the gifted asset, it may be cash, it may be property, it may be house property, anything. Suppose if it is a house property gifted to spouse, 27 deemed ownership concept will apply. As per 27, it's not clubbing. You are only treated as owner. In your hands only house property income will be computed. Yes or no? Sir, it's not house, sir. Some other property. Or cash, sir. I gifted cash to my wife. Or I gifted some asset to my wife. And she is getting income on that. Income on transferred asset, gifted asset is taxable in the hands of the transferor. Are you getting the point? Now, suppose I gifted her one car. She is renting that car and getting every month 1 lakh profit. 12 months into 1 lakh profit will be taxable in my hands because the car is mine. 12 lakhs is taxable in my hands. But 12 lakhs amount she is only enjoying. You know what she did? That entire 12 lakhs she kept in bank. And now she is getting interest. She is getting dividend also. That income I didn't transfer. That income I didn't gift. That she is only earning on her own. That is not subject to clubbing. Income generated. What is it? Income generated from accretion of the transfer is not subject to clubbing. For example, I gave a land to wife. Wife is getting rental income. Then the rent is only subject to clubbing. But what she did, that rent again she invested in bank FD. That is not subject to clubbing. Are you clear? Everybody? That's it. Now, so when an asset is transferred from one spouse to another without consideration or inadequate consideration, then it is clubbed in the hands of the transferor. Clubbing will not apply if at all the asset is transferred to live separately. In a divorce related scenario, if at all both husband and wife are transferring any asset, on that any incomes they are getting, that is not subject to clubbing. Similar condition is there for house property in 27 also. If house property is transferred to wife in an agreement to live apart, or house property is transferred at adequate consideration, deemed ownership concept will not apply in house property. We already covered in house property division topic. For house property, 27 will apply. Yes or no? That's it. Sometimes I gave cash to her. Cash. Or my wife gave me cash. Or I gave cash to her. Whoever it is. But what she did, she did not keep it as a deposit in bank. Suppose if I give a cash to her, she deposited in bank, interest she is getting, clubbed in my hands, correct? But she didn't deposit. She invested in a sole proprietary concern. Suppose she invested that money in partnership form. From partnership form, she is getting remuneration. Interest on capital. That interest on capital is taxable in my hands. How much is taxable? How much is allowed to the firm? That much is only taxable. But she invested in sole proprietary business. She invested in sole proprietary. In that business, her capital is also there. Now she is getting profit. She is getting profit from the sole proprietary business. How much is subject to clubbing? Total business investment, how much identify? Numerator, how much is the value of the asset transferred? How much is the value of the asset transferred? Proportionate income. Proportionate is what? Value of the asset transferred. I gifted how much? Divided by business investment total how much? In that proportion, for that year whatever profit is there, right, that is subject to clubbing. For example, total business amount, 10 lakhs she invested in the total business, but out of this 5 lakhs is my gift. For 24-25 year she made a profit of 5 lakhs. In this 5 lakhs, how much is treated as income from my gifted amount? 5 lakhs is my investment, right, which is I gifted, right? 10 lakhs is total, right? For 10 lakhs profit, 5 lakhs she got. Now 5 lakhs investment, how much it is? 2.5 lakh is subject to clubbing. However, one condition. This 5 lakhs when you gave, 24-25 year you're talking about, right? This 5 lakhs when you gave, I will see first. If at all it is given on 1st April 2024 only, you can put in numerator like this. And subject to clubbing. On 1st April of the year, no. Or on the date business started. Suppose if the business is started this year only. On 1st day of the business, I will see how much your gifted money is there. Suppose no, business is long back she started. I gifted her on 10th April 2024. And for 24-25, she made a profit of totally 5 lakhs in the TO. Total capital is 10 lakhs. As on 1st April, how much is gifted amount? I gifted on 10th April only. 1st April, I didn't give any gift. 1st April, 0. Clubbing will be 0. Clubbing will be 0. You know, for a particular year, if at all in the business there is a profit, that profit proportionate investment is subject to clubbing only when the gifted amount is there from first day itself. If gifted amount is not there on the first day, clubbing will not apply. Clubbing will not apply if the gifted asset is not there on first. For example, no, 25-26, no, okay, 24-25, clubbing is 0. 25-26 position, I will tell you. 25-26, she made a profit of 10 lakhs. You know, 10 lakhs she made. And you know what? In 25-26, actually, total capital is 10 lakhs, right? Last year. Plus last year profit, how much, you know? 5 lakh. Last year profit, 5 lakhs. Total capital is how much? 15. 15 lakhs capital is there in the 25-26. And for that year, she got 10 lakhs profit. How much is my gifted money? As on 1st April 2025, my 5 lakhs is there as it is. Yes or no? I gave 5 lakhs. That is there as usual. 5 lakhs is gifted. So 5 lakhs divided by 15 is equal to 3,33,333. This is subject to clubbing in the hands of transferor. Are you clear? Like this, there is a problem in MTP, RTP, previous exam questions or illustration, which we solved in our regular class already. Clear? 2 problems we solved on this. Confident or not? Okay, you also can solve this question in our question bank. It is there. You can download and then solve. So you can just download our website, Sreshta for CMA. In that question bank, you will free resources will be there. Inside that P3A, inside that question bank will be there. You just download and then solve it. Clear? Easy. Then same logics will apply. Same logics will apply even if you are transferring to son's wife. But when you're transferring to son's wife, no. Suppose if you're transferring house property also, no. House property is also covered under 64 only. For suppose if I transfer house property, 27 will apply. Remaining asset, 64 will apply. For daughter-in-law, whether I transferred house property or whether I transferred normal asset, which section is applicable? 64 only applicable. Correct? Here, in the above it is spouse, here it is son's spouse. That's the only difference. At the end of the day, income is taxable in the hands of the transferor. That's it. Last section in this chapter, 64 1A. 64 subsection 1A. Very simple. I am having minor children. They are getting income. It is straight away taxable in the hands of the parent. Which parent? Mother or father? Whose income is higher, check out. In their income, tax it. First time when you are clubbing only, you should check this point. Once it is clubbed in the hands of the mother, first time, because mother income is higher in that year. Second year, third year, fourth year, from until he became major, his income is taxable in the hands of the mother only. Yes or no? Once a minor income is clubbed in the hands of one of the parent, next assessment years also that minor child income is clubbed in the hands of the same parent until they attain majority. Whether a person, whether children is minor or not, as on 31st March you should see. As on 31st March, 18 years not completed. That's it, minor. For that year, is the children drawing any income? Yes, sir. Club it in the hands of the parent. Now here, when you are clubbing, no, 1500 exemption available under optional tax regime. How much exemption is available? 1500 exemption is available under optional tax regime. Suppose if at all the parent is filing return of income under default tax regime, 10 subsection 32, 1500 exemption will not apply. This 1500 exemption is per minor child. Suppose if 3 minor children income is added, then 3 times into 1500 you will get. That too if it is only optional tax regime. Now minor income is straight away taxable in the hands of the parent. Now how this minor is getting this income? Anyway, it doesn't matter. He is getting income. That's it. That income is taxable in the hands of the parent. However, if minor is getting income by special skill, talent, getting it, or if the minor is suffering from 80U disability, if minor is suffering from 80U disability, we will not apply clubbing. then the income is taxable in the hands of minor only. He will have a PAN number. You will file IT return as a guardian. That's it. On behalf of minor, you will file IT return. On minor PAN number only. As a guardian, you will file the return. That's it. Able to understand? All of you. Now, you will get one question. Minor, no, he participated in one chess competition. He got 10 crore money. He got prize money 10 crore. Okay. The 10 crore is subject to clubbing in the hands of the parent? No. Because it's a special skill and talent. The 10 crore is taxable for minor only. And what he did, cleverly, that entire 10 crore he invested in a shares of a company. Now company is paying dividend to him. 1 crore dividend he got in 1 year. 1 crore dividend he got in 1 year. Same year 1 crore dividend also he got. That dividend income is taxable in the hands of the parent. Why? Sir, it's out of special talent and special skill. No. 10 crore money is out of special talent and skill. This dividend income, he did nothing. He just invested 10 crore. He got dividend income. Dividend income, for getting that dividend income, did he apply any skill and talent? Nothing. That is taxable. Very simple. Minor's active income, manual labor, skill, disability, when these are all there, no, the income is called as active income. If minor's active income is taxable in his hands only. Minor is getting passive income. He is doing nothing, but he's just getting income. Passive income is taxable in the hands of the parent. That's a simple rule. Minor's active income is taxable in the hands of the minor. Passive income is taxable in the hands of the parent. Sir, parent gave asset at free of cost. Actually, minor bought a house from me. Bought a car from me. He paid me money and bought the car. Still, on the car, he is getting rental income taxable in the hands of the parent. Are you clear? Suppose if at all minor is doing business with skill and talent, then that business income is not taxable in the hands of the parent. Simple. Minor getting income. Yeah. Which income? Active income means he is performing work. His skill, talent, disability. Passive income means interest, dividend, all this. These are passive. Passive incomes are taxable in the hands of the parent, whose total income is higher before including minor's income. 64 subsection 1A. Able to understand? Now remember, in house property there is one point. House property transfer to minor child other than minor married daughter. Parent is treated as deemed owner. 1500 exemption does not apply there. Able to understand? Suppose if the house property is transferred to minor married daughter, deemed ownership concept will not apply, but 64 1A clubbing will apply. If minor married daughter house property is transferred, clubbing under 64 1A will apply. With this, clubbing is over. 64 subsection 2 and all not that important, so I am not covering it. Okay. Now there is a difference in 61. Revocable transfer in 64. Remember in 64 subsection 1 clause 2, if I transfer to my wife inadequate consideration, yes or no, I am treated as, for me it is taxable, that income is correct. Suppose no, I sold my wife. Sorry. I sold to my wife. Okay. Yes. I sold to my wife. Okay. I sold to my wife some asset. I took money adequately from her and I sold. Okay, come back. Yeah. Slip of tongue. Yeah. So I sold a car to my wife. She's earning some income. She paid me money and she purchased a car from me. Out of paying adequate, she purchased. But when I'm selling itself, I told her I will get back the asset whenever I want. It's a revocable transfer. If it is a revocable transfer under 61, consideration is there or not doesn't matter. I am treated as owner directly. In my hands only that income is taxable. Remember under 61, 62 to 63, even if adequate consideration is there, if revocation condition is there, it's a revocable transfer, straight away income is taxable in the hands of the transferor, whether consideration is adequate or not. Sir, I transfer it for inadequate consideration. Inadequate. Then 64 will apply. Clear all of you? Everyone? That's it. Then, so with this, clubbing is over. Okay, see, 26 minutes hardly. Clubbing is completed. Able to understand? Every point I touched. Everywhere example also I gave. Correct? That's it. Now set off and carry forward. Just a minute. Yes, let's begin set off and carry forward revision. Okay. In set off and carry forward, no, we have totally these many sections. 70 intra-head set off, 71 inter-head set off, 71B carry forward of house property loss, 72 carry forward of normal business loss, 32 subsection 2, carry forward of unabsorbed depreciation loss and carry forward of unabsorbed capital expenditure on scientific research, carry forward of unabsorbed capital expenditure on family planning, all that similar treatment under 32. Okay, then we are going to discuss 73, carry forward of speculation loss. 73A, carry forward of specified business loss related capital expenditure. Yes or no? Revenue expenditure for specified business, no, it's 8 years only always. Specified business related capital expenditure. Getting it? Actually, specified business, all types, 80, I mean, infinite only. Okay, revenue capital, no need to bifurcate. Actually, 70 specified business under 35 AD, they're mainly talking deduction about capital expenditure. Yeah. 73A, yes or no? Minus 74, capital losses, long-term capital or short-term capital loss. Then 74A, we have a loss from owning and maintaining race horses. Totally these are the sections. And finally there is a section called 80, which talks about due date for filing IT return, which talks about in order to carry forward the loss, you must file the return of income within due date. These are the sections. Now suppose SSC is having multiple sources within same head of income. Suppose I have multiple houses. Now from few houses, I have a loss after reducing interest. From few houses I have a profit even after reducing interest. Remember, under optional tax regime only interest on self-occupied property can be claimed as deduction. For let out and deemed let out property, you can always claim interest deduction, no limitation on that. For self-occupied house only, you can claim deduction. You can claim deduction towards interest only and optional. Under default tax regime, you can't claim. No, very simple. Within a head of income, if I have multiple sources, like I have multiple businesses in PGBP, I have multiple capital gains income, capital losses. Very simple. Loss from one source, I can set off with income from another source. In the same head, within the same head I will set off. Income and loss I can set off. One source I have a loss, another source I have income, I can set off. But there are certain restrictions. Speculation business loss, you can set off only with speculation business income. If you have a speculation business and there is a loss from that, you can only set off with speculation business income. What is speculation activity? In PGBP, I have not revised it actually, but you can read that and then cover. In our PGBP discussion introduction, there is a speculation business means what? Hedging is not a speculation. Shares derivatives is not a speculation. Commodity derivative is not a speculation. These three are not treated as speculation. And a company whose principal activity is trading, whose principal activity itself is investing, loans and advances, for them also buying and selling of shares is not treated as speculation. Banks, it is not treated as speculation. Are you getting it? So for banks and all, speculation concept will not apply. For companies which are exclusively involved in investing business, for them speculation concept do not apply. And for other people, derivatives is not a speculation, commodity derivatives is not a speculation, hedging contracts is not a speculation, forward contract is not a speculation. That's it, over. Speculation concept also over. Speculation means what? Buying and selling of shares without delivery. I buy the share and sell without taking delivery. Nothing but intraday transactions. They are all intraday transactions. That's it. Now, speculation, if I have a loss, I can set up that, but only with speculation business profit. Suppose I have a speculation loss, but I have another business, normal manufacturing business, I have a profit there. I can't set up these two because speculation loss I can set up only with the speculation gain. Suppose I have a specified business loss. Specified business means 14 specified businesses are there. Under PGBP, I have a loss from them. Incomes minus revenue expenditure minus capital expenditure, 100% reduction is equal to I have a loss. No problem. You can set off it only with another specified business. Only. Suppose I have a loss in 3-star hotel and I have a profit in hospital with 100 beds. Set off. Sir, actually 100 beds hospital is there, right? I am not claiming 35 AD deduction, sir. It's a specified business only, but I'm not claiming deduction under 35 AD. Is that income still eligible to set off this loss? Yes. See, they are saying specified business loss, you can set off only with specified business profit. They are not giving any condition like, are you claiming deduction under 35 AD? They are not at all asking that. If it is a specified business loss, set up only with specified business income. That's it. Are you clear? Next. Sir, I'm having a long-term capital loss. Suppose under capital gain set of income, no, I sold shares, long-term shares. I got a loss. I sold land and building. Short-term, I had a profit. Can I set off these two? They both are within the same source, no? long-term capital loss, it can be set off only with long-term capital gain. Same like speculation and specified. Speculation business loss, specified business loss, they can be set off only with respective incomes. Long-term capital loss can be set off only with long-term capital gain. Same way, sir, I am owning and maintaining race horse. From that I have a loss. How to calculate loss from owning and maintaining race horse? How to calculate loss from that? Very simple. You know, loss is equal to, did you participate in any winning and won the money? Check out. Yeah, I won. I won some money. And did you incur revenue expenditure for maintaining the race horses? Yes, I spent a lot of money in the full last 1 year. I spent so much on feeding the horses, all that. But in one race, I won money. So I won money, approximately 1 crore in the race. But feeding the horses and all, 2 crore I spent. 1 crore is loss. This is called as loss from owning and maintaining race horse. You know, these people who are owning and maintaining race horses, no, they incur revenue expenditure. That revenue expenditure will be used for calculating loss under other sources. Their income is what? Winning money. If at all they win something in the horse race, no, that winning we will consider. Winning we will consider only on gross basis. Winning minus that one. Sir, in this year, no winning, sir. Everything loss only. Only entire expenditure I spent on horse maintenance. Remember, for calculating loss, no, only revenue expenditure on maintaining the horse you should take. You should not take race horse loss. Horse races we participated and there I incurred loss. That is to be ignored always. That is to be ignored. I spent money on maintaining the horse. That you consider. Income from winning minus money maintained on horses is equal to balance. If still loss, then that is called as what? Loss from owning and maintaining. And that loss you can set off only with the same income from owning and maintaining race horses. Suppose, sir, in agriculture, no, if there is a profit, you are ignoring because agriculture income is exempted. If there is a loss, what about it? That is also ignored. If you are getting profit, we are ignoring because it's an exempted source. If you are getting loss also, it is to be ignored. Loss from exempted source shall be ignored. That's it. 70 section is over. Then 71, which is talking about interhead adjustment. What is interhead adjustment? Very simple. Loss under one head of income can be adjusted with income under another head. See, right now, what I did, within the same head, I have some houses and all. I have businesses. I tried set off. By the way, tell me, I have a normal business loss. Can I set off with speculation business income? Restriction is for speculation loss. Normal business loss, no restriction. Yes or no? Is there a normal business loss discussion here? So I can set off normal business loss with any source of income within the same head of income. Can I set off short-term capital loss with long-term capital gain? Yes. Where is restriction here on short-term capital loss? Here restriction is there only for speculation loss, specified loss, long-term capital loss, loss from owning and maintaining resource. No restriction for other incomes. For other losses, I can set off with other incomes comfortably. Yes or no? No. Suppose I set up the loss. I still have a loss. I can set off with other heads of income. You see, I have given very clearly material here. You see here, only one point I've highlighted here, and house property point I've highlighted with a green background. Rest of the points you see, same white background. What does it mean, Under optional tax regime, under default tax regime, for normal business loss, speculation loss, specified loss, long-term capital loss, short-term capital loss, for all of them, the treatment is same. Whether it is optional tax regime or default tax regime, it doesn't matter. House property loss. If I have a loss under house property head, first set off with other house property incomes. You still have a loss, huh? Set off with other heads of income. Set off with other heads of income only under optional tax regime. You can set off with other heads of income only under optional tax. That too, how much you can set off? 2 lakh. Suppose, sir, I am going with the default tax regime, sir, and I have a loss under house property. You can't set off. First of all, in default tax regime, you will get a loss under house property only for LOP, DLOP. You will not get loss for SOP. Why? SOP, you can't claim deduction at all. If NAV is equal to 0, you can't claim deduction towards interest under default tax regime. No deduction towards interest for SOP, UOP, where NAV is equal to 0. So loss is not at all possible in default tax regime for self-occupied house, unoccupied house. Loss is possible only for let out property, DLOP, where interest on borrowed loan is more than where interest on borrowed loan is more than net annual value. Net annual value minus 30% deduction. Then still you give interest on loan. If the resultant figure is negative, then that's a loss from house property. Now that loss, if you still have, even after set off with other heads, note, by the way, in default tax regime, you can't set off with other heads. You can't set off with other heads. But in optional tax regime, you can set off with other heads of income. Yes or no? And I told you, under optional tax regime, still have a house property loss, sir. What I can do? You can carry forward for 8 years. After setting off with other heads up to 2 lakh rupee, I can still carry forward for how many years? 8 years. Under default tax regime, ICA book contains a mistake. I am telling you once again, it's a mistake. Don't again ask me below comment saying that, sir, why it is not, it is given in ICA book, it is not carry for. No, it's a mistake. It's a mistake. That's it. And I spoke in the regular class, I showed in the regular class, I opened act and showed it's a clear-cut mistake. Yes or no? In the ICA book, they said house property loss cannot be carry forwarded, which is actually a blunder mistake. Getting it? You can carry forward. This point is given in ICA book, which is wrong. Very simple. Under default tax regime, house property loss you can't carry forward. Why? Under default tax regime, which loss you can't carry forward? That loss which you cannot claim deduction. In default tax regime, if you can't claim, you can't carry forward. If you can claim means you can carry forward. If you can claim means you can obviously carry forward. Yes or no? Restriction of not carry forward is there for what? Disallowed losses, disallowed expenses, unabsorbed depreciation and all, you can't carry forward further. For those kind only it is there. Yes or no? So under default tax regime, if I have a let out property, deemed let out property, default tax regime, and I have a loss from that let out or deemed let out property, I will first set off with other heads. No, set off with other heads is not permitted. You can carry forward. If you cannot carry forward, then why deduction they will give? Deduction for LOP, DLOP is unlimited, no? Under default tax regime, they will give deduction, no? If they are giving deduction, then why they are giving deduction without carry forward, right? Fundamental question. So you can still carry forward. In ICA book, it is wrongly given. In ICA book, it is wrongly given. In one of the MTP, it is wrongly given. Actual provision is you can carry forward. In exam, if the same question comes, what to do? You write an answer in such a way, point write not carry forward. Below write alternative answer. As per the provisions of the law, it can be carry forwarded. But in the ICA study material, it was given not carry forwarded. You just write that. That's enough. Are you getting it? 99.99% ICA will give right answer only. ICA will go for right answer only. Means it can be carry forwarded. Able to understand. So, house property loss. Can I claim deduction for LOP, DLOP interest? Yes. If there is a loss, can you carry forward in default tax regime? Yes, you can carry forward. Sir, what about self-occupied property? For self-occupied, unoccupied, where NAV is equal to 0, you can't claim interest deduction itself. When you can't claim interest deduction itself, how come you carry forward? There is no question of carry forward for self-occupied, unoccupied. Sir, what about optional tax regime? Optional tax regime, self-occupied, unoccupied, interest you can claim deduction. Loss is there. Set off with other heads of income up to 2 lakhs. Still loss is there. Carry forward for 8 years. Sir, let out and DLOP, sir. I have claimed interest, sir. I have still loss. Set off with other heads of income. Maximum 2 lakhs only. Balance loss. Carry forward. That's it. I spoke about set off, self-occupied, unoccupied, let out, deemed let out. Both under optional tax regime, default tax regime. I spoke about set off. I spoke about carry forward. Clear? Next. Sir, I have unabsorbed normal depreciation loss. Sorry, normal loss. Immediately, whenever PGBP loss information, suppose in the question they spoke about business loss. Suppose you are computing PGBP income in the current year. You got a loss. Immediately what you should do, suppose you got a loss of 10 lakhs. You got a loss of 10 lakhs under PGBP. Add back depreciation. Add back depreciation. How much depreciation? For example, 15 lakhs is the depreciation. Now business income is profit. Before depreciation, you have a profit. After depreciation, you have a loss, which means this entire loss is because of depreciation. This entire 10 lakhs is treated as depreciation loss. This entire loss is treated as depreciation loss. You can carry forward for infinite number of years. No restriction on that. Are you getting it? No restriction. You can carry forward infinite number of years. Depreciation loss, we call it as. It is nothing but loss due to capital expenditure. Similarly, if at all, very simple, compute business loss. First compute income from PGBP as usual. Claim depreciation, claim additional depreciation, optional tax regime. Suppose if it is default tax regime, claim normal depreciation only. Don't claim additional. Okay. Claim scientific research expenditure, capital expenditure, family planning capital expenditure. Every deduction you claim as usual. No compromise at all. You got a loss. How much? 10 lakhs. You got a loss of how much? 10 lakhs. Now add back depreciation. Sir, depreciation is 7 lakhs, sir. Now add back capital expenditure on scientific research, which is some 3 lakhs. Now add back capital expenditure on family planning. Now you see, when you are adding back, it became only 0, which means because of depreciation, you don't have a loss. Okay, I mean, you have a loss. Actually, you have a loss. Yes or no? Now add back, family planning on capital expenditure, 2 lakh. Oh, if at all you didn't claim all these capital expenditure, you have a profit of 2 lakh. After claiming deduction, you have a loss. After claiming all these deductions, you have a loss. Now, what do I call it as, 5 lakhs is depreciation loss. This 5 I will give 2, no, first I will give priority to depreciation, still 5 lakhs. So, mine 2 minus 7 lakhs depreciation, but 2 lakhs only I will claim. So, my business profit, my revenue profit is equal to, my revenue profit is only 2 lakhs. Actually, before claiming this, whatever profit is there, that is revenue profit after reducing revenue expenses. After reducing revenue expenses. Now I am reducing capital expenditure related deduction. Now I am reducing what? Capital expenditure. One of the capital expenditure deduction is what? Depreciation. Another capital expenditure deduction is what? Scientific research. Another one is what? Family planning. Oh, now 5 lakhs is depreciation loss. 3 lakhs is scientific research capital expenditure loss. 2 lakhs is family planning related capital expenditure. These 3 losses, no, you can carry forward infinite. You can carry forward infinite. No restriction on that. You able to understand? Very simple. You have a business loss, some amount. This is not fully your business loss. This includes some revenue loss as well as capital expenditure related losses. Find out capital expenditure related losses how much. Are you getting it? Now, for this business loss, no, add back capital expenditure deductions you claimed. What are the capital expenditure related deductions? Depreciation, scientific research, family planning. If there is a profit, means from business revenue activity, you have a profit. You don't have a loss. The loss is completely because of capital expenditure. Suppose after adding back also, you still have a loss business, then that is exactly called as business loss. That business loss, what you can do? You can set off with business loss. You can set off with other heads of incomes. Happily, you can set off business loss with other heads of income, except salary. Whether optional tax regime or default tax regime, same provision, except, sorry, not this is actually depreciation loss. Okay, normal business loss. You can set off against any head of income except salary. Sir, what about depreciation related loss? That also you can set off with any head of income except salary. Sir, depreciation has 2 parts. Additional depreciation loss is there. I am telling you, this breakup you will not find anywhere. In the ICA book is not there. Anywhere also you will not find. This clarity is very important for you. Yes or no? Because set off and carry forward, if an exclusive question comes, they will twist here only. I have additional depreciation also in. Yeah, that additional depreciation loss you can set off with any head of income except salary. See, first you will always set off with PGBP. If you don't have PGBP profit, brought forward depreciation, if you don't have PGBP, then you will set off with other heads except salary. Under default tax regime, additional depreciation, if at all anything is there brought forward, you cannot set off with other heads, because additional depreciation shall be added to opening WTV. Additional depreciation shall be added back to opening WTV. Yes or no? 115 BAC. It will be added to opening WTV. That's it. Now, after still, set off with other heads and all, still have a additional depreciation loss under optional tax regime, carry forward. Still have a normal depreciation loss under optional tax regime, carry forward. Business loss, carry forward 8 years. How many years you will carry forward? 8 years. Okay, suppose normal business loss I can carry forward for 8 years under optional tax, under default tax. Okay, what about additional depreciation loss? Happily carry forward under optional tax, but default tax you can't carry forward. It will be added to WTV, block of asset will be added. Normal depreciation loss, carry forward, carry forward. That's why you see here in house property, additional depreciation, specified business loss. Only for these three, the provision, the treatment of loss is different in optional tax and default tax. Now, sir, I have a specified business loss, sir. You can carry forward any number of years. But under optional tax regime, you don't get any deduction at all. Yes or no? Therefore, the brought forward specified business loss shall be ignored and cannot be carried forwarded further. Yes or no? Sir, I have a speculation loss, sir. I have a speculation loss. What about speculation loss? Array, you can only set up with speculation income. If you don't have speculation income, only, you can only set up with speculation income. You can only set up with speculation gains. You can't set up with other heads also. So, if at all any loss is there, carry forward for 4 years. Carry forward for 4 years. Correct? Sir, I have a specified business loss. What about this? You can set up only with specified business profit. Sir, this specified business, no, it's a specified business, but it is not eligible to claim deduction, sir. If they're not claiming 3580 deduction, it doesn't matter. You can set up with specified business income, not an issue. So no, loss under specified business after claiming 3580 deduction, if there is a loss, you can set up with another specified business profit, even though the later is not eligible for deduction. In optional tax regime, sorry, in default tax regime, specified business itself, they don't get a deduction. Yes or no? By the way, in default tax regime, specified businesses will not get deduction under 3580 for capital expenditure. Revenue expenditure and all they can still claim. Yes or no? Sir, long-term capital loss I have. You can set up only with long-term capital gain in both the regimes. Short-term capital loss I have. I can set up with long-term capital gain or short-term capital gain. Sir, I still have a short-term capital loss. Can I set up with other heads? No. Capital gain set off income itself is untouchable. And you can set off same. Owning and maintaining risk, same source I can set off. You can't set off with other source also. Loss from exempted, ignore. Now, still I have a capital loss, sir. What shall I do? Carry forward 8 years. Loss from owning and maintaining, carry forward for 4 years. Note number 5, nothing but computation of loss. That's it. Clear. So, loss from specified business can be set up only with specified business income, even though the later is not eligible for deduction. Doesn't matter. Easy or not. All of you. Now, under PGBP, what should be the order of set off? First to know, calculate current year income minus current year depreciation minus current year capital expenditure on scientific, current year capital expenditure on. First calculate net income under PGBP current year after reducing all expenses, revenue expenses, capital expenses, everything. Still you have a profit. Then brought forward business loss is there. Brought forward depreciation loss is there. Brought forward family planning, scientific research, capital expenditure are there. Now which one first I should set off? First set off brought forward business loss, because it can only be set off for 8 years. Then you set off unabsorbed depreciation. Then you set off capital expenditure on scientific. Then you set off capital expenditure on family planning. If you still have a profit, you can use that profit for set off from other hits. That's it. Clear? Now here, if you remember, there is a section called 41 subsection 5. That section says, you have 41 redeemed profits, 41 subsection 1 remission of trading liability, 41 subsection 2 sale of asset used for scientific, 41 subsection 2 balancing charge, power sector balancing charge, 41 subsection 3 sale of asset used for scientific research, 41 subsection 4 recovery of bad debts. In all these incomes, if you have a brought forward business loss, but 8 years over. It's expired actually, expired that loss. But that loss can be set off against 41 incomes. If at all you have any brought forward business loss which is already expired, normal business loss expired already, you can set off with 41 deemed profits incomes. That's it. Set off and carry forward is over. Finally, section 80. What this section says, remember, once in a particular head of income, after you set off the loss, after you set off the loss with other heads of income, if you still have a profit, if you still have a loss, you can carry forward, right? But here, one condition. If you want to carry forward business loss under 72, speculation loss, specified business loss, capital losses, loss from owning and maintaining race horses, getting it? You can carry forward only if the return of income is filed within due date. And if you are filing return of income with a loss, it is called as a loss return. That's why here the word is used is return of loss. You may call it as return of income or you may call it as return of loss. At the end of the day, that loss is there. If you file that within due date, what is the due date? 31st July for non-audit cases, 31st October for audit cases. If audit is applicable for SSE under income tax or some other law, doesn't matter. Audit is there 31st October. No audit 31st July. Within that date, if you file IT return, then only you can carry forward 72, 73, 73A, 74, 74A losses. Unabsorbed depreciation not covered in the list. House property loss is also not covered in the list. That's it. Clear? Mainly this aggregation 68, 69, these are all unexplained incomes discovered now. Unexplained cash credit, unexplained investment, unexplained expenditure, amount repaid or borrowed on hundi. Getting it? All these are treated as income of the SSE in the respective year, and they are taxable at flat 60%, 60 plus 25% surcharge. Effectively 78% tax will come, including education cess, all that. Black money taxation provision. Yeah. That's it. Setup and carry forward of losses is over. Remember, setup and carry forward of losses I discussed extensively, discussing all peculiar issues. House property loss, if it comes, how to do. Self-occupied case, how to do in optional default, everything. Yes or no? Entire setup and carry forward just in 4 pages. That too with a lot of clarity. Clear? Setup and carry forward is over. Confident everybody? That's it. Yes, let's discuss Chapter 6A deductions and deductions under 10AA. Deductions under 10AA. First I will cover 10AA deduction. Remember, under chapter 6A you have a section, you have a heading called heading C. Related to that we have 3 sections: 80 QQB, 80 RRB, 80 JJAA. These 3 deductions and 10AA deduction you can claim only if the return of income is filed within due date. You can claim these 4 sections related deductions only when CA certificate is obtained. Audit is compulsory. That is first condition. Are you clear? Now, 10AA. What is this section 10AA? At the end of chapter 6A deductions you will find. Remember, 10AA deduction and chapter 6A deductions both shall be reduced only from gross total income. When you are computing 10AA deduction, what is 10AA deduction? 10AA is for special economic zones, deduction for special economic zone towards export profit. What is export profit? Very simple. SEZ will be there. In the exam, they will give you SEZ related problem. Sometimes in exam, they will give you total company turnover and their turnover in domestic tariff area they will give. Total turnover of the company they will give, domestic tariff area turnover they will give. SEZ turnover you should find out. How much is the total turnover of the SEZ you should find out carefully. Now in the turnover, SEZ has exported also. SEZ has exported. Find out export turnover in the problem given of the only SEZ. Remember, by mistake you may take total turnover of the company or DTA. Sometimes they'll give you total turnover, DTA, domestic tariff area. Balancing figure will be SEZ. That they will not give you directly sometimes. So SEZ total turnover, export turnover how much? What is the profit of SEZ for that year? Find out. That result is what? We call it as export profit. We call it as what? Export profit of the SEZ. Okay, SEZ has an export profit. What is the consequence of that? That is that whatever export profit is there, first taxable under PGBP. As usual, PGBP is taxable, gross total income. Under chapter 6A plus 10AA, you can claim 10AA reduction from gross total income. How much you can claim? For first 5 years of the business, 100% of the export profit, whatever is there, claim deduction under 10AA from gross total income. Next 5 years, claim 50%. That next 5 years, claim 50% profit subject to investment in special economic zone reinvestment reserve. The amount deductible, you see here I have given star mark here. The amount deductible must be credited to special economic zone reinvestment reserve for utilization in the utilization. How many years you should transfer like this? Next 5 years. Actually utilization must be for in the next 3 years. Utilization must be within 3 years. For what? You must purchase new plant and machinery. You must purchase plant and machinery within 3 years from the special economic zone reinvestment reserve. Very simple. You started SEZ operation. You started SEZ operation. By the way, when you started by 31st March 2020, the unit must be operated between assessment year 2006-7 and 2021. Assessment year means what? Due date is 31st March 2020. Sometimes no. You might have got approval by March 2020 only, but you started operations before March 21, enough, you are also eligible. If you start operations by 31st March 2020 or approval you got before 2020 but started operations by March 2021, then you are eligible for 10AA benefit. If you are eligible for 10AA benefit, what you can do? From first year to fifth year of 5 financial years, 5 previous years, you can claim 100% of the export profit as deduction. How to calculate export profit? Just now I told. Year 6 onwards to year 10, 50% of the export profit flat deduction from gross total income. Then 11th to 15th year, 50% of export profit flat deduction, subject to how much amount you transfer to special economic zone. So amount invested there or 50% of profit, whichever is lower only, you can claim deduction. The amount invested in special economic zone, you must spend it for, the amount invested in special economic zone reinvestment reserve, you must use it for investing in plant and machinery within 3 years from the date of transfer. If you fail to invest, whatever amount left in that account is fully retaxable again, yes or no, to the extent deduction claimed. Next, and remember, deduction shall not exceed, by the way, you must transfer, right? You must transfer to special economic zone. That's it, correct? That's it. Now one more condition. You know, export turnover numerator, you are applying numerator formula, right? You apply numerator, right? Denominator, my total turnover 10 crore. You know, export turnover is 5 crore actually. Turnover to export is 5. But you know, I received in India, I collected foreign currency only 3 crore. I collected foreign currency only how much, you know? 3 crore. By due date for filing IT return. By due date for filing IT return. You see, receipt of export turnover within 6 months, actually they say not due date, actually within 6 months. Generally that is 6 months is nothing but due date for filing IT return. That's how it will come. Yes or no? But anyhow, 6 months only interpret. The proceeds from export must be received in foreign exchange within 6 months. Sometimes RBI might give a further extension. If extension is given, then extended period. Whatever export, suppose no 24-25 year, my SEZ sold 10 crore worth of goods. In that 5 crore is exports only. But you know, I collected within 30th September of the assessment year. Within 30th September of the assessment year, 3 crore only I collected. How much I collected? 3 crore. Then numerator 3 crore only we should apply. For remaining 2 crore worth of exports, you don't get any benefit because you didn't collect in foreign currency. You couldn't collect in convertible foreign currency. Able to understand? Okay, that's it. That's it. Then we have, you know, export turnover should not include freight charges, telecommunication, insurance expenses related to delivery of goods outside India, foreign exchange expenses for services rendered in case of computer software. So these charges will not be. The above expenses shall be excluded from both the turnover as well as total turnover when calculating, as they relate to delivery outside India. Freight charges in India, no, up to shipping port, they may be considered. Whatever the amount you are recovering from the seller for freight charges, no, the freight charges is 2 types: up to delivering to the ship location, from ship to foreigner, that particular location, that ship abroad freight charges only, not included in turnover. Remember, first of all, that is not a turnover. But why are we considering it as turnover? Because we are reimbursing from seller, sorry, buyer. We are getting it from importer. That's it. Major provision is over. Easy or not? All of you? And by the way, 10A deduction you will get only when you are filing income tax under optional tax regime. If at all you are filing under 115 BAC, you will not get a 10AA benefit, and deduction is only towards export profit, that too generated from SEZ, which started operation on or before 31st March 2020. That's it. 10AA over. Easy or not? All of you? Next, now I will go back to ATC. Now I will go back to ATC. You know, what are all chapter 6A deductions we have? ATC it will start with, and it will go up to 80U. All chapter 6A deductions, you can claim deduction under optional tax regime. But under default tax regime, no deduction. ATC to 80U not allowed under default tax regime. However, 80CCD subsection 2, contribution, employer contribution to national pension scheme, central government pension scheme. Getting it? Atal pension yojana allowed. 80CCH2, central government contribution to Agnipath scheme. 80JJA, 30% of additional employee cost incurred by SSE who is liable for tax audit. These 3 sections alone you can claim under chapter 6A as well. Remaining all other deductions you can't claim. Remember, there are 3 more sections set. One more rule is there. 80QQB, RRB, JJA. These 3 sections are together referred when you need to file return of income within due date. For that purpose, these 3 sections are referred. These 3 sections are referred when under default tax regime you can claim only these 3. Remaining you can't claim. That's it. Remaining all other points, nothing is there. Remember, under 80IC there is a section of return of income must be on or before due date for all these sections. In that orange letter, whatever highlighted, no, that is only there for in our syllabus. Remaining all chapter 6A deductions you can claim whether you file return within due date or after due date, but to provide it, remember, only under optional tax regime. Under default tax regime you can't claim deduction under chapter 6A. You can claim only 80CCD subsection 2, 80CCH subsection 2, 80RRB. 80JJAA. That's it. Yes or no? So 80JJAA, CCD2, CCH2. Only these 3 sections you can claim deduction under default tax regime. Clear all of you? Now 80C. Here you will get deduction for investments. You will get deduction for investments. Not maximum deduction under this section is 1,50,000. And remember, all sections, no deduction under default tax regime. Remember this point always. Now what deductions? You just have to read only highlighted points. I've highlighted with a light gray background. You see light gray background. Only those gray background one only. You just have to read it. Able to understand? Now maximum deduction is what? Suppose, sir, I paid LIC premium, sir. Life insurance policy I took. For whom? No, myself, spouse, children, sir. Children dependent, major, minor, nothing. Getting it? Only 3. Myself, my spouse, children. To them I paid life insurance policy related premium. Can I claim deduction? Yes. How much I can claim? Depending upon the policy issue date. Depending upon the policy issue date, 20%, 10%. In case of disabled person, 15% of the policy issue date is on or after 2023. For others, 10%. The amount is maximum. This is the maximum percentage of sum issued. Actual amount paid, how much you see? Maximum percentage applicable you see, whichever is lower. That much amount you can claim deduction under 80C. Now here one condition is there. The policy must be retained for 2 years. If the policy is terminated within 2 years, surrendered within 2 years, whatever deduction you claimed earlier will be re-taxable as income. Understood? Next, you can claim deduction for statutory provident fund. You can claim deduction for recognized provident fund. You can claim deduction even for PPF, public provident fund. Whatever deduction, whether you paid on your name, spouse name, children name, in case of HF, member's name, maximum 1,50,000 is allowed as deduction. I made a contribution under Sukanya Samriddhi scheme in the name of my girl child. Getting it? Whatever amount I have contributed, fully I can claim it as deduction. And same way from Sukanya Samriddhi scheme, and in future I can withdraw money. Whatever I withdraw, fully exempted. Clear or not? I invested in National Savings Certificate. Fully deduction. You can claim deduction under 80C. I paid tuition fee in India for full-time education to Indian. In India, I paid tuition fee for my children. Getting it? Only children. If I pay tuition fee for myself and my spouse, no deduction. For children tuition fee, if I pay 80C deduction. Yes or no? Then, suppose relating to house property, principal repayment. What is it? Principal repayment of loan on house property you will get. Remember, interest repayment you will get deduction under 24. That too only if it is optional tax regime in case of self-occupied, unoccupied property. In case of let out property, default tax, optional tax, in both the cases you will get. Yes or no? Principal repayment 80C you will get only under optional tax regime. Default tax regime you can't claim. Yes or no? Yes. Principal repayment, provided you are repaying to these people. You cannot borrow loan from unorganized sector, friends, relatives. That loan is not covered here. Stamp duty cost you can claim, whatever you pay at the time of purchase. Registration fee, other transfer expenses you incurred at the time of purchase, like brokerage commission, you can claim. What you cannot claim? Membership fee you can't claim. Expenses incurred for repairs and renovation you can't claim. Interest expenditure you can't claim. Now for house property you are claiming deduction for principal, stamp duty cost, all that, right? Condition: 5 years you should not sell that house. If at all you sold the house subsequently within 5 years from the end of the year in which you claimed ATC deduction, whatever deduction you claimed in the past 5 years will be retaxable in the 6th year. Sorry, retaxable in the year in which you sold. Sorry, 6th year if you sell, no problem. Within 5 years if you sell, whatever deductions you claimed in 2 years, 3 years, 4 years, 5 years will be retaxable. Clear? Next, investment in 5-year term deposit with a bank. Investment in 5-year post office in a scheme with the central government. 5-year term deposit you invested, bank or post office, doesn't matter, fully you can claim deduction. You are paying contribution to national pension system. You are paying contribution to national pension. Immediately when the student see contribution to NPS, no, he will think of ATCCD. Remember, first see which tier number they said. Tier number 2 they said, then ATC. Tier number 1 they spoke, then ATCCD section will apply. ATC will not apply. ATC, contribution to national pension scheme, second time. This deduction can be claimed only if it is a government employee, and deduction is applicable only if the contribution is to ATCCD tier 2 account, NPS tier 2 account. Tier 1 account contribution is covered under ATCCD. That's it. Are you clear, all of you? ATC is over. Then we have another section called ATCCC. What is ATCCC says? Contribution to pension fund of LIC. Whatever contribution you are making to pension fund of LIC up to 1,50,000 you can claim it as deduction. Now there is another section called ATCCD. What that section says, you know, contribution to national pension scheme or contribution to Atal Pension Yojana. Contribution to national pension scheme, contribution to Atal Pension Yojana. Getting it? This contribution, this contribution, this section we will cover and then we'll wind up now. Then again we'll continue in the next session. Getting it? ATCCD, contribution to national pension scheme. You see, in this ATCCD, deduction is given in 2 parts. Deduction for employer contribution, which is under ATCCD, where you will get under optional tax regime as well as default tax regime, both. Then you will get deduction for SSC contribution, my personal contribution. I will claim deduction only under optional tax regime. Now what is the maximum deduction? Here there is an amendment. This default tax regime is there, right? This is amendment for the first time applicable for May 25 exams. For the first time applicable for May 25 exams. Deduction up to how much? 14% of salary. Deduction up to how much? 14%. By the way, employer contribution, sir. Your employer, in your name, he paid to pension yojana, national pension. Yes, sir, he paid, sir. How much he paid? First tax under income from salary. Then whatever amount he paid, right? Under ATCCD subsection 2, claim deduction. How much you will claim? How much ever amount he paid? No, how much ever amount he paid, full tax it. Up to 14% of salary you can claim deduction in case your employer is a government. Sir, my employer is private, sir. Then 10% of salary I can claim deduction for his contribution. For his contribution, which is treated as income in my salaries, whatever amount he contributed, now I can claim deduction up to 10% of salary under ATCCD subsection 2. Sir, I'm going for default tax regime. Then 14% of salary deduction. This is an amendment. Then 14% of salary. Understood or not? Everybody. Sir, okay. Not only my company, sir. I also paid out of my pocket. What about that? You paid. You are an employee in the company, right? You paid, right? Whatever amount you paid, in the problem they will give you percentage and all. Never believe that percentage. How much they paid? 20%, 10%, 15%, something they'll give. First convert that into money. Suppose the amount paid came 1,80,000. First identify the money in the problem. First identify number. How much amount convert? They may say 10% of salary, 15% of basic salary, 25% of basic plus DS. Something they will tell. Calculate, identify what they told. Apply the percentage of what they contributed. Get amount first. Get amount first. 1B, allocate 50,000. Under subsection 1B, allocate 50,000. Do in the same way problem. Allocate under 1B how much? 50. Sir, 50,000 allocated, sir. Balancing figure how much is there? 1,30,000 is there. Allocate it here. This 1,30,000 is restricted to 10% of salary. If it is an employee contribution, as an employee I contributed to national pension scheme, how much amount contributed first, figure out, calculate the amount first. You see, identify the total amount first. Then allocate under 1B 50. Balancing figure allocate for subsection 1. Why you know? Subsection 1 is covered under 80 CCE overall limit. There is a section called 80 CCE. What this section says, you know, 80 CCE, deduction under 80C, 80 CCC, 80 CCD subsection 1 only. Yes or no? You know, all these three put together, maximum deduction is again restricted to 1,50,000. Now, in this 80 CCE purview, 80 CCD subsection 2 not covered, 1B is not covered. That's why if at all you are contributing any amount, first allocate to 50 because it is not covered in overall limit. Suppose if I allocate entire 1.8 here, no, already 80C 1.5 lakh utilized already. You know, if I allocate 1,80,000 here itself, under 1B if I do not allocate, I will lose 50,000 benefit. Yes or no? Sir, I'm a self-employed. My company and all contribution, nothing is there. My own contribution only is there. That time higher deduction up to 20% of gross total income. So first allocate 1B 50. You still have extra amount you contributed. That amount you can claim deduction under subsection 1. But maximum deduction cannot exceed 20% of gross total income. Very simple. Employer contribution. First add it in income from salary. How much ever amount, how much ever. That's it. 80 CCD subsection 2. Government employer. 14% of salary deduction. Private sector employer. Optional tax regime. 10% of salary. Default tax regime. 14% of salary. Yes or no? 80C employee contribution. First allocate under 1B 50,000. Balancing figure allocate under 1 but restricted to 10% of salary. I am a self-employed person. 1B allocate 50,000. Balance amount restricted to 20% of gross total income. Sir, what is salary? Basic plus DA terms of employment. Remember, commission and all is not there. Commission and all is not there as a percentage. Only basic plus DA. Are you clear? Now, you are contributing to national pension system, right? Sometimes you can withdraw later. Sometimes you can withdraw. Suppose no, you are withdrawing by closing the scheme. You are withdrawing by closing or opting out. You are just closing. You are permanently closing the scheme and you are withdrawing. 60% of the amount is exempted flat. Only 40% is taxable. Sir, I am not closing, sir. I am only withdrawing part of the amount. Oh, part of the amount you withdraw. Na? Amount withdrawn how much? Minus exemption how much? Till date you contributed how much identify? Employee contribution, SSC contribution how much you identify? Only your contribution till date in the past 5 years through 2 years whatever multiplied by 25%. That much is exempted in case of partial withdrawal. Are you clear? So that is withdrawal. You know, suppose no, if at all amount is withdrawn because of the death of the original account holder, then nothing is taxable. Or suppose I withdrawn amount, sir, I invested for purchasing another annuity, sir, then also nothing is taxable. Clear? That's it. 80 CCD over 80 CCE. 80 CCE section says the maximum deduction under 80C, triple C, CCD subsection 1 shall not exceed 1,50,000. Yes or no? Then under 1B and subsection 2, you can claim additional deduction that is not subject to 80 CCE overall limit. That's it. Clear all of you? That's it. We'll continue the next session remaining topics. Okay. So we completed in the previous session up to 80 CCD, right? Now 80 CCH. 80 CCH is regarding what? Contribution to Agniveer Corpus Fund under Agnipath scheme. Who will contribute? Central government will contribute and the person who enrolled in that scheme, Agniveer, he will contribute. The relationship is employer and employee. Central government contribution is treated as salary in the hands of the Agniveer first, in the income from salary. Whatever amount central government contributed, first we will tax it, correct? In the hands of the employee under income from salary. And whatever contribution is there, that can be claimed as deduction under 80 CCH, correct? First the contribution of central government will be included in salary. Then deduction will be allowed for the same under 80CCH subsection 2. Remember, this subsection 2 is eligible for both the regimes, whether you are going for optional tax regime or default tax regime. Then coming to 80CCH1, Agniveer personal contribution. That will be directly allowed as deduction under 80CCH subsection 1, but you will not get this deduction under default tax regime. Personal contribution, no deduction under default tax regime. Once again, I am repeating, 80C to 80U, no deductions under default tax regime. Only these three, 80CCD subsection 2, CCH subsection 2, AJAA, only these three sections you will get deductions under chapter 6A or even 10AA for that matter. Getting it? In this entire chapter, what are all the sections we are discussing? Only these three you will get deduction under default tax regime. That's it. Correct? Similarly, from Agnipath, this Agniveer corpus fund, tomorrow, once he withdraw, he can withdraw the money, right? Any payment from the corpus fund to the Agniveer, to the person enrolled under the scheme, whatever the amount he is withdrawing, fully exempted. That's it. Then coming to 80D, deduction in respect of medical premium. Deduction in respect of medical premium. You see, this deduction will be given in two categories. The deduction will be given in two categories. 80D, the deduction is in two categories. By the way, 80D is for what purpose? Mediclaim or medical premium or contribution to central government health scheme. Either buying a medical insurance policy from a approved insurer or central government health scheme. Under 80D, you will get deduction for what category? You will get a deduction for medical premium paid. For whom? There are two categories. SSC, the contribution, the medical payment, medical premium amount paid, you will get deduction under two categories. First category, SSC himself, spouse and dependent children. Dependent children, they can be major or minor, doesn't matter. Children definition means major or minor, anybody. Yes or no? Only if they say minor, then minor children we will use the word. 64(1)A, clubbing provisions, they specifically use the word minor children. Getting it? Then second category 2 is for what? I can also pay medical premium for my parents. How much is the maximum reduction? Simple, 25,000 for category 1, 25,000 for category 2 also. Many students misinterpret. For parents 25,000. No, it's not for parents 25,000. If the category persons, any of them is a senior citizen, then 50,000 limit is applicable. Many think that category 2 parents, it is 50,000. No, it's never wrong. Suppose if any of this person, SSC or spouse, between them, any one person, if at all, is a senior citizen, then 50,000 limit applicable for category 1. Obviously, if the SSC is a senior citizen, parents are obviously senior citizen, 50,000. Now, in this section, there is a thumb rule. What is the thumb rule? Maximum deduction. How much will be the maximum deduction in this section? Maximum answer. I gave you a thumb rule. Maximum deduction. In exam, this is like a checkpoint. Maximum, how much you will get? You see the problem. SSC age, spouse age, how much you see? Both are not senior citizens. Then 25 limit applicable. Parents, mother and father, both the age. Parents means more specifically for whom we have taken insurance policy. Their age you should see. Sometimes you might be taking insurance policy only on the father, but not on the mother. Or you may be not taking on father, but on the mother. Mother age is 59, father age is 62. But you took policy on whom? Mother only. Now, mother is not a senior citizen. Yes or no? The automatically, what is the limit applicable? 25,000. Are you getting it? If medical policy is taken on the any person whose age is 60 or above, between parents, suppose you took both of them, any one of them having senior citizen, then automatically 50 limit applicable. Are you getting it? Okay. By the way, one more category, one more point. If any of them are senior citizen, that's enough actually. Right now I told one logic, right? If mother only is senior citizen, yeah, we need not apply. If any of them are senior citizen, because they can claim medical expenditure also. They can claim medical expenditure deduction. Suppose if any of the parent, one of the parent does not have a policy, 50 limit is applicable automatically. Yeah. So thumb rule as usual, what we discussed in a regular class, the same rule will apply. SSC spouse, are they both normal citizens? Yes. Then 25 limit. Parents, any of them senior citizen, any one of them? Yes. Then automatically 50 limit will apply. Suppose SSC normal citizen, spouse SSC, parents, any one of them are senior, then 50. So maximum deduction will be 75. SSC is also senior, parents are also senior, then automatically maximum deduction under this section will be 1 lakh. This is the maximum deduction under this section, 80D limit. This is the maximum deduction under 80D. Now, suppose if, the policy, insurance policy is taken by HUF. For HUF, maximum reduction is 25. If any member of the HUF is senior citizen, one person also, then automatically the limit is extended to 50. Now, further, remember, this is the provision, correct? Huh? This is the provision. Now, for what you will get deduction here? You will get deduction, whether 25, 25, 50, all that is for medical insurance premium. It must be paid in other than cash. 1. You can also claim deduction for preventive health checkup expenses. Preventive health checkup expenses, which can be incurred in cash or other than cash. Any way you can incur. Preventive health checkup alone, you can incur in any way. How much you can spend? Under category 2, maximum deduction 5,000. Under category 1, maximum deduction 5,000. Again, towards preventive health checkup, whether you claim under category 1 or category 2, put together, maximum deduction will be 5,000. Again, I told, right? Section limit 25, 25. 25, 50, 50, 50. This 5,000 is within that only. Here first medical expenditure for each category, myself, my family, how much I spent. Maximum 5,000 I can claim deduction. For my parents, maximum I can claim 5,000 deduction. Again, both of us put together, towards preventive health checkup, maximum we can claim 5,000. Is this a separate limit, extra limit beyond the 25, 25, 25, 50, 50, 50? No, it is within the same limit. Category limit is same. Within this category limit only, you can claim this 5,000 deduction. Are you getting it? We have even solved problems in our class. Test your knowledge questions everywhere. Yes or no? In ICA book itself, we have illustrations TYK. That is best, more than enough. Next. Then third expenditure. You will get deduction for medical expenditure, not medical premium. Remember, medical expenditure on senior citizen. Either it might be SSE or it might be parents. Anybody it can be. But this is a medical expenditure you are incurring. Why you will incur medical expenditure? You will have insurance policy. No. Here, the person for whom medical expenditure is spent, no, he doesn't have a insurance policy. Medical insurance policy is not there. That's why we are spending out of pocket medical expenditure. Can that also be claimed as a deduction? Yes. Maximum how much you can claim? 50,000. This must be spent in other than cash. Remember, you need a proof. If you spend in cash, there is no proof. So, other than cash only, you must spend medical expenditure. That can also be claimed as deduction up to how much? 50,000. Remember, this expenditure is eligible only if it is spent for a senior citizen who do not have a medical insurance policy. Further, this expenditure limit is within category 1 and category 2, within the category limit only. What is the category limit? Normal citizen 25, category 1. Seniors, parents, normal citizen 25,000. SSC, normal citizen, parent senior 50. SSC senior, parent senior 50, 50. That's it, over. 80D section is over technically. Sometimes you might be. So that is what here we have given. Medical insurance premium paid other than cash. Medical insurance other than cash. Here you see category 1, self-spouse. Here parents. Parents may be dependent or independent, doesn't matter. But children must be dependent. So what is it? Normal citizen, senior citizen. Preventive health checkup also can be claimed as a deduction up to 5,000 for both the categories put together. Yes or no? But again, this will be within overall limit. Shall be within the overall limit. Medical expenditure on a senior citizen who do not have a medical policy other than cash shall be within the overall limit. Maximum how much? 50,000. That's it, over. Easy or not? HUFs also. Medical premium 25. If any member is a senior citizen, 50. Medical expenditure for senior citizen, 50,000. Preventive health checkup expenses for HUF, the section is silent on it. That's it. Clear? Next. So sometimes we might be paying medical insurance premium one time for 5 years validity or maybe 4 years validity. In such a case, you can't claim deduction for the entire premium in single year. You have to claim proportionately. Very simple. For example, I paid in 24-25 medical premium. In which month you pay doesn't matter. 24-25, the payment date comes under 24-25. How much I paid? 1 lakh premium I paid. And this policy is valid up to for 5 years. This policy is valid for 5 years. Very simple. 24-25 divided by, just identify 5 years, right? For example, I took a policy on, 1st March 2025 I took. this policy. 5 years means 28th February 2030. Correct? 6, 7, 8, 9, 10. Yeah, correct. 2030. Now, how many years are involved here? Identify. 24, 25 is involved. 29, 30 is also involved. 24, 25, 24, 25, 26, 27, 28, 29. 6 years are involved. Be careful. See, my policy validity is what? 5 years only. But how many previous years are involved? 6 years. Remember. Able to understand? Now, what is the deduction? 1 divided by number of previous years. The year in which lump sum payment is paid plus the subsequent years during which policy remains in force. Years means what for us in income tax? Financial year, April to March. So, actually you took policy on 1st March 2025 and the policy is applicable up to 28th February 2030. 5 years only validity. But how many financial years are involved in this? I see 6 financial years involved. So 1 divided by 6 you will claim deduction. Are you getting the point? Policy is 5 years only, but I will claim deduction for 6 years. But by the way, total deduction is always same. Suppose I spent 1,20,000 policy premium. By 6 is equal to every month 20. How much I am claiming in 6 years? Put together 120 only. So denominator 6 or 5 is not a big deal, because at the end of the day maximum deduction cannot exceed amount paid. Denominator, many students confuse. Getting it? Many students confuse in the denominator. The denominator is not 1 divided by 5 years policy, then 5 they will put. That's wrong. You should put how many years involved. So that's why you should see date on which it started, date on which it expired. Starting date, it comes under which year? End date comes under which year? In between, how many years are involved? Financial years. That's how you should calculate. Able to understand. All of you. That's it. So with that, 80D is completed. Confident everybody? Then coming to 80, 80U, 80DD, 80DDB. These are the deductions with respect to disability and diseases. You know, there is a section called 80DDB. Here, no, that section is eligible only for residents. The SSC must be resident individual or resident HUF. That's a deduction can be claimed for, you know, expenditure on treatment of specified disease or ailment. Expenditure on treatment of specified disease or ailment. You must spend money. How much you spent, that much only you can claim deduction. Now, on whom you should spend? On the SSC himself or their dependent. Dependent means what? In the next page I have given you, see. Dependent means what? Meaning of dependent. The same definition is applicable for 80DD, 80DD also. Dependent. Dependent means what? Spouse, children, parents, brother, sister, who is dependent on the SSC. All of them should be dependent on me. All of them should be dependent. Only then I can claim deduction for their disease treatment. If they are not dependent on me, I cannot claim deduction. Now, deduction here is for what? Medical expenditure on dependence treatment, who is suffering from some specified disease or ailment. 80DDB section gives deduction. How much you will get? Normal citizen. Suppose no, the person for whom you are incurring this disease expenditure is a normal, then maximum 40. You see, I have clearly used the word max word, whereas in 80D, I used the word flat. Getting it? 80DD, expenditure is irrelevant. You will get a flat deduction. Whereas here, you will have to lower off actual or 40. A senior citizen, then lower of actual or actually here it is 1 lakh, printing mistake. Okay, here it is 1 lakh. So maximum how much it is? 1 lakh. That's it. Now, suppose this is regarding what? Treatment expenditure incurred for specified disease or ailment of individual plus dependent. Everybody put together 80 DDB only. However, suppose if the individual is suffering from disability, SSC himself is suffering from disability, he can claim 80U deduction. Individual himself is suffering from disability. Now, for disability, no, doctor has to give a certificate. In that certificate, disability percentage will be given. If the disability is 80% or more, no, you will get a flat 1,25,000 deduction. Flat 1,25,000 deduction. No questions asked. Flat 1,25,000 deduction. How much you are spending? Have you taken insurance policy? You know, how are you? That and all irrelevant. Flat 1,25,000. Suppose disability percentage is less than 80, then it's called as a normal disability. Then how much reduction? 75. Sir, I am not suffering. My dependent is suffering. then can I claim deduction? I am only maintaining him. I am only incurring all the expenses and all. My dependent is dependent on me. Yes or no? Then what about this? Then 80DD you can claim deduction. Normal disability of the dependent 75. Severe disability flat 125. This is per dependent, all dependents put together. This is section limit. This is a section limit. You can suppose there are 4 dependents on me. All 4 of them are suffering from disability. I cannot claim 4 multiplied by 75, 4 multiplied by 1. No, you can't claim. This is a section limit. Are you clear? Sometimes, we will take insurance policy. Individual will take a insurance policy for dependent's safety. If something happened to me, he must survive. For that reason, I will take insurance policy. But unfortunately, he died earlier. Dependent died earlier. I received the maturity amount. That is fully taxable under income from other sources. If the individual received maturity amount from the insurance policy taken for the purpose of benefit of dependent, where the dependent is predeceased the individual, he died before, he predeceased the individual, then the amount received by the individual is fully taxable under income from other sources. Are you clear? So deemed income, if the dependent with disability predeceases the SSE who took the policy and the amount received is treated as income, yes or no? However, if the dependent with disability, he is receiving annuity or lump sum before their death, getting it, and discontinued, that deemed income, if the dependent himself is receiving the maturity amount, that is, this income taxation will not apply, deemed taxation will not apply. And further, you have 80DD, 80U, right? Suppose I am claiming, suppose my brother is having disability, he is dependent on me. Since he is a dependent on me, I am claiming in my income tax return 80DD deduction showing my brother name. Getting it? Because he is suffering from disability, I claim a deduction. Now my brother is also filing IT return. He is again claiming 80U because he is having disability, right? No. If at all I am claiming 80DD in his name, he cannot claim again 80U. In other words, if at all he is claiming 80U on his name, I cannot claim 80DD on his name. For the same person, 2 different persons cannot claim deduction. That's it. 80DD, 80DDB, 80U, all the 3 sections over. Easy or not? Yes or no? Next, 80DDB, one condition is there. In 80DDB, you see conditions under 80DD, conditions under 80DDB. 80DDB is for what? Treatment for medical expenditure. There one condition is there. Suppose I spend medical treatment expenditure 1 lakh, but actually 80,000, insurance company reimbursed me. How much I actually spent? 20 only you will get deduction, because lower of actual amount to spend, lower of actual amount to spend or maximum amount, correct? Actual amount to spend means what? Out of your pocket, how much you incurred, that's it. You may pay 1 lakh, but medical insurance company reimbursed 80,000 to you. So how much you spent actually? 20. That's it. That's what the point says. Over. Clear? Then 80D series over, 80C series is over. Now 80E series. 80E series is completely for interest. Deduction for interest. 80E, interest on education loan. 80EE, interest on house property loan. 80EEA, again house property loan. 80EEB, vehicle loan, electric vehicle related interest. Yes or no? Now, education loan, higher education. It must be for higher education. Where? It may be in India or outside India. What you can claim? Interest expenditure on education loan you can claim. How many years you can claim? 8 years you can claim. Loan should be taken from whom? Either a financial institution or approved charitable trust you can take. Higher education means what? After 12th standard, whatever you study, 13th standard onwards, that is straight away treated as what? Higher education. For whom I can claim deduction? Individual is pursuing higher education, he can claim. Relative is pursuing higher education. Relative means what? Spouse, children, or the student for whom I am taking a responsibility, guardian. Yes or no? For them or for myself, if I took education loan, interest amount paid, I can claim it as deduction. How much you can claim? No limit on that. Over. 80E. Simple or not? Then we have deduction for interest for new home buyers. I used the word very clearly. New home buyers. Under 80EE, 80EEA, 2 sections are there. Getting it? 80EE is dealing with the old financial year, 16-17. Suppose you got a loan which is sanctioned during 16-17. Loan was sanctioned in 16-17 financial year, 1st April 2016 to 31st March 2017. In that year the loan was sanctioned, and value of the house shall not exceed 50 and loan sanctioned amount shall not exceed 35, and at the time when the house is purchased, no, you don't have any other. On the date on which you are getting the loan sanctioned, right, you don't have another house, you don't have any house, which means this loan is sanctioned for the house which you are going to buy for the first time. That's why I named it as what? New home buyers. For them only they will get deduction. What they will get deduction? They will get up to maximum deduction. How much? 50,000 per financial year until loan is repaid. For what? 50,000, okay, deduction. For what? Interest amount. You will get deduction towards interest on loan taken. You will get a deduction for interest on loan taken. Very simple. Okay, 16, 17 year. Interest on housing loan taken. See, interest on loan taken, no. Here one point is no deduction is allowed for the same under 24B. Then only you will get deduction. If you claim interest deduction under 24 house property, you can't claim here. So simple. Suppose I am SOP, UOP. NAV is equal to 0. Yes or no? Maximum deduction under house property, how much I can claim under optional tax regime? 2 lakhs. Yes or no? Suppose I spend 2.5 lakh loan. 2.5 lakh interest is a half. Up to 2 lakhs I will claim there only, because I can set off with other heads of income also. Yes or no? Remaining extra interest, if at all per annum I incurred, that extra interest I can claim under 80E. 80EE. Conditions: 16, 17 loan must be sanctioned. Loan amount should not be more than 35. Value of the property should not be 50 lakhs. Remember, value of the property means not STV, simple value. Whereas in 80EEA, stamp duty value they specifically gave. Able to understand, all of you. Sir, suppose SSC is choosing a let out property, sir. SSC is going for a let out property. Now entire interest amount you can claim under house property itself happily. But remember, if it is a let out property, entire interest, even though you are claiming, if at all there is a loss, you can only set off with other heads only up to 2 lakh. Suppose if at all you are having higher loss because of interest amount, then claim interest amount up to the loss that can be set off. Extra interest claim here, 80E better. Yes or no? That's it. Sir, SS is following a default tax regime, sir. For SOP, UOP where NAV is equal to 0, you can't claim deduction at all there. 80E also you don't get any deduction because default tax regime. Suppose, sir, SS is an optional tax regime. Let out default tax regime, default tax regime, let out property. Entire interest amount claim under house property head only. Because you can carry forward the loss at least. Yes or no? Because 80E is not there for default tax regime. That's it. Similar logics will apply for 80EA. In 80EA, that is also for deduction towards interest. But later, initially this section was open only for 1 year. But later, instead of extending this section, government brought a new section. What? Loan must be sanctioned in the 3 years period. 1st April 2019 to 31st March 2022. Now we have another interest 80EEB. There it is 2023. Here it is 4 years. Here it is 3 years. Here it is 1 year. Loan sanctioned date must be in which date? In 80EE 1617. In 80EEA 2019 to 2022. 80EEB electric purpose 2019 to 2023. Able to understand? Now, stamp duty value shall not exceed 45 lakhs under 80EA, and you should not have any house as on the date of sanctioning the loan. Means this is also for the first time buyers. So once again the section is reintroduced in 2019 year. Getting it? This time maximum deduction for interest is how much? 1,50,000. Whatever logic I told, SOP, UOP, DLOP, everything is exactly here same. Just that here it is 50,000, here it is 1,50,000. So you should apply beneficial treatment, which we already covered in our regular class with some illustrations and all. Clear, all of you? That's it. By the way, who is eligible? 80EE individual. 80A also individual. Suppose you are already claiming 80E, means you already have one house. So you can't claim again 80EA. Able to understand. That's it. Next. Here DLOP, all that points have given clearly. Okay. Next. Electric loan. Electric vehicle loan. Any individual who have taken a loan for purchasing electric vehicle, deduction is available for interest payable. Now, how much deduction? 1,50,000 towards interest. When the loan must be sanctioned between 2019 to 2023, interest claimed is allowed as should not be allowed under other heads. Suppose I bought electric vehicle for my business purpose. It is added block of asset. If I am paying interest on that loan, I will claim under 36. That time I will not get deduction under 80 EEB. So indirectly, which assessee is, if an electric car is purchased for not for business purpose, then only 80 EEB is indirectly eligible. That too under optional tax regime. Suppose if the assessee is going for default tax regime, you can't claim 80 EEB. That's it. Yes or no? Next. Then we have 80G, donations. One of the most confusing section for many. So we made a simplest table, simplest way to calculate how to calculate answer under 80G. 90% of the cases students do wrong in 80G. Very simple. In 80G, donations, no, this is actually nothing but deduction towards donations. Deduction towards donations. What donations? Whatever donations you pay, no, these donations are divided into 4 categories. These donations are divided into 4 categories. Category 4 is having 5 kinds of donations. Category 3 is having 2 donations. Category 2 is having 1 donation. Now, how you should claim deduction? Simple. First, in the problem, no, they'll give you donations list. Donation paid to charitable trust, donation paid to government, donation paid to Olympic Association, donation paid to Prime Minister, National Relief Fund, some donations names and they'll give. You should remember which donation comes under which category. How to remember that, I'll cover it. Okay, now very simple. Suppose you saw the problem. You found some 10 or 15 donation list. First group it. How many of them comes under category 1? For example, under category 1, 5 lakhs worth came. Under category 1, 5 lakhs worth of amount donations came. Some 3-4 donations were there. Total put together 5 lakhs. By the way, donation exceeding 2000 rupees can be considered only if it is paid by other than cash. Suppose if at all donation amount to somebody is more than 2000 in cash, we will not consider. We will not consider. Then again, there are some 3 more donations where total donation value is 2 lakhs only. And all the donation comes under what? Category 2. Then I have paid another donation. I have paid some other donations. 3 or 4 more donations were there. Total put together 2 lakhs only, and they come under category 3. Then balance number of donations are there. Out of 15-20 donations, I removed 1, 2, 3 category. Now balance is put together approximately 2,50,000 is there. First, this is what given in the problem only. I am just dividing them into 4 categories. Okay, fine. Now what should I do? Calculate donation, calculate deduction. How much deduction? 5 lakhs. First category, 100% of amount paid. I paid amount 5 lakhs. So answer is 5 lakhs. Second category, 50% of amount paid. 2 lakhs I paid. So answer is 1 lakh. Third category, fourth category. You cannot straight away calculate 100% of amount paid. We didn't use that word. We said 100% of qualifying amount. Here we said 50% of qualifying amount. Qualifying amount means what? Amount paid or 10% of adjusted total income, whichever is lower. Which means category 3, maximum amount that covers under 3. Here in our example, 4,50,000 is the total. Category 3 and 4 put together, how much is there? 4,50,000. How much is qualified? How much is eligible? Amount paid is not eligible. Amount paid or 10% of adjusted total income, whichever is lower, only that much is eligible. For example, adjusted total income we calculated. What is adjusted total income? Very simple. Calculate gross total income minus chapter 6. First, capital gains and all you reduce. Special capital gains, special 111A, 112, 112A. Lottery's point is not considered here. Getting it? Lottery need not be reduced. Then deductions under chapter 6 except 80G, because some students know when they're reducing 80G, when they're reducing chapter 6, they reduce category 1, category 2 here. Never do that. 80G itself, don't touch it. But remaining all the deductions are there, right? 80C, 80CCC, all that, reduce it. Now you will get this one. Suppose this value is 30 lakh only. Adjusted total income, how much? 30. Into 10% means what? 3 lakh. Category 4, category 5 put together, amount paid is 4.5, 10% of adjusted total income 3 lakhs, whichever is lower. Only qualifying amount is how much? 3 lakh only. Category 3 and 4 put together, how much department will consider? 3 lakhs only they will consider. But you paid how much? 450. So how I will allocate? Category 3, full I will allocate. Because 3 lakhs I can consider. Category 3 is only 2 lakhs, right? 2 lakhs I will consider. Remaining out of 3 lakhs, 2 lakhs is allocated for category 3. Still I have 1 lakh only. 2,50,000 I paid, but I will consider how much? I will consider how much? Here 2 lakhs I will consider, correct? Here I will consider 1 lakh. Okay, now maximum qualifying amount is 3 lakhs. The qualifying amount we allocated for category 3, category 2 based on amount paid. Here amount paid 2 lakhs. We are eligible for 3 lakhs qualifying amount. So 2 lakhs fully allocated. Category 4 amount paid 250. But we are only having 1 lakh limit. Therefore 1 lakh is allocated. Now very simple. Apply percentage logic. 100% of qualifying amount. 2 lakhs into 100%. 2 lakhs is the deduction. 50% of qualifying amount. 1 lakh into 50. 50%. 50,000. So what is the total answer? 5 lakh plus 1 lakh, 6 plus 2, 8 lakh, 50,000. This is the answer. Now here one point you should remember. At the beginning of chapter 6A, I missed this point. Total deductions under chapter 6A plus 10AA cannot exceed your normal incomes. Total deductions under chapter 6A plus exemption deduction under 10AA both put together cannot exceed your gross total income, which consists of normal incomes. If my gross total income, normal income portion is only 5 lakh, my total chapter 6A deduction 10 lakh, 10A deduction 3 lakh, total 13 lakh is there, but my normal income 5 lakhs, I cannot claim more than 5 lakh. That's it. Able to understand. Next, remember donations in kind. Sometimes in exam they'll give you donation given kind, market value they'll give you, ignore. Yes or no? Deduction is not allowed if at all donation is paid in cash exceeding 2,000. Now in exam they'll give you list of donations. We should identify what will come under category 1, what will come under category 2, what will come under category 3, what will come under category 4. If at all you have a doubt, once again repeat the video. Getting it? Fine. So what all comes under category 2? Simple. Prime Minister Drought Relief Fund, National Relief Fund, CARES Fund, they all come under category 1. Prime Minister Drought Relief Fund comes under category 2. Category 2 means what? Directly 50% deduction, amount paid into 50. Category 3, you will get donation 100% but subject to qualifying amount. What amounts? Donation paid to government for family planning purpose, for promoting family planning. I pay to government for family planning. Suppose no, I pay to government only for some charitable purpose other than family planning. Other than family planning comes under category 4. By the way, to whom I am paying? Donation paying to government and local authority. Here also donation paid to government and local authority. If it is family planning, category 3. If it is somebody else, if it is something else purpose, category 4. That's it. Then, sir, donation paid by a company to sports association, sports association institutions for sports related donation comes under category 3, and that amount is eligible only if it is paid by company. Only for company SSC they can claim. Yes or no? Then what are all items comes under category 4? These items. Suppose I am donating directly for charitable trust, category 4. I am paying for housing, accommodation, town planning, that authorities, town planning, urban planning, all that authorities, category 4. I am paying for promoting minorities interest, category 4. I am paying for renovation, repairs of temples, mosque, gurudwara, church, archaeological place, artistic importance, yes or no, place of worships. So if I am paying any donation to them, category 4. So what are category 4? Charitable trust, government for charitable purpose other than family planning, then housing development, city development, town development for them, then for promoting minorities interest, then for renovation, reconstruction, or all that repairs of mosque, temple, gurudwara, all religious places, archaeological places, all that, category 4. Category 3, what are all? Sports related by company, yes or no? Then government for family planning, then Prime Minister Drought Relief Fund. All these comes under 2, 3, 4 category. You can easily, you remember 2, 3, 4. Then remaining all other donations comes under category 1. So in category 1, what to be remembered, highlighted with only red color, only this you remember. That's it. State government fund for medical relief, for army fund, CM relief fund, governor's relief fund, national sports fund, national culture fund. Remember, national sports fund is different. Contribution to any authority set up for promotion of sports, that is different. That is category 3, which is subject to qualifying limit. Swachh Bharat Kosh, Clean Ganga fund, PM CARES fund, all these comes under category 1. That's it. 80G over. Easy or not? All of you clear? Then 80GG. What is 80GG? This is okay. 80GG, I'll come back to it later. Let me cover donations only. Okay. 80G is dealing with donations, right? 80GGA is also dealing with donations. But here, donations are for scientific research, social research, rural development. Able to understand? Or you are donating to public sector companies for eligible projects. For eligible project. or you're contributing to Rural Development Fund, National Urban Poverty Eradication Fund. Sometimes some students know National Urban Poverty Eradication Fund. The moment they see, they think category 1 of ATG. They blindly think category 1 of ATG. But at the end of the day, your answer will be same only. Because ATGGA, contribution to national urban, 100% reduction. Category 1, even if you interpret ATG, no, you will get 100% reduction. So generally, whether you write the section number ATG or ATGGA for these points, no, the answer will be correct only. But if at all you think, will it come under category 1 or will it come under, ATGGA, if at all you are unable to decide, don't write section, you claim deduction happily. 2, 3, 4, you remember. Any other donation automatically comes under category 1. Suppose you saw National Urban Poverty Eradication, Rural Development Fund, you saw. Suppose you are unable to recollect 80GG, 80G category 1, you are unable to remember. Don't mention section, you claim deduction, you get the same answer. Are you getting the point? Yes. However, social research, scientific research, obviously 80GGA. By the way, this entire 80GGA deduction is eligible only for the SSE who do not have PGBP income. Suppose if the SSE has a PGBP income, all these deductions can be claimed by him under 35 itself. Here also, amount exceeding 2000, no, if at all paid in cash, you don't get deduction. 48 modes you are paying. Electronic fund transfer, account pay check, account pay draft, you will get. Bearer check, crossed check, cash, you will not get a deduction. Over. Easy or not? All of you? Easy? Then, donations to political party electoral trust. Donation paid by Indian companies. Donation paid by Indian companies. You can claim deduction under 80GGB. How? You should pay donation completely other than cash. Even 1 rupee you paid in cash, you will not get deduction for that. Donation includes one more point here, very important point. Suppose a company is there. They are spending some advertisement expenditure in a political party, brochure, newspaper like that. Under 37 PGBP section 2B, it is disallowed. And the same amount is treated as donation to them, and under 80GGB the company can claim it as deduction, because donation definition to political party under Companies Act includes advertisement expenditure also. So that's why under income tax 80GGA you can claim deduction for actual donation paid plus advertisement expenditure incurred in political party. Both are treated as donations paid by the company to political party. Remember, only Indian companies allowed, foreign companies not allowed, government companies prohibited for giving donation. Then sir, what about 80GGC? Here many interpret it as other than company. No, wrong. It's not other than company. MCQ very important. Only four categories are covered: individual, HUF, AOP, BOI. Yes or no? Okay. You see here, firms are not covered. Getting it? 80GGC is not available for AJP and local authorities. Actually, firms also you can claim. Firms also you can claim. Not an issue. Just 1 minute, I will see that word. Whether firm is exclusively covered or not, I will see, because in 80GGC specifically the section limit is given. Just a minute. Yes, this is Act. Yeah, except local authority and artificial judicial person only. So firm is covered. Getting it? So though I have not given the list, firm is covered. That's why I say 80GGC is not available for AJP and local authority. Getting it? Don't write the word other than company. Sometimes in MCQ they'll give you 80GGC deduction is available for whom? Companies, Indian companies. B, government companies. C, local authority and AJP. C, any person other than local authority and AJP. Yes or no? Any person other than D. Any other than company they'll give you. Many students will write other than company if at all the word is there. So other than AJP and local authority. Firm is also eligible. Simple. Other than AJP and local authority. So the interpretation is correct only. Able to understand. Next. Deduction is for what? If at all you are donating to a registered political party or registered electoral trust. That's it. Clear or not? Easy or not? Then 80GG, rent paid. Deduction for rent paid. Suppose if the SSE is incurring rental expenditure. If the SSE is incurring rental expenditure. Why is he incurring? He is staying in some other city. He is staying in a city where he does not have a own house. He does not have a own house there. He, his family member, his spouse, none of them are having a own house. So he is staying in a city for the purpose of business, for the purpose of employment, or some reason he is staying in some other city. There he is staying in a rented house. So there rent paid is allowed as deduction. How much? rent paid minus 10% of adjusted total income. Adjusted total income means what? Same definition which is given under 80G. Gross total income minus chapter 6 deductions. My other than 80GG minus capital gains 111A, 112A, 112, reduce it. You will get adjusted in the 10%. Up to 10% rent paid expenditure, rent paid up to 10%, you will not get any deduction. Beyond 10%, if at all you are paying rent, no, that extra rent amount will be given as deduction. Or 25% of adjusted total income, maximum deduction 5,000 per month. Are you clear? Then suppose no, if the SSC is receiving HRA, he can't claim deduction. Remember here they are saying, they are talking receiving HRA. Claiming exemption or not doesn't matter. Yes or no? Next, no deduction if the SSC or spouse or children or HUF having a own house in the same city. Yes or no? And SSC if at all claiming SOP, DLOP, not UOP. UOP I am not covering. Why? Because UOP means what? I am staying in different city. My house, I have a own house in another city, but it was not occupied. Yes or no? Then only it is called as UOP. Suppose if at all you are claiming optional tax regime, NAV is equal to 0 towards UOP reason, still you can claim 80GG deduction. Suppose you are claiming SOP or you are showing DLOP because of SOP nature. Yes or no? When you say SOP, you are staying in your own house, right? Why are you paying rent? You will not get deduction. Able to understand? 80GG over. Clear? Confident? Everybody? Then 80JJA, I'll come back to it. First 80 okay, QQB RRB also I'll come back to it. 80 TTA TTB. 80 TTA TTB is for what? Deduction towards interest. Deduction towards interest income. 80 TTA deals with the savings interest. Yes or no? Suppose no, SSC is getting savings interest from bank, post office. Whatever interest first you get, no, tax it under income from other sources. However, when you are getting post office savings interest, 10 subsection 15 up to 3,500 rupees exempt. Suppose no, I am getting savings, bank interest 7,000, say post office savings interest 7,500 I am getting. Under other sources, how much is taxable? 14,500. Sorry, 14,000 is only taxable. Income from other sources, how much is taxable? 14. How, sir? Bank interest fully taxable. Post office 7,500 I am getting, no, 3,500 is exempted. 3,500 is exempted. 4. Oh, 11,000. How much is taxable totally? 11,000 is taxable under income from other sources. So now IFOS 11,000. Okay. My gross total income is also 11,000 only. I don't have any other income. You can claim again 80 TTA deduction up to 10,000. Already 11,000 is taxed. So up to 10 only. Suppose no, in other sources, no, savings interest taxed amount is 8,000 only. Then 80 TTA also 8,000. So the deduction cannot exceed tax amount or 10,000, whichever is lower. Yes or no? Next. Now here savings deposit, individual and HUF. You can be a resident and non-resident, doesn't matter. Yes or no? Income shall be first included in IFOS. Able to understand? Then what is 80 TTB? This is introduced later on for senior citizen purpose. The two resident senior citizen. Suppose if the resident senior citizen is getting interest income, fixed deposit interest, savings interest doesn't matter. The moment you see senior citizen, you should remember 80 TTB also. And the moment you see senior citizen, resident, interest income is there. Automatically 80 TTB adjustment you must do in the exam. In exam they will not tell you 80 TTA TTB clue. They will say interest income clue. That interest income means what? You should claim 80 TTA, 80 TTB under optional tax regime. Default tax regime, no deduction at all. Yes or no? Now, first senior citizen, whatever interest is getting, no, first tax it, IFOS. Savings interest, up to, savings interest, whatever income you get, first tax it. Post office savings interest, 3,500 you give exemption, balance amount tax it in IFOS. Fixed deposit interest, fully tax it. Gross total income minus, you can claim deduction under 80 TTB up to 50,000 rupees or interest income taxed under other sources, whichever is lower. That's it. Easy or not? All of you. That's why I have given post office interest, all that is also correct. Next. So next 80 QQB, RRB, JJAA. These three are income based deductions. No, sorry. These three are heading C deductions. 80 QQB heading C plus income based. 80 TTA TTB is not heading C but income based. 80 JJAA is heading C but expense based. Able to understand? So three sections we have heading C related. In chapter 6 deductions, no, heading C is there. 80 JJAA, QQB, RRB. Now many students confuse in QQB calculation part. Very simple. QQB, RRB, both of them is for what? You are getting royalty income. First taxed under PGBP. You are getting royalty income. First taxed under PGBP. For example, no. For example, Suppose 80 QQB is dealing with royalty on books other than textbooks. 80 RRB is dealing with royalty on patents. Okay, now what 80 QQB says, suppose you are getting a royalty income. You are getting every year lump sum money, irrespective of sales, no link with the sales. You get a lump sum fixed amount. You published one book, one publishing house, they told you they will give you fixed amount. You will get only fixed amount 5 lakhs yearly. So I got 5 lakhs. PGBP income is how much? 5 lakhs. How much is the PGBP income? 5 lakhs. Getting it? I don't have any expenditure, nothing. Now, under 80 QQB, I can claim deduction for this lump sum royalty. How much I can claim? Actual amount how much? 5 lakhs. Maximum deduction? 3 lakhs. Whichever is lower. That's it. So, 80 QQB answer is how much? 3 lakh. Are you getting it? Sometimes, you will get royalty income as a percentage of books. As a percentage of books sold. For example, the company, they are giving me as a percentage of books. They are giving me as a percentage of books. How much they paid me? 2,80,000 rupees they paid me. How much they paid me? 2,80,000. The same problem, I think similar number only there in the problem also. Okay, 2,80,000 they are paying me. At what percentage? 18%. At what percentage? How much they are paying? 18. As a percentage of sale, 18%, they are paying me 2,80,000. Okay, fine. Do tax under PGBP. PGBP, how much it is? 2,80,000. And you know what? I spent 40,000 rupees expenses already for getting that income. So how much is my net income included under PGBP? 2,40,000. Now, for this proportionate royalty which you get as a percentage, you will get a deduction. How much you will get deduction under 80 QQB? Up to 15% of sales only. 15% royalty only you will get deduction. Okay. 2,80,000, 2,80,000 is equal for 18. How much is for 15? 2 lakh. 2,80,000 is for 80. 18, 18. A calculator, do it, no? 2 lakh. Okay. 2,35,000 for the sake I will keep. Okay. 2,35,000 I will keep. For example, for the sake of convenience, 2,35,000 is equal to 15% royalty. 18% is equal to 2,80,000. For convenience sake, 15% royalty is 2,35,000. Yes or no? Up to 15% royalty only you will get deduction. How much you will get deduction? 2,35,000. But you know what? This amount is you are getting from abroad. For example, see, suppose if this amount is you are getting in India, no problem. 2,35,000. How much deduction you can claim? Already 40,000 rupees is you claimed, no expenditure related deduction towards royalty. Already you claimed 40,000 deduction. That 40,000 eliminated. Balance 1,95,000 is the maximum deduction. Further, suppose sir, I am getting this 2,35,000 from abroad, sir. Okay, from abroad. The royalty for me is paid by a foreign company, foreign entity, they are paying me. Then there is one condition. Within 6 months from the 31st March, end of the financial year, from the end of the relevant year, within 6 months, how much you received in India? That much only is considered. See, 15% only maximum. But you know what? I received in India 2,10,000 only. Within 6 months from the end of the financial year, I received only 2,10,000. Then 2,10,000 minus 40,000. Then 2,10,000 minus 40,000. 1,70,000 only I can claim deduction. If at all you are getting royalty percentage income from abroad, how much deduction eligible is linked with how much is collected in India in foreign currency, convertible foreign currency. Within 6 months from the end of the financial year, how much is brought in India, only that much is eligible for deduction. Able to understand. First, always calculate 15%. This is the maximum deduction. Then again, maximum deduction is restricted to how much is brought in India. Again, from that eligible deduction amount, already deduction you claimed in PGBP, reduce it. See, if you do not claim any PGBP, you will get full deduction. Since you are claiming already towards royalty expenditure, some amount you are claiming already. So, deduction cannot be extra. So, deduction here will be adjusted, whatever deduction. That's why here matter is also given. You see, royalty. So, deduction other than lump sum royalty. Suppose I am getting deduction is equal to royalty income before expenditure, calculate first. Not exceeding 15% of the value. So, before expenditure, how much is the royalty income up to 15% calculate. If any expenditure is claimed under PGBP, the same shall be reduced from deduction eligible under 80 QQB. From 80 QQB deduction, reduce that. 80 QQB deduction, how much? Income earned outside India, if at all, must be brought into India within 6 months. Yes, and only that much is income eligible. So, first deduction. Deduction means what? 15%. Then reduce it to Reduce that money to how much is brought in India. That much deduction you can claim. But again, if PGBP deduction is claimed, that you should adjust it. Balance amount only you can claim it as deduction. Look at that once again problem, you will understand. That's it. Clear all of you? Sir, I am getting royalty for patents. There is no proportionate patent income. Only lump sum. Maximum deduction is lower of amount received or 3 lakhs. That's it. Over. 80 QQB, RRB, both are over. Able to understand. Next. That next 80 JJAA. 80 JJAA. What is this 80 JJAA is about? 80 JJAA is talking about employee cost, additional employee cost. What deduction you will get? You will get 30% of additional employee cost. Very simple. Sir, in my business I recruited employees, sir. I am paying salaries to them. I can claim deduction under PGBP for salary. 37 deduction I can anyhow claim. In addition to that, to promote employment opportunities, to encourage more and more employers, generators, so no, 80 JJAA section is brought. What this section is saying, you claim PGBP happily, no problem. How much you claim with no salary cost? In that salary cost, 30% you can claim additionally under 80 JJAA for 3 years. For how many years you can claim? 3 years. 3 years, if at all you are incurring additional employee cost, 3 years, if you are incurring additional employee cost, you can claim. Every year you can claim. By the way, for additional employee you can claim 3 years. Second year, suppose I started my business year 1, this year. I recruited employees. Whatever salary paid to them, this year how much I paid into 30%. Next year how much I paid to them into 30%. Third year how much I paid to them into 30%. Next year again I hired some more people. 2, 3, 4. Third year I hired again some more people. 3, 4, 5. Like that will go. Now, deduction is calculated at 30% of additional employee cost. Additional employee cost means what? Employee cost incurred in that year. Employee cost incurred in that year towards additional employees. Towards additional employees, how much employment cost I incurred? Who is an additional employee? Who is an additional employee? This is the question. Additional employee means what? In case of new business, no, amount paid to new employees during the year. I started business this year only. Everybody I recruited is a additional employee. All of them, whatever salary I paid, that is called as what? Additional employee cost. Sir, I am an existing business already. Last year, 31st March, I have 150 employees in my. Last year I have 150 employees. This year, no, 50 employees left. 70 employees joined. 50 employees left. 70 employees joined. Now, totally 170 it became this year. Only 20 will be considered as additional employees. Only 20 will be considered as additional employees because already you have 150. Now you have only 170 as a whole. Don't say 70 people I hired, sir. 70 you hired. 50 you did replacement. That is not new employee you hired, it's a replacement. So extra how many you hired? 20. Only that 20 is eligible for additional employee definition. Only that 20 will come under additional employee. In case of existing business, additional employee cost will be 0 if no increase in total employees or amount is paid in cash. If at all you are paying salary in cash, no, you will not get 80 JJAA deduction. You will get 80 JJAA deduction only if you pay other than cash, even 1 rupee also. Able to understand? Fine. Now, again, who is an additional employee? Simple. An employee employed during the year. This year we recruited him. Yes or no? And due to which there is a total increase in number of employees compared to last day of the previous year. Sir, this year I hired 70 employees. But out of 70, only 20 employees are additionally recruited. 50 employees, no, they left 50 recruited, replacement only. Able to understand? Again, the following people are not counted in additional employee number. Now I have 20, no, extra. 20 out of 20 I can't count again. From this 20, I should eliminate people. Employee whose emoluments are more than 25,000. Whose emoluments? Emolument means what? Monetary salary plus non-monetary perquisites all put together. Emoluments. But excluding provident fund contribution, pension fund contribution, gratuity, leave encashment, that and all you should not consider. Yes or no? Provident fund. For his future related anything you pay, that is not considered. Present how much you are paying for him. Present what benefit he is getting. Monetary, non-monetary, allowances, perquisites, everything you consider. Total emoluments. If at all it is more than 25, he is not considered under additional employee. Suppose, no, out of this 20, no, 4 employees, no, they are drawing 30,000 per month. Eliminate it. Okay. Then employee for whom entire contribution is paid by government under pension plan. Government is taking care of his welfare, future welfare. You know all that. For example, Prime Minister Rozgar Yojana, for example, it is not there in the ICA book, I'm just giving you. Okay, the under that scheme I recruited employees. Under PM Rozgar Yojana I recruited these employees. Getting it? They will not be considered in additional employee definition. Like that I have 5 employees during the year. Like that I have 5 employees during the year. Sir, there are some employees who are not participating in RPF. There are 5 employees who are not participating. 2 employees who are not participating. Sir, I recruited employees, sir. They were employed for less than 240 days in this year. In this year, they were employed for less than 240. Employed means what? They worked. It's not working days. On which date they joined? They were there up to 31st March also. From the date of joining to 31st March, what is the gap? Less than 240 days. Don't count them like that. Like that, for example, 2 employees were there. So 9 plus 14, 13. 20 minus 13 is equal to only 7 employees are treated as additional employees in this year. To them, how much salary you paid this year? Multiplied by 30% you can claim deduction. Multiplied by 30% you can claim this year deduction. To these 7 employees, next year also you will pay salary for, right? 7 into salary paid into 12 months into 30%. Third year also you pay some salary amount, right? 30% of the salary paid in the third years. For these 7 employees you will get deduction. Further, now 2 employees I reduced here. 2 employees I reduced, saying that they were employed for less than 240 in this year. Next year they will be considered as 2. Next year means year 2, these 2 employees will be considered. For them you can claim deduction for year 2, 3, 4. In second year, how much you paid salary into 30%. Third year, how much you paid salary into 30%. Fourth year, how much you paid salary into 30%. Very simple. An employee who is employed for less than 240, he is also additional employee. But for this year, he can't claim. You can't claim any deduction for them. From second, third, fourth year onwards, you can claim deduction towards them. Are you clear? Employee employed for less than 240 days is not an additional employee. Now, the 240 days logic is treated as 150 in case of footwear, leather and apparel industry. Getting it? For footwear, apparel and other industry, it is not 240 days logic, 150 days only. If at all they are employed for less than 150, then only we will exclude them from the additional employee limit. But remember, these employees will be counted in the next year onwards. Yes or no? Employees satisfying 240, 150 condition in the succeeding year will qualify for deduction from that year for 3 years. Easy or not? Yes or no? Now here audit report is compulsory 1 month prior to the due date. By 30th September audit report is compulsory. This business should not be formed up by reconstruction or splitting up of existing. It must be a newly started business. The business should not be acquired from another. Simple. It must be a newly started business. Okay, you started the business, you didn't acquire from somebody, then you are eligible for 80 JJAA deduction. Clear or not? How much you can claim? 80 JJAA, 30% of additional employee cost. Additional employee cost means what? Salary paid during this year to the employees. Which employees? Those employees who are newly hired. All newly hired? No. Newly hired, because of them, total number of employees compared to last year of the last day should increase. Only that increased recently recruited employees, you should take them into account. Salary paid this year, how much? Into 30%. Next year, salary paid to them into 30%. Third year, salary paid to them into 30%. Now, additional employee does not include employee drawing more than 25,000, employee not participating RPF, employee whose pension plan is taken care by government, employee who is employed for less than 240 days, less than 150 days. But this fourth category, temporary exclusion in this year, but they will again be considered in the next year. Able to understand? All of you? That's it. Entire chapter 6A deductions and 10A deduction both are over. Confident? We completed within 1 hour 20 minutes. Chapter 6A. 1 hour 20 minutes or 1 hour 10 minutes or 1 hour 15 minutes. See the quality. Yes or no? Each and every point we covered. In fact, in a regular class, we discussed much more in depth with so many illustrations. Correct? That's it. Confident now? Able to recollect everything? That's it. Let's begin total income chapter, where we are only having one provision to discuss. In ICA book, no. If you open this chapter, no. Total income chapter, no, there is so much of unnecessary discussion and all is there. Once again, they'll talk about all the provisions, default tax, all that. Not required. What is the most relevant provision in the total income chapter? That I am covering here. Rest of the points which are there in total income chapter in ICA book, no, they are all covered in other chapters for us. That content unnecessary confusing you. No, don't go for it. AMT provision, total income and AMT, alternate minimum tax. What is alternate minimum tax? Suppose, no, by the way, The sections are 115 JEE and JC. Both are dealing with only same concept. Okay, one section is talking about applicability, another section is talking about procedure. That's it. One is talking about applicability, one is talking about the procedure. JC talks about the procedure. Okay, JEE is talking mainly about the applicability. Now, what these sections are saying? Suppose any person other than company, because for companies, AMT, MAT, there is another provision, 115 JB is there. For company, there is another section called 115 JB, which is not there for in our syllabus, CA Intro. It is there only in CA Final. What this section says? Any person who is claiming deduction under, look at this carefully, if this provision, introduction, if you do not understand, that's it, gone. Any person who is claiming deduction under chapter 6A heading C, not all chapter 6A, remember, heading C chapter 6A. What are heading C chapter 6A? Heading C chapter 6A, in our syllabus we have only 3 sections, AT, JJ, AA, QQB, RRB. Employee, additional employee cost deduction, those who are claiming deduction towards royalty income, those who are claiming chapter 6A, AT, JJ, AA, QQB, RRB, or other heading C deductions which we don't have in our syllabus. Yes or no? So SSCs who are claiming chapter 6A deductions other than ATP also we don't have in our syllabus, so don't worry. So in our syllabus we have only what? These 3 sections. So if the SSC is claiming deduction under these 3 sections of chapter 6A, or SSC claiming deduction under 10AA, or SSC is claiming deduction under 35AD, income based deductions, nothing but. If the SSC is claiming deductions for incomes, not all, again, interest on savings deposit, that is not covered again here, by the way. Okay, SSC claiming deduction, these are all deductions given based on some business specialty. If the SSC is claiming deduction under 10AA, or if the SSC is claiming deduction for specified business capital expenditure under PGBP under 35AD, or if the SSC is claiming additional employee cost 30% deduction, QQB, RRB, royalty related deduction, then AMT provisions will apply. AMT provisions will apply. What is AMT provision? Purpose of AMT, I will tell you. Simple logic. Suppose I started a 5-star hotel. I made a profits and gains from business or profession 10 crore before 35 AD deduction. Before 35 AD, that capital expenditure before I claim, my revenue income minus revenue expense is equal to 10 crore profit I have. But hotel construction cost 200 crore, I claim a deduction now, building cost. Resultantly, my income reduced to negative 190. And what the section says, we have a section called 73A, you can carry forward for infinite number of years. So because of this, what is happening? SSCs are not at all paying tax. Same way, suppose I am incorporating a company in a special economic zone, enterprise in a special economic zone, any entity, and I'm exporting, only export I have. Entirely I'm receiving in foreign currency within 6 months, 10 AA. Remember, we have already seen. My full profit is exempted. I literally pay 0 tax. Because these sections, they are bringing your income to 0 or negative, and where you are not paying any tax at all. But department want to collect minimum some tax. But they gave deduction, they can't collect it, because you have a negative income here. As per your section logic, it is a negative income. But what department is doing, they bought a section called 115 JEE and JC. What they are saying is, let me compute AMT for you. Let me compute alternate minimum tax for you. What the section says, so your income is what? 10 crore. Add back the deduction. How much deduction you claim? 200. Sorry. You are having loss of 190. You are having loss of 190 crore. Do one thing. Add back 200 crore deduction. Yes or no? Now how much is your income? Crore. Correct? Before adding the deduction, how much is your income? 10 crore. 35 AD deduction, 10 AA deduction, QQB, RRB, JJAA deduction. If at all you claimed, you first see, always first calculate as per normal. Whatever rules applicable, calculate total income. Add back these 3 deductions. Now see how much is the income. Department is asking, pay 18.5% tax on. Pay 18.5% tax on this. How much? 1.85 crore. Pay through challan plus cess and all, add and pay. Pay minimum tax. This is the minimum tax you pay. Arey sir, you told me I am having 3580 deduction. All these days I'm thinking, all these days we are thinking my income is negative. I don't have any tax liability. Now you are saying you will add back and then collecting tax again. Then what is the purpose of the section? Don't worry. The department is saying you are paying this 1.85 crore now in cash right to me. Tax payment is over, right? This amount I will give you as AMT credit. I will give you this amount as what? AMT credit. This amount I will give you as, remember the section is actually little more different is there. First I am telling you basic how the section works. I am first telling you how basic section works. AMT credit I will give you first. I will give you. What will I do with this, sir? Next year you will calculate normal provisions based income tax, right? Suppose next year, no, your revenue income minus revenue profit is equal to 20 crore is there. That time you don't have 3580 deduction. How many times you will invest? First year only you will invest in business. Second year also you constructed another building. No sir, second year and all I don't have. Okay, that in the second year, no, business, no, I don't have 3580 deduction. 10 year not there, nothing is there. On normal income, 30% tax is equal to how much? 6 crore. Are you getting it? On 6 crore, this amount you set off. This amount you set off. Indirectly, what are they saying? In the year in which you claim a deduction, I will give you deduction. You show your loss, carry forward loss, everything is same. But when you are computing tax liability, no, at that time alone AMT provision will apply. Remember, AMT is not applicable for total income computation. AMT provision we should apply at the time of tax computation. Does AMT computation have any impact on set off, carry forward, gross total income computation? No. It is only a tax computation time you should do working note. That's it. AMT is just a working note at the time of tax computation. Minimum how much I should pay tax. For that reason only AMT you are doing. Are you getting it? So compute tax. AMT you pay. So every year as per AMT, whatever tax comes, that minimum you should pay. Beyond AMT you have a tax in normal regime only. Normally only you have 6 crore tax. Suppose in second year also I claimed 3580 deduction. I claimed 10-year deduction, something is there. But as per AMT, 2 crore only coming in the second year. But as per normal provisions, 6 crore tax is there. That time AMT will not apply. Normal provision will apply. That time what is applicable? AMT will not apply. Normal will apply. Remember, once again. Sir, I claim a deduction under 10AA. I claim a deduction under 35AD. Or I claim a deduction under 80JJAA, QQB, RRP. Okay, you claim a deduction. You claim deduction, compute total income, all that. You compute total income, some amount is there. Compute tax on that, 5 crore is coming, for example. You compute your normal tax liabilities, how much is coming? 5 crore. Very good. Keep it aside. Don't pay this amount directly. Compute AMT now. How do I compute AMT? Your total income is the right. For that, add back 3580, 10AA, 80 series deductions, all that you claimed, right? Add back. Now you get some income, right? This is called as adjusted total income. This is called as what? Adjusted total income. The word adjusted total income is used here, ATG, but the meaning is altogether different. Compute adjusted total income. By the way, this entire working I should do in rough notes only. This is not affecting my income computation, set off and carry forward provision, nothing. My income tax computation is always same. My total income computation and all is this only. This is only for working note purpose, yes or no? Now, total income you take, add back the deductions, you get some amount on this. Straight away apply 18.5% tax. Straight away apply 18.5. Sir, this amount comes 7 crores, sir. This amount comes 7. Oh, as per normal income tax, your tax liability is 5 only. But as per AMT, 7 is there. You must pay alternate minimum tax. This is a minimum tax you must always pay. 7 crore you pay. Anyhow, you are liable to pay 5 crore, no? 7 crore because of AMT you paid, no? Now tell me, SSC problem is here what? Paying 7 crore is a problem, or paying more than 5 crore is a problem? More than 5 crore is a problem. Do one thing. You paid extra in the form of AMT how much? 2 crore. This 2 crore I will give you as AMT credit. you can carry forward in the upcoming years. 15 years. You can carry forward for 15 years. What I will do after carry forward? Set off. Set off with regular income tax liability. Set off with regular income tax liability. Sir, okay, sir. This is year 1, sir. Year 1, no. Year 1, no. AMT credit is there, which is 2 crore. I will carry forward, sir. In year 2, no. I have regular tax, which is 4 crore. And I have AMT, which is 3 crore in year 2. Luckily, I have how much? 3 crore in year 2. Or else, let us assume 3.5 crore. How much I have? 3.5. Now, forget about year 1. Year 2, will I pay AMT or normal tax? Department clever. Hey, if normal tax is 4 crore, no, more than minimum, no, pay 4 crore only. But, sir, I have AMT credit, no. You told me I can set off, no. 4 crore minus 2 crore, balance 2 crore only should I pay? No. Minimum tax, AMT, whatever is there, I want to buy cash only always. To the extent of minimum 3.5 crore, I always want tax only, cash only. Department will not, out of 4, no. 3.5 crore is anyhow AMT you are liable, no. Extra how much you are paying? 50 lakh you are paying extra tax in the second year in normal provision. This 2 crore can be set off with this 50 lakhs. The 2 crore limit can be set up only with 50 lakh only. Whatever minimum 3.5 you are paying, no, that and all you should pay in cash only. Now tell me, balance AMT credit how much now? 1.5 crore is the balance. Again you carry forward 14 years. Again you carry forward for 14 years because year 1. By the way, in year 2, did you pay AMT? In year 2, did you pay AMT? No, you didn't pay. You paid only normal model applicable. AMT not apply. But to the extent of AMT liability, department will collect only in cash. Just because they are collecting in cash to the extent of AMT, does it mean are you paying AMT liability? You're not. You're paying normal tax liability. Why? The logic is what? AMT credit cannot be set off with AMT liability. Simple logic. Input tax credit cannot be used to set off input tax to be paid under reverse charge. Input tax liability you pay under reverse charge, no? Suppose if I have to pay in GST reverse charge, input tax, reverse charge tax, can I use my input tax and pay reverse charge tax? I cannot, because reverse charge is also input tax. Input tax you should pay, you should set off with output tax. You cannot set off with the same. AMT input credit can be set up only with regular income tax. It cannot be set up with AMT liability. Are you getting it? Don't worry, I will summarize. Indirectly, what are they saying? Suppose alternate minimum tax compute. Every year you compute AMT. By the way, you will compute AMT only when in that year, if the SSE claimed 35AD, NAA, JJAA, QQB, RRB. SSE claimed that deduction. Then to the total income, add back them. The adjusted total income you will get. On that 18.5% you compute. Then the tax is called as AMT minus. SSE, if AMT is not there, normal total income is there. As per that normal tax rate, 30% to special incomes, all the tax rate is there, right? You calculate regular tax. If AMT is more than regular tax, if it is positive, then you should pay AMT liability directly to the department, yes or no? And whatever tax amount paid under AMT in excess of regular tax, what is it? In excess of regular tax, that extra amount is called as AMT credit. Very good. AMT credit, what you can do? You can carry forward for 15 years. You can carry forward for 15 years. Against what you can set off? AMT credit you can set off against regular income tax in the next year, exceeding AMT liability in that year. In the second year, third year, like that, no. Calculate regular tax. Calculate AMT in that year also. Beyond AMT, how much extra regular tax you are getting? Something is there positive, then only you can set up with this. Sir, in second year also, my AMT is only higher than regular, sir. Which means in second year also AMT only applicable to me. Then what? No, then that time what you will do? No, AMT minus regular tax amount is there, right? That you will carry forward for another 15 years. Are you getting it? All of you. Simple. What is alternate minimum tax? Adjusted total income you compute. On that adjusted total income, apply 18.5% tax plus cess rate. Yes or no, 4% cess. All that you apply. Then whatever the tax you get is called as AMT. Are you clear? Here no, special incomes, 20% capital gains tax rate to 10% capital gains tax rate to 12.5% capital gains tax rate to 15% triple 1 year before amendment tax rate, that and all ignore. On adjusted total income, straight away tax rate is 18.5. Sir, adjusted total income consists of special income, sir, lottery income. Ignore. When you're calculating AMT, straight away entire income is taxable at 18.5%. Are you getting it? Now, okay, sir, AMT calculated. Now, what should I do? Compare this AMT with the normal tax, regular income tax payable. Is AMT more than regular income tax? Yes, sir. Then that excess amount is called as AMT credit. Getting it? By the way, AMT amount you should pay by challan. You should pay by challan. Now immediately you might get a doubt. Sir, regular tax, optional tax regime, default tax regime, optional tax regime only. You see, SSC, a person who is paying tax under default tax regime under 115 BAC, AMT itself will not apply. Logic is simple. 35 AD he can't claim. 80 JJA, QQB, RRB he can't claim. But remember, 80 JJA he can claim, no? 80 JJA he can claim under optional default, both the cases. But AMT provision will not apply if default tax regime is applicable. Simple logic. Suppose in the problem, no, SS is going for default tax regime. Blindly AMT question itself will not apply. Sir, SS is going optional tax regime. 3580 deduction he is claiming. Or 10A he is claiming. 80 JJA, QQB, RRB he is claiming. Optional tax regimes are not default tax regime. Then AMT logic will apply. Are you getting it? Yes or no? So now look at this. So excess amount is called as AMT credit. Please carry forward it for 15 years. This AMT credit, no, I can set off with regular tax amount which is in excess of AMT in that year. Are you getting it? Every year AMT will be there. For example, to the extent of AMT, always you should. Suppose in that year AMT itself is not there. Entire tax is regular tax. Then entire AMT credit I can set off with a regular tax. Here or not? Over. This is one of the tough provision, you know. One of the toughest provision which many don't understand. Getting it? Simple logic like this. Clear all of you? Now look at this. How should I calculate? So when AMT is applicable, any person who is claiming deduction under these 5 sections, 10 AA, 35 AD, 80 JJAA, 80 QQB, 80 RRB, for them AMT is applicable. Exemption from AMT, non-applicability. When AMT does not apply, the individual is declaring income under default tax regime. If the SSC is declaring income under default tax regime, or there is one more, adjusted total income is not exceeding 20 lakh. Array small SSC, sir. Why for him also? Adjusted total income is not exceeding 20 lakhs. For individual, HUF, AOP, BOI, AJP, if the adjusted total income does not exceed 20 lakh, then AMT will not apply. Are you getting it? Sir, what is adjusted total income? First you calculate a total income, no? Normally you calculate a total income, no? How you calculated? After reducing 35 AD, after reducing 10 AA, after reducing 80 JJAA, QQB, RRB. Add back. Add 35 AD deduction. 35 AD deduction you claim, no? Add back. Deductions under 10 AA is there, no? Add back. Yes or no? And now tell, I'm a deduction claimed under 80 JJAA, RRB also add back. Now actually you are not claiming deduction, right? Add back means what? You didn't claim deduction. Remember, capital expenditure under 35 AD, if at all I am not claiming, I am eligible for depreciation on that, right? Depreciation, additional depreciation, I am eligible on that, right? If at all I am not claiming 35 AD, reduce notional depreciation. What is it actually called as? Notional depreciation for assets, for which 35 AD deduction is claimed as if no deduction is claimed. Because no, in AMT computation purpose, no, you are adding back what? 35 AD deduction you claimed, you are adding back, means you are not claiming, no. That time you will get depreciation, no. That adjustment you do in exam, no. 99% of the students miss this point only. This point they will miss. They will add back 35 AD. They will compute very super fast adjusted total income. They will pay 18.5. Entire answer is wrong. Depreciation they forgot. Depreciation they forgot to reduce. Are you getting the point? So if at all 35AD deduction you claim, remember this logic will not apply for 10AA deduction, 80 JJAA, QQB, RRB. If at all SSE claimed 35AD deduction, add back when you are calculating adjusted total, less you calculate roughly on the same capital expenditure, depreciation will come now, buildings 10%, plant and machinery 15%, computer 40%, like that. Calculate depreciation. Additional depreciation also calculate if it is a manufacturing activity. Reduce that depreciation. Notional depreciation we call. Are we really claiming depreciation here? We are not claiming at all, sir. We are claiming 3580 deduction, sir, as per our tax. As per our regular income tax provision, we are claiming 3580 deduction. I am not claiming depreciation at all. Then why are you claiming? Sir, here also I am not claiming, sir. I am computing adjusted total income for the purpose of computing tax liability. This is a working note. This is a rough note, working note in a tax liability purpose. AMT concept and all come at what stage? Tax liability computation stage only. It will not come at income computation stage. Yes or no? If at all somebody asks you what is SSC total income, normal income only. What is tax liability? Then wait, sir. I have a working note. Okay, normal income I will compute tax. AMT also I should compute. For AMT, I should compute ATI, adjusted total income. For computing adjusted total income, I should add back deduction under 35AD. Then I should reduce notional depreciation under section 32. Then I will get adjusted total income. If this adjusted total income is more than 20 lakh only, you will proceed further. If this adjusted total income is not exceeding 20 lakh, AMT provision itself will not apply. Yes or no? All of you, that's it. AMT is equal to what? Straight away 18.5% of ATI plus surcharge plus health and education cess. For surcharge, no, you will see adjusted total income limit with optional tax regime. Optional tax regime exceeding 1 crore but not exceeding 2 crore, exceeding 50 lakh, exceeding 2 crore, exceeding 5 crore. Yes or no? Optional tax regime, that limit 10%, 15%, 25%, 37% surcharge as the case may be. Then add cess. Are you clear? All of you? Yes or no? Then special incomes, if any, shall be ignored while computing. AMT, when you are computing, special incomes always ignore. Ignore means what? It's not reducing. Don't keep them in mind. Sir, for them separate tax rate. No, ignore. Entire adjusted total income is taxable at what rate? Straight away 18.5%. Correct? Now, what is the tax limit? Sir, I computed AMT, sir. Should I pay it? No. Wait, check. You have a checkpoint here. What checkpoint? If regular income tax payable by a person for a particular previous year as per normal provision is less than AMT, then adjusted total income shall be deemed to be total income of the person. AMT shall be payable through challan. Yes or no? Then if at all you paid AMT under 115 JC, AMT credit, you will get what is AMT credit? Excess of AMT paid over regular income tax under the provision, that is called as AMT credit. What you will do with the credit? You will carry forward for set off up to a maximum period of 15 assessment years succeeding the assessment year in which AMT is computed. Correct? Okay, sir, I will carry forward. What I will do? Such credit can be set off against regular income tax payable. Full regular tax? No. Regular tax in that year which is in excess of exceeding AMT payable in that year. That is an amount equal to AMT in every year must be paid by challan only. In other words, AMT credit cannot be set up with AMT liability in the subsequent years. It is just like an input tax under reverse charge mechanism. Yes or no? Now, sir, tax credit, no, can I even set off? Suppose I have a brought forward tax credit, sir. This year my adjusted total income is less than 20. AMT itself does not apply. Still doesn't matter. This year you have a regular income tax liability? Yes. AMT is not there. It's okay, no problem. Regular income tax is there, right? AMT credit is there. Set off. Yes or no? Tax credit is allowed even if the SSE is not claiming, sir, this year no deductions at all, sir. AMT itself does not applicable, sir. Sir, moreover, I'm going for default tax regime, sir. If at all you are claiming default tax regime, AMT credit will be lost. If at all you are claiming default tax regime, AMT credit will be completely lost. If you are going with optional tax regime, you can set off. Sir, in this year, I don't have any deduction under 10AA, 3580, nothing. AMT provision itself does not apply this year, sir. Still, your regular tax is there. You can set off AMT credit. No problem. Are you clear? Very simple. AMT credit can be carry forwarded and you can apply set off against regular income tax, which is in addition, which is in excess of AMT tax in that year. Sir, in that year AMT tax is 0, sir. Still you can set off. Are you clear? Sir, I am choosing default tax regime, sir, in the second year or third year. AMT credit will lapse. Now, just come back to our beginning page. Just come back to our beginning page. In AMT, here I will tell you, here I will show you. In the default tax regime, you see here, default tax regime. Okay, in the default tax regime, what happens? AMT liability, not at all liable for AMT. If at all SSE chooses default tax regime, correct? Look at the page number 18. AMT credit, not eligible for to claim AMT. You can't claim AMT credit itself. That will lapse. Able to understand? All of you. That's it. Once you choose default tax regime, AMT credit will be lost forever. Why? AMT credit is for whom? Business SSEs. AMT credit is for business. There is one more reason. Sir, who can go for default tax regime? Anybody. But there is one logic. Sir, SSE does not have PGBP income, sir. I am talking about default tax regime now. Sir, SSE does not have PGBP income, sir. Happily he can go every year. He can happily choose every year whether to go with default or optional. Every year he can choose. Whichever is beneficial, he will opt that year. But SSE, who is having PGBP income, he must exercise this option. Whether he will go with default or normal. Normal exercise, AMT provision is applicable. We will see all that. You choose default. You must choose it before filing IT return. Before the due date, you must choose that too. Sir, I choose a default tax regime, sir. Once exercised, all subsequent year default only. For example, sir, I want to withdraw, sir. Last year, I without knowledge, I choose a defaulter. I am losing 35 AD all the benefits, sir, because I choose a default tax regime. I am losing all tax benefits, incentives, sir. I am losing. Okay, you withdraw. You withdraw. You can withdraw from the default tax regime. Which SSE I am talking about? SSE having PGBP income. SSE having PGBP income, he withdraw. So can withdraw option only once and pay tax under normal tax. Yes, sir, I did. Sir, next year again I want to pay under default, sir. No, you cannot opt in. The business SSEs don't choose default tax. Go with optional. You choose in default, pay only in default. You withdraw later. Forever you can't come back. Forever you can't. A business SSE came and choose a default tax regime. Later in the second year he withdrawn. Third year he withdrawn. Once earlier you declared under default tax regime and later now you withdrawn, you can never get back to default tax regime unless your business discontinued. Suppose you don't have a business income at all later on. Now you can again come back to optional default every year. Able to understand? All of you? Now look at this. Suppose I choose a default tax regime. AMT itself will not be there. AMT credit and all I will lost. Sir, I am not at all going for default tax regime, sir. Yes or no? Business SSE, sir. One time I choose, I am forever obliged. Or one time I withdraw, forever I will not have. So this is the risk I have. What should I do? Getting it? Happily go with optional tax regime. Pay alternate minimum tax, which is actually beneficial in reality. Are you clear? Everybody? Yes or no? That's it. So, annual exercise of option of shifting out. Compute income under both the regimes. Choose the regime whichever is beneficial. This option is there for SSE who do not have business income. For business SSEs, this option of choosing every year not applicable. You choose in one time, declare forever. You want to withdraw later, withdraw, no problem, I'll give you, but one time withdrawal only. You withdraw, you can't come back into default tax regime ever. And once you choose a default tax regime, remember all your AMT credit, everything will be lost. Later again, you withdraw on default, you are going back to optional. That credit can I brought forward? You can't do it. Are you clear? That is the punishment given to SSE who is choosing default. So SSE who is having 35 AD benefit, 10 AA benefit, never they should go for default tax regime. That's tax advice I'm giving you. Tomorrow your clients, if at all they ask you, don't tell them to go with this. Are you clear? Now go back. Are you clear with AMT? Yes. Shall we do one problem on this? I will directly do the problem. Okay. Question number 12 in the total income topic. Fantastic provision. Question number 12 in total income chapter. I think this is TYK illustration. I'm not sure. You just see that. Okay. TYK only, I think. The illustrations, I think we don't have directly, all are TYK only in this chapter. Okay. Question number 12. Pause the video. Here they are asking, SSE is an individual. They are asking whether he should pay income tax on the default tax regime or normal tax, which means probably this might be his first year. So he is in dilemma. He is a business SSE. He has a doubt whether to go for default tax or whether to go for optional tax regime. He has a doubt. But remember, when he is going for optional tax regime, 35AD, 10AA, if at all these sections are there, he is liable for AMT also. But if at all he is going with the default tax, he can't claim any deduction. And he should pay tax as per default tax regime rates, and AMT and all does not apply. Correct? Fine. Okay. Now, let me compute. Pause the video. First you solve it. Okay. You solve along with me. Carefully you see. Mr. X, okay, an individual, he set up a unit in special economic zone for the year 1920 for production of washing machines. Okay, special economic zone, he produced washing machine. The unit fulfills all conditions of 10AA. Very good. During the year 23-24, by the way, he started operations in 1920. So, okay, during the year, we are doing problem for 24-25, 1920 first year. Correct? Okay, 2021, 21-22, 22-23, 23-24, we are in the 6th year. He can claim only 50% deduction of the export profit. Remember that. Next, in 23-24, he also set up, say, warehousing facility in the district of Tamil Nadu for storage of agricultural produce. Array, agricultural produce storage, warehouse, 35 AD business. It fulfills all the conditions of section 35 AD. Capital expenditure in respect of warehouse is 75 lakh, including land cost 10 lakh. You can claim 65 lakhs only deduction for building. Correct? You can't claim land cost under 35 AD. Yes, keep it. The warehouse became operational with effect from 1st April 2024 and expenditure 75 lakhs was capitalized. Oh, prior to operations, prior to commencement of business, 75 lakhs incurred. You can still claim deduction provided on opening date of the warehouse, on opening date of the business, the capital expenditure must be capitalized in the books. The condition also satisfied. 3580 deduction he can claim. Yes or no? Next. They have given some details. Profits of the SEZ, how much? 40 lakh. Export turnover received in convertible foreign exchange within 6 months from the end of the financial year. 80 lakhs he received. Export turnover means only 80 you should consider now. Correct? Domestic sales of the above unit 20. Total sale is what? 1 crore. Yes or no? Then this is profit from 3580. Okay, fine. That I will come back to it later. Profit from warehouse before 3580 deduction they gave. That's it. Compute income tax liability including AMT, all that as per regular provisions, as per normal default, which is better? They are asking yes or no. Now can I proceed? Now I will compute PGBP income computation. Correct? First 3580 income I will compute. Warehouse. How much is the income? 1 crore 5 lakhs. Correct? Yes or no? Minus I am eligible for 3580 deduction. No. How much deduction I am eligible for? 65 lakhs I am eligible for. So what is my balance income? 40 lakhs. Yes or no? Array, all of you. Then what is my SEZ profit totally? So where I have a factory, I have a factory, How much is the profit? Oh, profit located in SEZ is totally 40 lakhs. That is fully taxable under PGBP, right? What is the total profit? 40 lakh. Gross total income means what? I know, sir. What about 10A exemption? After GTA, you should do that adjustment. Yes or no? How much is that? 80 lakhs is my gross total minus 10AA deduction. How much is 10AA? Sir, profits of the SEZ 40 lakhs. Exports is 80 lakhs. Total sales is 1 crore. Remember, total sales, they didn't give information. They only told sales domestically 20 lakhs. See, export 80. Total sales means what? Array, yes or no? Yes or no? 1 crore. So how much is the deduction? 32 lakhs. How much is the 10AA deduction? 32 lakhs. What is the balance? Total income how much? 48 lakh. Correct? Oh, wait a minute. Yes. 10AA. First itself I told. How much it? 50%. Very good. How much? 16 lakh only he can claim deduction. Correct? So how much is the tax total income? 80 minus 16. 64 lakh. Correct? Remember, if this question comes in exam, minimum 12 marks. Minimum 12 marks waiting. 64. Okay, I will do one thing. First, I will compute income tax liability. Okay. By the way, SSC is who? SSC is individual, age not given, normal citizen I will assume. Yes or no? Fine. 64 lakhs, right? First I will compute basic tax. 64 lakhs basic tax is what? Very simple. Up to 10 lakh, 1,12,500. Correct? 54 lakh at the rate of 30% is equal to how much? 16 lakh 20,000. Correct? So total basic tax how much? 17 lakh 32,500 plus surcharge. Total income is exceeding 50 lakh. Surcharge is applicable at 10%. Yes or no? 1 crore 73 lakh 250. Correct? Subtotal 19 lakh 5,750. Yes or no? Plus cess at 4%. How much it is? 76,230. Okay. What is the gross tax liability? 81,980. Correct? That's it. Answer not yet over. This is tax liability under normal tax regime before considering AMT. Now I should also compute what? AMT liability, because SSC claim a deduction under 35 AD and he also claim a deduction under 10 AA. Now calculation of AMT. Correct? Until now everybody understood. Yeah. Now before I decide to pay this amount, I will first compute AMT. AMT liability. Fine. First total income as per normal provisions how much? 64 lakhs. Just now we computed. Correct? Hey everybody, add back 10 AA deduction. How much we claimed? 16 lakh we claimed. Add back 35 AD deduction. How much it is? 65 lakhs. But remember, immediately depreciation under section 32. 65 lakhs is building into 10% on 1st April onwards itself. Building is there. Full year is used. More than 180 days. 10% full you can claim. 6 lakh 50,000. What is the adjusted total income? 64 plus 16, 80. 80 plus 65. 1 crore 28 lakh 38. 1 crore 38 lakh 50,000. Now on this straight away 18.5% tax how much? Basic tax is equal to 25 lakh 250 plus surcharge at 15%. Why? Total income is exceeding surcharge at 15%. Yes or no? 1 crore to 2 crore surcharge rate is 15%. Yes or no? How much? 15% how much? 3,84,000. 3,84,000. 338. What is subtotal before cess? 28 lakh 29 lakh 46,000. Okay, plus 4% total. Tell me, gross tax liability. Sorry, I will call it as AMT liability. Yes or no? How much is that? 30 lakh 64,000 451. Amma, AMT is more than. You see, this is normal tax. AMT is 30 lakh. Since AMT is more than normal tax, if I go with optional tax regime, if at all I am going with optional tax regime, minimum tax payable is equal to 30 lakh 64,451. Agreed? Everybody? Now, since if I go with optional tax regime, this much tax minimum I should pay, and I am eligible for AMT credit. AMT credit is what? AMT 451 minus 19 lakh 81, 19 lakh 81, 19 lakh 81, 980. How much is the answer? 10 lakh 80. That's it. This is AMT credit. Correct? Fine. Under normal tax regime, I computed. Now I will go for default tax regime. Now I will go for default tax regime. Okay. How do I compute default tax regime? First, I will see total income as per normal tax regime. How much it is? 64 lakh. Correct? Now, since I am going for default tax regime, 3580 deduction I cannot claim, right? When I am not claiming 3580, happily I can claim depreciation, no, in default tax regime. Remember, I can happily claim 32 depreciation. If at all I am not claiming 3580 deduction, how much it is? 6 lakh 50. Again, I cannot claim 10AA exemption also, right? Array, how much I cannot claim? 16 lakhs. If at all I go for default tax regime, my total income, by mistake, don't write adjusted word here. It's a total income under default tax regime. How much it is? 1 crore 30, 38 lakh 50,000. Correct? Everybody, now compute basic tax on this. We know very well. Up to 15 lakh, 1 lakh 40,000 tax. Correct? Up to 15 lakh liability. Remember, default tax regime means up to 3 lakh 0, 3 to 7, 5%, 7 to 10, 10%, 10 to 12, 15%, 12 to 15, 20%, beyond 15, 30%. Yes or no? Up to 15 lakh, 1 lakh 40,000 rupees only the tax. I think I remember correctly. 1 lakh 40 only will come. Up to 15 lakh, how much is the tax? 1 lakh 40 only, no? 1 lakh 12,000 optional tax regime. That is up to 10 lakhs. This is default tax regime. Correct only. Okay. It's okay. My instinct says correct. Go ahead. Up to 15 lakhs rupees worth of income, no, in default tax regime, the fixed tax liability is 1 lakh 40. Beyond that, how much is there? 1 crore 23 lakh 50,000, which is taxable at 30%. How much? 37 lakh 5,000. Oh, basic tax totally. Appa, 38 lakh is coming. Plus surcharge 15% applicable. Total income crossed 1 crore. Up to 2 crore, 15%, how much? Okay, 44 lakh 21,750. Okay, fine. Plus 4%, add final figure. Default tax regime, tax liability. Yes or no? How much? 98,620. Array, if I go with default tax regime, I'm getting 45 lakhs. If I go with optional tax regime, 30 lakhs I'm getting. Moreover, I'm getting 10 lakhs credit also. I will go with optional tax regime. Easy or not? I hope the numbers are right. I will see the numbers. Which regime it is? Default tax regime. 45, 98, 620. 45, 98, 620. Correct. Okay. Then computation of total income under regular provisions. 18 lakh 1,000. For us, how much we got? They did not add surcharge. Their computation is wrong. Surcharge they didn't add. 10% they are supposed to add. No. By the way, basic tax is right only, no? We computed basic tax right, no? Under regular income tax, you see, 17 lakh 32, 500, right? Yes or no? That's it. They forgot to add. In the book, they forgot to add surcharge. That is where they did wrong answer. Clear? By the way, AMT, how much they got? AMT surcharge they added, luckily. Appa. AMT, how much is? 30 lakh 64, 450. For us also same answer, no? 30 lakh 64, 450. Perfect. Then AMT credit minus this one is equal to the tax. Are you clear? That's it. They did wrong calculation in the book. Surcharge they did not add here. Here they are supposed to add 10% surcharge. Then 4% says this answer would have been different. How much this answer is actually? How much is this answer? We have computed just now. 19 lakh 81 980. Correct? 19 lakh 81 19,81,980. AMT credit how much? This you remove. 19,81,980. AMT credit is what? 10,82,470. Correct? 10,82,470. That's it. Easy. You know, we computed differently from them. First they computed default tax regime. Then they computed tax. Then they arrived optional tax regime separately. Yes or no? In default tax regime, first they did default tax regime. So when they're doing default tax regime, profit from cess they took, profit from warehousing full amount they took, depreciation they reduced, all that. Whereas then they arrived optional tax regime. So how they arrived optional? Oh, they did freshly again. Freshly again they did. So total income is what? 64 lakh. Correct? So first they did default, then they arrived optional, then AMT. First we did what? Normal, then we did AMT, then we found out under normal, then part 2 of the section, part 2 of the question, then default tax regime. Since optional tax regime only, with AMT capital tax liability is lesser than default tax regime. Clear? That's it. So question number 12 is over. Everybody understood. All of you. I'm telling you, no, total income chapter is dead easy. Income tax is easy if you remember all the provisions. Any confusion until now? That's it. Okay. Now next we will see randomly, we will see some problem. Rosie Mary residential status related problem. Assuming both exercised option of shifting out of default tax regime. Both of them are exercising option of shifting out, means optional tax regime they are choosing. Yes or no? You know what are they asking? Rosie and Mary are sisters. Born and brought up at Mumbai. Rosie got married in 1982 and settled at Canada since 1982. Mary got married and settled in Mumbai. Both of them are below 60 years. Now you see, Rosie got married and settled in Canada. Okay, na? She settled in Canada. Rosie, she is a non-resident. Yes or no? Mary was settled in Mumbai. She is a resident and ordinarily resident. They are giving the following incomes. Pension from state government, taxable because it's a Indian income. Pension from Canadian government for Rosie, not taxable because she is a non-resident. Long-term capital gain on sale of land on 15th May. 15th May means before 23rd July, which means tax rate applicable on long-term capital gain is 20%. Yes or no? But anyhow, tax liability and all they are not asking, I think. Oh, tax liability they are asking. Oh my God. Here crux. Here there is a crux. 1 minute. Just 1 minute. Yes. So I will compute income. Okay. Now I will compute income. Correct? So now look at Rosie, non-resident, Mary, resident and ordinarily resident. Yes or no? Pension amount is taxable for Rosie. Sorry, Mary. How much it is? 60,000. Correct? Canadian government pension she is receiving. Okay. For Rosie, nothing is taxable. Then they are receiving what extra? Long-term capital gain. Both of them 1 lakh, 1 lakh. Long-term capital gain. Both of them are having 1 lakh because they are from Indian company. Source is in India. Yes or no? Short-term capital gain on sale of shares on 23rd April. Here also both are before amendment. Indian listed company STT paid 111A short-term capital gain. Yes or no? 111A short-term capital gain. This is before 23rd July. This is also before 23rd July. This is taxable at 20%. This is taxable at before amendment 15%. How much is for Mary? How much is for Rosie? 20,000. Rosie 20,000. Mary 2,50,000. Both are in India. Yes or no? LIC premium paid. That is ATC purpose. Premium paid to Canadian Life Insurance Corporation. Where you pay doesn't matter. You can claim ATC deduction in India. Able to understand? Medical policy. Oh, this is chapter 6. This is chapter 6. Medical policy. Deposit in PPF. Rent. Rent received from house property. Rent received it is. Gross annual value it is. Yes or no? So house property income. How much it is? 60,000 for Rosie minus 30%. Net income is 42. Mary, how much she is receiving? 30,000. Just 30,000 minus 30% is equal to 21,000. Understood or not? Gross total income. Gross total income. 1,62,000. Here it is 1,60,000, 4,10,000, 4,31,000. Correct? Minus chapter 6A deduction. 80C. So Rosie, no. 1 minute. A pension received, right? Yes. Very important observation. Pension received is taxable under salary. Flat 50,000 deduction. By the way, SSC is choosing optional tax receipt. Flat 50% deduction. So which means only 10,000 is taxable. Very good observation. 60K minus 50K is equal to how much? 10K. Remember, when you are computing income from salary, they gave pension received, not computed income. Yes or no? So 50,000 flat deduction, standard deduction. So here it is 3,81,000. Correct? Now 80C deduction you have to compute. 80C what? LIC premium paid. Percentage and all we don't know. We assume that it is within the limit. Yes or no? Then Rosie, medical premium also she paid. PPF, deposit in PPF. PPF is also 20,000. 80C. Medical premium paid. Medical premium paid by account to pay check. So eligible. How much it is? 25,000. 80D. Yes or no? Then Rosie, 40,000 she paid for life insurance premium. That she can claim deduction. Correct? What is the balance total income? 1,22,000. 3,81 minus 55. 3,26. Remember, both of them are normal citizens. Optional tax regime. Yes or no? And long-term capital gain they got right. Long-term capital gain, that is from sale of land, not an issue. Sale of land means no problem. Okay. Now you see tax computation. For her, no, short-term capital gain she has. Yes or no? Anyhow, let us compute basic exemption limit. She is a non-resident, remember. For non-resident, unutilized basic exemption limit concept is not applicable. Yes or no? Fine. So I am computing first Rosie tax liability. What is the total income? 1,22,000. In that, what is the capital gain income? 111A, 1 lakh. Balancing figure is what? 22. Since it is less than basic exemption limit, zero tax on normal income. Sir, unutilized limit is there? No. Can I set off? No. Residents only can set off. Resident individual only can set off unutilized basic exemption. Now this is taxable at 15% flat rate. This is taxable at 15% flat rate. How much is the tax? 15,000. So Rosie, basic tax is what? Just a minute. No. Before amendment 15%, 111A. For her, long term, this one. Okay. She has, got it. Understood. Okay. Which means 3 income she has. This means she is having 3 incomes, correct? 3 income she is having. Okay. You should have told me that information. I thought only one gain is there. Okay, fine. 1,22,000, right? Long-term capital gain how much? 1 lakh. This is before amendment she got, before 23rd July. Short-term capital gain she got. This is taxable at 20%. Sorry. Before amendment 15%. Before amendment 20%. Balancing figure 2,000 only. Correct. Balancing figure 2,000. Because she has 42,000 income from house property. LIC 40,000 is there. Able to understand? So entire 2,000 less than basic exemption 0. Now long-term capital gain she got before 23rd July. We all know long-term capital gain tax rate is 20% if it is before 23rd July. 20,000 basic tax. Short-term capital gain 3,000. Total basic tax is equal to 23,000 plus surcharge will not apply. Education says 23 minus rebate. See, total income is less than 5 lakh. But rebate is not applicable for non-resident. 87A rebate is not applicable for non-resident. 4% is equal to gross tax liability. See how many complications are there? Small problem, but you see the complexity involved. So how much is that? 23,000 plus 4%. 23,000. That's it. This is rosy tax. Mary. Now we'll compute for Mary. Mary total income is how much? Mary total income is how much? 3,26,000. Antena? Correct, no? 3,26,000, right? Is it right? 3,26,000. Now, normal income is how much? Special income. For Mary, no, capital gain long term is there. Short term is not there, no? Short term is also there. Huh? Oh, both are there for both of them. Huh? Okay, 1 minute, just let me check. Oh, short term 2,50,000. Long term 1 lakh. Okay, okay, so big. Okay. I think we did something wrong here. Hey, wait. Remember chapter 6A deduction when you are claiming. This is not eligible. This is not eligible for chapter 6A. Chapter 6A total amount is what? I told you, every checkpoint you should not take it granted. Luckily in this problem, since 350 is there, allocation 381, I could figure out that there is a mistake. But normally you can't figure out. If at all bigger amount is there, you will be doing wrong answer. Always follow the system. Whenever you are claiming chapter 6A, immediately checkpoint. How much of this is normal income? 31,000 only there. How much is there? Total chapter 6A deduction is very good. Now total income is exactly. Now Mary total income is what? 3,50,000, correct? Now remember, she got entirely special incomes only. Long term capital gain before amendment she got how much? 1 lakh, which is taxable at what rate? Short term capital gain 2,50,000, which is taxable at. Now fantastic observation I will tell you here. Now basic balance is 0, but she is eligible for 2,50,000 basic exemption. I can set off this. Because long term capital gain is taxable at 20%, I will first set off long term capital gain. Yes or no? Now balance still I have 1,50,000. That 1,50,000 I will set off here. Still I have balance long term 0, balance short term 1 lakh. Remember, if at all the capital gains are after amendment, 23rd July, if at all the capital gains, then first I will set up 2,50,000 with 2,50,000, which is taxable at 10. This is taxable at 15. Sorry, this is taxable at 12.5%. This is taxable at 20 if it is after amendment. That time I will set up with this. Because I have higher tax here. So I will use exemption for higher tax income. Understood the logic? I was thinking somewhere it should come problem. Luckily it came here. Okay. Then 1 lakh multiplied by 15%. So how much is the basic tax? 15,000. But remember, plus surcharge. How much is surcharge? 0. So 15,000 is subtotal plus cess. No. SSC is a resident. Yes or no? Total income is how much? Not exceeding 5 lakh. Remember, rebate will not come under 112A income. Here 111A she has. Not 112A is not there. So don't worry. If at all 112A tax is there, you will not claim rebate to that extent. Now maximum rebate, optional tax regime 12,500. Yes or no? So balance tax is what? 2,500 plus 4% is equal to fantastic provision 2,600. You see, such a complex problem. Yes or no? By the way, answers right? That you check first. Amma, thank God. 2,600, 23,920. Both are correct. Thank God. Are you clear? All of you? Since I remember entire provisions, I able to recollect everywhere. One provision at chapter 6A, I directly applied. If at all the problem, that number is bigger, no, I would have not discovered the mistake. At the time of tax computation, 350, is special income 326. How come it is? Immediately I found out. Yes or no? Not every time you will be lucky like this to find. Able to understand. Every checkpoint, follow the system. Fantastic problem, no? So many observations are covered everywhere. That's it. Clear, all of you? Yes. We'll take 5 minutes gap and then continue. Now, the first one, you know very well, in income tax, the first question is straight away total income problem, which is 15 marks question. First question is straight away 15 marks total income question, right? In income tax. Now, how to solve the total income problem? What are various checkpoints in total income? What are various checkpoints? Now look at. First thing that you need to identify, whether the SSE is an individual, and if so, what is the residential status? 99.99% for us, individual related total income problem only will be there. Very rare partnership from total income problem can be given. Mostly the first problem will be individuals related, that too resident individuals related. We don't have non-resident taxation in CA inter level, so non-resident based complete total income problem they will not ask. Second one, the second thing immediately you need to identify is what is the regime. What is the regime? Is it default tax regime or optional tax regime? Here, in the question they will use something confusing word. SSE exercised option of shifting out. SSE exercised option of shifting out. Exercised option of shifting out means what? Shifting out of default tax, nothing but optional tax regime. Another words will be there. SSE not exercised option of shifting out. Not exercised option of shifting out means what? He is going with the default tax regime. Or sometimes how it's straight away simply they can give, SSE wanted to go with the default tax regime 115, BAC. Sometimes they will give SSE do not want to proceed with 115 BAC. Okay, SSE want to declare income, SSE want to pay tax under optional tax regime. Like that they will clearly tell sometimes. But sometimes if they have to make it little confusing, exercised the option of shifting out, not exercised the option of shifting out, like that they will use confusing wording. So be clear. Identify the regime. The moment you identify the regime, all dissolvents, everything that you should keep, you should get in mind. Okay, don't worry, what are all the consequences of default tax regime we will be discussing. Then identify the major head, because the first question 15 marks question, no, the entire question will be predominantly based on one major one head of income. Predominantly 99.99% it will be PGBP based. 99, most of the exams I saw in the past 20 attempts, if you see, almost I can say 17 to 18 attempts. Okay, PGBP is the base problem. Total income problem is mostly PGBP based, means predominant major head is PGBP is what they test. And sometimes, rarely, the total income problem 15 marks question will be salary based. But in every exam 6 marks question will be there on salary based. On a salary based question, either 6 marks or 8 marks will be there in every exam. But 15 marks question generally will be from PGBP based. Very extreme rare cases, capital gains may be the major head in that problem. In a 15 marks total income, in extreme rare cases, capital gains base can also be there. Now, within PGBP based, there are two types of models. P&L account they will give you and ask you to compute total income, or sometimes receipts and payments account they will give you. One is P&L account they will give you, or receipts. P&L account is generally given for business SSEs. Suppose if the individual is carrying on business, P&L account will be given and you have to compute total income. First you need to figure out PGBP income, then other heads income, and then gross total income, all that. Don't worry, we will be discussing all those steps. Receipts and payments account sometimes they will give. When receipts and payment account is given, generally receipts and payment account is given for individual engaged in professions. Suppose total income of a doctor, total income you need to compute of a chartered accountant. So generally if professional people are given, receipts and payments account will be given. So PGBP will be the major one. Now when P&L account is given, dissolvences concept will apply, obviously, because add back will be there. First you will start with net profit, then add back. What are all to be added back, all that I will discuss it in the PGBP section. So we have a separate chapter wise discussion in the same full length video. Okay, so in that PGBP related discussion will come. There I will discuss in depth about all the dissolvences. Next, so these are the main important observations initially you should keep in mind. Now first compute major head income, like whatever PGBP head of income, whatever is there, first compute. Like how you should do, what is the presentation format, for example, they give you total income. You need to put heading clearly. Some students know, please, question number 1. Okay, question number 1. Even in the margin also keep heading. Computation of total income of Mr. X for assessment year 25-26. For the September exams, for the September 2025 and even January 2026 also. The assessment year will be 25-26. Previous year will be 24-25. This is the year based upon which the questions will come. Okay. So computation of total income of Mr. X for the year. Now headings: particulars, and amount. Now here, no, based on once you read the question, you know what are the heads of income present. First list out income from salary, income from house property, PGBP income, capital gains, income from other sources. So now you will get here gross total income. Yes or no? From this chapter 6A deductions. Remember, chapter 6A deductions you will get when you are opting for optional tax regime. If it is default tax regime, chapter 6A only 3 sections will come. Don't worry, this is just an introduction I'm giving you. I will go each and every point in depth. Okay, so first I'm telling you the structure to follow. I hope you're able to understand, and I'll be very happy if you like the video and also comment, participate in the live or in the below normal comments. If you comment, it'll be more good for me also, so I'll be able to understand whether you're able to follow me or not. Chapter 6A. Then what you will get is total income. This is the format. Okay, then here you should put computation of tax liability. Okay, fine. Wait, I'll come to it. Now for each head of income, working note 1, working note 2, working note 3, working note 4, like that, for each head of income, maintain a separate working note. This should be the structure of the first page. Total income, first page. You should not write fully everything. So, you know, first, you see, the moment the examiner open your first question answer, okay, brief summary, okay, gross to head wise breakup is there, gross total income is there, chapter 6A is there, total income is there, answer over. Technically, now PGBP, he will go to the next page. Working note is there, na? You would have given working note, right? Then salaries income, then house property income, working note will be there, right? They will go to the working note and then see your answer. Now, computation of tax liability. Generally, 15 marks total income question, no, they will also ask tax liability computation. Tax liability computation will have a weightage of approximately 3 to 4 marks. Many students think it is only 1 mark. No, it will have at least 3 to 4 marks depending upon the complexity involved. For example, special incomes, capital gains, lottery income is also involved. And total income is more than 1 crore or more than 50 lakhs. Suppose if surcharge is there, and special incomes are involved, agriculture income if it is also involved, then tax computation will be having 4 to 5 marks weightage. Depending upon the complexity of the problem, depending upon the composition of the total income, tax liability computation weightage will vary. Are you clear? Now still I'm only at introduction stage. So look at now. So first compute major head of income, then compute income for other heads, then put it in the table which I showed right now. Then clubbing provisions you apply, set off and carry forward provisions you apply. When you are solving income under other heads, especially, yes or no, clubbing provisions also you should keep in mind. Then you will get gross total income. Once you completed gross total income, you will check for chapter 6 deductions, correct? Huh? You will check for chapter 6 deductions. Don't reduce it. Never. In the working note, no, or in your mind, in the gross total income, how much are normal incomes, how much are special incomes identify. Okay, so normal incomes means what? Special incomes means what? 111A, 112A, 112, 115BB, 115BBJ, all this lottery incomes, all these are all special incomes. For example, gross total income is, let us assume 15 lakhs. Okay. Now, special incomes are approximately 12 lakh. Then balancing figure will be 3 lakhs, which is actually called as normal income. And you know what? Chapter 6A deductions you will compute, right? Total of chapter 6A deduction shall not exceed 3 lakh. The total of chapter 6A deduction shall not exceed normal incomes, because special incomes are not eligible for chapter 6A. Long-term capital gain 112A. Normal long-term capital gain 112, short-term capital gain 111A, lottery income, all that, they are not eligible for deductions for chapter 6A. Therefore, even though 15 lakhs gross total income is there, for example, no, hypothetically, chapter 6A total comes 4 lakhs, but you can claim deduction only 3 lakh. Very important. These are all for MCQs, especially at the time of MCQ solving. This is very, very important. Next. Okay, now again, when you are claiming chapter 6A deduction, remember the tax regime here. Why? Because no, chapter 6A deductions, in chapter 6A deductions, optional tax regime, you will get all deductions, whereas under default tax regime, you will get only deductions under 80CCD subsection 2, 80CCH subsection 2, 80JJAA. Only these three deductions you will get. 80CCD subsection 2, CCH subsection 2, JJAA. Only these three deductions you will get under default tax regime. You will not get these, only these three you will get. Remaining all other deductions under chapter 6A, you cannot claim in case of default tax regime. Suppose you are going with optional tax regime. Every chapter 6A deduction, 10AA exemption, 80C deduction, 80U deduction, everything, 80D, 80DD, 80DDB, 80JJAA, 80QQB, RRB, everything you can claim. I hope you are clear. Next. Now, then once you keep all these points in your mind, finally you will get total income. Like gross total income you computed, then reduce chapter 6 deductions where the total deduction value shall be less than or equal to normal incomes. Okay, if the paper has to be tough, they will test all these adjustments. You have to be very, very careful. I know you know all these points, but the point is, when you're writing an exam, if you don't have an approach like this, when you do not have any proper approach, mostly what I see in many students is they learn concepts by solving more problems. No, of course that is a way concept will be built up, but only when they see a problem which they already solved, only that they will be able to solve. If a new question comes altogether, many of them not able to solve, only because they don't have this kind of clarity. I hope now you are getting a lot of clarity. Yes or no? Then you will get total income. Fine. So total income is over. Okay, now see here, each head wise what are all the provisions were there, we need to discuss that. We will discuss little while later. Now once you completed total income, the second part of the answer, 15 marks question, is computation of tax liability. You know what, I will tell you guys, straight away follow this format. Here there is a format which I gave, right? I developed this format, tax computation format. Straight away follow this format. Don't deviate from this format. First, what you should compute when you're computing tax? Basic tax. First, what you should compute is basic tax. Again, when you're computing basic tax, what are the checkpoints? When you're computing basic tax, what are the checkpoints? First, identify the tax regime. Once again, the moment you start computing tax, look at the tax regime. If it is optional tax regime, up to 3 lakhs exemption, 3 to 7, 2.5 lakh up to 2.5 lakh, 2.5 to 5, 5 to 10, beyond 10, right? Yes or no? If it is optional tax regime, residents, they will be classified into 3 categories: normal citizen, senior citizen, super senior citizen. Whereas non-residents, only 2.5 lakh basic exemption. Optional tax regime I'm talking about. That to tell me, tax rates will be varying based on the regime. Which incomes? Normal incomes. Normal incomes only the tax rate will be different. Okay, like normal incomes, the tax rate will be, for normal incomes only the tax rate will be different. Under default tax regime and optional tax regime, the tax rates are different with respect to what? Only normal incomes. Special incomes are there, right? Long-term capital gain, 112, 112A, short-term capital gain, 111A, lottery income, all that, 115BB, all that. No. For them, the tax rate is same. Whether it is optional tax regime or default tax regime, doesn't matter. The tax rate is same. So, first identify the regime. Then, second thing you should check is, see whether agriculture income is there. I know it is exempted. In the given problem, agriculture income might be there. It might have been credited to P&L account. Agriculture income might have been credited to P&L account. When you are computing PGBP income, what you should do, net profit you will start, right? In this net profit, agriculture income is already credited in P&L. That is considered in this net profit. But actually, is it taxable? No. So to arrive PGBP income, what should I do with that agriculture? You will reduce it because it is not taxable. So you computed PGBP income, substituted that income in the total income, computation, all that is fine. But when you are computing tax liability, if agriculture income is there, aggregation concept will apply. Basic tax cannot be computed straight away. You can't simply compute basic tax. Agriculture income also should be considered when you have agriculture income. Like what is the, we call it as aggregation concept, right? What do we call it as? Aggregation concept. You see, I'm giving you here. There is a concept of aggregation. Tax calculation steps. What are the tax calculation steps if agriculture income is there? First, compute basic tax on total income, including net agriculture income. What do you mean by net agriculture income? For example, no, SSC is no, he's growing mulberry leaves and then selling it. Mulberry leaves. Mulberry leaves is an agriculture produce. You know, he got totally 10 lakhs proceeds. But to grow this mulberry leaves, he spent 5 lakhs. Now, what is the net agriculture income? 5 lakhs. Only 5 lakhs will be added to. Originally, you computed total income, no, taxable income, total income. To that total income, add this 5 lakhs. Now you will get a revised total income. On that you compute basic tax. Okay, for example, no, my total income is 15 lakhs. Now agriculture income is 5 lakhs. My total income is 20 lakhs now. This 20 lakhs now again split into two parts. How much are special incomes? How much are normal incomes? Special incomes 12 lakhs, sir. Normal income is balancing figure, which is 8 lakhs, sir. On special incomes, no, long-term capital gain 112. Apply depending upon the date of capital gain. If the capital gain is before 23rd July, 20%. If the capital gain is on or after 23rd July, 12.5%. Okay, now so like that, apply special rates. Okay, whereas normal income law, apply, identify the regime, default tax or optional tax, where you are computing, identify the regime. Accordingly, apply the tax rates, 0 to up to 2.5, 2.5 to 5, 5 to 10, beyond 10 if it is optional tax regime. In case of senior citizen, 3 lakhs. In case of super senior citizen, exemption is up to 5 lakh. Yes or no? Whereas default tax regime, irrespective of senior citizen, residential status, that and all doesn't matter. In an optional tax regime, 115 BAC is applicable for individuals whether they are resident or non-resident, doesn't matter. And the tax rates are constant up to 3 lakhs, 0, 3 to 7, 5%. Yes or no? 7 to 10, 10%, 10 to 12, 15%, 12 to 15, 20%, beyond 15 lakh, straight away 30%. There is no 25% slab rate, correct? There is no 25% slab rate in case of optional tax regime. You know, May 26 exam, May 26 I'm talking about, Finance Act 2025, 25% slab rate also has been brought. Fine, anyhow, for Jan 26 attempt, September 25 attempt, okay, this particular slab rate do not apply, don't worry. So, under default tax regime, these are the tax rates. I'm just showing you once again. Up to 3 lakhs, 0, 3 to 7, 5, 7 to 10, 10. Up to 12, 10 to 12, 15%, 12 to 15, 20%, and straight away after 15 it is 30%. Remember, these are applicable on normal incomes only, not on special incomes. Now, I told all the checkpoints here, yes or no? Now, look at the checkpoints once again. So, check the tax regime. You know, check for age, residential status in case of optional tax regime. Suppose if at all you are computing as per optional tax regime, if at all you are computing income as per optional tax regime, check for the age of the SSC and what is the residential status. Suppose if it's default tax regime, straight away calculate. So agriculture income point I considered and regime I considered. Now I will compute basic tax at first. First I will compute basic tax. When I am computing basic tax now, while calculating basic tax now, I will apply normal tax rates on normal incomes. Special incomes, I will apply special rates. And again, no, one more important point. For resident individuals, whether unexhausted basic exemption limit is applicable, check out. Sometimes what happens, you know, for example, suppose no, I am following default tax regime. Suppose in the exam, they gave a question of default tax regime. Total income is, for example, 15 lakh. Total income is how much more? 15 lakh. Now, within this 15 lakh, no, 3 lakhs is only, or else let us assume 2 lakhs is only normal incomes, 13 lakhs are special incomes. Now, normal income is 2 lakhs, right? Applicable basic exemption limit is 3 lakhs. Under default tax regime, basic exemption limit is applicable how much? 3 lakh. Now, 1 lakh basic exemption limit is free. No, that can be set off against. So, that 1 lakh is first called as unutilized basic exemption limit. This unutilized basic exemption limit can be set off against long-term capital gain 112 or 112A or short-term capital gain under 111A. So, to any of this you can set off this 1 lakh. You know what how I will set off, you know, for example, no, you know, here is where for September 25 and Jan 26 only the complication is there. May 25 attempt, September 25 attempt, Jan 26 attempt. For these 3 attempts, no, previous year is 24-25, assessment year is 24-26, especially if capital gains is there, date on which transfer happened is important to decide the tax rate. Suppose no, within this year, if at all transfer happened before 23rd July and transfer happened after 23rd July, long term capital gain 112, you know, if it is before 23rd July 20%, 112 ma, not 112A. If it is after 23rd July, then long term capital gain is 12.5. Same way, 112A before 23rd July, the tax rate is 10%. Okay, after 23rd July, the tax rate is 12.5%. Now 112A tax rate is there, right? 112A tax rate 10% if the capital gain is before 23rd July, if the shares are sold before 23rd July, if the shares are sold on or after 23rd July, if at all you are selling the shares, then tax rate is 12.5%. Here, most important point, you know, right? Before 23rd July, the tax rate is 10%. On or after 23rd July, the tax rate is 12.5%. And you know very well that 1.25 lakh exemption is there. Suppose, by the way, remember 1.25 lakh, like 10% beyond 1.25 lakh, 12.5% beyond 1.25 lakh. This is what the provision, correct? Like, is it separate 1.25 lakh before 23rd July, separate 1.25 lakh after 23rd July? No, it's a combined limit in the entire year. Suppose, no, 112A capital gain SSE got before 23rd July, before, I mean, okay, before 23rd July, SSE got, for example, 3 lakh, and after 23rd July, SSE got 2 lakhs. So total 112A capital gain is how much? 5 lakh. And we know very well, this is taxable at 10%, this is taxable at 12.5%. Now we know very well, total is 5 lakh, maximum exemption available is 1.25 lakh only. Throughout the year put together is 1.25 lakh only. Again here, this 1.25 lakh, no, where I should set off? Should I set off against, 10% income or 12.5% income? There is no provision in the law. They only say up to 1.25 lakh long-term capital gain under 112A is not taxable. They say there is no tax on that. Remember, they are not saying it is exempted. Don't confuse with exempted income concept. Under 112A, whatever long-term capital gain is there, up to 1.25 lakh basic exemption tax is 0. Beyond 1.25 lakh 10% or 12.5, whichever is applicable depending upon the date of transfer. That doesn't mean 1.25 lakh is exempted income. Be careful, it is not exempted, it is taxable. That entire long-term capital gain 112A will form part of gross total income, will form part of total income only at the time of tax computation. First 1.25 lakh I will not consider any tax. First 1.25 lakh I will not consider any tax amount. Beyond 1.25 lakh only I will consider. Now this 1.25 lakh I can set off either against 12.5% rate or 10. That is your choice. But I recommend, because tax rate is 12.5, 2.5% extra na. So I will set off here 1.25 lakh. 1.25 I will set off. So balance amount is what? 75,000. Balance amount is 75, which is taxable at 12.5. This 3 lakhs I will tax at 10%, which is equal to 30,000. That's it. I hope I have given you clear explanation on 112A 1.25 lakh limit. Next, still once again, when we open basic concept chapter, when I'm revising there, I will connect all these dots. Okay. This 15 marks total income computation is the deciding one for income tax, especially whether you will be scoring or not. This 15 marks question will decide. If at all you understand until now, whatever I've covered until now, I'm telling you, trust me, you will really rock the paper. No matter how tough the paper, easy or tough. I personally do not discriminate whether paper is tough or easier. I only know, do I know the question or not? Do I know the answer or not? That's it. If you don't know the answer, many questions, if you don't know the answer, you call it as tough. If many questions you know the answer, you call it as easy. Means here, it's not the paper which is tough or easy. It's whether you know it or not decides tough or easy. That's it. Now, again, so when you're computing basic tax, unexhausted basic exemption limit point I told, 112A 1.25 lakh point also I told. Now, next one, check for long-term capital gain. See, in the question, in the given question, total income question, or maybe a separate capital gain question, or maybe MCQ question. Suppose there is a long-term capital gain. For example, there is a long-term capital gain on what? On residential immovable property. Residential immovable property is there, which is sold by individual or HUF. Who sold it? Individual or HUF sold it. Residential immovable property. But when that was acquired, it is acquired before 23rd July. It is acquired before 23rd July. The house, these people acquired long back. And the house is sold on or after 23rd July. For these people, in previous year 24-25, any long-term capital gain, no indexation at all. I hope you are aware of indexation point. I hope you are aware of indexation point, right? Long term, if a capital asset is a long term asset, indexation facilities available, non-depreciable assets I'm talking about. Section 48 computation format of capital gains. As per section 48 computation format of capital gains, long term assets are eligible for indexation. But if at all you are selling during the year, that too you are selling when after 23rd July, no indexation at all, no indexation. See, if at all you are selling on or after 1st April, but before 23rd July, as usual, full value of consideration minus transfer expenses, then you will get net consideration minus indexed cost of acquisition, indexed cost of input, happily you can take. But if the transfer date is after 23rd July, that too what you transferred is immovable property. When you are computing capital gain, no indexation. But when you are computing tax liability, and property was purchased before 23rd July and sold after 23rd July 2024, and it's a long-term asset, indexation we did not claim. At the time of computation of capital gains, we did not claim indexation. But at the time of tax computation, you once again compute long-term capital gain. Rough notes in tax computation, once again you compute, at the time of tax computation, once again you compute long-term capital gain with indexation after exemption, then balance amount applied tax rate. Okay, 20% with indexation tax rate, 12.5% without indexation. Yeah, I will try to solve a problem also if possible. Don't worry. Okay, I will solve it. So don't worry. So 12.5% without indexation, 20% with indexation. Try to apply that. Okay. Now then you will get some tax, lower tax, 20% tax rate, and what is the tax liability? 12.5% without indexation on that. How much is the tax? Between these two, whichever tax is low, that tax you will take into basic tax. This is one more major checkpoint when you are computing basic tax, because this is important for MCQ. In the recent exam, May 25 exam or May 25 exam, this question was asked. In the May 25 MCQ exam, this question was asked. Long-term capital gain on residential immovable property beneficial scheme they asked. And remember, for 112A capital gain, no rebate at all. For 112A capital gain, no rebate at all. Then follow the steps as per above tax computation format to arrive gross tax limit. Now, until now, what we computed, only basic tax. Only basic tax we computed. So once you compute basic tax, put number here, basic tax. Then add surcharge. Surcharge at what rate? I'll show you. Don't worry. Surcharge at what rate? It depends upon the regime again. Surcharge is influenced by regime. By the way, before I go into surcharge, let us look at the rates, tax rates. Special income 112, long-term capital gain. What is the tax rate? If at all the capital asset is transferred before 23rd July, straight away you will get 20% is the tax rate for long-term capital gain, where indexation, if applicable, you can claim indexation benefit. You can claim indexation benefit while computing capital gains. Suppose if the transfer is on or after, 23rd July, that to what you transferred, land, building, or both. Who transferred? Resident, individual, or HUF transferred, which is acquired by them long back. Sold on or after 23rd July, but acquired by them long back. Then tax rate, I'm talking about tax liability. I'm not talking about capital gain computation. Capital gain computation is always, see, transfer date after 23rd July. Yeah. Transfer date on or after 23rd July. Yeah. No indexation at all. It's a long term or short term, doesn't matter. No indexation at all. Now, lower of 20% tax rate with indexation, 12.5% tax rate with indexation. So compute wherever the basic tax is low, that tax will be final, added to the remaining basic tax, and then rest of the format will apply. Okay. Then this is regarding unlisted shares by non-resident. That is not relevant for you. 112A. Suppose you are having long-term capital gain on equity shares, equity-oriented funds, or business trust. Okay, long-term capital gain. I already told 112A, STT is paid. If the transfer is before 23rd July, straight away the tax rate is 10%. If the transfer is on or after 23rd July, the tax rate is 12.5%. In both the cases, no, up to 1.25 lakh, no tax. And this 1.25 lakh is full year limit. In entire year, up to 1.25 lakh only, no tax. Okay. And that too, beneficial treatment. Which 1.25 lakh I can claim exemption, sir? Whether I can claim exemption where 10% income or 12.5%. You can claim exemption on 12.5% portion. Then short-term capital gain 111A, same equity shares, equity oriented fund, business trust where STT is paid. If the transfer is before 23rd July, earlier it was a lower tax rate, 15% only, but now the tax rate is higher. If the transfer is on or after 23rd July 2024, the tax rate is 20%. Remember, for September 25, Jan 26, and even already we completed May 25 attempt. Okay, in all these three cases, the previous year will be 24-25, assessment year will be 25-26. Previous year 24-25 means what? The problems will be based on information given from 1st April 2024 to 31st March 2025. That's it. And 115BB winnings, flat 30% tax rate. 115BBJ online winnings, net winning is straight away taxable at 30%. And unexplained income, black money discovered, 60% tax rate. That too for black money, no, when you're taxing it, separate surcharge rate of 25% is applicable. Separate surcharge rate. So effectively the black money is taxed at 78%. That's it. Now surcharge, like as I already told, no, once you arrive basic tax, then you need to add what? Surcharge. When you're again adding surcharge, no, identify is it default tax regime or optional tax regime. Identify once again in the given question, default or optional, identify. Now when you're adding surcharge, no, see what is the total income, including everything, including every income. If the total income is just between 50 lakh to 1 crore, if it is between 50 lakh to 1 crore, 50 lakh crossed, less than or equal to 1 crore, surcharge rate is 10%, whether default tax or optional tax doesn't matter. Surcharge rate is how much? 10%. Suppose if the total income is between 1 to 2 crore, total income is between 1 to 2, including everything, then the tax rate is 15, surcharge rate is 15. Sometimes no, suppose no, total income you computed, no, it is more than 2 crore, then automatically these two options closed. Immediately you will come to third option, fourth option, fifth option. Now total income you have, no, from that, no, remove dividend, remove capital gains. Okay, 111A, 112, 112A. Some students, no, here they accidentally removing lottery income, all that. No need. Only dividend, capital gains under 111A, 112, 112A. Only capital gains income, dividend income. Only this. Exclude that. Now how much is the total income? If the total income is more than 2 crore but not exceeding 5 crore, if the total income is more than 2 but not exceeding 5, then 25%. Sir, total income is crossing 5 crores, sir, but under default tax regime, the maximum surcharge rate is 25. But if it is optional tax regime and total income is more than 5 crore, 37% surcharge. 37% the surcharges. And sometimes, no, total income is more than 2 crore. But if I exclude a dividend, no, total income, including dividend, everything is more than 2 crore. Okay, since it is more than including dividend, everything more than 2 crore, that is not coming here. Okay, I will exclude dividend and capital gains. Again, it is not coming under 3 and 4. My situation is total income including dividend, including capital gains will not come under, is not coming under 1, 2, 3, 4. Then fifth provision will apply. As per the fifth provision, the surcharge rate is 15. Remember, most important, rate of surcharge shall not exceed 15% in respect of tax on dividend, tax on capital gains. When you compute tax on capital gains, no, on that the surcharge rate can be maximum 15%. Further, all other incomes, normal incomes, everything, on that you will have computed some basic tax, no? It may be lottery income, it may be other casual income, they are all taxed by 10, 15, 25, 37 as the case may be. Simply, the surcharge rate on dividend and capital gains cannot exceed 15%. So like how you should compute this, very simple. For example, my SSC total income is, let us assume 3 crore. SSC total income is, let us assume 3 crore. Look at carefully how I'm solving this. Okay. Now in this, no, dividend income is, let us assume 20 lakh. Long-term capital gain 112 is, let us assume 20 lakh. Long-term capital gain 112A is, let us assume, let me write more clear, 20 lakh, 3 lakh. This is, let us assume, okay, fine, 10 lakh. And short-term capital gain 111A, short-term capital gain 111A, that is also, let us assume 10 lakh. And there is some special income, lottery income is also there. Lottery income is also there, which is 10 lakh. Then what is the balancing figure? What is the balancing figure? So just identify this. What is the balancing figure here? So 10, 30, 50, 50 plus 10, 60, 70. Out of 3 crore, 70 lakhs or special incomes remove, then balancing figure is 2 crore 30 lakh. Yes or no? 2.3 crore. Now here, lottery plus these two has to be considered, which is 2.4 crore. Total income excluding dividend, excluding quantum, all this is 2.4, which is more than 2 but not exceeding 5. So then automatically on this first you compute basic tax. How you should compute basic tax? On 2.3 crore, no. On 2.3 crore, no. At slab rates you compute basic tax. On 10 lakh, no. 30% you compute basic tax. Okay, you will get basic tax. On this you will have surcharge at 25% or 37% as the case may be. Since it is more than 2 but not exceeding 5, surcharge rate is right away. Surcharge rate is right away, 25%. Now, when you're computing, suppose here dividend is there, long-term capital gain, short-term capital gain, everything is there. Now dividend is also normal income only. Now when you're computing first normal basic tax, you already computed basic tax, no? So in that, how much is dividend related tax? How to compute the dividend related tax, So here dividend is 20 lakh divided by total normal income. Total normal income is 2.5 crore. Total normal income is 2.5 crore. And normal incomes total on 2.5 crore normal income. How much is the normal rates of tax? Apply. So you got some tax amount. Dividend income is this much. This is the total tax on total normal income. You will get dividend related tax portion. Why you need to compute dividend related tax portion? Because here 15% only surcharge will apply. Whereas here, by the way, this related logic I think I already covered in my marathon. The original marathon is there, right? My 12 to 15 hours marathon is there, right? There I already covered. That's it. Yeah, I'm speeding up, I'm speeding up. Okay, that's it. Some students are feeling that September 25 law paper was very tough. What if I lose? Generally, when the paper is extreme tough, paper valuation will be little liberal. So even if you think you won't get 40, sometimes you may see in the paper, in the question paper, 50 plus marks you will see in the result card. So don't lose hope. Be serious on tax. Trust me. Okay, if at all you have given at least 60 to 70 marks, if at all you at least attempted 60 to 70 marks, and the paper is extreme tough, there are high chances you will score 45 plus 50 plus for sure. Don't worry at all. Okay, fine. Next, so that's about surcharge. Once you computed surcharge, then what you will get is this subtotal. From this, rebate is applicable. When rebate is applicable, we already know. When total income is not exceeding 5 lakh, rebate is applicable. If it is optional tax regime. If it is default tax regime, when total income does not exceed 7 lakhs, then also rebate is applicable. Now I'm not going into rebate calculation, all that. I hope you already know it. If at all you want to know rebate calculation, how it works, all that, please go to my main marathon. There I have already clearly explained. So then rebate, then marginal relief. Marginal relief, how to compute marginal relief? My main marathon is that there you can listen to it. So marginal relief also you compute. Then what you will get is called as subtotal. For that, add 4% education says what you will get is called as gross tax liability. What is this called as? Gross tax liability. Once you computed gross tax liability, be careful. The gross tax liability you computed, right? Answer is not over yet. Most important, the AMT applicability. If at all optional tax regime is there, AMT is applicable. That too, when AMT is applicable? If the SSE has claimed 35 AD exemption, deduction, 10 AA deduction, 80 QQB, RRB, JJAA. Yes or no? The SSE who claimed 10 AA, 35 AD, 80 QQB, RRB, JJAA. If these deductions are claimed by the SSE, then AMT provisions are applicable. Be careful. That too, if at all you are computing income under optional tax regime. Suppose if the total income problem is straight away default tax regime, then AMT question itself will not come. Suppose if the problem is optional tax regime, then AMT question will come. Sometimes, if the paper has to be very tough, examiner want to make very tough paper, they will ask you to compute income as per both the regimes. Wow, that will be even more tough. Both the regimes they will ask. When both the regimes are tested, first you compute gross total income as per DTR. Then do little adjustments to arrive OTR income. Then compute again tax. When you are computing tax under optional tax regime, compute as per whatever we discussed. Plus see AMT applicability. In the question, 35 AD deduction is there. 10 AA deduction is there. 80 QQB, RRB, JJAA deduction is there. Add back all these deductions to the total income. Under optional tax regime, you compute total income, right? Add back all these deductions. Minus notional depreciation. What is it? Notional depreciation. Because 35 AD deduction you don't get, right? Yes or no? When you're claiming, in AMT, 35 AD deduction we will not consider. So on the capital expenditure, 35 AD deduction we are adding back. So we are not claiming any 3580 deduction on a capital expenditure. On that, when you're not claiming 3580 deduction, you can automatically claim depreciation. So notional depreciation, reduce it. Then what you will get is called as adjusted total income. And if that adjusted total income is not exceeding 20 lakh, if that adjusted total income is not exceeding 20 lakh, AMT provisions will not apply. If the adjusted total income is crossing 20 lakh, if the adjusted total income is crossing 20 lakh, then AMT tax will attract. Then accordingly, don't worry, AMT related provision also I have clearly given, very easily I have given. Look at this, okay? I'm about to finish this total income topic. I'm about to finish this, and immediately after that I'll go to salaries chapter discussion. No, residential status chapter discussion I'll do, or salaries chapter discussion I'll do, okay? Now look at, if a person is claiming deduction under 80 JJAA QQB RRB income based deductions or 10AA 35AD, then automatically AMT will apply. Again, AMT tax you don't have to compute if the SSC adjusted total income does not exceed 20 lakh. What is adjusted total income? First identify tax as per normal regular provisions. Add back deductions under 10AA, add back deductions under 35AD, less depreciation under less depreciation in respect of the capital expenditure, whatever 35 deduction you claim, no deduction you're adding back, no. So on that notional depreciation you reduce, then add deductions claimed under 80 JJAA QQB RRB, then what you get is adjusted. If this particular income is not exceeding 20 lakh, no AMT. Suppose if it is exceeding 20 lakh, straight away the tax rate is 18.5%. straight away. Sir, this income has special incomes like lottery, everything is also there, sir, because no normal incomes, no, that include lottery. So automatically 80 also include lottery, long-term capital gain, short-term capital gain. For AMT provision, what income is there doesn't matter. On entire income, 18.5% tax rate apply. That's why I gave you special incomes, if any, ignore. In the sense, no, ignore the logic of special rates of tax. Special rates of tax, ignore. So and on adjusted total income, straight away 18.5%. So 18.5% plus surcharge. Surcharge at what rate? If adjusted total income is more than 50 lakh, then surcharge rate is 10%. If the adjusted total income is more than 1 crore, then surcharge rate is 15%. If adjusted total income is more than 2 crore, then surcharge rate is 25%. Straight away. You clear? Next. That's it. So that is regarding AMT. AMT credit, all that I'm not discussing here. If you want to have an idea on AMT credit, all that, in the description I gave a Google Drive link. No, inside that, what are the resources to be followed. By to that extent, this particular video is there as part of a playlist. Go to my YouTube channel, see Ram Harsha. Day before exam taxation playlist is a September 25. Inside that, my marathons are already there. Inside that, part 2 marathon is the TDS, TCS, AMT. So inside that, you go and see AMT related detailed discussion I gave. That's it. Okay, so now such a complicated, no? So then AMT check. You should do AMT check if it is optional tax regime. Okay, most important, check once again AMT applicability, compute AMT on adjusted total income 18.5%. If AMT is higher than regular gross tax liability, then gross tax liability will be nothing but AMT liability. Whatever AMT that you are paying beyond regular tax, no, that is called as AMT credit, which will be carried forwarded for 15 years. Now finally arrive the tax payable amount. How to arrive tax payable amount? Right now you decided gross tax liability. Suppose if AMT liability is less than regular tax, then regular tax is gross tax. If AMT liability is more than regular tax, then AMT will be the gross tax. From this, no, reduce TDS, TCS, advance tax, everything, then you will get tax payable amount. That's it. This entire total income, what are the points, what are the checkpoints that are involved, everything I have covered. Now each head of income we need to discuss. Okay, now before I proceed with heads of income, in the basic concepts I want to discuss certain concepts. For example, I want to discuss about agriculture income concept. Every attempt agriculture income, some question they're asking. Every attempt they're asking. I have seen in September 24, Jan 25, May 25, agriculture income question